higher on Wednesday, 445 points higher on Thursday, and then a 200-point decline that we saw on Friday itself. But between December 31st low and Jan 2nd high, we actually saw a rally of over 750 points. So just trying to understand what exactly took place out there. The rally, of course, was led by strong auto sales and FII short covering on Thursday, which was the weekly options expiry day. But then came the draggers on Friday, which was HDFC Bank and the IT stocks. And both of them in focus. IT stocks ahead of big earnings right now, and HDFC Bank ahead of their Q3 update that Abhishek just spoke about. The other couple of factors that are playing out, the FIIs, they sold on Wednesday, bought on Thursday, sold again on Friday, 4,200 odd crores. And even in index futures, the short covering was not long lasting apart from Thursday, because on Friday they sold about 2,000 odd crores and added 23,000 shorts back again. So if you look at the FII exposure in index futures, which started with a negative 2.34 lakh on Jan 1, is now back to negative 2.3 lakh itself, and long exposure from 14% moved to 20% and now back to 17% itself. What does all of this mean? It means that the Nifty may trade in a range, but if it were to break out of that range, the street is positioned for that as well. 24,100 call is fairly active for a premium of 112 rupees, and 24,000 put also active for a premium of 150 rupees. That tells you that the range could be 23,800 to 24,200. But if we were to break out or break down of that range, there has been positions taken at the 24,500 call and the 23,600 put as well. So those are a couple of levels we'll keep an eye out on. From a technical standpoint, definitely watching out for the 200-day moving average as the first support, 23,900 that is. And on the way up, the Nifty does congest around that 24,150 mark, largely because of the 20-day moving average and the 50-day moving average. Were we to cross that, maybe a dash towards that 24,500 mark.
Oh, we'll anticipate that for sure. Mangalam, thanks a lot for that. Time for a short break. More lined up on the other side. Stay tuned.
Place name on the list is also from the south. That's Tamil Nadu's M.K. Stalin with 47 criminal cases against him. This, remember, is as per the studies conducted by both ADR and NEW. When it comes to liabilities, the south again isn't too far off as far as the upper levels of this list is concerned. While the total number of liabilities, or the largest liabilities per chief minister, belongs to Arunachal's Khandu at about 180 crore rupees, both Siddaramaiah and Chandrababu Naidu continue to figure on the top of this list. In fact, Siddaramaiah accounts for 23 crore rupees worth of liabilities, while Chandrababu Naidu's liabilities come in at about 10 crore rupees.
Countdown for the Mahakumbh Mela 2025 has begun. It is just a few days away. Devotees see this as a once-in-a-lifetime chance to bathe in the holy waters of what is called the Triveni Sangam, where the rivers Ganga, Yamuna and the Saraswati meet. The holy event starts from the 13th of January and will last till the 26th of February. About 450 million people from India and abroad are expected to flock to Prayagraj, which is the spiritual heart of India. This isn't just any regular event. The Mahakumbh only happens once every 144 years. It is the culmination of 12 Purna Kumbhs that happen every 12 years. The Ardha Kumbh happens every 6 years. The Purna Kumbh is organized in 4 holy places: Prayagraj, Haridwar, Ujjain and Nashik. As demand for travel is expected to go up, airlines are going all out to launch flights to Prayagraj from different destinations in the country. The airport authority says there are 20 new flight connections exclusively for Prayagraj for the Mahakumbh. Indigo has launched flights from Ahmedabad, Kolkata and Bengaluru, while SpiceJet is connecting Delhi, Mumbai, Bengaluru and Ahmedabad. Limited flights means devotees will have to...
Welcome back. Now, post the release of the new draft data protection rules, IT Minister Ashwini Vaishnav spoke to CNBC-TV18 on how the rules attempt to strike a balance between industry and user rights. Now, he began by answering why the draft rules were delayed for 16 months and what stands ahead.
When this law was presented to the Parliament in November 2023, we had very clearly promised that it will be digital implementation. Sure. It will be completely digital by design. So in the last 1 year or so, despite the elections being there, general elections being there, we have worked very meticulously to create a completely digital portal, digital workflow, digital processes, so that when we finally start implementing this law, the entire data protection board will be fully digital by design first. Second, as you are aware, this is a very pragmatic approach towards data protection, and we have made sure that the balance between innovation and regulation, we have a huge innovation economy, right? Huge, large innovation startup ecosystem.
Right.
And we have to make sure that citizens' rights are protected with full fervor, full confidence. So that's why we have created this structure where the innovation and regulation is properly balanced.
So let's take this next logical question in terms of what does this do as far as obligations of data fiduciaries or companies collecting data is concerned? What does it mean for them? What are the obligations they're now looking at?
The obligations on the data fiduciaries are very well established as per the principles set out in the Honorable Supreme Court's judgment regarding consent, regarding purpose. All those obligations are properly set in the law, and the rules basically implement those.
Sure.
Like the law, the rules are also very simple in language, very clear examples, illustrations are given everywhere. We have made sure that, as I said, in a very pragmatic way, we have made sure that we have not made everything very prescriptive. We have kept, because digital technology doesn't stand, right? It evolves every week. Every week there is a new thing which happens. So the law should be able to catch up with those developments.
That was the IT Minister, Ashwini Vaishnav. Time for a short break. More on the cues from the commodities side. Next up, stay tuned.
Fares. For instance, a one-way ticket from Mumbai to Prayagraj on the 12th of January is nearly 30,000 rupees. Then Bengaluru to Prayagraj on the 11th of January will cost over 22,000 rupees. The Prayagraj airport is also stepping up its game. The existing terminal is being revamped and a new terminal is being developed to together handle about 2,700 passengers at peak hours. Staying in hotels will also be an expensive affair, with room rates per night soaring to as high as 40,000 rupees. The state is spending a whopping 5,496 crores for this event, a lot more than what it spent in 2019. The government has allocated 4,000 hectares of land for the Mahakumbh 2025, which is double than over 1,900 hectares of land allocated in the Purna Kumbh of 2013. Over 1,50,000 tents and 25,000 accommodations are being set up for the sea of visitors from India and abroad. And for the first time ever, the entire tent city will be mapped on Google Maps, making it very easy for tourists and devotees to navigate in the Mahakumbh Mela. The Mahakumbh is a big deal for the hospitality and other commercial sectors. The state is expecting a revenue of 25,000 crores, bringing a wave of opportunity to the region.
Well, if you look at the statements by Elon Musk and by Mr. Rabasani, who, as you know, was a president.
Welcome back, and Manisha Gupta now joins in with all the updates from the commodity space. Manisha, good morning. But the crude prices, though slowly but surely, are grinding higher.
Oh, well, absolutely. If you look at the previous week, we've seen the crude oil prices gain up between 3 to 4%, and that's the first week of 2025. The prices currently at 76 plus kind of levels are trading at a 2-month highs. Well, there are three factors which are supportive. One, it's cold weather in US and Europe, and the markets are looking at increased demand. Second is the expectation that you will see strong China economic stimulus measures coming in. Third, the markets really are waiting with abated breath for 20th of January on what really will conspire as Trump takes office there. And then the markets also are looking at geopolitical tensions with Russia halting gas pipeline exports through Ukraine. The markets also are reacting to the Chinese PMI data slightly on the weaker side, and that perhaps is weighing on. But even with the dollar index trading at a 2-year highs, you still are looking at the crude oil prices trading firm. That's exactly the scenario that you've seen within copper in the metal as a sector. While all of the base metal prices have started Asia slightly on a weaker note, copper prices, after that 10% decline in the last quarter of 2024, have started 2025 on a positive note. So we are up by 1% in this year already now, and some more buying is what I can see in Asia.
Manisha, thanks a lot for that update. Now, today also marks the record date for the ITC Hotels demerger. The restructuring will see ITC retain a 40% stake in the hotels business, while the remaining 60% will be held by shareholders. Manglam is back with us for more on this. Manglam.
Good morning. So, if you look at ITC, July 2023 was when this structure was announced. So, to jog your memory, the structure meant that ITC would have 40% stake directly, 60% would be given to shareholders in the alternate structure. And importantly, this entitlement ratio is 1 ITC hotel share for every 10 ITC shares that you own. How big is ITC Hotels as a percentage of ITC's overall business? They contribute about 4% of revenue, close to 2.5% of operating profit, but more importantly, 14% of total assets. What this basically means is that the demerger is ROCE accretive for ITC's current business, and for the hotel business, which is resultant, let's talk about that as well. They have currently about close to 140 hotels with 13,000 keys. 55% of their business is managed hotels, and FY24 occupancy was close to around 69% as well. And the 2030 stated target that they have is close to 200 plus hotels with 18,000 keys and 65% salience coming in from managed portfolio. If you look at the financials for the last financial year, the revenues were close to 3,000 crores, 1,000 crore EBIT, and they do have 33% of EBITDA margins as well. For the first half of this year itself, the revenue has been close to around 1,500 crores with 28% margins. Nearly 40% of their revenue comes in from F&B, 50% comes in from room itself. If you look at the opportunity that they have, it's a zero debt company, 1,500 crore cash. 20% of its inventory is operating at 75% of potential occupancy, and the capex is estimated at around 8 to 10% of their revenue. The big question, how do you value this company? Let's look at the assumptions. We're assuming close to 3,700 crore on the top line this financial year, 4,400 crore next year with 1,450 crore at EBITDA. And if you look at the listed hotel companies, they're trading anywhere between 17 to 37 times. My sense is that ITC would settle between Indian Hotels and Chalet Hotels, somewhere between 26 to 28 times. That values the company between 36,000 to 39,000 crore. But remember, 40% of this is held by ITC, on which there would be a holding company discount. The residual stake would be valued at around 22,000 rupees. So the value of ITC Hotels share would be 170 to 190 rupees the day it lists. But today what happens of ITC, around 15 to 20 rupees gets shaved off as the business goes ex-hotel demerger.
Indeed, Manglam, thanks a lot for that explainer on ITC and its demerger of the hotels business. But with that, it's a wrap on this edition of Power Breakfast. From me and the team that put this show together, thank you so much for watching. Bazaar Morning Call sets you up for the day ahead.
And with an Indian background, they're both saying that students graduating from universities in the US who are from India should automatically be given a green card. And I think Trump will implement that going forward because they realize that they've got to hold these very intelligent Indian students who are now becoming very capable professionals. I mean, if you look at Silicon Valley, look at how many people of Indian backgrounds, actually with Indian citizenship, are running the big tech companies in California. And I think that's going to hold true in other parts of the states. So I think the administration realized the value of the brain power that India has and will want to hang on to these people. But by the way, there's a benefit to India as well, not only because these Indians will be sending money back to India, but more importantly, they're going to obtain experience in the US and education from the US and bring that back to India because India is going to become much more competitive in terms of offering these people good earnings. So it's going to be a win-win, I think, for these students in America. And I think it's going to be very interesting going forward. But I, for one, I'm quite optimistic about these students living and working in America. First of all, you must remember, if a country is growing at 6, 7, 8%, whatever number you want to pick, companies will be growing at double at the rate. Good companies that have a high return on capital will be growing at double that rate. So you're talking about 14, 15, even 20%. So an increase in price of 20% more than accommodates the kind of increase in value that you have in these stocks. So I don't think we should be too worried about the fact that many of these stocks have gone up so much. They will continue to go up if these earnings continue to go in the direction that we've seen them. The other factor I think is very important, and that is for those companies that are exporting, let's say Infosys that exports a lot of software, they are going to become more competitive because of the weakening rupee. So I think you've got to look at many of these stocks that have a US dollar income component will continue to do very, very good. And I think we're on this cusp of more exports coming out of India, not only in the software area, but also in manufacturing.
India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning, hello, and welcome to a brand new week and a brand new edition of Bazaar Morning Call. We're coming to you as always live from the CNBC-TV18 Motilal Oswal studios. I'm Surabhi Upadhyay, back with the first day of the new year in terms of back in the studios with my friends and co-hosts Nigel D'Souza and Rima Tendulkar. Let me start by wishing both of you a very, very happy new year, guys.
Well, happy new year, Surabhi, and welcome back. And I'll tell you what, it's happy new year to a lot of people out there, because last week I don't think too many people were tuned in. So a lot of people getting back to work. A very, very happy new year. Let's hope 2025 is better than 2024.
And we're kick-starting with so much news flow, right?
Yeah.
In terms of the business updates from banks, the consumer stocks. Now that Surabhi is back, things are going to be in action.
Well, I think the action was happening even while I was away, guys, because I was watching that FII number very carefully, even while I was away from the market, just because it kept making headlines. We were hoping for that FII selling to ebb, but I don't think that's exactly what transpired last week. So let's quickly start looking at the cues. The good thing is that we've managed to see a positive close on Wall Street. So Friday was fairly okay. After a shaky start, the indices across the board, S&P 500, the Dow, the Nasdaq, all of them put on gains between about 0.8% to all the way up to 1.8% of the Nasdaq. The tech pack was really fired up in US trading on Friday. So that's one. The data point that came out was on the manufacturing front. So we had the December US ISM manufacturing number come in, and that number is creeping back towards the 50 mark, which basically tells you that the economy or the manufacturing sector is expanding once again. The number came in at about 49.3 in December, which was higher than estimates. And what did that do? Not only did that sort of give a leg up to the equity market sentiment, but once again, we've been talking about the rise in the dollar and the rise in yields, and that continued on Friday as well. In fact, if you're talking about US yields, I mean, largely speaking, they have been elevated through the last week, including on Friday, 4.6% thereabout on the US 10-year. And the dollar index is still hovering around the 109 level. I mean, those historic moves that we've seen last week, all put together, the DXY was up almost 1%. And even this morning, it's managing a move around the 109 handle, which has been the big story, which has been driving markets around the world, not just the US. We'll watch out for how that plays out as well. Talking about some of the cues this week, I mean, it's going to be all about this all-important jobs report, which comes out on Friday. That's going to be setting the chain of events in motion. In the anticipation, of course, we'll watch out for more announcements and, of course, more social media posts coming in from either Donald Trump or Mr. Musk, which has happened over the weekend as well. What also happened over the weekend, just to put the global picture in context, was China, particularly the PBOC, the Chinese Central Bank, wrapped up a two-day meeting, and on Saturday, the highlight was the PBOC committing to what should be a moderately loose monetary policy for 2025. Now, there were no specific indications of how many rate cuts and when, but the idea was that the PBOC is going to be largely supportive. So let's watch for the China piece as well. Now coming to the point that I was talking about, all through last week, if you thought that at least the end of the year phenomena is going to keep the FII selling at bay, that did not happen. Just look at the bars, look at the numbers. And then Friday was the biggest one. Again, selling of over 4,000 crores coming in. To some extent, it was masked by the domestic buying, but it wasn't enough. And this is something that's going to be the biggest watch point as we talk about it. The FPI exodus is having its impact on the currency as well, coupled with the fact that the dollar is very, very strong in the international market. So watch out for this. The rupee has been racing towards the 86 mark. And if you look at the forex flow picture that we got on Friday, given that the fact that the RBI has been in the forex markets, off and on, our forex reserves also depleted by about 4 billion, give or take. So the rupee picture continues to be extremely important. Now for the market, 1% rise overall for the Nifty last week. But the question is, can the Nifty see any kind of a rise in the face of this kind of FPI selling? It's been testing the 20 DMA and the 50 DMA. Friday, the close wasn't above these levels. So let's see how it plays out from here on. And I would say the key question for me is, can earnings, the FPIs will do what they do, but can earnings provide any kind of a support? I know Rima is going to kickstart the season with TCS. But ahead of the earnings, we got a lot of corporate commentary, and we'll talk about it as we go forward, from banks, from consumer companies. But on consumer, folks, what I noted was that it's still a very, very mixed picture. Dabur is still very worried about what's happening with the general trade channel. They're still very, very cautious, talking about single-digit growth. But there are others like Marico that's saying that double-digit growth is going to happen in the third quarter. So I think the commentary from consumer is very mixed. Banking is lots of updates. But really, I guess the question is going to be, can domestic earnings in the third quarter provide a little more hope and optimism compared to what we had from earnings in the second quarter?
Well, watch for HDFC Bank, right? That's the biggest contributor, and it was the biggest drag on Friday, 2.5% lower for the stock price, and the advances growth was very anemic. That said, the deposits growth picked up to about 16% on a year-on-year basis, so that was a positive, but the street will be a bit worried about the fact that the advances growth has been just tepid at close to about 3%. So that's going to be an important stock. In fact, lots of heavyweights, right? Kotak Mahindra Bank, ITC, and so many other financial stock updates, whether it's from Bajaj Finance, IndusInd Bank, Bandhan, RBL, L&T Finance, Bank of India. We'll talk more about it. In terms of the key data this week, remember the NYSE will be shut on Thursday to mourn the death of the former President Jimmy Carter. So it's going to be a holiday truncated week for the US markets this week. On Wednesday, you've got the ADP employment report. On Thursday, the FOMC minutes for the December meeting and the JOLTS data. And Friday, the all-important non-farm payroll data. On Friday, the markets closed lower, closer to the 24,000 mark. Thursday was a strong session for our markets, but on Friday, the markets pulled back and gave up close to about 0.7%. Some of the key markers to watch. So last week, the intraday low was 23,460 and the intraday high was 24,226. So just in the immediate term, Watch for 24,460 going up to 24,300. And as long as the Nifty holds on to the 200-day moving average, which is 23,900, as it did on Friday's, as per Friday's close, I think the bulls will try to push higher and higher through the course of the week, but depends on the earnings and the headlines that we get on that front.
Well, that's right. You know, what's positive from the US market perspective is at least it ended in the green, and the other positive was the dollar index cooled off a little bit from the top. I'll tell you what, the bulls will be very, very happy looking at that because the dollar index was going out of whack towards that 110 odd mark. So cooling off is good news. What did the FIs do though? As you all said, yes, they sold in the cash market and they added all the shorts that they unwound or they covered in the previous trading session. So there was a big short addition of more than 20,000 contracts on index futures and some mild unwinding of long positions. So how do the things stack now? The FIs and the clients, they're on opposite ends of the spectrum. The FI is net short with 83% of their positioning on the short side, with the absolute number at around 2.3 lakh contracts on the short side. Clients, they are net long with close to around 70% of their positions on the long side, and that number is roughly around 2.5 lakh contracts, and both of them have moved to the opposite ends of the spectrum. Two strikes were fairly active. 24,100 call, well, that was fairly active in Friday's trading session, 40 lakh shares getting added there. And on the downside, you look at the 23,700 put that was fairly active. Plugging in the numbers and going by the technical levels as well, the 24,200 mark becomes the near-term resistance. Why do I say that? Because the 20 and the 50 DMA are in that vicinity of around 24,150. And we did a U-turn from around 24,200. So that's the near-term resistance that we're looking at. Going by the options data, that becomes the near-term support because the 23,700 put was active, premium roughly around 50 rupees. So that's the level to track on the downside. Well, the swing factor of the day is going to be HDFC Bank. The stock has gone weak into this operational update, and it seems the street was sensing something. I won't be surprised if the stock opens up a little bit softish. It moves up, and this will actually be the trend for the day. This one, the way it moves, that's going to send the note for the remaining of the day because the street clearly was factoring in some kind of weakness, and it appears, at least with regard to this operational update, the weakness could be in the price if it opens up a little bit lower. The Nifty Bank as well, very, very important market is what it is at. It closed closer around that 51,000 odd mark. On the upside, you're looking at the 100 DMA, which is a little bit away, but the 200 DMA is around 300 points away from current levels. So that's the crucial zone that you're looking at for the Nifty Bank. Finally, another stock that I'm going to be looking at is Crompton Consumer Electricals. The stock has seen a very, very sharp correction in the last 1 month itself. It's down close to around 10%. But there was big delivery-based action in Friday's trading session. 25 lakh shares got delivered. That compares with an average of around 6 to around 7 lakh shares. So the fall was only around 2% on Friday, and big delivery-based action is what we saw. Let's see whether or not it's forming some kind of bottoming out process because it's been a big, big underperformer just in the last 1 month or so. So I'll keep an eye out on this stock. It's moved to around 365 rupees odd. Stock to track.
Thank you very much for that. Rajiv Agrawal, Managing Partner and Fund Manager at Doordarshi India Fund, is now joining us on the show. Rajiv, thank you very much for joining in. You were a bit cautious on India. You were contemplating taking, cash out of the markets. And since then, we've seen the markets correct close to about 10% and not quite recover from there. So what have you done in terms of your portfolio in India for the last 3 months? And what's the outlook over the next 3?
Actually, that's a very good point you raise. We are quite bullish now on India. I think given what has happened in Q2, where the GDP slowed down, we think that the GDP will start picking up back. And some of the sectors in India that were underperforming will also start doing well, especially on the CapEx and the infrastructure side. So we are actually now deploying cash, and we are seeing some good opportunities, especially as the market has pulled back.
Deploying cash?
Yes.
Do you want to talk to us about the opportunities? Where exactly are you putting your money to work?
Sure. No, so I think one of the sectors we have been a bit excited about has been the banking and finance space. And especially what has happened is with the MFI performance in Q1, Q2, which was very, very weak, there is this narrative that this particular weakness will continue. We do think that the rest of the year would be a little bit muted, but going into 26, financial year 26 and 27, we think that will be a good area for growth. We also think that some of the big banks actually have been beaten up because there is this concern around RBI reducing the rates going forward. So we think, again, that is an area that should do well, because ultimately, as the capex comes back, both from the government and the private sector, I think that will help the banking sector to increase its book, and through that, be able to make more returns for the shareholders.
Rajiv, hi, good morning and Happy New Year to you. So yes, I mean, I think that the interesting facet is that this week or this year has started with investors slightly tempering their expectations from the market. At least that's what all the wise men on the street have been telling us, right? You've been favoring BFSI for a while now, but what else? Since you are now willing to deploy cash, where else is the money going in India?
Yeah, I mean, I think the biggest opportunities we are seeing is in the banking and finance. But beyond that, I think even real estate, there has been some pullback. We think real estate cycle is still in the early to medium stage, and I think there is some good opportunity there. You are seeing in certain pockets a lot of excitement there. So real estate is another interesting area. I think renewable energy, I have talked on your show in the past. We think renewable energy right now is very, very cost competitive versus the traditional form of power generation. And India has some big, bold goals out there for 2030. So we think that momentum will continue. And then, the capital markets remains to be seen, given what has happened with the whole futures and options constraints that SEBI has put in. We will see how the Q3 numbers look. But those are some of the segments that we are liking, which is banking and finance, real estate, renewable energy are the primary ones.
All right. Hi, Rajiv. Good morning. Good to see you in. Wishing you a happy new year and looking forward to your inputs all through the year. But Rajiv, let's, get a little bit stock specific, if you could give us some color. In the past, you've named a few stocks. Manappuram is a stock that you've spoken about, some of those private sector banks as well. So from both these themes, or all the three themes, if you could give us at least a name, banking and financial, the real estate basket, as well as the renewable energy space. What do you like? Stock specific.
Sure. So, I mean, just before I give the names, as you know, usual disclaimer, we own most of the stocks that I will mention, so we are clearly biased, not a recommendation, right? So I think in the banking and finance, Manappuram is something we have talked about. We think you might have seen in Manappuram case, one of its subsidiary went under constraints from RBI, where 4 of the NBFCs were put under constraint for disbursing any loans. 2 of them have actually come out. So I think that is one of the reasons possibly why Manappuram has been rising, because 2 of the 4 are no more under the constraint, and there is expectation that possibly even Ashirwad will, over the next few months, come out of that constraint. Beyond that, I think even we have talked about IIFL Finance in NBFC space. We think IIFL Finance, if you looked at the Q3 numbers, the gold loan numbers of IIFL Finance in Q3, which they put in their presentation recently, very strong gold loan growth. So we think IIFL Finance should be another interesting opportunity for the long term. Beyond banking and finance, if we go to renewable energy, I think the name that we own is Inox Wind, and we own that through Inox Wind Energy Limited, which is a holding company. We think, again, Inox Wind in India's renewable energy space, especially the wind turbine space, there are 2 main players, Suzlon and Inox Wind. And then we think both of them have a big, wide opportunity to continue to grow. They have done well in 24, and we expect that given the opportunities they are seeing in this space, where the rates for generating new wind power is pretty competitive to the traditional rates, we think that they should continue to do well. And then on the real estate side, sorry, you have a question, Nigel?
No.
Go on. Yeah, real estate,
we want to hear the real estate name. So we've got from renewables, you said Inox Wind Energy, right?
Yeah.
That's right.
And Suzlon.
Yeah.
Let's hear the real estate pick then.
Yeah, so on the real estate side, I think we have been much more bullish on the Mumbai MMR space, and I think that is one area where we have looked at Sunteck in the past. And Sunteck, right now we are basically holding, but I think Sunteck is a stock which also now is having some property in Dubai, and they have some good properties that they're developing in the MMR region. So we think that could be an interesting space to look at. Clearly, these are things that we have held for multiple quarters now, so not necessarily a recent buy.
Okay, so lots of interesting anecdotes and ideas there, BFSI, real estate and renewable energy. Rajiv, to sort of round up the picture, sort of pull back, zoom out and go global once again, because it's all about the 20th of January and what actual real policy announcements will come in from President Trump, right? But even as we, move up to the event, the fact is that India has been hit hard by this rising dollar strength, by the fact that, FPIs are continuing to press the sell button, including the last week of the year. What do you make of this? And on a slightly more macro level, how do you think, India will sort of deal with these dynamics, this FPI selling that now has been on for 3 months?
Yeah, so actually, we have a contrarian view there. I think the US equities have done very well in the last 2 years. And therefore, a lot of the positives are already in the price. We think US equities, people are too sanguine about what Trump will do. We think that a lot of those are already in the price. So we would expect that 2025 will be a little bit more muted in terms of returns than what the street is expecting. As that happens, we think that the power of Indian equities and the growth that we have in India will start becoming more prominent. And so there will be a reversal of this flow that we have seen in the last few months. The second thing is that we have seen that Chinese yuan has also been depreciating. So I think the Indian rupee and the Chinese yuan will continue to be moving close to each other, because clearly there is a lot of areas where there is parity that needs to happen. So if Chinese yuan continues to depreciate, we think Indian rupee will also depreciate. But irrespective of that, I think the exports should pick up over time. And we think that Indian equities from current pricing should actually give better results or returns in 2025 as compared to where the US stocks look right now.
Rajiv, great conversation. Thank you very much for joining us on the show this morning. And now let's move on and tell our viewers the corporate interactions we've lined up. So first up at 8:35, Nishant Pitti, former CEO of Easy Trip Planners, will join in to discuss his resignation and the decision to sell 1.4% stake in the company. 9 a.m., we've got Abneesh Roy of Nuvama Institutional Equities to talk about the ITC Hotels demerger and the various consumer business updates coming through from Marico Dabur. 9:20, Devina Mehra of First Global will be our market master for the day. 9:30, the management of Rainbow Children's Medicare will talk about the H2 outlook. Following that, Anand Agarwal of V-Mart Retail will be chatting with us at 9:40 to discuss their Q3 business update. 9:50, Rahul Sharma of JM Financial Services will join in to decode charts and the technical trends in the market and several counters. And finally, end of the show, it's our special segment, It's the Economy. Lata will be in conversation with Shantanu Chakraborty of BNP Paribas to discuss what the early advance deposit growth data indicate about the Q3 performance for banks.
Well, it's time to slip into a short break, but we have a lot of stock-specific action to track for you. We get to that in just a bit in our special Top 10 segment. For the time being, we're running through the list. HDFC Bank, Bajaj Finance, Nykaa, they'll be reacting to positive news flow. On the flip side, Kotak Mahindra Bank, JSW Energy, IndusInd Bank, RBL Bank, L&T Finance, Dabur and Marico will all be reacting to negative news flow. Slip into that break, come back, we'll get into all these stocks in greater detail.
Well, it's been yet another record-breaking night for quick commerce platforms as India's consumers took to their phones to order in their New Year party needs. Now, apart from the usual party essentials, many interesting items like grapes, condoms, ENO, milk packets, and even men's underwear were ordered for in huge quantities across apps. But let's look at Blinkit first. Blinkit saw its highest ever orders and also its most orders per minute and per hour. And in terms of trends, last night saw the most number of chips and most grapes sold in a day. The biggest order Blinkit received.
Welcome back. You're watching Bazaar Morning Call, and these are the top stocks to watch this Monday morning. Our research team is standing by. Abhishek, first up, it's HDFC Bank and Kotak Mahindra Bank that everyone will be watching. Good morning.
Good morning, Rima. So to begin with, deposit momentum for Kotak Mahindra Bank has been better than industry average, growing at nearly 16% YOY and 2.5% quarter-on-quarter. Management has been highlighting that they intend to bring down the CD ratio, and that is why they are giving up on loan book and selling down the portfolio, which has led to advances growth being just 3% YOY and about 0.9% sequentially. But credit deposit ratio continues to decline, which is in line with what they have been guiding as well. Kotak Mahindra Bank now 8 to 9 months post the RBI ban on their various digital platforms. Their CEO and CTO has resigned, which raises concerns with respect to top management churn over there. Milind Nagnur has resigned as the CEO and CTO of the bank with effect from 15 Feb 2025. Back to you.
Okay, all right, got that. Abhishek, thanks very much for that. Let's move on to Vivek, who's tracking some news flow on JSW Energy this morning. Vivek, morning, what's up?
Well, good morning. That's right. A slightly concerning development as far as the entire power sector is concerned. Now, what's actually happened is that the Centre for Electricity and Regulatory Commission, that is the CERC, which was supposed to go ahead and approve a tariff for a project. This is a BESS project, a battery energy storage system project. This particular project was won by JSW Energy's renewable energy arm, and this was a project won from the SECI, that is the Solar Energy Corporation of India. The project was a 500 megawatt that was supposed to give close to 1,000 megawatt hour standalone BESS project, and CESC has not approved the tariff for this particular project that the company had won via the auction or the bidding process. This was done in 2023. CERC says that the main reason that they've cited is that the discovered tariffs in subsequent auctions for other projects are actually lower than the tariff that was discovered in this particular project. And along with that, CERC has also cited delays that SECI has done in terms of going ahead and signing both the supply agreements as well as the power purchase agreements for this particular project. JSW Energy says that they will go ahead and appeal this particular verdict from CERC. Expect a red as far as JSW Energy is concerned today.
Thanks for that, Vivek. Let's go back to Abhishek. Abhishek, some more banking updates you want to give us?
Well, 21 lenders came out with their update, Nigel, over the weekend. So let's begin with Bajaj Finance. The new loans have grown by 24.5% sequentially, which has aided the AUM growth. Now, AUM growth may look at 7-quarter low, but take no away from the fact that it's grown at 28% YOY and about 6.5% sequentially. The cross-sell rate has also improved on a sequential basis. Now, our IndusInd Bank, their deposit momentum has been slowing down. YOY, the growth of 11% is perhaps one of the weakest in last 16 quarters, and for the first time in last 19 quarters, you are looking at deposits declining for them on a sequential basis, and this has impacted their loan growth as well. Loan growth has come in at 12.3% YOY, one of the weakest that you are seeing in last 12 quarters, and sequential growth is at 2.8% quarter-on-quarter, one of the best in last 3 quarters, but a small number. RBL Bank, the deposit momentum has slowed down to 15% YOY, and it has declined by 1.1% sequentially, the 9-quarter low with respect to deposit momentum for them. Advances growth on account of low deposit flow is at 13.3% YOY and 3.3% sequentially. It's at 5-quarter low. Now, L&T Finance, the rural business has taken a huge knock over there. The rural business finance disbursements are down 16% YOY and about 15% sequentially. This has meant that the retail disbursements are up just 4.5% YOY and about 0.7% sequentially. Remember that they have been focusing on the retail business over the last few quarters, and this number looks to be on the weaker side. Back to you.
Thank you very much for that. On Bajaj Finance, I think there is a Nomura upgrade which has come through post the Q3 update. But it's over now to Mangalam for the latest on Dabur and Marico and what the Q3 trends suggest.
Well, if you look at Dabur and Marico, the trend suggests that there has been softness in their update coming in. For Dabur, they've said that while rural consumption is resilient, general trade is still under pressure. So as a result of which, consolidated revenue expected to grow in low single digits, much below what the analysts were anticipating. Beverages reported a muted performance. That's uncharacteristic of the third quarter, where typically you see good performance coming in out there. Healthcare has been impacted by delayed winter, and the company expects, flattish operating margin growth as well. So see red on Dabur. On the other hand, for Marico, the consolidated business has reported mid-teen revenue growth year on year, but it is higher than expected inflation in copra and vegetable oils that have impacted gross margins. So they expect moderate operating profit growth this time around. Revenue growth is strong for Marico, but margins may compress, going with mild green for Marico and red for Dabur.
Okay, so some green for Marico and some red for Dabur. What about Nykaa, Manglam? Looking pretty or not?
Bright pink, I would say, if I could, but it's green right now. We had Anchit join us on the channel on Friday as well, spoke about the underlying trends in the beauty segment, and that's something that's reflecting in their business as well. Net revenue growth likely to be higher than mid-20s in a segment which is poised for growth, and beauty vertical itself has accelerated, growing in above mid-20s, and the gross merchandise value out there growing upwards of 30% as well. So that's a positive. Fashion business, it's subdued, but still will grow net revenue over 20%. So see green on Nykaa.
All right, Mangalam, stocks aside, wishing you and Sonal all the very best as you all welcome baby Vani. Pink is the color, brother, that you're going to be going with, and that look that that little baby is going to give you is going to be the look that no one ever gave you in your life, and the warmth when she holds your hand as well. Wishing both of you all the best and welcoming baby Vani as well, Mangalam. Best times for you await.
Thank you so much for your wishes, advice, blessings and all of that. I'm sure you guys will keep peppering us with experience and a lot of advice as well. Last 15 days, they've been a joy and we're very excited for the lifetime ahead.
Lots of love, Mangalam. Thanks a lot for running us through all of the stocks. And thanks, guys, for running us through the entire top 10 segment. Well, let's run you through the entire list. Stocks with positive news flow include HDFC Bank, Bajaj Finance, Nykaa, as well as Marico. Stocks with negative news flow, Kotak Mahindra Bank, GSW Energy, Indices, RBL Bank, L&T Finance, as well as Starboard.
Now let's get in a handle of what's happening in the commodity and currency space. Manisha Gupta joins in as always. Good morning.
Morning, and thank you so much for that. Well, I'll start with the crude oil prices because we've seen already a gain of 4% since the time 2025 began. So prices for crude is trading at a 2-month highs. Well, 3 or 4 factors which really seem to be supportive. One, you have cold weather in US and Europe, so the demand for crude products is on the higher side. Second, the markets are anticipating China economic stimulus measures to come in more stronger this year. That sentiment is keeping the prices higher. And this is happening even as the dollar index is trading at 109. And that should be putting pressure on prices. But as of now, it isn't. The third thing really is about the decline in U.S. crude inventories for the last 3 weeks now. And that has been supportive. And then it's going to be about geopolitics as well. Markets do believe that Iran could be looking at some more sanctions from U.S. going forward. Russia already has halted gas pipeline exports through Ukraine. So those are the factors supporting crude oil prices right now. But within metal as a sector, we've also seen copper prices gain up back above $4 a pound. So that is a multi-week highs coming in for this one as well. There is buying interest, especially after copper prices fell by 10% in the previous quarter. So a couple of these things have started Asia on a very positive note.
Okay, all right, Manisha, thank you very much for a roundup. With that, we do have to take a very quick break. On the other side, we will connect with Prakash Diwan. He will weigh in on the fundamental ideas and cues that we have today. Back with that in just a bit.
₹64,988 from Kolkata. Now, Instamart too saw its highest ever orders, which was the double of last year. And what did consumers look for the most? Milk, chips, chocolates, grapes and paneer. And the biggest order came from a user in Goa for 70,325 rupees. Now, on Big Basket, orders for things like games, soft drinks, mixers were all up anywhere between 200% to 1,290%. Now, after 2024 turned out to be a year of the quick commerce boom, Zepto CEO Adit Palicha rang in the new year with 3 predictions for 2025. Now, he says that 2025 will be the year where quick commerce will start hitting scale comparable with e-commerce. Now, we've already seen the lines blurring between the two in 2024. Now, his second prediction is that this year, the quick commerce model will really be put to test. Succeeding in this scale will require exceptional execution, he says, which will be a challenge for every single player to be able to deliver. Thirdly, he says that the fundamentals of quick commerce will evolve dramatically and the unit economics to build operating leverage will also change. And finally, as Zepto also gears up for an IPO this year, Palicha says that the capital markets environment from private to public will also be different compared to 2024 and 2023. So from a year of its boom to its true test of scale, it will be really interesting to see how quick commerce evolves in 2025.
2024 has now become the 9th consecutive year of positive returns for the Indian equities, and that's the record.
Welcome back. You're tuned into Bazaar Morning Call and hope you're having a good morning. Well, let's focus on the other big news point today. Today marks a record date for ITC Hotels demerger. The restructuring will see ITC retain close to 40% in the hotel business, while 60% will be held by shareholders. Mangalam's here to break all of that down for us. Mangalam, over to you.
Well, it was in July 2023 where ITC first announced this alternate structure. So after a long drawn process, today is finally the record date for ITC Hotels demerger. ITC in July 2023 announced an alternative structure for the hotel business wherein the company would own 40% in the business by itself and the remaining 60% would be held by shareholders via an entitlement swap for which each shareholder will get one ITC hotel share for every 10 shares that they hold. The ITC hotel business, does it list today? No, that lists in mid-February. But today, ITC will go X the hotel business. Of its total business, the hotel business has 4% revenue, 2.5% EBIT, but more importantly, 14% of assets, which makes this demerger ROCE accretive for the parent company, which will be listed today. For the resultant company, that is ITC Hotels, currently has 140 hotels, around 13,000 keys, 55% properties are managed with 69% occupancy. The important part is their stated target, 200 plus hotels with 18,000 keys by 2030, with 65% salience coming in from the managed portfolio. ITC Hotel financials reflect the underlying improvement in the hotel industry as well. Post-pandemic, over the last few years, we've seen growth. And in the first half of this year itself, ITC Hotels revenue has been around 1,500 crores with operating margins of around 28%. Remember, in the hotel business, we have the second half, which is more margin accretive than the first half itself. If you look at the balance sheet and the opportunity as well for ITC hotel business, remember 52% of the business revenue comes in from rooms, 40% from F&B. There's a strong opportunity in the hotel business with zero debt, cash balance of 1,500 crores, and only 20% of their inventory is currently operating at 75% of potential occupancy. So that is telling you that there is room for operating leverage as well. They're also looking at value accretive M&A and alliances. The big question, how do you value this business, right? So for that, you have to look at projections. Given the recent history and the numbers that we have, FY25 could be close to 3,700 crores in revenues, FY26 4,400 crores with EBITDA of close to around 1,500 crores itself. And if you look at all the other listed hotel companies right now and their multiples, Indian Hotels is at 37 times, Chalet Hotels 25 times, the others between 17 and 18. My guess is ITC would settle between 25 and 37, closer to 26 and 28. And that means a market value of the ITC Hotels business between 36,000 to 39,000 odd crores. But remember, this is the entire hotels business. 40% will be held by ITC, on which a holding company discount would be there. And the remaining 60% could be between 22 to 24,000 crores. What happens to the ITC hotel listing? Whenever that lists, the shares could be worth 175 to 190. But today, the important part is the ITC share could adjust by around 17 to 19 odd rupees as the business goes ex-hotel business.
Okay, all right. Mangalam, now very nicely explained. Thank you very much for telling us how optically, even how the ITC share price will reflect the fact that today is the ex date.
And between 9 and 10 a.m., there is going to be a special pre-opening trading session for price discovery. So
absolutely, yeah, and we have some ballpark, estimates to work with in terms of how the market could be valuing the business. And interesting times to list as well. I mean, there hasn't, I think, been a better time for the hotels and hospitality sector than in the last couple of months. Though the ITC, you must say that overall, if you look at the ITC share price, it hasn't gone anywhere. It's been a very range-bound last 12 months for ITC. Well, let's welcome in Prakash Diwan into the conversation. Prakash, morning and season's greetings. Wish you a very, very happy new year. My first conversation with you in 2025. So let's start right there. ITC, I mean, tell us how you look at the rest of the businesses, ex-hotels, and whether you like hotels enough and you think there's enough value unlocking potential, because you need to own the shares today if you want to get, if you want to participate and have the listed hotels business as well.
Yeah, thank you, Surbi, and best wishes for 2025 to you as well. It's very simple. The ITC stock hasn't gone anywhere, as you rightly said, post the BAT exit. It moved up. It's been steady because everybody's been waiting for this event. This was a critical event in terms of price discovery. If the ITC hotel loses, let's say, $20, that means the hotel business is getting valued at 200. So it's going to be nothing very dramatically different if you already own the ITC Limited stock beforehand. But now you have a very clear choice of whether you want to own the fast-moving hotel business or the fast-moving consumer goods sector. So that differentiation means a lot to a lot of people who allocate money. If FMCG is not drawing that kind of capital in recent times because of the slowdown and general tepid performance that you see from the sector, it's probably the hotel business that could fetch a lot of attention. And my sense is that's exactly what will happen once it gets listed and traded in the month of February. But ITC itself, after this demerger, starts getting to use this cash that it generates for growing its other businesses. And some of the FMCG businesses have started maturing quite well. The consumer-facing businesses, the products which they've been recently trying to rebrand and relaunch. My sense is ITC also will benefit. So win-win for both. I don't see there's no preference over one over the other. It's going to be actually beneficial to buy both if you really want to. On the hotel business, I'm very positive. In fact, the likes of Lemon Tree, if you recall about 4 months back, there was this setback that Lemon Tree had in its quarterly earnings, saying, they have a lot of money that's been allocated to refurbishment and all of that. And the stock went all the way down to 120 or something, and it's moved back, started moving up. I think it's still a very good buy at these levels, given the expansion that it's doing. So it's a great space. ITC will get very good premium valuations eventually, if not today. And that's what we would expect.
All right. Stay on, Prakash. We'll have more questions for you in just a bit, including probably the next company you want to listen to this conversation, Easy Trip Planners, because there's been a lot of chatter about what the promoter intent really is with the Easy Trip Planners. We have Nishant Pithi joining in. Now, we know the developments from last week. Nishant did resign as CEO of the company with immediate effect, citing personal reasons. Rikant Pithi has now replaced Nishant Pithi as the CEO. Nishant is with us on the phone line. Nishant, hi. Thank you so much for taking the call. And I'll just cut to the chase. The market is really wondering what is your intent. I'm looking at the last available public shareholding, where your shares were, your stakeholding was 14.2% roughly. You've sold about 1.4%. I believe you were looking to sell almost the entire stake, but that didn't happen. What is your intent? What are you thinking? And what about the other promoters and the overall promoter shareholding in the company?
Good morning. So firstly, I repeat your question. The decision, the first answer would be the decision reflects in strategic focus on driving growth and expanding EasyMarket's global and international presence in my capacity as chairman of the company. While I continue to play an active role in shaping company's future, Rikant will be taking over as CEO to oversee day-to-day operations and ensure seamless execution to a vision. I'm confident that his business acumen and deep expertise in travel industry will pave an exciting and promising future for EasyMarket. And the second question was for selling the stake. The reason to sell a portion of my stake, that is just 1.4% out of 14%, was a strategic step to diversify my personal investment and unlock a value after doing 20 years for EasyMarket. Despite the sale, I still own 12.6% shareholding. And as promoter group, all the three brothers continue to own almost about 50% of the company.
Nishant, weren't you looking to sell a much larger chunk? How much of your shareholding do you want to sell right now?
We are not going to sell anything right now. My focus remains firmly on EasyMarket growth, and I'm fully committed to supporting its expansion and success.
So can you confirm that you, Rikant and Prashant, all of you, which comprise about 50% of the company's shareholding, that neither of you, would be selling any further stake?
Absolutely correct. Moreover, EasyMarket stands out as one of the few new age companies where overall promoter equity remains almost about 50%, which you will not find, in other e-commerce companies.
Mm-hmm. Hi, Nishant. Good morning and good to have you on the show. Nishant, we get that clarification, but the reason you're not selling is because you couldn't find the buyers, right? Otherwise, you were looking to sell 14%.
No, we are not selling.
You had enough buyers, is it?
Yes, we were.
But why didn't you do a strategic sale? You could have reached out, got institutions to participate. We're seeing the institutional shareholding as well as fallen. This could have been handled in a better way. Don't you think so?
It is a better way, but still right now we are not focusing on selling the entire stake. That was being highlighted by the media. And I'm being the chairman of the company. We are just going on global expansions and day-to-day activities, as I mentioned, will be taken care by Rikant. We have a lot of more to deliver on the table.
So you're saying that there was, if you were looking to sell that 14%, the remaining that you have, then there was enough demand, but you have chose that you only wanted to sell this 1.4% and now you'll not sell more. Is that the clarification?
That's correct. That's correct. That's absolutely correct.
But, don't you think from a shareholder perspective, they're absolutely baffled? You all did so many corporate actions, the retail holding in the, went up, the institutional holding came down. It could have been handled in a much better manner, right? Because suddenly you have so many question marks that are out there. And for a business as you're stating, you're so confident about, it could have been handled in a better way. What's your comment on that?
It would be a better way. Now you'll see that we are completely revamping the complete things into the use metric as well. And as I told you, we are just going ahead with the organic and inorganic growth, both pedals we are scaling it up. So if you see any other companies in new age tech businesses, particularly in the e-commerce space, you'll not find any other company who will be having so much of promoter equity till now. Everybody starts raising the money. We are the first one who never raised money, who a bootstrap company, went to the IPO and diluted only 25% the time of IPO, which was mandated to us. We only sold 25% in the last 4 years of listing.
But Nishant, initially, when the block was on sale, it was a 14% block, your entire holding. So what was the intent at that point?
It was not entire holding was on sale. We just sold a part of that. That is
you did sell eventually. Yes, Nishant, you did eventually sell only 1.4 out of the 14%. But when the block was offered to, 10%, agreed. But initially, what was communicated to the bankers and what was on offer? It was an entire block of 14%, right? So the initial intent,
14%. It was the initial intent was 10% of the block which I hold. That is 14%, 1.5% of the 10%, 1.4% of 14%. And as I told you, we still own almost 50% of the equity.
So you're clarifying that only 1.4% was on sale and that got taken up. Is that correct? You're saying that 14% initially itself wasn't on sale. We understood otherwise. That's why we're trying to clarify this.
Oh, yeah, that's correct.
Okay. So now you're saying the promoters will not sell any further stake. If you could just tell us the timeline. Is this for 2025? For how long will this hold?
This will be holding up. We can't just give you some timeline, but still, we are not selling anything right now. And that could be, you can say, in 2025, we are not going to sell anything.
2025. Okay, so Nishant, these clarifications are really important. So you're saying the promoter group will not sell any further stake this year, 2025?
Calendar or fiscal?
No, there are no immediate plans to sell promoter stakes. I'm giving a timeline if you are particularly asking. We are not going to.
No, so but are you saying fiscal year FY25 or calendar year 2025?
You can count it both ways. We are not going to sell anytime soon.
The two are very different, but Nishant, the two are very different. If you're saying that you're not selling any more in fiscal, that means come April there could be sale. I think let's also get to the broader point here.
We are not. There are no requirements to sell in calendar year 25 also.
You have no requirements to sell in calendar year 25.
We are not. That's correct.
We get that. So now,
and entering into new vertical like corporate travel and luxury tourism, there are a lot of innovations happening, leveraging AI, data analytics, including exploring blockchains to enhance consumer experiences. We are just going into promoting eco-friendly tourism and carbon offset programs as well. A couple of things which the companies will be doing in calendar year 2025. Particularly to answer your question.
Okay, so there's a lot of innovation getting into corporate travel, etc. So you have resigned as a CEO, but you're going to stay on as a board member and the chairman of the board, right?
I'm the chairman of the company, that's correct. And I will be taking care of the international expansion of the company throughout. And Vikrant will be taking care of the Indian operations, the part which is going to handle up on a day-to-day activity.
Okay, and all's good in the hood, right, between the three brothers?
That's correct. Everything is fine between the three brothers.
No, right. No, because from a shareholder perspective, they want to know what's going on with the promoter entity. A couple of other questions. You have sold some stake, in the recent past in 2024 itself. What are you going to do with all that money?
We are going to diversify into certain, there's a personal choice, we are exploring certain options, and which will be, of course, in line to travel verticals only. We only know travel. Since at the age of 38 years, I'm just 38 years, and my 20 years have been into travel. So we don't know anything besides travel. So everything will complement my trip. That's all I can say right now.
What happened to that bid for SpiceJet? Are you still interested in the M&A action in that sector?
No, we are not.
Okay, so leave us with some ideas, some projections, a broad picture. I'm just going back and looking at some of the numbers because the market is also wondering what the promoter intent is and whether a lot of the diversification that has been spoken of or started this year, whether that's going to eat into the current cash levels, the current growth trajectory. So leave us with key numbers. Your CAGR revenue outlook, say for the next 1 to 2 years, the cash levels in the company, and the margin that you'd like to maintain since you're committing, since you're saying promoters are absolutely committed to the business of the listed entity.
That's correct. That's correct. Till now, we were focusing only on the air travel part. Now, as I told you, we are focusing on different areas of travel. This could be non-air also. So in that, the margin numbers are too much. Like compared to the just flight tickets, the margins into hotel segment and the holiday segment are much more compared to the flight tickets.
How much is the cash, Nishant? Finally, what's the cash level in the company right now?
I think so. It's almost about 400 crores.
Okay. All right. Nishant, we appreciate you joining in and giving us some clarifications. We're going to be holding you at all these details. But thanks a lot for coming by. You're trying to clear the air on various aspects. And we'll hold you that you and the remaining promoters are on the same page and not looking at selling any more shares. Got it. We'll take that.
While also strategically acquiring, we are complementing businesses which we are doing on our personal capacity. This will also add up to a dual approach for each matter.
Got it. Got it, Nishant. Thanks a lot for joining in. We have taken note of your journey, which has been great. But off late, the shareholders have been perplexed with regard to what they've seen. But you've clarified, so we'll take that on board. Well, thanks a lot for joining in. That's the stock price of Easy Trip. A lot of corporate actions. The stock has come out drastically from the recent top, but we'll have to take the promoter's clarification on board as of now. Prakash, what's your view on Easy Trip? A business that was bootstrapped and, it started off very, very well and they were growing the business till what happened in the last 12 months or so. Corporate actions, promoter selling stake, a lot of uncertainty.
Absolutely. I mean, that's exactly why it's not taken flight. And I hope, all these innovations that he's talking about come around in terms of creating shareholder value, which has been languishing for a while. It's a very competitive business. You can't keep on burning cash and expect to get market share when you have much more established business, have a head start. So things are difficult. It's not easy at all. But yeah, I mean, you'll have to wait for things to turn around before taking any kind of interest in terms of a buying call. But as of now, it's just wait and watch.
Prakash, do stay on. Need to slip into a very short break. We'll come back. We'll also chat with Mitesh Thakkar and Sudarshan Sakhani and get in a few technical trading ideas for the morning.
A year of record in many ways, the highest fundraise in a single year, the ever-growing domestic pool, and so on. But the big question is, what is in store for 2025? Will the rally sustain? Will the mid and small cap continue to outperform? These are the questions in the minds of the investors. So now, crystal gazing is always a challenge, but CNBC-TV18 has reached out to the biggest market experts to bring to you an Outlook 2025, the biggest market poll for the new year. In fact, it was a poll across 61 participants, including fund managers, HNIs, as well as institutional dealers. So let's begin with the first and the most important question. What kind of return should investors expect in 2025? Majority of the respondents expect a single to mid double-digit return in 25. Only 11% of the respondents expect a negative return on the Nifty next year. In that case, will the broader markets continue to outperform in 25? Surprisingly, 50% of the respondents believe that 25 will be a year of large caps. Only a small percentage are still betting on micro cap and small cap stocks, which brings to the next big question, and that is the biggest theme to bet on in 2025. Here there is a surprise. First surprise, financial has emerged as the biggest theme to bet on for the next year, and that is despite the macro challenges that the sector is facing and the fact that they have been an underperformer. The other surprise was the stellar outperformer of 24, which was capital goods. That's been considered as the least preferred bet going into 2025. We spoke about the returns and the big themes. Now, what's going to drive all these returns? And the near consensus answer is earnings, earnings, and earnings. That's going to be a dominant factor for the Indian equities to outperform going into 2025. There was a small portion who also believe that the Trump policies could be interesting to watch out for. Now, we spoke about the macro, the micros and the themes. Let's focus on some of the macro.
Welcome back. Asia is a mixed picture this morning. Japanese markets, which were shut last week on account of New Year holiday, even on Thursday and Friday, have reopened and they've opened on the back foot. So down over 1% on the Nikkei right now, 1.2% gone. But some of the other markets like Kospi and Taiwan are up in the green, perhaps taking cues from the Wall Street bounce on Friday. The GIFT Nifty will also come up for you on the screen. It's suggesting a positive opening of close to about 50 points. Things have been a bit choppy. Thursday was a strong session. On Friday, we gave up close to about 200 points in the Nifty. And Monday morning, things look like they could start off on the positive note. But let's get in Mitesh Thakkar and Sudarshan Sukhani now to talk about a few technical trades. Gentlemen, good morning. Hope you had a restful weekend. Mitesh, let me start with you. What's your approach to trade?
Good morning. So, last week on Friday, we, kind of started declining after hitting the 24,200 mark, which was done on Thursday. So Friday was a negative day. Broadly, I think the structure is slightly on the positive side, but two things. One, we need to hold above these levels of 23,950, 930 zones. Two, I think once we cross 24,200, there could be a dose of momentum. So for the timing, I'm treating this 250 point as the immediate range. Would try to buy near the lower end of the range, which is closer to about 24,000. Take a 50-60 point stop and try to take profits around 24,200. And on a breakout above that, would go aggressively long.
Okay, all right, got it, Mitesh. Sudarshan, good morning to you as well. And by the way, Happy New Year to both you gentlemen. Let's get your call for the index first, Sudarshan. Any trades?
Yeah, good morning and a Happy New Year to you. On Thursday, I had suggested let's go long for the simple reason that the charts were a little conducive for a long trade. Now, no one knows it will go 400 points up, but we have to be on the side of the charts. Today, again, and Friday was a very normal correction. It was a dip, minor dip after that monstrous rally. Nothing to worry about. So the short-term uptrend that started continues and persists. Again today, after that dip, we are getting an opportunity to go long and buy the Nifty. Now, markets will remain choppy in the sense that they will not oblige us like they did on Thursday, going relentlessly up minute after minute. But the trend continues to be in the short term on the upside. Be long, keep a stop under 23,800 and just wait for a choppy ride, but eventually higher.
Okay, got it. Good morning, gentlemen. Thanks a lot for joining in. Sudarshan, you go first. Tell us about individual stocks as well.
Well, I have long ideas, and there are a lot of stocks that are giving signs of basing patterns, imminent up moves. Let's see what happens. ONGC is a buy with a stop under 250. SBI card is another dip, base, imminent breakout opportunity, stop under 710. After a long time, Tata Motors is suggesting that maybe the decline is over in it. So Tata Motors is a buy with a stop under 760. And finally, a stock that doesn't come much, Hudco. That's a buy with a stop under 240. So I would suggest be very protective if you are taking shorts, otherwise be on the long side.
Mitesh, your stock calls?
Yeah. I have more of buy calls today, and FMCG is something which is catching my eye apart from auto. These two sectors are showing very good relative strength. So today I have more of FMCG stocks. Dabur is a buy with a stop at 518 for targets of 540. Marico is a buy. Keep a stop below 648. Look for targets of 685. A buy on DMart with a stop at 3980 for targets of 4130. And ICICI Bank is the solitary sell call. If it breaks 1260, take a short position with a stop at 1276 for targets of around 1225, 1230.
Gentlemen, we'll slip into a very short break. We'll come back with the pre-opening rates. We'll also be joined by Abneesh Roy of Nuvama Institutional Equities to talk about the ITC Hotels demer, Titan's numbers which just came out, strong jewelry growth of 26%, and also the updates from Dabur and Marico.
Q2 was a bit of a shocker as far as the GDP figure is concerned, and after that, many on the streets have trimmed down their growth forecast for the country for next year. But will the growth surprise on the upside? We asked that question to majority. Most of them believe that the GDP growth will be between 6.25 to 6.5% in 2025. Only a mere 3% expect the growth to fall below 6%. So that's the big GDP growth forecast. So what's going to drive the GDP growth? And that's where the consensus seems to be, and that is the government spending. 77% of the respondents believe that government spending, which was lackluster in the first half of this year, will pick up in 2025. So that's going to be the big driver as far as the GDP growth is concerned. We had a record year as far as rupee is concerned. So we asked the question as to will that be a spoil sport into 25 as well. Most of the experts believe that the rupee is going to be ranged between 85 to 87 a dollar, while a small segment expects the currency to appreciate below 85 as well going into 2025. Also, we saw a new RBI governor taking charge, and that the first policy will be in 2025. So we asked the experts what to expect in terms of RBI action. It's a divided house there. 50% believe that the first rate cut from RBI will be in the Q4 of this financial year. However, a small portion believes that the stretch line could be as late as the third quarter of FY26. So that's the RBI action. Indeed, if the RBI has to cut rates, then
Welcome back. This is Open Exchange, and we're coming to you live from the CNBC-TV18 Motilal Oswal studios. Well, we've got the technical picture out of the way. Let's look at some FNOQs for the morning as well. We've got Chandan Taparia joining in from Motilal Oswal. Chandan, hi, and good to be speaking with you in the first conversation that I'm having with you in 2025. So happy New Year. What are the trades now?
Good morning, Surbhi. Thanks for having me. Happy New Year. Looking at the index, we witnessed a decent recovery on Thursday, but it failed to cheer the momentum on Friday. Index failed to surpass its 50-day exponential moving average, but trend is now turning to slightly buy on decline stance after the recent recovery in last week. So I believe that any declines towards 23,850 could be the buy on decline stance with support of 23,700, with the view that index can again head towards 24,250 to 24,400 levels. Talking about Bank Nifty index, it failed to cheer the momentum on Friday. Momentum fizzled out and now again got stuck in a range. So 50,500 to 51,500 is going to be broader range. And if I compare Nifty versus Bank Nifty, I believe Nifty may provide more stability than the Bank Nifty and needs to hold the 23,700 zone with buy on decline stance in the index. Now looking at the stock specific idea, first there is buy on Bata India. The stock has seen a consolidation breakout of last 100 trading session, with a strong comeback in the entire week. It is holding well above its volume weighted average of the week and added built-up of long led by short covering. So one can buy Bata India with support of 1415 and Bata can head towards 1520 level. Second trading idea, there is buy on Tata Motors. It surpassed its falling supply trend line and bottoming out after the weakness of last 18 weeks. We have seen bullish divergence and bullish crossover on the daily and the weekly chart, which clearly indicate short covering spike, and open interest activity also indicate some price action on the upside. So one can buy with support of 775 for an upside target of 830. Last trading idea, there is buy on Lodha. Here we have seen a decent corrective move and bottom out approach again. Major trend of the counter is positive. And after the corrective move of last 13 days, it is now respecting well to its 50-day exponential moving average and turning higher. So better risk reward ratio on the lower time frame. One can buy with support of 1375 and this stock can head towards 1475 marks.
Thank you, Chandan, for joining in. By the way, strong update coming in from Jubilant FoodWorks, where in Q3 the top line has gone up by 56%, and the like-to-like for Domino's, the same-store sales growth stands at 12.5%, and we haven't seen a double-digit like-for-like growth for Domino's stores, at least in the last couple of quarters. Q2 was 2.8. Q1 was just a tepid 3% growth. So strong update coming through there.
You know, Rima, on 2nd of January when I joined, one of the stocks that had given as a stock to watch was Jubilant Food, because the stock was making newer highs. It was seeing a bit of a short covering bounce, and delivery-based buying as well was there. So it seems the streets sniffed the pizza, and the pizza is quite good, as per that update.
Yeah, indeed, 12.5%, very, very strong. But let's invite Abneesh now, Abneesh Roy, the Executive Director at Nuvama Institutional Equities, to talk more about the consumer sector. Abneesh, before we get to ITC, on Titan, We just got the Q3 update. The overall sales growth 20%, 24%, jewelry 26%. But I remember the concern in Q2 was on margins, and they downgraded their margin guidance, citing competition. How did these numbers, stack up versus your expectations for Titan?
Yeah, I think it's a decent set of numbers by Titan. Clearly, marriage season and the festival season and the strong gold pricing is helping Titan and other jewelers. You're absolutely right. The concern on margins continues to remain. But my sense is now base becomes a bit more favorable. In first half, the base was adverse. Also, with a 25% kind of a growth, they can get some level of operating leverage also kicking in. Here, what we need to see is how the gold versus the studded share is. Because studded generally, obviously, is higher margin. That and competitive intensity, that has been the key concern for Titan. So overall, I think sales numbers are decent, but I think largely as per expectation. And my sense is other jewelers also should see good numbers because of these reasons, gold pricing and strong marriage and festival demand.
Okay, all right. That's Titan. And of course, gold jewelers, which have had a pretty good showing. Now on to the other news, the big one, Abneesh, and that's ITC, right? We're looking at the demerger of the hotel business finally getting in motion. What is the kind of valuation you're ascribing to it? And, X of the hotels business, what do you see ahead for ITC, the rest of the businesses themselves? I mean, I'm just trying to understand whether as a shareholder, you'll be more optimistic on the X of the hotels business or hotels or both.
Yeah, so hotels business was a very small part of ITC's overall SOTP. It is not that we were not doing SOTP. But yes, I think it's good win-win for the shareholders also and for the company also. So we expect that the hotel, once it gets listed, say in February first half, we expect around 35,000 crore kind of market cap for ITC hotel business. And today, of course, ITC stock should account for that. So you'll see some technical correction there. We expect around 15 rupee kind of a correction in ITC main company. But ITC currently will not be in our top picks. We continue to like from longer term, but February 1st union budget is a key monitorable. Our personal belief is probability of a sharp tax hike in cigarettes on February 1st is very low, given the illegal industry continues to remain concerned. And even in Q3, we expect 3.5% volume growth for cigarette. So I think the rational tax industry for cigarette is the right way for the government and for the customer. But overall, Q3 results for ITC will be a bit muted. We expect almost flattish EBITDA because FMCG business is likely to see profit decline because of the palm oil sharp inflation, because of the maida sharp inflation. And even paper business will see weak numbers. So overall, ITC good from long term. But currently, our topics will be essentially United Spirits, United Breweries, Marico, and Pidilite.
Okay, all right. Hi, Abneesh. Thanks a lot for joining in. Just a couple of details. The ITC stock price today corrects by around, adjusts by around 15 to 20 rupees. Is that correct?
Yes, that is our expectation.
And what kind of value do you ascribe to the hotel business? If you could give us that share price number, and also what multiple are you giving it? Because you have Indian hotels that gets the premium, and then the other players, they get anything between 15 to 25 times. So what value are you giving to ITC hotels?
Yes, so in our view, ITC hotels, once it starts trading around 35,000 crore kind of market cap, and we think the industry and the street could value at around 25 to 30 times EV EBITDA, given it's much larger than most other peers. Of course, Indian hotel is bigger, and we see that around 150 rupee to 175 rupee could be the price of ITC hotels once it gets listed.
Okay, we just had Jubilant Food as well that came out with a set of numbers, which looks pretty okay. The stock is at a fresh 52-week high. What's your view on the counter?
So clearly what we are seeing is market share gains for Jubilant Foods are happening. If you see even past few quarters, the numbers are improving, and the gap with Pizza Hut, when you see numbers of Devyani, etc., Sapphire, etc., clearly gap is for Domino's is increasing. Second, the stock has also done well apart from the recovery in the same-store sales growth and delivery format. Of course, at the promoter level, what's happening at the Coca-Cola franchisee, that is also interesting development. And now my sense is clearly we will see Coca-Cola getting sold inside Domino's stores also. So clearly we are seeing Jubilant Foods, lot of optimism, lot of positivity. And this kind of number is a good number. You have to note that it is now almost 8 quarters of slowdown which the QSR industry has seen. So that has brought the base effect clearly. But we are seeing this quarter that Avenue Supermart also positively surprised, and Domino's also clearly positively surprising. So clearly market share gains are possible for these very well-run companies. So Q2, if you see, Avenue Supermart investors were not happy, but I think they know how to come back, and we have seen 10 stores getting added in Avenue Supermart, and they have done well, 17.5% sales growth. So I think Jubilant Foods, we remain positive from longer term. Of course, valuation comfort is low there. The stock has done well, but it's a good number for Jubilant Foods, same store sales.
But do you think QSR as a space is now turning around after 8 quarters of subdued growth? We saw Jubilant's numbers, but what about for the rest of the pack, like a Sapphire Foods, Restaurant Brand, etc.?
Our sense is clearly 8 quarters of slowdown means that the base has become favorable. So I think the worst is behind. But this kind of a strong numbers for Jubilant Foods, I don't think the other players are currently seeing. This is more of a delivery format doing well, in which clearly Domino's is the number one player. And previous quarter also, if you see, within Domino's also, the in-store dining was not as strong as the delivery format. So this is more of market share gain. They have done well in terms of pricing. They have made free delivery options being there. So I would say that this is more of a Domino's specific. But yes, 8 quarters of slowdown does mean that the base has become favorable, and you will see gradual recovery, but not this kind of a number for other QSR in December quarter.
And what's your target price for Jubilant Food?
The numbers have come, and we'll see how the overall EBITDA, etc. pan out. But from a longer term, we are positive. But currently, our top picks in that space will be more like Trent, V-Mart, etc.
What about Dabur and Marico? What were your key takeaways from the business update?
So we continue to prefer Marico. If you see in FMCG, clearly the mid and top end of urban is still doing quite well. The problem is the lower end. So Dabur, if you see mass consumption, so clearly there the impact is there. Impact of Campa Cola is also there. You will see the same thing pan out for Tata Consumers weak numbers in Narishco in Q3. Although they'll see good volume growth in Narishco, overall they will see sales decline in Narishco this quarter also. So we are seeing that Campa Cola impact and the lower end of the urban consumption is an issue for Dabur. Marico, if you see good set of numbers. So we would be quite positive on Marico from a near-term, medium-term perspective. Stock has done well, but for Marico, 6% volume growth and 15% sales growth is a good number. Now, some investors may see that gross margin pressure, EBITDA margin pressure, but that is how Marico operates. So when sharp inflation happens, they take pricing, but they also go for market share expansion. So we are positive on Marico. Our sense is for Nestle, etc., I think still valuation correction has happened, but triggers are missing. For urban-focused companies, I think clearly triggers are still missing. But Marico has done well because they cater more to the mid and top end of the urban consumption, not to the lower end of the consumption in their foods and personal care.
Okay, so perhaps Marico, the stock to watch in this FMCG earnings season. Got that, Abneesh. Thanks very much for joining in and giving us a color on some of the updates that have come through, and of course ITC as well. Really appreciate you joining us on the show today. With that, let's shift attention back to the market. So now that the pre-open rates have settled, let's quickly take stock. About 40 points up on the Nifty. That's what the pre-open is indicating at this point in time. Bank Nifty is absolutely flat, not doing anything at all. We'll watch out for the reactions in some of the bigger stocks where the updates have come in. Let's, for instance, pull up a Bajaj Finance. Bajaj Finance is up about 1.25%. Been looking at some of the brokerage commentary, which is fairly optimistic. The numbers are pretty good, 29% AUM growth in this quarter as well. And then there is HDFC Bank, which was the other one. Now, with HDFC Bank, the problem is the deposits are growing, but they're growing at what cost? It's term deposits which are growing, not so much CASA. CASA ratio has been coming down for HDFC Bank, so watch this one. That's under pressure. Let's quickly get to our technical experts then for some final advice before trade begins. Sudarshan, 910, what's the call?
Well, consider buying Tata Motors. Tata Motors, buy with a stop under 760.
Okay. And Mitesh, what would you go with?
I'll go with the buy on Marico for targets of 685 to begin with.
Marico. Okay. So that's sort of the technical advice and the fundamental advice coming together in sync, because we just had Abneesh there talk about his optimism on Marico as well. Mitesh, very quickly before we let you go, just a word on the other two biggies on Bajaj Finance and HDFC Bank, if you have a trade at all.
Yeah, I like the Bajaj twins, both Finance and Finso, and I think they have started to move. We should see them at least test the recent swing highs. So for Bajaj Finance, the targets would be in excess of 77.50. But HDFC Bank, the chart structure is slightly weak. And my belief is that I think, HDFC Bank could possibly do a range of 1700 to about 1820 in the next few weeks. So somewhere in the middle, right now I don't want to take a call, but around 1700 maybe you would want to trade for a short covering bounce back.
Got that. Thank you very much for that. Abhishek is now joining in while he's watching SBI Cards and Bajaj Finance, of course. Very strong growth numbers.
Well, to begin with, brokerages have upgraded SBI Card. So we have Nomura, who has upgraded it to buy, raised the target price to 825 from 625 that they had earlier. They say that they are observing a few major concerns in the near term, especially with respect to asset quality. However, they expect credit cost to be at 9.1% in FY25 and then fall to about 7.5 and 7% in the subsequent financial years. So company is likely to be the biggest beneficiary of any potential rate cut that might be seen in FY26. We also have Nuvama on SBI Card. They have upgraded it to buy, raised the target price to about 850 per share from 620 that they had earlier. They say that credit cost shall improve from Q4 FY25 onwards. A potential rate cut by RBI over coming quarters will actually be very positive for SBI Card. Now, Bajaj Finance, the brokerages are upbeat. They say that Q3 business update in terms of AUM growth is much better than investors feared. As you know, they expected a sharper YOY deceleration, but it has grown by 28%. So customer addition was the highest ever seen in a quarter, and focus is now shifting to credit costs, which may peak out in Q3 FY25 and then start improving from Q4 FY25 onwards. Now, Citi has their 90 days positive catalyst watch open on Bajaj Finance, and they expect management transition update along with Q3 earnings momentum this time around. So watch out for that on the result date. Brokerages remain upbeat, buy overweight and buy target from BofA, JP Morgan and Citi. Target price ranging from 7,300 to 8,800 per share. Back to you.
Okay, all right. Thanks very much, Abhishek, for that. So watching out for those two names from the financial side. Let's get back to JSW Energy. Vivek is back with us. Vivek, just remind us on this tariff issue that has not been approved. What can be expected?
That's right. So it's a clear negative as far as JSW Energy is concerned, given the fact that the company would have hoped to go ahead, sign the PPA, and then go ahead and start delivering on this particular project. Quick context over here, Jan 2023, the company announced to the exchanges that they had won one particular 500 megawatt project. This is a battery energy storage project. This is from SECI, the Solar Energy Corporation of India. What was pending was this agreement to be signed in terms of both the supply sale as well as the power purchase agreement. Both of them were delayed, and also the tariff that was discovered in that particular auction or in that particular bidding, CERC has not approved that particular tariff. CERC states that the tariff discovered there is much higher compared to what has been discovered recently in latest auctions. And along with that, they also say this particular development, there has been quite a lot of delay from the SECI in going ahead and signing both the supply side as well as the power purchase agreement. Negative as far as JSW Energy is concerned, but the company says that they will go ahead and appeal this particular verdict by CERC.
Okay, all right. Thanks a lot for that, Vivek. Well, let's quickly wind this down. Mangalam joins us to help us out with a few updates that came in. Mangalam.
Well, we start with Titan that just recently came in strong revenue growth. It's led by festive and wedding season and gold price rise. If you look at the jewelry business, the standalone revenue grew at 24%. Jewelry business showed a revenue growth of 26%, in which it was led largely by gold coins and gold itself because of the gold price rise. 24% growth out there is what we've seen, whereas studded sales showed a good growth of 21% as well. But because of the gold price being higher and gold sales being higher, studded ratio may come down. Other businesses, barring watches and wearables, which grew 15%, haven't shown as big growth as expected. Emerging businesses in particular have grown just by 5% due to flat sales of Taneira. Key to track will be performance of all the other players that they report, because over the last few quarters they've been outperforming Titan. Margins would be lower due to higher salience of gold price and lower studded ratio. And growth path for CaratLane and Taneira are something that I'll particularly be watching out for. For Titan, see mild green at the open. Perhaps thereafter we'll look for more details coming by. For Marico, good performance coming in on the revenue front, largely led by price hikes in copra and vegetable oil. Out there, the operating profits is something that the company is a little watchful about, but good growth overall in the revenues itself with sequential volume pickup. See green there. And Nykaa as well, over 20% overall revenue growth, led by beauty business, gross merchandise value growing over 30%, fashion growing 20% as well. Slightly subdued on the fashion side, but beauty will more than make up for that.
Okay, and it is looking rather beautiful right now in the pre-open. Nykaa is up about 4%. Mangalam, thank you very much for that. So a lot of these updates are going to be, of course, in sharp focus. from the BFSI space and from the consumer companies that have reported over the weekend. Well, we're almost starting off with a 40-point pop. The problem, however, is the bank Nifty. Let's see if it is going to be in step with the Nifty or not. To begin with, there's a bit of a red on the bank Nifty, and if you look at some of the names, then on the downside, there is a Kotak Mahindra Bank, there's HDFC Bank that's starting quite soft. There's Cipla, Tata Consumer on the way down. There's JSW Steel also, Tata Steel slightly lower, and Coal India is slightly lower. So steel, some banks on the weaker footing as we speak. The Nifty is also losing ground. Now the 40-point pop is just about a 20-point pop. Gainers include Bajaj Finance and Finserv because of the reasons that Abhishek mentioned, 28-29% AUM growth, lots of positive brokerage commentary rubbing off quite well on the stock. Titan's numbers are being well received by the market, 1.5% higher. There is Shriram Finance, SBI Live. These are some of the other names that are up and about. And tech is starting with hope and promise because it is the beginning of the earnings season this week with TCS. So you've got Infosys, Tech Mahindra, Wipro, HCL Tech. A little bit of a tinge of green on most of these stocks. So we have to watch for the banks because they're offsetting whatever little excitement that the tech stocks are showing. The bank Nifty is now down about 45 points at this point.
Well, that's right. Just take a look at a few more stocks, Surbi. Angel One, their trading update, in fact, is ahead of most estimates. The average number of orders declined by around 21% month-on-month. That compares with an expectation of a 30% decline. The client acquisition as well increased quarter-on-quarter. MTF book increased quarter-on-quarter, and market share is more or less stable. Explains why that stock is up close to around 5%. Jubilant Food, we had highlighted this last week itself. There was delivery-based buying being seen out there. There were some shots that were getting covered out as well. The stock has made a fresh high post the Q3 numbers. So big move is what we're seeing on that one. Easy Trip, we had Mr. Nishant Pitti who joined us, and he clarified that neither him nor the other promoters are looking at selling any stake. Explains why the stock has opened up higher, but we'll have to see how long it can stay at those levels. For the time being, big volumes up close to around 8%. DCX Systems, another stock that was on the radar last week as well. We're seeing some bit of delivery-based buying. They've gone ahead and won a large order. The street likes that. So explains why that stock is up and about in today's trading session. What's on the downside? We have Dabur that's down close to around 3%. So that comes up for you on the screen. United Spirits is seeing some kind of profit taking. And Union Bank is down close to around 5% or thereabouts. But otherwise, green on the screen. The Nifty holding with mild gains. HDFC Bank, that's down close to around 0.5%. I think that's going to be the swing factor for the day.
Okay. SBI Cards, let's just quickly chat about SBI Cards because there was an upgrade from Nomura. Target price now set at 825. Nuvama has upgraded it to a buy. Their target price is 850, and it's a strong start for SBI Cards as it gains close to about 4%. Nykaa is another one opening up with strength. As Mangalam was just telling us, the BPC, the beauty personal care category, has seen a growth of 30% plus for the company, and that's a positive opening. Macrotech developers also came out with their Q3 update. The company has reported the highest ever pre-sales. Pre-sales in Q3 went up by 32% on a year-on-year basis. The company has brought down its debt. It's a good opening for Macrotech developers. Another real estate stock is Brigade, where the company has just announced that they are planning to develop a residential project in Bengaluru with a gross development value of 2,700 crore rupees. JSW Energy, another one we were tracking, has opened with a cut of nearly 2.5%. And pull up HUL because there were some reports which suggested that the company is looking to snap up the skincare startup Minimalist for about 3,000 crore rupees. HUL, it's a report as of now. CNBC-TV18 has not confirmed it. It's a flat opening for HUL, and ITC I don't think that's got a trade right now. It's just awaiting for it to, the price discovery.
Yeah, the price discovery will happen for an hour.
For an hour, so no trade yet on. And Kotak Mahindra Bank, on the back of the CTO resignation, is also on the back foot.
Just one word on HDFC Bank. That one, in fact, it moved briefly into the green. Now it's still down, but it's down marginally. It's come off a little bit from the low point of the day. So that's the stock, I think, to track for today. Its low today is 1,736 rupees odd. The street was prepared for a softish showing. It is a little bit softish, but let's see whether or not we see a bit of a bounce from the day's low.
Banks are really playing spoil sport. No denying that. This Bank Nifty is down 120. But what's happened is that even for some of the larger franchises like HDFC Bank, even if they're mobilizing deposits, the question is at what cost? And in HDFC Bank's case in specific, it's more term deposits. You have to pay more interest on those term deposits. They don't come as cheap and convenient as CASA. And CASA ratio has declined for the bank even quarter on quarter. So those are some of the concerns perhaps that are weighing on the stock this morning. But more on the markets with our next guest. Our market master of the morning is Devina Mehra, founder, chairperson and managing director at First Global. Devina, great to see you in the new year. First of all, wishes and greetings for a very happy, healthy and, of course, wealthy and prosperous new year as well. So let's start right there. You know, the interesting factor is that as we were collecting a lot of the opinion as 2024 was rounding up, for the first time in many years, people were really tempering expectations. Even the poll that we did a street poll that said that, expect maybe just high single digit to low double digit returns in 2025. Do you share that sense of cautious optimism, if I could call it that?
And wish you and your viewers also a very happy new year. May it be a blessed year for everyone. So coming to the one-year expectations, I have never given a one-year picture either in January or at Diwali time. And I recently wrote an article precisely on this, that what you should do with one-year projections. First of all, you should see what people said a year ago, 2 years ago, 3 years ago, because Bloomberg actually did a study which went back 25 years and all the big names in the world. So all the Goldman Sachs and the Merrill Lynch's and HSBC or Deutsche Bank or Citicorp and all the people listen to very carefully that they have a hold on what's going to happen. And the projections were off on the average by 15% points. So if somebody said the market will be up 10%, it could be up 25 or it could be down 5. And everybody clusters together because it's easy when everyone is wrong together. So I mean, so that should tell you what to do with one-year projections, because that's in a category called objective ignorance, as Daniel Kahneman calls it. That is not just a thing you don't know, but you cannot know. But coming to expectations, yes, I think expectations in general have run far ahead of where they should be. I have people coming to me and saying, yes, I'm fine with a conservative portfolio. I'm fine with 30% return a year.
So 30 is the new conservative, huh? That's the problem that we're dealing with. But Devina, hasn't a lot of that started, tempering? Because we have seen a time correction, maybe not a very savage price correction, but definitely a time correction. The market hasn't been galloping one way higher like it used to. I mean, we've been in this zone for now a little over 3 months.
Yeah, I mean, as you should be. If you go back again 18 years, if you look every year, there have been only 3 or 4 years where we haven't had a double-digit correction. So in 2023 also, we did not have it. So you can say after 2 years, you saw just in the double-digit category. So it was not something which is unexpected if you are really an observer of the markets and really look at data. So we had been expecting this. Of course, we bought hedges in the middle, but the market continued to run up. So we were cautious in March. We were cautious in June before the election results. But we did not go into cash. We bought hedges. So this year we've spent some money on hedges, but that's like, we didn't get used in a sense, but that's like buying health insurance and not getting hospitalized. I don't think it was a waste, but this was not something we were not expecting. As far as the situation now is concerned, I think if you have made money in very frothy areas, time to move to a steadier, more conservative portfolio, because I don't still see a big risk in the mainstream larger stocks, which is not to say that the market can't go down another 5%, it may, but I'm saying I don't see a big risk of a crash, because that comes when you're way out on the return trend line and you are still not there, primarily because 2010 to 20 was a very bad decade for the market. You didn't even make anything more than fixed deposit returns for a whole decade. And that's why you had this bull run. I mean, from, I think, the COVID lows, the Nifty is up something like 220% and the 500 is up some 270%. So we've had a great run, but I don't think you are still in that territory where you will, we're looking at a crash. The small cap, micro cap, that category is different, because again, people with a very who are very new to the market don't know that in every bull run, some of these stocks that run and then there is a correction or crash or whatever in the next uptrend, it's not the same stocks that go up in general. So, keep that in mind. So, as I said, if you made the profits or even if you haven't, get out of the frothy areas and get into more conservative portfolio, steadier portfolio and properly risk managed.
Devina, in the past, you've highlighted how banks, despite being a consensus overweight, hasn't really given oversized returns to investors, they have largely underperformed. Now going into 2025, what's the call on the banking and financial sector? And pharma seems to be a big overweight for you.
Yes, pharma has been an overweight since, I think, first or second quarter of 2023. And again, pharma had a poor run prior to that for many years, which created the room for this up move. And so we continue to be overweight pharma. Of course, in the next 10 days or so, we will be doing a quarterly rebalance. So, but we are still overweight pharma. We are overweight auto components and IT. These would be our overweights. Capital goods, industrial machinery, which we were overweight for 3 years, unlike most fund managers who discovered it in 2023. We were overweight from 21. Now we are underweight. So that is the picture as far as pharma is concerned. And what was your other question? Sorry,
Banks.
Said on?
Banks, I think, is what we. I think, Devina, if I remember correctly, you have been underweight banks, right?
Yes, we have been almost always underweight banks since we started the PMS almost 5 years now. As someone was saying, you repeat this in every interview of yours, that I am a nervous investor in banks and lenders. And the primary reason is that that's a thing that's an area which always gives negative surprises. And if you look at from 2020, in the past 5 years, it has underperformed every single year except 2022. And 2022 was the only year where we were market weight to slightly overweight on banks. Otherwise, we are almost always underweight. And if it wasn't the biggest weight in the index, probably I would love not to look at it. But even last year, if you see, the Nifty is up more than 10%. Of course, the broader indices are up even more, and Bank Nifty is up 5 and odd. And 2020, it was the only sector which was the only major sector in the negative. 21, again, it was half as much as the market. 23, again, underperformed. So every year, if you see, they generally underperform. And so that's the thing, that that your lender, your borrower does very well, you don't get anything extra. So you are in a highly leveraged business where the only thing is on your kind of luck part is not there on the positive side, it's there on the risk side. And if you look at the numbers also, I think now there is in the whole credit system, may or may not be exactly the banks, there is, I think, pressure building up on credit. A lot of indicators like that, like gold loans going up, which means people are forced to mortgage jewelry. And then this is something I heard Mr. K.V. Kamath saying, and that was a light bulb moment for me, that if you look at the two sides, that if you look at all the losses that are made, let us say in the F&O market, which is, I think, something of the order of 1.5 lakh crores, and that's likely mostly funded through these unsecured credit. And of course, there's issues on the deposit side also. So, and also remember, theoretically, also bank margins go up when interest rates go up. Which is when the loans get repriced immediately and the deposits, the interest rate goes up for slowly. So now you are again not on the right side of the cycle there. So those are all the concerns. I mean, it may be a market perform, I think, at best, banks.
But Devina, so, kudos on the pharma call, because actually if there's something that's worked really well in the last year, is actually pharma and healthcare. They have been the best performing indices. But I'm coming back to your point. You're saying stay away or, clear a bit of the froth in your portfolio. It's time to get a little conservative. Now, how else do you do that? Banks, you sort of outline some of the concerns that you have. Healthcare, you're overweight on. But how else do you take that conservative stance? When FMCG, we've been discussing this whole problem of anemic growth, for instance. And wherever there is growth, one can argue valuations are maybe still elevated. I mean, whether you're looking at jewelry stocks, you're looking at a Trent, etc. So how else do you get conservative, and which is the frothy part of the market where narratives are still strong, but you still see some froth? I mean, whether it's EMS or renewables, EV, the narratives are going very strong. But are you concerned about the prices?
Yeah, I mean, we don't generally go to those kind of frothy areas. If you look at, for example, there were a lot of defense funds that came out in the first half of 2024, and they have underperformed. So I always say that one easy thumb rule is to know where froth is to look at the areas where the new fund offerings are coming, because that's normally when that theme has matured and is close to the peak, is going to likely fall from there. So concerned about that. If you are in micro caps or stocks generally below, let us say 5,000 crore market cap, that's an area where risk management is very hard. So if those stocks fall, your stop losses don't work because they just keep falling. And also there is no hedge available because the only liquid hedge is on the Nifty and on the Nifty put, and then that doesn't move with the small cap. So that's like some easily identifiable area. Any new area that's coming up, if you want to have an exposure, have some exposure, but that should be a small portion of your portfolio, because companies with no history are inherently risky. And also remember that even if a company is doing well in a particular, if they've created a space, if they've created a business where none existed, if it's very attractive, that will draw in more players, so more competition, pressure on margins, etc. So, all those things also are there. So be careful. FMCG, yes, I mean, we've been watching for the last few months, and we have increased exposure in the middle of the year. But that story has been stalling. I mean, I'd seen, of course, the consumption slowdown has not come in the last 2 quarters. If you look at financial year 23-24, and you look at the GDP number, the private consumption number was at a 21-year low or something. So, I mean, people started looking at it only when the market started correcting.
Yeah.
But the problem is that the inflation has been a little more persistent than I thought. I thought good monsoon, now, food prices might go down, and therefore that will be a relief for the FMCG. But then, palm oil prices, everything has been quite strong. So, but I think, I mean, FMCG is probably somewhere in the bottom area now. It may not be the standout performer, but it's not looking too bad either.
Okay, so, perhaps something on your radar. And let's see, we'll take that up in our next conversation. But thank you so much for joining in. Once again, wish you a fantastic 2025 and look forward to more conversations. By the way, speaking about the slowdown, guys, I don't know, I mean, there were a lot of articles over the weekend talking about how the sales, end of season sales, the discounts are ranging between 70-80% because there's so much inventory that these brands are trying to clear. So I guess a lot of it, because the companies are not listed, or the brands are not listed here in the market, doesn't get captured. But I suppose it's just another sort of facet of this urban consumption slowdown that we're talking about. Anybody heading to the mall over the weekend? 60, 70, 80% discounts apparently.
Okay, all right. Well, let's move on. Let's invite our next management on the show. We have Rainbow Children's Medicare. That's the next stock on our radar to discuss the expansion plans, business outlook. We're joined by Dr. Ramesh, the chairman and managing director at Rainbow Children's Medicare. Hi, Dr. Ramesh. Good morning, and thanks a lot for joining in. Well, I've had the privilege of visiting your hospitals in South India, and boy, oh boy, you're taking care of the little ones, and best in terms of medical assistance is what I understand in parts of India as well. Well, tell us, Dr. Ramesh, how are things shaping up? You have big capacity addition plans. I think you're close to around 2,000 beds. Tell us about how do you see these capacity additions take place, and also a word on your expansion in North India, namely Delhi, Gurugram. I believe that out there you're looking at increasing your beds by a couple of 100 beds. Tell us more of that.
Yeah, thank you, Nigel. Happy New Year to you. So our the bed expansion almost we're going by 50% in the next 3 years' time. By calendar year 27, and I think we'll be adding about 1,000 beds. Most of the beds, about 450 beds, are going to be in Gurugram, and the rest of the beds are going to be in the south, mostly in the form of regional spokes as well as the city hub and spoke model. So this is how we are looking at it. In terms of Gurugram, we are kind of almost close to obtaining permissions. We are kind of planning to do a groundbreaking towards end of February or first week of March. So from there, I think it will take about 2.5 years' time. Maybe by 27 mid-year, we'll be operating both the hospitals in Gurugram.
Okay, all right. So 400 beds is what the addition is likely to be in Gurugram itself, out of the total 1,000 that you're looking at by 2027. Is that correct?
Yeah. We have a possibility of 200 beds coming in the form of acquisition, which is we are in the initial phase of working on it. Probably kind of we will know in a few months' time.
tell us, where is that inorganic growth, Dr. Ramesh? You know, I remember pushing you even when we had you had joined us on Inside Out. I was trying to quiz you, where exactly are you looking at? So this 200-bed opportunity, first of all, the time horizon that you're looking at, and if you could give us a broad geographic idea. Is it in that part of the world, the northern India?
Yeah, as I was always kind of been passionate about the Northeast, so that's likely to happen soon, and also kind of the acquisition closer to Hyderabad as well.
So these are two separate acquisitions. Hi, sir. Great to have you on the show, Surabhi here. So you are looking at two separate target entities, one in the Northeast, one in Hyderabad. Could you give us a rough sense of how large these entities are, bed capacity, and what are you thinking right now in terms of funding these? How close you are, and whether the funding is going to be all entirely, through internal cash?
I think the Northeast one is, right now they have 100 beds. I think we are kind of working on expanding to 150 beds in the Northeast. In the South, which is one of the Tier 2 cities closer to Hyderabad, we are working on about acquisition of 75 beds. So
and by when?
I think these things too should happen in the next 4 months' time, 4 to 5 months' time. This is what we are working on. So, CapEx-wise, so we have a lot of internal approvals. That shouldn't be a problem. We would be kind of taking over majority of the stake in both the places. We still yet to decide how much majority we're going to take.
So your cash was about 580 crore as of September. Will that be enough for you to fund your acquisitions, the two proposed ones, and your capex plans?
Yeah, that will be more than enough at the moment.
More than enough. Okay. And as you expand your bed capacity by FY27, what would the margins of the company look like according to you? Because you've been steadily expanding your margins. So what's the trajectory on margins as you see it?
So we've been expanding in the last 3 years' time, kind of year on year. We are adding about 15 to 18% of the beds. We continue to deliver about 25-26% of EBITDA margins. We never failed on that. So how I look at it is that what we call is disciplined expansion. So if I'm adding about 250 beds in a year, then that would probably take about EBITDA pressure of a percentage or so for about 2-3 quarters. Otherwise, we'll come back to normal. So we've been witnessing this the last 3 years, and I think we'll continue to grow the same way. The thumb pressure will be there for a few quarters. Otherwise, we'll come back and quickly. One of the reasons our southern business is getting more matured and matured. So as the southern business gets more matured, that EBITDAs are not going to be a big problem for us.
Okay, all right. Just a quick couple of questions then with regard to this EBITDA per bed. I think as of last year, it was 6.4 million. Now, I'm reading a couple of brokerage reports that believe that in the next 2 years, it'll go to around 8 million. Do you think that that could be the aspiration?
Yeah, I was looking at it. I think it would probably be closer to the 8 million and may not be exactly 8 million. Suppose if you are growing our RPOPs by 6% year on year, I'm sure we could achieve that, provided occupancy support us with the 55% of occupancy at a group level. We should be able to achieve that, closer to at least 8 million.
Got it. I just want a quick word on the Madhukar Hospital in Delhi. I think profitability is a little bit lower out there. You could help us out with that number. But the belief is that the margins move to mid-teens over there. Could you help us out with clarity on that front?
Yeah, I think it's Madhukar is a kind of would be probably talking about 10% or more than 10% margins. So this is a model where I don't think we will achieve the EBITDA margins of 20 or 25% because of the cost structures, because of the free beds, what we are supposed to do, and also the high rental payouts to the owners. So these are all the kind of stumbling blocks there. Perhaps this is how DDA properties, trust hospitals work. So we are doing well, but the margins are going to be the same. But considering that our capex per bed was quite low, we believe it's okay.
So from 10%, it moves up a little bit, say to 12 to 15% in the coming 18 months?
I think it should go up to 15%. Beyond that, it's going to be challenging.
All right, Dr. Ramesh, you built a great franchise, taken care of a lot of children as well across India. What's the, the succession plan? I believe that your son as well is already on the board, but he's due to join the business. Could you help us out with that succession plan? Because succession is something that the stock market looks at very, very closely.
Yeah, my son is Adarsh Kancharla. He's right now doing a fellowship in London within the transplant fellowship program in King's College Hospital. So he has got a kind of seat in London Business School and is waitlisted in Harvard. So very likely he's going to join one of these two schools in August, September of current year. So we always believe in that. We have been a kind of purely doctors and doctor entrepreneurs. The next generation is likely kind of, if they have come back with a business background to build the organization, will do better. So I encouraged him to kind of go for an MBA. So he's a bright guy. I'm sure with a medical background and business background, I think that's going to be a future asset for a long-term building of Rainbow.
Okay.
Thank you. Thank you, sir, for joining in. We look forward to chatting with you when your Q3 numbers come out and as and when those acquisitions close. Thank you once again for joining in. Get into a break. On the other side, Anand Agarwal of V-Mart Retail will join in to talk about their Q3 business update.
Welcome back. Just eye on the market and the color is completely red. Blame it on the banks. But it's not just the banks. Today, even the mid-cap market is feeling the heat. It's not a very pleasant looking screen early on because there's a decline of 0.5% on the mid-cap index and the bank Nifty is really sliding.
You know, the ITC, the initial rates are coming out because we have close to around that 40-45 minutes is over. So the rate that it's settled at is 456, which would be a 24 rupee, I think, adjustment in comparison to Friday's close. So that as well will come up for you on the screen.
And there's just one more stock, LTI Mindtree, because there is a double upgrade on LTI Mindtree by Jefferies. It's now a buy rating versus an underperform, and target price stands at 6,650. LTI Mindtree has been an underperformer. So whole of last year, the stock didn't do anything. It was absolutely flat. While the Nifty IT index gave a return of more than 20%. So after this kind of an underperformance, Jefferies believes there is value at current levels. So double upgrade for LTI Mindtree.
Okay, there we go. So some stocks that are in focus, but otherwise the texture of the market is weak, at least at this point in time. What, however, is not weak is the Q3 update that we got from V-Mart Retail. That's the next company on our radar. Now, V-Mart reported what looked like a pretty good operational update for the third quarter. The revenue is up by about 16%. Same-store sales growth has come in fairly healthy in double digits as well. To talk about this, we have Mr. Anand Agarwal, Chief Financial Officer of V-Mart Retail, now joining in. Thanks very much, Mr. Agarwal, for being with us. I'm just pulling out the numbers for the benefit of our viewers as well. 16% revenue growth and same-store sales growth at 10%. It's very good, but if I compare it to the 9-month same-store sales growth, then it's 10% versus 12% for the 9 months. Let's dive a little deeper into what you're seeing in urban, in sort of semi-urban, rural, and what the contours are behind the 16% revenue growth.
Hi, good morning. I must say, I think the going has pretty been good for the last 1.5 years. We've been constantly been improving on our operations, and obviously the macro also is helping. There's definitely far better traction that we are able to see both in the rural as well as in the urban segments. When I say urban, it's not really, so much of the urban customer for us. It's still a tier 2, tier 3 kind of customer who comes even in a tier 1 town for us. So that way, I think what we are seeing is a recovery from the last 2-3 years. Post-COVID, this segment had definitely, gone down a bit. And that is where we also saw our numbers, plummeting down a bit. But now for the last 1.5 years, we're seeing a good recovery, both at the macro level as well as a result of what we have been doing as part of our revamp and restructuring.
Okay, so give us some projections. Now we're almost done. I mean, just last quarter left in the full financial year, right? You grew 20% in the second quarter. Now the top line growth is 16%. So FY25, looking at the fourth quarter, what is the overall revenue expectation that you have?
I think we should still be able to grow at mid-teens or high teens. That's the trajectory that we have set for ourselves. I think quarter 4 is a very small quarter. But having said that, quarter 4 will also see early Eid and probably a winter Holi. So that should bide well for all of us and us included. So I'm quite hopeful that quarter 4 should also pan out quite well. We are also opening a lot of new stores. We have seen a good traction in the new stores that we've opened so far this year. And also the numbers look promising in terms of the performance or the sell-throughs that we are able to see on the ground. So quarter 4 definitely looks promising. At an overall level, therefore, the total growth should be in mid-teens or high mid-teens. At the same store sales growth level, I think high single digit or maybe just touching double digit is something that I would still target for.
How were the discounts, Anand, in Q3? Was it more than normal given the kind of urban consumption fatigue that we're seeing? And what would be the outlook on margins now?
No, I would not say that we put in more discounts. We did not see a lot of fatigue in the segments in which we operate, which is like tier 2, tier 3 towns, not as much in tier 1. We did not resort to a lot of discounting. There was a bit of concern early on due to the late start of winters, but later on, I think pretty much everything is normalized. There's a bit of concern around winters in East India and other central parts of India, but otherwise things probably remain normal. As far as the margins are concerned, I think we should still be able to see the kind of growth that we've been seeing so far. The numbers are still to come for quarter 3. So I would not like to comment so much on the margins, but margins should remain in a healthy range.
And what about LimeRoad? You had earlier indicated that break-even should happen by Q4 FY25. Is that on track?
Slightly challenging. It's a very, very small business, but an important business for us. It's less than 5%. The online business is less than 5% of our overall revenues. We've been constantly improving our performance on LimeRoad and the other parts of the digital business. The losses there have come down by almost 35%. The revenues have also come down. So we are not targeting to buy revenue. We are targeting to make that business sustainable. As far as the break-even is concerned, I am not too sure we should be able to see break-even this year. I think we are still some distance away from that. But the good part is that we've significantly reduced our cash burn. We've significantly reduced our losses from that business. And we are building towards a much brighter and a better online business as a portfolio for V-Mart.
So what's the cash burn right now in LimeRoad? And do you think by the end of this calendar year, is there a possibility it can break even?
Possibly, yes. I will not say again on a full year basis. There may be quarters, there may be periods where we will break even, where we may also have a profitability. But the online business is such mired with such complexities that it's very difficult to run that very profitably at a low average selling price. And our average selling prices on LimeRoad as far as our merchandising mix is concerned is definitely much lower. So we are running it more like a omni enabler for the V-Mart group, and that's the objective. So it will still remain probably a cost center, not as much a profit center in the near future.
Okay, so that's LimeRoad and the digital business. Finally, to come back to the capacity addition and the store rollout plan, I think you're at 488 stores as of December. How many more are you looking to add in this fiscal year, FY25? And overall, I mean, what's the rollout plan for the calendar year as well?
I think on a full year basis, we should be opening roughly around 55, 58 stores. There may be a few store closures that may come in Q4. We've not closed any stores the last quarter, that being the festive quarter. So we typically avoid any store closures in Q3. Q4 may see some amount of store closures, which are very normal, nothing abnormal. So every year there should be 1% of store closures, 1 or 2% of mistakes that we will actually always end up doing. So that will happen in Q4, but on a full year basis, the net store addition should still look like around 50 to 55 stores.
Okay, all right. Anand, we'll leave it on that note. Thank you very much. Once again, wish you, the very best for 2025 to you and, of course, your team at V-Mart Retail. That's V-Mart, but we have to, take the eye back to the screen as well, because this is once again a big decline. The only caveat is that let's keep the context in mind. Today, we're not falling alone. That's the little reassurance, because if you look at a lot of the regional markets across Asia, many of them are also seeing red. For instance, you're seeing the Hong Kong markets lower. The Japanese market is falling actually quite a bit, 1.5% down in Japan. So it's sort of mixed shades. Even the Chinese markets, despite what the PBOC said over the weekend about moderately loose policy, despite that, there's weakness in regional markets. But yes, for us, I mean, the concern continues. The selling in banks, when the Bank Nifty is now down almost 1%.
Yeah, and that's even though HDFC Bank is as flat as can be.
It's still not falling,
HDFC Bank is as flat as can be. So the other stocks, in fact, are contributing, namely Kotak Mahindra Bank, that's under pressure, and a couple of other names as well are lower in today's trading session. Just a few stocks that I want to highlight. Jubilant Foodworks, that's the outlier today. It's in this year itself, we're just not even 5 sessions into the year. The stock is up already around 10%. So that's seeing a good amount of price action. There were a couple of dips that we saw in the last 40 minutes or so, but that's quickly got bought into. So that's one stock that's clearly done well, 12% in the last 1 week, as my director very helpfully pulls up. And Crompton Consumer Electricals. We had highlighted this in the morning as well. The stock has fallen more than 10%, I think, in a matter of 15 sessions. But currently, it's trying to pull back a little bit. It's up close to around 2.5% or thereabouts. It's been a rank underperformer, but that's moving with some volumes as well. So just highlighting that stock.
And QSRs, that's the other theme. So there is a rub-off impact of Jubilant Foodworks on Devyani International, 4% up, and Sapphire Foods, which is up 4.2%. As Abneesh was saying, that QSRs have gone through a period of 8 quarters of subdued growth. So now the base effect is favorable. And so far, at least, some of the numbers from the consumption side, whether it's Avenue Supermarts or even Jubilant, do indicate some positive momentum. So QSR is a pocket which is doing well. And in banks, PSUs, the Nifty PSU banking index is down more than 2%. Union Bank has a fall of 6%. Bank of Baroda, PNB down 4%. Indian Bank, Central Bank, these are under significant pressure.
What's also standing out for me is the fact that even Marico came out with a pretty decent update. Third quarter update was good. They're talking about possibly double-digit growth, and some of their portfolio brands have done really well. But now that is really helping the sentiment, about 4% down on that stock. Dabur is a different story. Dabur anyway has been guiding the market towards a weak quarter, and they've said the pain in this, the general trade channel, that is continuing. So Dabur is also down 4.5%.
Just one more stock, IMFA, Indian Metals, Ferro and Alloys. We've been telling you all here on CNBC-TV18 for the last 10 to 12 months that there is a shortage of chrome ore, globally. And because of that, ferrochrome prices remain more or less steady, irrespective of what's happening with other commodity prices. IMFA is holding with a gain of around 2.5%. Noted investor Dolly Khanna's name had got, turned up in that 1% plus shareholding. So that could be one of the reasons why the stock is holding up with a gain of around 2.5%. And as Nimish has told us in the past, there could possibly be some kind of corporate action that the street is waiting forward to. In the last few days, the stock is up. Last 1 year, in fact, I think it's up close to around 50% or thereabouts. So keep an eye out on that one. And as we told you earlier, ITC, 25 rupees is the adjustment that we have seen on that particular stock as well. That pre-open special trading is out of the way. And this is listed now, X of the hotel business. Well, Rahul Sharma, the Director and Head Technical and Derivatives at JM Financial Services, joins us on the show. Hi, Rahul. Good morning. 2025, hopefully it's a good year. Wishing you, your team, your family a very, very happy new year. Well, you normally join us and you normally give us that one kind of a data point that you're stressing on. What's it this time around? The FIs are net short. So what is the data point, if you could tell us? And also, what are the levels you're looking at on the Nifty for this year?
Yeah, thanks, Nigel. So, the good thing is markets have somehow managed to create a higher low over the last few weeks, and the 23,263 low that we formed in December seems to be intact. Now, this will remain a crucial level as we head into the big, the weeks where we have a lot of events. We have earnings, we have the US, president taking charge, plus also the possible rate cut happening in the first week of February. So I think incrementally markets should get better from here. 23,700 is a crucial support for this week as markets will try to find their feet after once we start getting into the earnings numbers. And on the upside, I think slowly, gradually we should be. So two levels in mind: 23,700 for this week, and the panic low that we had formed in December remains a crucial, all-important level in case you were to create long positions at these levels. Now, the technical setup is indicating that we are on the way up. There could be a bit of volatility, which is something there. And secondly, the positioning of the FIIs continues to remain short. That should get challenged once we cross 24,200. So 24,200 once gets taken out, may happen this week, may happen next week. I think the next stop for the Nifty should be at 25,000, which could be a short covering move, which can take the markets higher. So all in all, look to be a buyer on dips, look to buy around the support levels. And we feel that, over the next few weeks, market should do well from here.
Rahul, L&T, what is the chart telling you?
Yeah, so Larsen and Toubro has been sideways for the last few months, in fact, almost a year now. And this sideways structure is more of a technical, box that it has created on the monthly charts. Now, you could be an investor in this stock. We feel that the stock has got long legs. So, in fact, this is also one of our stocks for the year 2025, which can deliver a return of north of 20-25% on the upside. So one can look to buy L&T at these levels. I think the risk reward is very much favorable. This also is part of the capex theme that is expected to do well over the next few months. And technically speaking, I think this stock has got legs up to 4,500 on the upside. So 25% upside broadly. L&T remains our top pick from the capital goods space, which can outperform the market going ahead from here.
By the way, just taking a minute away from this interaction, just to point out that there's a lot of weakness in PSU banks today. Union Bank is down 6.5%, Bank of Baroda is down 4.5%, PNB, Central Bank of India, IOB. So the entire PSU banking pack, look at that, 3%. That's a crunching blow on the PSU banking space. The Bank Nifty relatively is better. Bank Nifty is down about 0.7%. I just want to put out, I think we'll get Abhishek as well to recap some of the updates because BOB reported, numbers over the weekend, the Q3 update. Union Bank's update I was looking at, sequentially deposits are down. Even year on year, the deposit mobilization is just 3-4%. So very, very anemic compared to some of the other private sector names. We'll put the spotlight on them in just a bit. But Rahul, coming back to you, and banks is really what I want to talk about. I mean, slightly more medium-term perspective. Because this banking move has been a non-starter. You get a couple of good days, a trading bounce here and there on some names, but that big bank move, that's completely eluded the market in all of 2024. What do you see ahead?
Yeah, so at this point in time, clearly Bank Nifty is at a make or a break level. 50,500 to 50,000 are the twin supports for the banking index. It also happens to be the 200-day EMA support for the banking index. Now, clearly, the follow-up buying has not happened in the private banks. We saw them do well in bits and pieces, but eventually, they have to give these big breakouts, which have not happened as of now. So I think the best strategy at this point in time is to switch to NBFCs. NBFCs have done relatively well. In fact, the 21st November lows are still intact in something like a Bajaj Finance. And I think over the next 12-month period, this is one stock where you could keep your eyes on. This stock is something which can come out of the last 3 years of consolidation that it has been. In fact, the stock has been broadly sideways over the last 3 years. And the breakout could very well take us, north of 25% in the same. So, there's a triangle pattern, as you can see on the graphs on the long-term charts. And this has shown resilience over the last few trading sessions. The kind of volume-based buying that has happened is clearly indicating that strong hands have entered into it. And I think if I were to bet money on one NBFC stock which can do very well, I think it could be Bajaj Finance. So rather switch to NBFCs as compared to what is happening in banks. Maybe wait for a better day and a breakout confirmation. Once that happens, that would be a better play at that point in time. But at this point in time, I think it is Bajaj Finance. It looks pretty solid.
Well, valid point you're making out there, and it's out of the blocks in a flash. It's the top Nifty gainer for this calendar year so far. What are the ultimate targets you're looking at on Bajaj Finance?
Well, technically, projections are coming around 9,000, but I think 8,600, 8,700 is where one could look to, look at a target as, which is approximately around 20-25% from these levels.
All right, and the one that has defied gravity in the last few years has been Gravita. The stock pulled back a little bit after they raised some money, but you believe it's good for more. I think that's one of the top picks you have. What are the targets out there?
Yeah, so Gravita is something which is more of a continuation play. The stock did fairly well in the first half of 2024. Post that, it entered into a consolidation correction, time correction, if I may call it. I think, the stock has got a 40% upside from these levels and can be bought at current prices. It has got a pole and flag pattern on the weekly and the monthly charts, which it should, provide continuation in the current uptrend. So I think this can recycle into a new trend, and one can look to be a buyer in this, especially if you have a 6 to 12 month kind of a time frame. This stock can be the best performer of the all the stocks that we've discussed today.
And SBI Life, Rahul?
Yes, so this is one of the bargain plays. So from the insurance pack, this is one stock which is available at a long-term support line. So, as you can see, 2020 onwards, there has been a rising trend line. The stock has taken support over there twice. I think, at these levels, the risk reward is very favorable, for a fresh upside. And, one can look to buy in this space for a potential upside of around 30%. So, insurance play plus the budget also coming up, I think there could be triggers. But at the same time, technically speaking, the risk reward is very, very favorable. And one can look to buy at these levels for an investment perspective.
Okay, all right, Rahul. Thanks a lot for joining in. I think the call that you are making is buy on dips in the near term till the lower levels get violated. And as we had that chat with Rahul, the stock, or the Nifty, the Nifty has recovered close to 80 points from the low point of the day. The few of those IT-related names, well, they are pulling back. They have moved to the high point of the day. So good move from tech as we speak. HDFC Bank is more or less flattish. So that's good news as well, because that's holding one end up. That's a bit of a fight back that we're seeing from the low point of the day. Slip into a short break. On the other side, Manisha Gupta is waiting for us. She'll tell us what's transpiring in the commodity space.
That the street is penciling in. Half of the respondents, which is 50%, believe that the rate cut going into 25 would be at least 50 basis points. So 50 to 75 basis points is what a lot of people are betting on. So that's the rate cut expectation going into 25. In fact, 24 was a very volatile year. We had a budget, we had general elections, multiple state elections, and so on and so on. But 25 could be a year of moderate returns, but the expectation is that the positive returns could continue going into 25 as well. That's the big poll from CNBC-TV18.
Well, the consolidation theme continued to play out in 2024, with 40 million tons of capacity folding up into the hands of Adani Cement and Ultratech. And over the years, Adani's foray into the cement space with a massive war chest has acted as a catalyst, triggering the race for capacity share, which has increased the competitive intensity. The top 5 players now account for more than 60% of the market. That compares with only around 40% 7 years back. The question is, will consolidation slow down from here on? Remember, the recent deals have been concluded at around $100 per ton mark. That's closer to replacement cost. Well, ICICI Securities says that cement majors like Ambuja as well as Ultratech, they have exhausted most of their cash reserves post the recent acquisitions. They add, except for a few NCLT cases, they believe that low-cost acquisitions are largely behind. And now the potential deals may command a significant premium to the replacement cost. That could make them much more.
Mid-caps are tumbling, so mid-cap index is down 400 points, 0.7% lower now in the mid-cap index. The advanced decline ratio, which has been positive for the last 4 days, has turned adverse. We've got nearly 3 stocks declining for 1 in the red. At the day's low now for the broader markets. But let's talk commodities. Manisha is here with us in the studio. Manisha.
Well, thank you for that. I'm starting with metals here, which have started 2025 on a very mixed note right now. Well, there are 2 things to work on. One is the dollar index, which is trading at around 109. It's a 2-year high, so that is putting some pressure on prices. And on the other side, you had some Chinese data to react to today. While the services PMI was on a stronger note, but the overall PMI numbers did not excite the street. So it was lesser than the previous month and lower than what the street was anticipating as well. I want to start with precious metals because 2024 was a great year. We did see 22% gains for silver and 28% for gold. And this year as well, for 2025, the last 5 or 6 days, the momentum has just about continued and we've seen money flowing in precious metals there. The base metal that seems to be doing well is the copper prices. Remember, for 4th quarter of 2024, we saw the copper prices decline by 10%. It even went down to a 9-month lows. But the first week of 2025 has seen copper prices gain up by nearly 1.5% on the higher side. Well, the street is anticipating that you will see more stimulus measures coming in from China. Of course, much would also depend on the buying interest, especially after 20th of Jan, on how the world changes, is something that's keeping the markets jittery. But at this point in time, the copper prices are starting 2025 on a stronger note. And this is even as the dollar index is trading at a 2-year highs. What is not doing well is the other base metal prices. So when you look at zinc, which gained 13% in last year, has started 2025 3% on the lower side. Aluminum gained 6% in 2024, is 2.5% on the weaker side. Steel and iron ore prices fell in the previous year and have started this year as well on a weaker note, awaiting on what China would really do. I want to take you to the iron ore prices because we saw nearly 25% of decline in the previous year. We're down by 4% for this one in this year as well. It's trading at a 3-month lows. $100 a ton has broken on the lower side there. Rising inventories, weak Chinese data, all of that seems to be bothering. But what is important to watch in this week is really going to be the jobs data, employment data from US. And apart from that, there are various speeches from US Fed officials that would keep the markets choppy as well. Okay, all right, Manisha, got it. Choppy it is for commodities and choppy it is for equities as well this morning, actually. The good news for the bulls is the fact that there is some recovery from the immediate lows that we were sitting on. And the recovery is happening thanks to some buying on consumer stocks, select consumer stocks, and select BFSI as well as IT names. Speaking of consumer, let's look at the trends that are outlined in the 3rd quarter print. And the stocks are really moving. So you have pizza and lipstick, which is moving higher. I'm talking about Nykaa and Jubilant Foods. But the staples, Dabur, Marico, these stocks are still under pressure. Let's go across to Manglam to get a quick heads up again on those numbers. Manglam.
Well, pizza, lipstick doing well tells you about, the schism that we're seeing in consumer sector while staples are not doing as well. So you have a very, very strong update coming in from Jubilant Foodworks. The consolidated revenue grew 56%. Optically, this looks very strong. But remember, consolidated revenue includes the acquisition of DP Eurasia as well. The number to watch out for is the standalone revenue. There too, it's a 19% growth that the company has reported. And that is led by higher like-for-like growth coming in from Domino's India itself. And they've opened 60 net stores as well. So all these factors working well for them. The important thing we need to watch out for is the like-for-like growth in delivery versus dine-in, because over the last few quarters we had seen dine-in decline even as delivery was starting to pick up. So has there been an arrest in dine-in now, the decline out there? Secondly, we'll watch out for the impact on gross margins on account of beverage portfolio changes. Remember, ever since the Bhartiya family went ahead and bought HCCB, they did do a tie-up with Jubilant Foodworks to sell Coca-Cola as well as against Pepsi in the Domino's store. So does that come at a higher gross margin or not? And the third thing we'll watch out for, the growth in their other franchise, which is Popeyes. So that's a couple of things that we'll have to watch out for Jubilant Foodworks. For Nykaa, we did speak to Anchit Nair a couple of days ago on our channel itself when they released their beauty trends report. There they said that net revenue growth will be higher than mid-20s in the third quarter. But importantly, the beauty business is doing a lot better. The growth has accelerated out there. And, this time around, it will be above mid-20s, and the gross merchandise value in the beauty business will be in low 30s itself. So it's a good update coming in a sector which was earlier looking for some growth coming by. Fashion business as well for them, which was earlier supposed to be a growth driver, is struggling a little, but there too we've seen about 20% revenue growth, which is subdued, but the street expects this to improve as consumer sentiment improves as well. Speaking about consumer sentiment, not much improvement in general trade is what we've seen. Dabur had called out this weakness earlier, and that's what's reflecting in their performance this time around as well. But if you look at Marico, the overall revenue growth of the company would be in mid-teens. What's worrying the street right now is that this revenue growth is largely price-led, and there could be some margin-related impact, which the company has called out in their third quarter update as well, where the gross margins have actually fallen a little more than expected.
Thank you for that, update, exhaustive update. It's now over to Abhishek for Union Bank.
Well, Rima, I don't remember the last time for a sustained period of, let's say, 2 to 4 quarters that Union Bank of India did gain market share. Very weak business momentum coming in over there. A deposit growth at 3.8% YOY, decline of 2% sequentially. In that, the domestic deposit growth is just 2.5% YOY and a decline of, around 2.4% sequentially. Advances growth is close to 6% YOY and 2.2% sequentially. In that, the domestic advances have grown by 5.3% YOY and 2% quarter-on-quarter. The domestic RAM, that is retail, agri as well as MSME, which has been the focus area of all the lenders, that is up only 6% YOY and has declined by 1.5% sequentially. So a weak business update is being factored in the stock price in trade today. Back to you.
Okay, indeed, and Union Bank is leading the entire PSU banking pack down with it, but the numbers on deposits probably the weakest for Union Bank. Thank you for that, Abhishek. Very quickly, back to Mangalam to wrap this up. ITC, the demerger of the hotels business finally happening. Mangalam,
yes, the
price is on the screen now.
The price is on the screen right now, and if you compare the opening price to the previous close on ITC, it would be a difference of around 26-27 rupees, which is slightly higher than what the street was anticipating. More on the street, we're working with a number of anywhere between 15 to 20 rupees per share of the hotels business, and now the stock price is correcting to that as well. So it will be very interesting to see how the hotels business lists now sometime in mid-Fed. The stock opened lower by 26 rupees per share. That implies that the hotel business could be valued at close to 54,000 just basis the stock price move. The real, proof of what the hotel business is valued at will be when the hotel business lists in mid-Feb itself. But once again, to, jog your memory on the hotel business, first half of this year, revenues were closer to 1,500 odd crores with 28% margins, assuming they do 4,400 crores revenue by FY26 with close to 1,450 crore in terms of EBITDA. Valuing it anywhere between 26 to 28 times, which is a discount to Indian hotels and a premium to all the other players. This could be worth nearly 175 to 190 rupees per share. But the street believes, basis the price difference right now, it could be valued at a little higher. But the proof of that will lie in when the hotel business lists.
Okay, all right, Mangalam, thank you very much for that. With that, we have to slip into a quick break. On the other side, our special segment, It's the Economy. Lata today will be in conversation with Shantanu Chakrabarti of BNP Paribas to discuss what the early advances in deposits growth data indicate about the Q3 performance that can be expected from banks.
On borrowed funds at low cement prices. Well, the pain point is elevated competitive intensity has led cement prices plunging to 4-year lows. Demand as well has been plagued by general and state elections, heavy rainfall in few regions of South India, the construction ban in NCR region, and also labour unavailability in various parts of the country. But part of the street is optimistic that cement sector has hit rock bottom and it's ready to fight back. Well, Jeffrey says that dealers suggest that price declines have bottomed out, and now the industry is attempting price increases every month. They believe that the recent increase in industry consolidation further supports a case of revival in cement prices. Though sustainability of the price hikes will depend on what the leaders prefer, volume or price increases. Well, Goldman says that their channel checks suggest that demand is recovering, though on a low base. With the expected pickup in government capex, rural demand is likely to improve, and urban real estate market, well, that's doing well as well. So they expect that cement demand will grow by around 7% in FY26. On the profitability aspect, well, INCRED says that lower fuel cost, improvement in volumes, that could lift EBITDA per ton by around 160 rupees on a sequential basis. Though they admit on a year-on-year basis, it will still be down by around 200 rupees per ton. Axis Capital says that cement spreads are on recovery path. It's at the highest levels we have seen since January 2024. They add that spot spreads are now 12% higher sequentially, though it's still down by close to around 5% on a year-on-year basis. So 2024 has been a brittle one.
Welcome back. Indian stocks in general and the Nifty Bank in particular have plunged into the red following Asian markets and probably as a result of the strong dollar and US yields. But the bank stocks are also reacting to the early Q3 deposits and advances disclosures. For a majority of the banks, deposit raising has been a struggle, and the way the early data is showing, it looks like NIMs or margins are going to be under pressure when the full results come. For HDFC Bank, it's the other way around. It appears that not margins, but the volume of loan growth will be a bit of a letdown. To analyze the early numbers from banks, I have with me Sandhanu Chakrabarti, the head of banking and finance company analysis at BNP Paribas. Santanu, good morning. Thank you very much indeed for joining us. And well, it's still the first week of the new year, so a very happy new year to you and everyone at your company and your family.
Thank you, Lata. Good morning and a very happy new year to you too. I just heard you speaking about the deposit numbers, and just looking at liquidity in December, you'll see where those numbers are coming from.
Oh, absolutely. It was tight liquidity. But you know what? Since the market is more preoccupied with what is dragging down the indexes, I'll begin with HDFC Bank. It's not the one that's lost the most, but willy-nilly, even if it is in the red, it pulls the Nifty Bank a goodish bit. What have you made of the numbers? That 3% loan growth is after having sold off 46,000 crore of loans this year. Otherwise, the number would have been different.
I mean, otherwise also on their base, the number doesn't look blazingly different. And frankly, the loan sale downs tell us more about their approach towards profitability and pricing consciousness, rather than have a material impact on the size of the balance sheet at this point. This was true of the mortgage sales that they did in the first half, and it remains true even at the end of the third quarter. But gives us a sense that they are very cautious that the money that they are raising incrementally is high cost money, and therefore the asset uses it should be put into should be commensurate to the cost of that money and the nature of that money. So, for example, in this quarter's early release also, Lata, you'll see that their focus the growth has been primarily in what they call CRB, commercial and rural banking, and retail, and wholesale, which is corporate, essentially still continues in shrinkage mode, and that follows the plan to a T. Having said that, is 0.9% quarter on quarter a low number? No doubt about it. But the interesting thing about
Shantanu, the question I have about HDFC Bank is, first, what do you expect their margins to be? My sense is the margins are going to be as good or better than the previous quarter. But ultimately, EPS or profit is both volume and value. So margins are high, but volume is going to be low. So what is your EPS forecast, ROE, the entire, how do you approach the bank?
Right. So, in this part of the interest rate cycle, the cost of funds for most banks have kind of matured. So ROE, I mean, margin erosion to start with, which drifts down into ROA and ROE, is not material for any of the major banks. HDFC is a special case where HDFC, because of a very, somewhat irregular liability structure that it's coming off and it's gradually rationalizing, you might actually see I mean, even better performance on a sequential basis on margins vis-a-vis other banks, right? And now the moment you see that they have been able to move deposits up by 2.5% sequentially, not a large number, but a meaningful number, a 64,000 crore number is not small in the context of what's happened in the system in the last quarter, especially in December.
Fair enough.
And in that context, I think, the margin surprise, which the market reacted so positively to last quarter, that positive margin surprise could come through. Now, I hear your point around how profits are ultimately a function of both loan growth as well as margins. But I think in HDFC's case, especially if people have a price to book prism on valuations, they're trying to figure out what steady state margins and therefore ROAs and ROEs look like. And better and improved optics on that on a sequential basis, I think is going to weigh heavier than, what the EPS number looks like.
Okay. So what would your price to book forecast be for the year? And I think you have the biggest price target on this street, 2,550. Right. Yeah. Okay.
Right. So, I mean, look, I have still some way to go before re-rating it back to what it used to trade at. But I'm just saying that at 2.1 time price to book, it's probably, I mean, if you strip out the subsidiaries, it's probably trading at a valuation that better suits a wholesale lending NBFC than a retail dominant bank, even if it's with low CASA. And therefore, my target multiple is around 2.8, right? And that gives you that much of upside. And I think the path to achievement of that multiple is that margin improvement and therefore consequent impact on ROE.
Okay, fair enough. Let me quickly look at the other banks. More generally, what have you taken away from all the other private sector banks? We don't have too many of them. We've got IndusInd, RBL, CSB. Many of them are smaller banks. The big Axis ICICI are not out. But what have you made of the private banks? I'll come to the PSU in a bit.
And so, I mean, the one which stood out for me was IndusInd. So IndusInd's growth number, now I can understand there's some stress in the MFI sector and it's hard to make a segment commentary at this stage from the early releases. But the numbers on both assets as well as liabilities looked a little lackluster, to be honest. And there's a takeaway from there as well. And Bank of Baroda has also put out numbers today, and their growth is about 9.5%. Yeah, I heard the previous anchor was also speaking about Union Bank. So their numbers have not looked great. So overall, I think the tightness of liquidity is starting to bear down on deposit growth. But what is quite interesting, Lata, is at least the CD ratio aspect of it is no longer a topic that seems to be in play. Because if you look at the last fortnight's disclosure, you'll see the loan growth and deposit growth, as we had expected, has exactly converged to 11.5%. I think easier liquidity is required.
Yeah.
And
no,
that's
I would
perhaps
assume,
required even more than easy market.
I would assume
for
we
the
will hear
growth to
of...
accelerate.
Yeah, I agree with you. I mean, I think we will hear of OMO, OMO purchases by the Reserve Bank and probably at the lower end of the curve, not at the 10-year, but definitely at the lower end of the curve, there will be liquidity that they will provide. But there is a separate story on the kind of pressure we are seeing on the currency. On Friday, the Chinese PBOC has allowed the currency to go beyond 7.3. And today, the offshore currency is 7.36. So, I mean, we don't have too many options. We will have to let the rupee go, perhaps. And right now, as I speak, 85.80 has been given up by the Reserve Bank. They seem to be protecting it last week. Today, they've given it up. Okay, coming back to NBFCs, then I'll come to the PSU banks. What's true for you? Bajaj Finance, winner all the way?
5 million customers added, Lata. I mean, I've been looking at this. It's my top pick in NBFCs, okay? But just,
even at this price,
irrespective of what view you have on the company, to look at that and appreciate. I mean, in this environment, to add 5 million new customers, it is a stunning achievement. And their growth is tracking. Now, there's no comment around asset quality. But if asset quality pressure was a major concern, would they have grown at 28?
Okay, any PSU bank you like?
So, SBI, we have just gone to neutral because, the pricing appears a little more full to us at this stage. But we like the setup. I mean, there's nothing wrong there as far as we are concerned from a business perspective. But just that relative to what we have available on things like HDFC Bank at this point, we have moved to a neutral on a sector basis because our recommendations are sector relative.
Okay. What intrigues me is I think you have a coverage on SBI cards. That still remains underperformer, right, for you?
Right.
I guess
yes,
likely
it does.
so.
Yes,
Okay.
it does. The regulatory pressures and the business has structurally changed. I mean, I don't mean just the SBI cards business, the credit cards business. The revolvers, a lot of them have become essentially EMI customers. And even in a period where you're seeing some stress, you still do not see revolver behavior, right? So something has fundamentally changed about that business with implications for profitability and ROE generation capability of that business. Apart from that, all the regulatory overhangs continue to exist. On top of that, when I see valuations which are probably a little richer than Bajaj Finance, it's very hard to make sense of them on a relative basis.
Okay. Overall, how does BFSI figure for BNP Paribas? I mean, this is, of course, your strategist question I'm asking you. Right. But you tell me, what do they think? Should we even chase banks? Or should we really wait for even 6 more months for liquidity to return and banks to get more comfortable?
Right. So the BNP Paribas view throughout the last year has been, that we have preferred banks and IT. That's what our strategist Kunal has preferred. Now, within banks, not much has fundamentally changed, right? I mean, maybe in the beginning of the year, if we would have thought about a September or a December cut, and now we are talking about a February cut. But other than that, if you look at the overall setup of the business, nothing has really changed. And I suspect that, therefore, banks will continue to feature prominently.
Let me put it this way. Let me put it this way, Shantanu. Have deposits costs peaked? Have margins bottomed? Or you think there is more of margin erosion left to come? And for how many quarters?
So the answer to that is, as far as our pre-cut basis is concerned, both of those things have happened in a material sense. I mean, 1-2 basis points here there is different, because what were the costs hardening from? The costs were essentially hardening from the repricing of the FD back book. Now that is done. If you look at the existing FD books of banks, what their implied yields look like, and the incremental pricing on which they're raising FDs, they're both at par. I mean, for most banks, that's about 7.25%. Right. Okay. And so incrementally, the only pressure on cost of funds is the extent to which FDs increase in proportion of total funds. That's about it. That's a couple of basis points here, there. Okay. What happens is margins actually bottom after rate cuts, because remember, a very large part of the loan book is repo linked. And a slightly larger part will become repo linked the moment rates get cut. I'm talking about top corporate exposures, which will go to the lowest rate. So the margins bottom after that. From that point onwards, you have stable to slightly improving margins, which creates a great earnings growth setup for FY26.
So in short, margins still have to suffer. And it's only after the rate cuts that we are going to see them improve. For broadly the sector, exceptions notwithstanding.
Right, but until pre-rate cut, you are not going to see too much of turmoil in margins. It will be around this level.
Okay, got it. Thanks a lot. Thanks a lot, Chandru. Out of time, and we will touch base after the big banks announce their numbers. Thank you very much indeed for joining us. And as we wind down on Bazaar, the markets are still indicating a lot of pain. The Sensex and the Nifty are holding up, but mid-caps quite clearly under pressure. And I think the pressure is coming from global factors. Wrap up on that note. Chartbusters coming up.
The hope is that 2025 cement will be in far better shape and it could deliver a far steadier performance.
India is in vogue for a number of international brands this season. Surabhi Upadhyay, CNBC-TV18, Mumbai. Hello, I'm Surabhi Upadhyay and I am going to be joined by trailblazers who are transforming the banking and finance sector in India and around the world, only on CNBC-TV18.
Celebrating 25 years of CNBC-TV18.
From sharp insights in the political arena to all the excitement from the world of sports. We are here at the CNBC-TV18 budget headquarters as we've done for the last 25 years.
Celebrating 25 years of CNBC-TV18.
The markets are betting big on affordable housing. You look at the kind of stocks that have risen.
We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating 25 years of CNBC-TV18.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18.
Jubilant Foodworks rallies 4% on the back of strong quarterly business update. Domino's India like-for-like growth comes in at 12.5%. Consolidated revenue growth is at 56% year-on-year.
Titan 2 trades higher after its Q3 business update shows a 24% year-on-year revenue growth and a 26% growth in the jewelry segment.
Angel One climbs 3% on the back of its third quarter business update. Client acquisition grows 29.3%. Client base also grows about 2.5% month-on-month.
Nykaa climbs close to 2% following its third quarter business update. The net revenue growth is likely to be higher than mid-20s. The company's beauty vertical growth has also accelerated. Currently, the stock at the high point of the day, almost up 4%.
On the other hand, we have Union Bank under pressure after a weak third quarter business update. Deposit growth disappoints, declining 2% versus the September quarter.
Hello and welcome to Chartbusters. I'm Nigel, and with me after a while is the new Papa in town, Mangalam. Mangalam, congratulations yet again. Our first show since the time you're Papa. So the entire team of Chartbusters wishing baby Vani all the very best. Lots of love, prosperity, waiting to hold her in my arms, and best wishes to you as well as Sonal. The journey has just started, and I'll tell you what, it's going to be the most precious feeling you'll ever get. When she looks at you, oh my God.
Thank you so much, Nigel. You know, the last 15 days, they've been brilliant, but it's just, you know, one-sided because the baby doesn't respond as much. You're just hoping for the time when she starts responding, and then that becomes two-sided. I'm sure if the first 15 days are something to go by, there is a lot more exciting times ahead. And thank you so much, you and, you know, everyone in the Chartbusters team as well for the wishes, blessings, and a lot of timely advice that you keep giving from your own experience.
Well, that's right. 15 days not responding too much. Next, I think 15 months, she'll respond a lot. After, I think, you know, close to 4-5 years, will be like, thoda time, give me, I just want some time to myself to do my workout, Pilates and all of that. But Great experience, but we've got the markets to look at, so let's get straight to that.
Absolutely. We're talking about chart busters. This has been the biggest chart buster of the last 15 days for me personally, but the market's pretty much in the range itself. Where does it go from here? Shivangi Sada of Motilal Oswal joins in now. Shivangi, at higher levels, we did see some selling today, but importantly at the lower levels, we saw some buying as well. All in all, the net change on the Nifty, not very much, just down about 46, 47 points. What does one do?
Good morning, Mangalam and Nigel. Congratulations on baby Malu and best wishes ahead to you and Sonal. So we've seen that, markets have been quite a lot, filled with swings, and there has been some pressure at the higher zones. Call writers are strengthening their positions, thereafter. There is some sort of rejection at the 50 daily exponential moving averages for Nifty, and that is somewhere making the index a little nervous. Now, of course, it's January, and historically, we've seen that this month is filled with swings, and India VIX is also acting up. So some sort of volatile swings will be there. So watch out for, 23,650 as an important support over here for the index, and a crucial hurdle of 24,200 mark. So recommended, to be in this swing. Preferably, we could enter into a bear put strategy for the intraday perspective to play out this one. Talking about Bank Nifty, this one has been underperforming as compared to the broader market. And thanks to the heavyweight stocks, which have been, facing some sort of resistances over here. Even the PSU banks, which were earlier showing signs of recovery and reversal, are now not, giving any contribution here. So there will be some sort of pressure which will continue here in the banking index. Although NBFCs are somewhat in focus, but the core banking stocks will be, in pressure. So we are seeing a little more downside over here till the zone of around 49,750 levels, and the hurdles are placed at 51,000 zones. So this is the take for Nifty and Bank Nifty.
All right, hi Shivangi, good morning, and wishing you all the best in 2025. Give us individual stock calls as well.
Absolutely. So stock calls on my radar is Coforge. Firstly, for that matter, we've seen that IT stocks have taken a little bit of a pause, but this stock has remained resilient, and it has seen, buying interest from the last 7 months itself. Even from the December series, we've seen rollovers have been quite positive. Till now, we've seen that, any small shorts have been covered, and people are, buying opportunities at any small decline. So definitely this one's on the radar. It has consolidated from the last 11 trading sessions, which kind of makes it a good base over here at the higher zones. And we are recommending a good upside move over here. So next targets for Coforge is 10,100 for a stop loss of 9,500 levels. Now, the second pick on my radar is Titan. Of course, wedding season is, in a lot in focus. And we've seen that this stock has surpassed its previous hurdle of 3,500 levels. Excellent amount of short covering move can be seen over here. And this January series so far, we've seen 12% open interest addition on the long side. RSI is turned positive for this one, and looking quite lucrative at these levels because risk reward is quite favorable. So recommending a buy here with a target of 36.50 and a stop of 34.30 levels.
Shivangi, just wanted your call on HDFC Bank. That one was steady earlier this morning. Now it's moved to the low point of the day. Where does support come in on HDFC Bank? Because that's the reason that the Nifty has now moved to the low point of the day.
Yes, so heavyweights have been in pressure, especially, the banking private heavyweights. And I am sensing a little bit of a more downside move over here because there is some sort of a rejection at the higher zones. Now, it is not being able to hold above 1750 levels. So till the time it holds below this level, we could see somewhat around 1680 odd levels for HDFC Bank.
All right, we take that point. Thank you, Shivangi, for your views on the market and the wishes as well. With that, we'll talk about Growth Code, an initiative by Grow and CNBC-TV18 designed to provide you with valuable trading strategies. This week, Nigel D'Souza sat down with Rohit Srivastava, who's the founder and market strategist at IndiaCharts.com, to understand what pump and dump schemes are and how traders can totally avoid this. Hear this.
Let's talk about this, that's come to light in the last few years, which is the pump and dump schemes, not just in India, but globally as well. So could you tell us, how do scamsters, orchestrate artificial price hikes? on very, very low liquidity issues.
Yeah, so one of the ways to do that is spread the word, so which is why so many groups get created, investment groups around certain themes, and then people are instigated into buying those stocks and driving them up, right? So a lot of people end up participating in these small stocks thinking that, yeah, this 5 rupee stock could suddenly become 20 in a short period of time. Let us buy a good amount of quantity. And when you get a large number of investors to do that through multiple groups, then the stock price shoots up, and the investors who really bought in early get out and leave everybody else holding. So that is how these schemes operate. In the old days, you also had something like, circular trading, a lot of which has been pulled together by SEBI, but even now in different ways. If you use a lot of, individual accounts at different locations, you can even do circular trading to push up the prices and make it look like the price is moving up very fast and everybody starts participating. So these are things to be very aware of.
The Standard Glass IPO has been subscribed within 20 minutes of bidding itself. What we'll do is take a short break, come back. We have the management of that very company to tell us about their post-listing plans. We have Nageshwar Rao Kandula, who's the MD, and Anjaneyalu Pathuri, who's the CFO of the company, joining in to discuss their business and growth prospects going forward. Don't go anywhere.
Live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs.
Well, let's get straight to Standard Glass Lining Tech. We do have with us the MD of the company, Nageshwar Rao Kandula. Remember, it's an IPO that opens today. 410 crore rupee issue, of which 200 crores is an OFS, 210 crores a fresh issue. The issue has been entirely subscribed in the first 20 minutes of being launched itself. 133 to 140 rupees per share is the price of the company in terms of an offering. Let's discuss the business plan with them. Mr. Pathuri, thank you so much for joining in. Mr. Kandula as well. Just wanted to understand first up, what portion of the capex set up for pharma and chemicals do your products account for? If you could, give us a revenue breakup in terms of sectors, and at the same time, give us a sustainable revenue run rate, because it's been all over the place. If you look at it, over the last few years, some years it's actually doubled, some year it's declined. If you could give us what a sustainable revenue growth path for your business would look like.
Thank you for the opportunity. Total opportunity India, total pharma and chemical opportunity is almost 40,000 crores. Engineering opportunity is there, and if you remove the civil part, 20%, so 30,000 crores opportunity is there. Today we are doing only 2 to 2.5% revenue based on that 30,000 crores versus our revenue. 97% scope is there. And the last 5 years, we are maintaining the CJR 25% growth. And coming 10 years, we are going to maintain the same growth.
Okay, all right. Hi, Mr. Kandula, as well as Mr. Pathuri. Well, I had a quick query. I'm looking at some of your peer set, which includes GMM Pfaudler, as well as HLE Glasscoat. And they have clearly been struggling. You're a little bit smaller. So on that smaller base, it appears you're growing faster. Is there any other reason why their growth is not as much, but you're growing so well? As you said, last few years, CAGR has been quite good.
No, we are not, compared to their figures, we are not smaller. If you look into the standalone revenue, compared to their GMM Pfaudler is 50% revenue coming from heavy engineering and 50% is only equipment. HLE also a size of 500 crores domestic standalone revenue. If you look into this year, we are going to 10 years, 11 years old company. We are going to touch this year 650, 670 crores revenue. We are slow. Next to 25 financial, we are becoming number one. And our growth is, though both are not our competitors, honestly. Okay. Why? They are limited product range. We have full basket. We are complete equipment we are manufacturing. 65 variety of products we are manufacturing, and we are doing complete turnkey projects. Not only equipment, loose equipment supplied, we are customized equipment supplied, we are service sector, and also we are complete plants we are building. Recently, we completed one turnkey project for Dr. Reddy's. One project we completed, Cohen's project we completed. All top clients are in our...
Got it, sir. So what you're telling us is that it's not a like-to-like comparison,
Yes.
with regard to these two competitors. So you'd not like to compare yourself because your product mix itself is a little different. We take that on board. And as you said, towards the end of this year, you could do anything between 650 to 700 crores. What kind of utilization levels? What is it, sir?
650 to 670 crores we are going to touch.
650. Got it. So what utilizations levels would that be, in terms of your current capacity? What would it be, 650 crores?
650 crores. Recently, we added one more facility. Now we have 9 facilities. These 9 facilities dedicated to pharma and chemical equipment manufacturing. Yeah. This we are bringing new technology, robots and automatic polishing machines and automatic welding machines, and we started this all implementation. Coming 2 months, we are going to implement another 40 crores capex we are going to do on the existing facilities. Another 60 crores we have planned. Total 100 crores we are going to complete in coming 2 years. But within 6 months, we are going to complete first phase 40 crores. Based on that, this upgradation of the all facilities, our revenue can increase up to 3-fold.
Okay, revenue from current capacity and the capex that you're doing can increase 3-fold is what you're saying.
Yes.
And basis your 25% CAGR guidance that you've given for the next 10 years, it appears that you can actually, increase your revenue by 2x in the next 3.5 years, and maybe 3-fold in the next 4.5 years. Is that a fair estimate?
Fair estimate, yes. 20-25% we are targeting. And also, we industry growth is single digit, but today India have 6,000 clients. Standard class only 800 clients. And recently, IPP USA worldwide 150,000 clients are there. We signed agreement. We are our export also. This year we are going to touch 15%. Next year we are going to touch 20%. Our export revenue also increasing day by day, year on year.
So exports will become 20% from 15% this year. Just wanted to understand two things from you. Mr. Kandula, while on the top line, things are looking extremely great. You are talking about great growth going forward as well. It is not reflecting in your cash flow from operations. If I look at it, your FY22 cash flow from operations was -7 crores. FY23, it was just 1.7 crores. FY25, it declined. It was -65 crores. So if you could give us a sense on what kind of EBITDA margins and cash flow from operations can you generate over the next couple of years?
Cash flow negative is all are aware that this pharma and agrochemicals is facing last 2 years stress mode, and the receivables is getting delayed. And also meanwhile we started turnkey projects and also upfront equipment ready-made deliveries. This all little bit affected, but now last 6 months improved and we received some receivables. Maybe next coming 6 months cash flow going to positive, and profitability going to a slightly. This year we are going to touch 15% export sales. So our profitability going to slightly this year we are going to increase, maybe 12 to 13% increase. Profitability going to increase, and EBITDA margins going to touch 20%. Our profitability and EBITDA is main coming from export sales.
Okay, all right. Just a quick query. So your operating cash flows turn positive in the coming fiscal, right? That's what you're telling us.
Yes.
And margins are sustainable at around this 20% odd mark because it's improved in the last few years from mid-teens to 20%. It's sustainable.
Yes.
Got it. And final question. Yeah.
Future is we are increasing the major focus is domestic is margins are very tight position situation now today, and export margins are very high. Even our investor AGI, our investor Japan, they have 12% stake. They are in board, and they are also started giving orders. We are going to export to next coming 2 months.
So there's a potential for margins to improve, sir. Is that correct?
Yes.
Potential margin. Finally, your ROC and ROE, they have seen a sharp fall in the last 2 years. What kind of targets you have on both these two ratios?
Due to Japanese investment, that investment 170 crores they invested. After that investment, this ROE gone down. But now we are increasing our sales, and it will coming back within coming 15 months. It coming to back. Whatever earlier is there, same level it will come.
Okay, we'll take that point. Thank you so much for joining in and giving us a brief primer into your business. But Mr. Kandula, we'll leave you with a promise that you join us on the listing day and give us a lot more details about the growth plan for your business, and at the same time address issues of receivables, cash flow, as well as return on equity and return on capital employed ratio improvements going forward as well. For now, good luck with the issue so far. With that, let's slip into a short break. And as we do that, here's some good news for our viewers. India's business news leader is now just a click away, introducing CNBC-TV18's all-new app. We'll talk more about that in just a bit. Take a short break, come back, we focus on the markets and a lot more stock-specific action.
The stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros, and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
An analysis of election affidavits carried out by two independent non-profits has revealed that Andhra Pradesh Chief Minister Chandrababu Naidu may well be India's richest Chief Minister, and by a whopping margin at that. Recent surveys conducted by two independent organizations, that's the Association for Democratic Reforms or ADR and the National Election Watch or NEW, has pegged Naidu's declared assets at around 931 crore rupees. That's just shy of nearly 3 times the second place name on that list, and that's Arunachal Pradesh Chief Minister Pema Khandu, whose assets come to around 332 crore rupees. In fact, both Naidu and Khandu top this list of India's richest chief ministers. In fact, both these organizations surveyed chief ministers belonging to 31 states, whose total cumulative assets came to around...
Welcome back. Markets at the low point of the day as we speak. A few stocks that have slipped a little bit more. Mahindra & Mahindra actually has done a bit of a U-turn. That's moved into the red. Shriram Finance as well as another stock that's moved a little bit lower. So some kind of selling is what we've seen. The Nifty Bank is the one that's struggling. Now it's moved below the 200 EMA at a very, very crucial mark. But let's talk about Nycoa as well as Marico, both of them in focus, post their quarter 3 update. Mangalam, tell us how you read them.
Well, good numbers coming in from Nykaa, no two ways about that. And the stock is reflecting that at 4% today. And why is that? Because this time around, the company will report revenues in terms of growth, in excess of mid-20s. And that would largely be led by their beauty segment. You know, for Nykaa, two segments are important. One is the beauty and the other one is fashion. Up until now, the street was hoping for some margin expansion coming by in beauty and revenue growth coming in for fashion. But this time around, what was a margin expander actually is driving the revenue as well. Beauty vertical growth has accelerated. Its net revenue growth will be upwards of mid-20s, and at the same time, you know, the gross revenue growth will be upwards of 30% in the beauty segment itself. So that's doing well. Fashion business has been facing some, you know, consumer sentiment weakness, not very different from what we've seen in other companies as well. There too, it will grow at around 20%, which is why, you know, mid-20s growth in beauty and 20% growth in fashion means overall growth at around 25%. And the underlying trend for Nykaa looks good out here. That explains the stock up almost 4% odd. Marico, on the other hand, they will report mid-teens revenue growth, but most of that would be because the underlying prices of copra and vegetable oils have increased, so the company had to take some price increases. And as a result of which, the gross margins have been impacted by a lot more because the underlying raw material prices have increased itself. So the stock opened mildly higher because the street saw mid-teens revenue growth. But then from there, it sold off because the company said modest operating profit growth, which means that margins would compress. If your revenue is growing mid-teens and there is a small growth on the operating profit, margins compress, and that's something that the company will be watchful of going forward as well. And as a result of which, the stocks sold off a little bit. But the good part is that these price hikes are getting absorbed, and they did see QOQ volume recovery. So that's something we'll watch out for.
All right, Mangalam, thanks for that. Well, let's turn our attention to Easy Trip Planners. It's bounced up today. This after Nishant Pitti. He had resigned as the company's CEO with immediate effect for personal reasons. He'll be replaced by Rikant Pitti. Earlier today, though, we asked him all the queries with regard to the stake sale and what's the outlook from here on. Let's hear out what Nishant had to tell us.
Reflects in strategic focus on driving growth and expanding EasyMarket's global and international presence in my capacity as the chairman of the company. While I continue to play an active role in shaping company's future, Rikant will be taking over as CEO to oversee day-to-day operations and ensure seamless execution to a fair vision. I'm confident that his business acumen and deep expertise in travel industry will pave an exciting and promising future for EasyMarket. The reason to sell a portion of my stake, that is just 1.4% out of 14%, was a strategic step to diversify my personal investment and unlock a value after doing like 20 years for EasyMarket. Despite the sale, I still own 12.6% shareholding, and as promoter group, all the three brothers continue to own almost about 50%. We are not going to sell anything right now. My focus remains firmly on EasyMarket growth, and I'm fully committed to supporting. Moreover, EasyMarket stands out as one of the few new age companies where overall promoter equity remains almost about 50%, which you will not find, in other e-commerce companies. The initial intent was 10% of the block which I hold. That is 14%, 1.5% of the 10%, 1.4% of 14%. And as I told you, we still own almost 50% of the equity. This will be holding up. We can't just give you some timeline, but still, we are not selling anything right now. And that could be, you can say that in 2025, we are not going to sell anything.
All right, promoters not looking to sell stake, and as a result of which that stock higher in today's trading session, seeing a bit of a bounce back. But with that, we'll wrap up on this edition of Chartbusters. As we do that, and as we promised earlier as well, some good news for our viewers. On Nigel's right will be India's business news leader, just a click away. That's the CNBC-TV18 all-new app. You can get instant access to breaking news, in-depth articles, and all the updates coming in from the financial world itself on your fingertips. What you can do is download the app from either the Apple Store or the Google Play Store, depending on the operating system that you use, and get cracking on the CNBC-TV18 business app.
₹630 crore. That's an average of 52.59 crore rupees per chief minister. But remember, this average number is largely buoyed by the large assets declared by both Naidu and Khandu. Incidentally, the South isn't too far off when it comes to the upper echelons of this list. Karnataka's Siddaramaiah has declared assets of 51 crore rupees and is third place on this list. But remember, this number is still short of that average value of 52.59 crore rupees per chief minister. The quote-unquote poorest chief minister on this list is West Bengal's Mamata Banerjee with assets of just about 15 lakh rupees, while the third poorest name on this list is again from the south, that's Kerala's Pinarayi Vijayan with assets of just about 1.18 crore rupees. However, the south continues to find dubious mention as far as this list is concerned. The most number of criminal cases lodged for a chief minister belongs to Telangana's Revanth Reddy with 89 criminal cases against his name. The second place name on that list is also from the south, that's Tamil Nadu's M.K. Stalin with 47 criminal cases against him. This, remember, is as per the studies conducted by both ADR and NEW. When it comes to liabilities, the south again isn't too far off as far as the upper levels of this list is concerned. While the total number of liabilities or the largest liabilities per chief minister belongs to Arunachal's Khandu at about 180 crore rupees, both Siddaramaiah and Chandrababu Naidu continue to figure on the top of this list. In fact, Siddaramaiah accounts for 23 crore rupees worth of liabilities, while Chandrababu Naidu's liabilities come in at about 10 crore rupees.
Countdown for the Mahakumbh Mela 2025 has begun. It is just a few days away. Devotees see this as a once-in-a-lifetime chance to bathe in the holy waters of what is called the Triveni Sangam, where the rivers Ganga, Yamuna and the Saraswati meet. The holy event starts from the 13th of January and will last till the 26th of February. About 450 million people from India and abroad are expected to flock to Prayagraj, which is the spiritual heart of India. This isn't just any regular event. The Mahakumbh only happens once every 144 years. It is the culmination of 12 Purna Kumbhs that happen every 12 years. The Ardha Kumbh happens every 6 years. The Purna Kumbh is organized in 4 holy places: Prayagraj, Haridwar, Ujjain and Nashik. As demand for travel is expected to go up.
Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Vivek Iyer. Markets are sliding. We're down close to about 180 points on the Nifty. The Nifty's breached the 200-day moving average. It's 23,825 on the Nifty. The Sensex is down close to about 550 points. Banks are weak in trade. The Nifty Bank is down 1%, over 1%. PSU Bank's down nearly 3%. You've got cuts and deep cuts coming through in metals, realty. And look at the advance decline ratio, right? You've got about one stock advancing for 6 in the red. The small cap index is down 1.7%. So, after seeing a positive finish on Wall Street, you were hopeful. The GIFT Nifty was up 50 points, but things have turned south.
Absolutely right. Good morning, Reema. The first thing that notices is that it's a broad-based sell-off. There's a tinge of green you could call as far as the markets were concerned, but there's been a very sharp sell-off, especially in the last 45 minutes of the session. What's doing worse, especially as far as the benchmark or headline indices are concerned, the small cap index down 1/8% or 1.8%, the mid cap index down 1.5%, and it's all happened in just the last half hour where the slide has been even more significant. What's actually doing very poorly in the session today are the entire PSU stocks. All of the PSU stocks today under significant pressure. Look at names like HPCL, SJVN, a container corp for that matter. Look at the Union Bank down almost 7% after the operational update. Names like Bank of Baroda. Few pockets of green in the BFSI space on the back of either brokerage upgrades that have come in or strong earnings. So look at names like Bajaj Finance, SBI Cards, they are doing quite well. And few pockets of green in the consumer pack, Titan, Jubilant Food, Nykaa, they're doing quite well. Dabur Marico, despite a reasonably good set of operational updates, actually seeing a bit of a sell-off. So Dabur, Marico, these stocks too doing very poorly in the session. But Reema, the entire BFSI pack, Abhishek was pointing out almost 21 updates, and all of them are reacting, to the kind of operational updates they've actually given.
Indeed. So let's get to them one by one. So first up is Kotak Mahindra Bank. Now here it's not a Q3 business update, but the negative news that the bank's chief operating officer and chief technical officer has stepped down, citing personal reasons. And this, remember, comes in the midst of an ongoing RBI embargo on the bank from onboarding new customers online due to IT system deficiencies. So it's a bit of a blow coming through for Kotak Mahindra Bank. Abhishek is here with the details.
Well, Rima, you said it all. It's been 8 to 9 months post RBI ban on the digital platform. The CEO and CTO has resigned with effect, from 15th of Feb 2025. Now, Nomura has written on Kotak Bank. They have a buy recommendation, target price of 2,170 per share. They say that this resignation adds to recent top management churn. They continue to monitor changes in top management, especially in the light of the recent churn that has been happening. Any impact of the recent management exit on the medium-term growth outlook will be seen closely. Back to you.
Thanks so much for that, Abhishek. But I'm sure we're going to keep coming back to you through the course of the show to get us more operational updates as far as the BFSI space is concerned. But one stock that's doing quite well is actually Jubilant Foodworks. It's surging on the back of its Q3 FY25 business update. Mangalam is here with more details.
There's a good update coming in from Jubilant Foodworks for the third quarter. Remember, third quarter is seasonally fairly strong as well. And in that, the consolidated revenue of the company has grown by about 56%. But remember, consolidated revenue actually includes the acquisition of DP Eurasia as well. So the more important number to watch out for is the standalone business. And now there as well, there has been a growth of almost 19%, 1,611 crores. So that's a positive. Importantly, it's led by like-for-like growth from Domino's India itself. 12.5% is what the company has reported, which is the highest that we've seen in at least the last 7 or 8 quarters itself. They've opened 60 net new Domino's stores as well. More importantly, now what we need to watch out for in the results is the like-for-like growth trends in both delivery and dine-in. Over the last few quarters, dine-in had seen a decline in like-for-like, whereas delivery was holding steady. Now, have we seen an arrest in that decline or not is something we will monitor. And the second thing we'll look at is the impact of gross margins coming in on the beverage portfolio changes. Remember, now they have a deal with Coca-Cola as against Pepsi earlier. So has that come in at better gross margins or not is something we'll be watching out for. Domino's is doing well. Is Popeyes doing as well as or not is something we'll watch out for in the third quarter numbers. But from whatever numbers have been reported by Jubilant Foodworks in their pre-quarterly update, it is strong and the stock is reflecting that. On the other hand, however, Dabur is under pressure today, and that's largely because the update has been largely softish this time around. If you look at it, the companies said they would report low single-digit growth in their consolidated revenue because rural, while it is resilient, general trade is still under a wee bit of pressure. Importantly, the margins also is something that the company is watchful of because of inflation that we've seen in some of the raw material prices for the company itself. Beverages portfolio particularly has been weak in the third quarter, even as healthcare portfolio has seen a bit of a delay because of delayed winter. So those are a couple of factors we'll keep an eye out on for Dabur.
Thank you very much for that. Marico too has slipped close to about 3%. But even where there have been good positive updates, like look at the case of Macrotech Developers, right? That's a real estate company.
Right.
They reported the highest ever pre-sales. I think pre-sales went up by more than 30%. The stock was up in the green in the morning in the first 30 minutes, but now is down close to about 2.2%. Even Brigade, where there was an update that the company is developing a new residential project in Bangalore with a total gross development value of 2,700 crore. Again, the stock opened up in the green, but now is down over 1%. IEX, right? That's I think you said the volume in the month of December was fairly strong.
Fairly strong,
and,
almost 30% higher.
It was a 30% jump, but look at the way, I mean, it's just the market sentiment today is so downbeat that even where you have positive news flow, it's being sold into. And case in point is perhaps even HDFC Bank.
Absolutely. If I could just highlight JSW Energy, it's down. This is a very interesting development. We've been highlighting it since morning. So what essentially happened was that in 2022-2023, there was a bid that happened, and this was one of the largest tenders as far as a battery supply project was concerned, or a battery energy storage supply project was concerned. JSW Energy, after going through the entire process of bidding, it emerged as the lowest bidder. So it won this particular bid fair and square, and the discovered price there was quite significant, almost 10 lakh rupees per megawatt per month. But what happened after that is that in subsequent auctions, the discovered price for tariffs has been lower. So SCCI, has made a delay in terms of going ahead signing the supply agreement and also in the power purchase agreement. And CRC now has said that they would not be going ahead with this particular discovered tariffs. This is a setback as far as JSW Energy is concerned, given that this is a large project, and also put some uncertainty, especially when it comes to other projects where there have been power purchase agreements that have been signed, and this is something that will keep the entire power sector in focus.
Okay, let's move on and talk about SBI Cards. Well, that is managing to hold up in the green because brokerages are now turning upbeat on SBI Cards following the recent underperformance. Abhishek is back with us.
Well, Nomura has upgraded SBI Card to buy. They have increased the target price to 825 per share from 625 that it was earlier. They say that they are observing few major concerns going away in the near term, especially on the asset quality side. So they expect credit cost to be at 9.1% for FY25, 7.5% for FY26 and about 7% in FY27. So the company is likely to be the biggest beneficiary of the rate cut in the near term. Nuvama has also returned on SBI Card. They have upgraded it to buy. Target price has been raised to about 850 from 620 that they had earlier. They say that the credit cost shall start improving from Q4 FY25 onwards. The potential rate cut by RBI will actually help SBI Card in the near term. Back to you.
Thanks so much, Abhishek. You know, where the entire banking pack, BFSI Bank, seeing quite a bit of pressure, that particular stock is holding out in the green. But you've also been tracking two PSU banks for us, Union Bank, along with Bank of Baroda. They are in focus on the back of the Q3 business update. Give us more details.
Well, to begin with, the Union Bank of India has seen the lowest growth on a year-on-year basis in lower single digits. Perhaps no other bank has seen that number. So deposit growth is at 3.8% YOY and down by 2% sequentially. In this, the domestic deposit is up only 2.5% YOY and a decline of 2.4% sequentially. So amongst all PSU banks, what you are seeing is that the domestic business is not growing at the pace of the industry level, but it is the international business which is actually helping them in terms of business momentum. This is not good given the fact that international businesses do command a lower net interest margin than the domestic business. So advances have grown by 5.9% YOY and about 2.2% sequentially. In this, the domestic advances is up 5.3% YOY and about 2.1% quarter on quarter. The domestic RAM, that is retail, agri as well as MSME portfolio, that's grown by only 6% YOY and is down 1.5% quarter on quarter. Now, Bank of Baroda, after a strong show in Q2 FY25 with respect to their business momentum being really strong quarter on quarter, this quarter they have seen softening of the growth rates in terms of quarter on quarter movement. So deposits are up 11.6% YOY and about 2% sequentially. The domestic deposit is up 9.2% YOY and about 1.3% sequentially. Advances growth at 11.5% YOY and about 2.5% sequentially. In this, the domestic loan growth is about 11.8% YOY and 2.6% sequentially. The domestic retail advances, that's shown a strong growth over here, close to 19.5% YOY and about 4.7% sequentially. Back to you.
Thank you very much for that. And now it's time for a short break. But before that, it's time for a growth code, an initiative by Grow on CNBC-TV18 designed to provide you with valuable trading strategies. This week, CNBC-TV18's Nigel sat down with Rohit Srivastava, founder and market strategist, IndiaCharts.com, to understand what pump and dump schemes are and how traders can avoid these.
Let's talk about this, that's come to light in the last few years, which is the pump and dump schemes, not just in India, but globally as well. So could you tell us how do scamsters, orchestrate artificial price hikes on very, very low liquidity issues?
Yeah, so one of the ways to do that is spread the word, so which is why so many groups get created, investment groups around certain themes, and then people are instigated into buying those stocks and driving them up, right? So a lot of people end up participating in these small stocks thinking that, yeah, this 5 rupee stock could suddenly become 20 in a short period of time. Let us buy a good amount of quantity. And when you get a large number of investors to do that through multiple groups, then the stock price shoots up and the investors who really bought in early get out and leave everybody else holding. So that is how these schemes operate. In the old days, you also had something like, circular trading, a lot of which has been pulled together by SEBI. But even now in different ways, if you use a lot of, individual accounts at different locations, you can even do circular trading to push up the prices and make it look like the price is moving up very fast and everybody starts participating. So these are things to be very aware of.
all out to launch flights to Prayagraj from different destinations in the country. The airport authority says there are 20 new flight connections exclusively for Prayagraj for the Mahakumbh. Indigo has launched flights from Ahmedabad, Kolkata and Bengaluru, while SpiceJet is connecting Delhi, Mumbai, Bengaluru and Ahmedabad. Limited flights means devotees will have to pay more for airfares. For instance, a one-way ticket from Mumbai to Prayagraj on the 12th of January is nearly 30,000 rupees. Then Bengaluru to Prayagraj on the 11th of January will cost over 22,000 rupees. The Prayagraj airport is also stepping up its game. The existing terminal is being revamped and a new terminal is being developed to together handle about 2,700 passengers at peak hours. Staying in hotels will also be an expensive affair, with room rates per night soaring to as high as 40,000 rupees. The state is spending a whopping 5,496 crores for this event, a lot more than what it spent in 2019. The government has allocated 4,000 hectares of land for the Mahakumbh 2025, which is double than over 1,900 hectares of land allocated in the Purna Kumbh of 2020.
Welcome back to Trading Hour. Well, the selling pressure that we just spoke about, that we've been witnessing for the past hour, has intensified. The Nifty is now down a full 1%. The Bank Nifty down almost 1.5%. And look at the broader end of the market. The mid-cap index now down close to 2%, 1.9% to be precise. And the small-cap index down over 400 points, over 2% lower as far as the small-cap space is concerned. But moving on, we'll shift our focus to the commodity space. Manisha joins in, and today we are focusing on crude.
Well, yes, and we are doing that because we've seen prices continue to gain. Well, the last year wasn't such a great one. It has been 2 years of a decline in crude oil prices in a row. But we've seen 2025 start on a slightly better note. 76 is holding, even with that bit of a decline that you are seeing on your screens. And as 76 holds, we are up by nearly 4% for 2025 till time. Some pressure comes in right now because of the strength in US dollar index, which is holding around 109, which is a 2-year highs. But then the markets also are reacting to the Chinese data, where the services PMI number came in stronger, but the overall PMI has slipped yet again for the month of December. That perhaps seems to be weighing in. But then it is about cold weather in US and Europe, so you will see crude product demand on the higher side. It also is about the markets anticipating that you could be looking at stronger China stimulus measures going forward. And then it also is about decline in US crude inventories for a 6th straight week. And that decline has brought the US crude inventories right now to 415 million barrels there. The street also is watching out for the geopolitical tensions, where the Russian pipeline from Ukraine has been shut since 31st of December. It also is about the Goldman Sachs report, which came last evening, which puts the point forth that Iran oil production and exports perhaps could decline by the second quarter, depending on what kind of sanctions do we see from US coming in from this oil producing country. So there's various things to watch out for, but at this point in time, it does seem like it is on a stronger start, and we seem to be trading above an average that we saw in the previous year.
Thank you very much for that. Slip into a break. On the other side, market technicals lined up with Soni Patnaik from JM Financial Services.
Over 1,50,000 tents and 25,000 accommodations are being set up for the sea of visitors from India and abroad. And for the first time ever, the entire tent city will be mapped on Google Maps, making it very easy for tourists and devotees to navigate in the Mahakumbh Mela. The Mahakumbh is a big deal for the hospitality and other commercial sectors. The state is expecting a revenue of 25,000 crores, bringing a wave of opportunity to the region.
Well, if you look at the statements by Elon Musk and by Mr. Rabasani, who, as you know, was a presidential candidate and with an Indian background, they're both saying that students graduating from universities in the U.S. who are from India should automatically be given a green card.
Welcome back. Let's take a handle on what's happening on the technical front because markets are slipping more and more. We've now breached even 23,750. It's a 265-point cut on the Nifty. The Sensex has stumbled close to about 800 points. On the mid-cap index, it's more than a 1,000-point fall. So there is no arresting the decline that we've seen. Most of the traders, investors will be back today. So in a way, today is the full, first trading day of 2025. Soni Patnaik from JM Financial Services is now with us on the show. What have you made of this big selling pressure that's come through today? What would you attribute it to? And what are dealing rooms doing?
Hi, good morning, Rima. Thank you for having me on the show. So I think it is back, what we can see is that it's mostly led by Bank Nifty today and the likes of heavyweights in banks such as HDFC Bank, which is contributing majorly to the downfall today. In the previous past, we've seen Bank Nifty held on to its 200 EMA support, but today it seems to have broken that. So the range of support that was 50,400, Bank Nifty broke that level. If it closes below this level, you'll see it, opening gates towards 49,500. So positionally, it becomes quite weak, and Bank Nifty, as long as it's not crossing above 51,500, it remains quite a sell-on rise. Because of this, you can see Nifty also retesting its 200 EMA back again towards 23,700. If that breaks, there's a chance that it can break and head towards 23,500 to 23,300 range in a positional basis. On the upside, 24,000 is acting as a very strong resistance for now. As long as the resistance levels for both the indices do not take out, we can see a sell-on rise structure, and there could be possibilities that both the indices continue to test its lower support levels.
Soni, any individual trades for the day? Any buy or sell calls?
Hi, good morning, Vivek. Certainly. So the first idea would be in a sell call that's in Prestige. So Prestige, we've seen a very strong sell and a breakdown below 1650 level today. So one can sell Prestige in futures with a stop loss of 1650 and a target of 1570 to 1540 positionally can be seen. So Prestige is also on the verge of breaking below its 200 exponential moving average, below which it will become like quite weak, and you can see it heading lower towards 1550 odd levels. So I think that's the targets to look out for. The second sell would be in DLF. DLF again, it's trading below all its major moving averages, and just today it has broken below its 200 exponential moving averages. So a lot of stocks actually breaking that 200 exponential moving average on charts today, which is indicating us, selling a spree. So DLF one can sell in futures with a stop loss of 830 and a target of 770.
Thank you very much for that. For the markets, by the way, once again, the dollar index has started inching towards 109. It's been in 109 levels. Last week, we went up to levels of 109.5, but we're still at 109 now. And Brent, remember, overnight has increased quite a bit. From last week to this week, we have seen the Brent prices also scale up to beyond 76. So these are the two overhangs, globally. And in terms of the Asian markets, we're on the back foot. So I think Hang Seng has a cut of close to about 0.5%. Shanghai is down close to about 0.6%. And the Japanese market, which resumed trading from today, down 1.5%. But what's the outlook for India 2025? Morgan Stanley released their strategy note. Hormis is here with a summary.
Three important scenarios that Morgan Stanley has highlighted in its note. Now, we've been talking about the Sensex reaching that 1 lakh level for quite a while now, and Morgan Stanley's bull case scenario expects that to happen this year itself, where the bull case scenario was projecting a price target of 1,05,000 for the Sensex. Now, we'll get to that in just a bit, but the base case scenario first up, where it says that India's macro stability will further increase through fiscal consolidation and increase in private investment, the positive gap between real growth and real rates, along with robust domestic growth and no recession in the US, along with benign oil prices. So these are some of the scenarios that Morgan Stanley has highlighted in its base case, where it has a price target of 93,000 for the Sensex by the end of this year. Now, some further points in the base case where it says that a modest reduction in interest rates, a positive liquidity environment, and it expects Sensex earnings in the base case to compound at 17% annually over until FY27. Now, for the bull case, where it has this, it has 30% probability of the Sensex hitting 105,000 by the end of the year. It expects oil prices to remain persistently below $70, lower, which will result in lower domestic inflation and further rate cuts from the RBI, and a better energy balance as well. And foreign flows, with FIIs being net sellers so far in the cash market, that surprises to the upside, and some government reforms as well, with a slew of GST rate cuts, some progress being made on farm laws, and here they expect the earnings to compound at 20% until FY27. And lastly, a bear case scenario which has a 20% probability, that is a Sensex price target of 70,000, where oil prices cross $110 a barrel, and instead of loosening rates, RBI ends up tightening to protect macro stability. The US market slip into a recession, the Sensex earnings only grow at 15%, and the multiples derate to project these poor macros. Now, as a result of this, the Morgan Stanley is overweight on financials, financials, telecom, consumer discretionary, and it is underweight on staples and utilities and materials, along with healthcare. And 10 stocks it has in its focus list, which includes the likes of Brainbees Solutions, Maruti, Trent, Reliance Industries, ICICI Bank, Ultratech, SBI Life, HAL, L&T, and Infosys. So base case target as of now is 93,000, but the bull case projects the Sensex to cross 1 lakh by the end of the year.
Thank you so much, Harmas, for bringing us those details from the Morgan Stanley report. Interesting base case over there as well. But moving on, the Indian rupee fell below 85.8 mark today, a level which RBI appeared to defend last week, dealers say. What's led to giving up of this level, and what's happening in the market today? Lata is here with more details.
Well, actually, a big event for the currency markets, especially for India, is that the yuan, or the PBOC, has allowed the onshore yuan, that is what you call the renminbi, to go beyond 7.3. That happened late on Friday. The yuan appeared to be moving, they stood at 7.29, 7.28 for a goodish bit. But in the end on Friday, they allowed it to go below 7.3. The offshore yuan, that is, the one traded in Hong Kong, the CNH as you call it, has already gone from 7.33 to 7.36. Again, that happened on Friday. So, the RBI appeared to be defending the 85.8 mark. They allowed it to come till 79 several times and go back. That was happening last week. Then on Monday, that's today, with the yuan also falling, they have allowed the rupee as well to go beyond that so-called protected mark. Protected for a very brief period, actually, just for 1 week. Now, actually, everything is going against the EMs. You know the list of factors. The dollar index strengthening all the way to 109. Even now, it is 108.86, or 88. It's still very much the 109 level. The US 10-year yield at 4.62, actually. It just makes currencies or funds get more attracted to US. All these exacerbate the US exceptionalism when both the currency and the yields are higher. For India, the added reason, we do watch the dollar, but we watch the yuan very carefully. I might just actually add a data point over here. In 2024, the rupee depreciated by 3% from about 83 to 85.5. The yuan also depreciated 3%. So India tries to be in step with yuan as well, because it's our largest trading partner and maximum dumping happens from that country. So you don't want your country to not depreciate as much as the yuan. You want to keep in step. And of course, as you'll have been pointing out, the crude prices also are slightly adverse. Lately, crude is not a very big factor. The crude price have remained south of the $75 mark. The big talking points are really how the dollar has been rising, yields have been rising in that country, and of course yuan as well. All currencies competing with India depreciating. The expectation in the market is, of course, there is a lot of FPI buying of dollars, which means they are selling Indian shares even today. You don't need an expert to tell you that, the way in which the shares have been falling. The fear in the currency market is that the PBOC will allow the yuan to depreciate even further. People are freely talking about 7.4 and 7.45 before Jan 20th. The impact could be even more if the announcements post Jan 20th, when Trump takes over, are worse than what the market is prepared for. But even fearing that event, 7.45 is on the cards, which means rupee is also not stopping at 85.8. The move towards 86 looks like a writing on the wall.
Thank you very much for that. That's an important update coming through from Lata. We will slip into a very short break. On the other side, we'll also discuss market fundamentals. Siddharth Vora of PL Asset Management joins in next.
I think Trump will implement that going forward because they realize that they've got to hold these very intelligent Indian students who are now becoming very capable professionals. I mean, if you look at Silicon Valley, look at how many people of Indian backgrounds, actually with Indian citizenship, are running the big tech companies in California. And I think that's going to hold true in other parts of the states. So I think the administration realized the value of the brain power that India has and will want to hang on to these people. But by the way, there's a benefit to India as well, not only because these Indians will be sending money back to India, but more importantly, they're going to obtain experience in the US and education from the US and bring that back to India because India is going to become much more competitive in terms of offering these people good earnings. So it's going to be a win-win, I think, for these students in America. And I think it's going to be very interesting going forward. But I, for one, I'm quite optimistic about these students living and working in America. First of all, you must remember, if a country is growing at 6, 7, 8%, whatever number you want to pick, companies will be going at double at the rate. Good companies that have a high return on capital will be growing at double that rate. So you're talking about 14, 15, even 20%. So an increase in price of 20% more than accommodates the kind of increase in value that you have in these stocks. So I don't think we should be too worried about the fact that many of these stocks have gone up so much. They will continue to go up if these earnings.
Welcome back. IT across the board is under pressure, barring a LTI Mindtree, which is up 1%. And this is on the back of a Jefferies upgrade on LTI Mindtree. They've upgraded it to a buy, and their target price now stands at 6,650. The reason is they say that the stock was one of the worst performing stocks of 2024. The stock price was down 10%. It saw 15% EPS downgrades for calendar year 2026. The PE got derated. But after the recent correction, Jefferies says the stock is trading at 30 times forward PE, which is in line with its 5-year valuation, and therefore valuations are attractive. Also, they're saying high exposure to North America and discretionary spends positions LTI Mindtree as a recovery play. So according to them, the recent correction factors in all the headwinds, and a potential CEO transition will also be a key. So this double upgrade on LTI Mindtree is pushing the stock up higher.
Green stock in an otherwise extremely red trading session. Well, moving on, the other stock in focus today that's seeing quite a bit of a sharp cut is ITC. But ITC trades ex-hotels business today. Mangalam is here with more details.
Exactly. So the ITC stock price optically is seeing a sharp cut because it's seen, the hotel business going out of the business. So if you look at it, from yesterday's close to now, there has been a delta of close to 25, 26 rupees at the open itself, now down 31%. The actual decline in the stock price is just around 5 to 6 rupees, but the 25, 26 rupees is largely because the street is seeing an adjustment for the hotel business. They had expected an adjustment of almost 15 to 20 rupees per share versus the previous close, but ITC hotels business will now list in mid-Feb, and that will tell you what the actual valuation of that business is right now. But basis this 26 rupee cut, the street seems to be valuing the hotel business upwards of 50,000 crores. It currently operates about 140 hotels with 13,000 keys. They have a target of 200 hotels by 18,000 keys by 2030. And if you look at the multiples of the hotel business itself, Indian Hotels is at a sharp premium at 37 times, as against Chalet and EIH, which are at around 18 and 25 times. The street was hoping for ITC to be between 26 to 28. Today's stock price correction tells you that maybe it could be around 37 times, but the proof of that would lie in when the hotel business lists in mid-February itself.
Thank you so much, Mangalam, for joining us and giving us all of the details as far as ITC is concerned. Well, moving on, like promised, Siddharth Vora from PL Asset Management now joins us to discuss market fundamentals and his top sectoral picks. Good morning, Siddharth. Thank you so much for joining us. First up, in the midst of what is a steep market correction today, and especially, we are seeing Q3 updates coming in. What exactly are you penciling in as far as Q3 is concerned in terms of earnings, and where do you see the markets headed from here on?
So I think after staying defensive for the last, I would say, 6 months now, we've been extremely defensive in terms of our portfolio construct or the sectors we've chosen. I think we are gradually starting to turn a bit constructive on the markets. Whether I look at my factor allocation, or I look at my sector mix, or I look at my market cap mix as well. We're now getting more tilted towards the mid and small cap buckets of the market once again, after 6 months of staying focused more on the large cap and mid cap side. And I think the reason for that is, large caps, while fairly valued, I think they're still extremely vulnerable to foreign flows. And mid and small cap on the other side, they're less vulnerable to foreign flows and quite resilient, driven by domestic flows. The way we also look at the market is, right now we're starting to turn constructive simply because all the major bad news items, right? Whether you talk about the earnings slowdown, the moderation in the pace of economic growth, the rising US bond yields, geopolitical stress, the sticky inflation numbers, the US election outcome, a lot of things are now starting to get factored in. And in the near to medium term, markets appear to be slightly oversold based on some of the quantitative and technical indicators that we're looking at. So I think despite the choppiness and volatility that is expected through the course of the next couple of quarters, we expect some recovery in the markets. And it's very critical of how we really approach, portfolio construction, risk management, agility while managing the portfolio during this phase of the market.
So Siddharth, hi, morning, Rima here, and Happy New Year. So can you tell us about the technical and quantitative indicators which have made you turn gradually constructive?
So I think our macro and style regime detection models are now starting to say that, okay, we've seen a defensive risk-off phase in the markets for the last couple of months. Now the risk indicators have started moderating to a level where they do see some support in terms of a mean reversion playing out. When I look at my style factor analysis also, right, it's very evident that momentum, value, growth, some of the higher beta factors are doing equally badly, or rather equally well, in the fall, like some of the defensive factors like quality and low volatility. So it's extremely critical to see how the market pans out from here. So traditionally, large caps are more defensive versus small caps. Quality is more defensive versus value. And momentum is, low volatility is more defensive versus momentum. All the defensive factors have also been beaten down to an equal extent in this fall. And because of that, the higher beta factors have slightly outperformed on the fall. And that is one of the reasons that despite our macro stance being slightly cautious, we are turning constructive in terms of the factors and sectors and market cap mix we are choosing in the portfolio.
Got that. So that, looking forward to your sectoral views, almost 21 lenders have come out with their operational updates over the weekend. How do you read Q3 for them? Was Q3 expected to be weak, especially in terms of deposit accretion? Is that something that the market has already priced in? And especially, in another couple of days, we'll see a lot of IT numbers coming in. So banks and IT, what's your view over there?
So currently, we're not owning much of banks. We are pretty much out of the whole banking space and the lending space in terms of our financial allocation. Our portfolio is hugely tilted towards the capital markets theme, whether it is brokers, asset managers, wealth managers, depository participants, or some of the tech plays within the space. So that's the way we've approached our financial exposure. We don't have any banks. In terms of IT, we've been owning IT for the last 4 or 5 months, and we continue to own IT. We're not having the heaviest allocation there, but we're overweight versus the benchmark. I think the thing with IT is, with rupee depreciation, there is obviously a natural tailwind there. Other than that, the bigger risk is that the valuations of the IT sector have also been a little stretched now. So we got to, approach IT with a little caution that, despite the defensive nature of the business, despite the high free cash generating nature of the business, and despite the rupee tailwind, we still think growth could be quite average compared to the other sectors that we are focusing on. So I think overall, IT is a must-have in the portfolio, but at the same time, you need to be quite cautious in terms of when to get out because valuations are not on your side when you're investing in IT for now.
What else? No banks, you like IT, slightly overweight IT. What else makes it to your portfolio?
So right now, the bigger themes that are dominating our portfolio include capital markets, IT, consumer discretionary, and healthcare, which covers export-oriented pharma companies and domestic hospital players. So I think these are some of the big overweights in our portfolio and a bit of exposure to real estate as well. We're gradually pruning down our auto exposure now as we go into the next quarter.
When you say pharma, you say you like export-oriented themes. So will you be looking at the generic players or will you be looking more at the specialty-focused players, someone like a Sun Pharma? And is your tilt more towards the large-cap pharma healthcare players or will it be more in the mid-cap players maybe exposed to the CDMO, CDMO theme?
So I think we have a healthy mix. It's quite a significant allocation to the overall healthcare theme. Roughly, 30% of our portfolio is divided across API players, generic exporters, and domestic hospital franchises as well. So I think it's a good mix of the whole bucket that you're talking about. But large cap and larger mid cap names within the pharma space or the healthcare space.
Siddharth, do you study the global markets? We were chatting with Sandeep Tandon of Quant just last week, and he said the biggest risk to the Indian markets, though India will be a relative outperformer, will emanate from the complacency, the over-optimism going, for the US markets, particularly NASDAQ, which is why they've completely exited their tech exposure. So
Right.
is there while you did say that most of the risks perhaps are priced in right now, we've been talking about a time correction of 6 months is done. What's the global top-down approach for you?
So I think globally, we still perceive more risks than opportunities simply because the growth premium that India was experiencing for the last, 3 years in terms of differential versus other EMs, that is narrowing down to a significant extent. Valuations continue to stay rich despite a slowdown in the economy and despite a slowdown in earnings, along with sticky inflation. So I think the macro of India is not as strong as it used to be. And of course, with a weakening rupee, with higher bond yields in US, we do see developed markets sentimentally doing a little better than emerging markets. And even within the emerging market pack, the advantage that India had in order to sustain those valuation premiums is now starting to gradually wear off, at least in the short term. So till we don't see 1 quarter of a really strong recovery, I think Indian markets would tend to be a little range-bound, volatile, and choppy.
Thank you.
Yeah.
All right. Siddharth, we leave the conversation here for now, out of time. Thank you for joining in. As we slip into a break, here is some good news for all our viewers. India's business news leader is now just a click away. So introducing the all-new app. Get instant access to breaking news, in-depth articles, financial world updates at your fingertips. Don't forget to download the CNBC TV18 app now from the Apple Store or Google Play Store.
In the direction that we've seen them. The other factor I think is very important, and that is for those companies that are exporting, let's say Infosys that exports a lot of software, they are going to become more competitive because of the weakening rupee. So I think you've got to look at many of these stocks that have a US dollar income component will continue to do very, very good. And I think we're on this cusp of more exports coming out of India, not only in the software area, but also in manufacturing.
Welcome back to Trading Hour. Well, the market continues to see quite a bit of a fall, and within that, a couple of stocks that are doing quite well today. Nykaa is doing quite well, but Marico has seen a bit of a slip. But both are in focus today following the third quarter business updates. Mangalam joins in with more details.
A good quarter update coming in from Nykaa. Remember, the discretionary part of consumption is actually doing a lot better. We saw that in the likes of Titan and also Jubilant Foodworks update, and Nykaa as well. The underlying beauty and personal care market doing a lot better. In that, premium care is also doing equally well, and that's what's reflected in the Nykaa's third quarter numbers. Overall revenues for the company grow in higher than mid-20s sort of number, and that's a positive. And this has been led by their beauty vertical. If you look at the beauty vertical for Nykaa, which accounts for majority of their revenue, the growth has accelerated versus previous quarters. So this time around, the company will see net sales growth of mid-20s in the beauty vertical. And if you look at the gross sales growth, which is basis the MRP, that growth would be upwards of low 30s itself. So that's a positive, which the street is liking. However, the only fly in the ointment is that the fashion business, which was supposed to be a revenue driver for the company, has grown at around 20%, which is subpar as against analysts' expectations, and that's largely because of the consumer sentiment, which has been on the weaker side. So any sort of recovery out here is something that the street will eye. But the core of their business, which is the beauty and personal care business, which is doing a lot better, and the street likes that, the stock up 4%. On the other hand, Marico, that opened higher because the company said that in the third quarter, there was mid-teens revenue growth on a consolidated basis. However, swiftly those gains were sold into because those growth numbers for the revenue front came in largely on account of price hikes that the company had taken because of the increase in copra and vegetable oil prices. And then the street is worried about that having an impact on their gross margins because the company has said it's seen an impact on the gross margins. Although there has been sequential recovery in volumes, the important part is how much of that revenue growth is led by volume and how much of that is led by price hike is something that we'll watch out for in the numbers itself. They have said that while the international business has shown about 15% sort of revenue growth or mid-teens constant currency growth, the value-added hair oils continues to be challenged by weak consumer sentiment and competitive activity. The company, on account of that, is watchful for the margins in the very, very near term, and as a result of which, that up move on the stock has been sold into. However, given the fact that there is growth and there is underlying improvement in Saffola and Parachute, the downside on Marico has been limited, which is why the stock down about 2.5% itself.
Thank you very much for that. Lots of NBFCs also came out with their updates, including the big one, Bajaj Finance. Abhishek is here with the details.
Well, to begin with, Bajaj Finance, their AUM growth, though remains healthy in double digits, but it is the lowest growth that you are seeing in last 7 quarters. Such a benchmark that they have set with respect to AUM growth. AUM growth is at 28% YOY and about 6.5% sequentially. One of the best that you are seeing in terms of all the other lenders with respect to the business momentum. The new loans are up 22% YOY and about 24.5% quarter on quarter. Seasonally, Q3 has been a strong quarter for them given the festive season that we are in. Customer base has grown nicely at about 21% YOY and 5.5% sequentially. The AUM growth that I mentioned, about 28%, is at 7-quarter low just because the other quarters they have seen much better growth rate. Cross-sell rate has improved to 7.24% versus 6.2% in the previous quarter. Even the deposit momentum remains strong at about 18.6% growth YOY and about 4% quarter on quarter. With respect to L&T Finance, the retail business has shown signs of slowdown. So the retail disbursements have grown by only 4.5% YOY and about 0.7% sequentially. This is because the rural finance business disbursements, they are down more than 16% YOY and about 15.5% sequentially. The retailization continues to move upwards in terms of the portfolio mix. So the overall retail portfolio is now at 97% of the AUM versus 96% in the previous quarter. Retail loans, they have grown nicely at about 23.3% YOY and 3.65% quarter on quarter, but Q2 growth was about 7% quarter on quarter, so there is some softening seen over there. Disbursements to AUM ratio, that's dipped down to 21% versus 29% in the previous quarter, suggesting a faster rundown in the AUM that you are seeing. Back to you.
Thank you so much.
Oh, sorry. Go ahead.
No problem. Thank you so much, Abhishek, for that. If you could pull up the intraday chart of Bajaj Finance, the stock at one point of time was up almost 2.5%, but it's seen a very sharp slip from there in fact now trading near the day's lowest point. But another company, this time from the real estate space, that saw its Q3 operational update coming in was Macrotech Developers, or earlier known as Lodha. Winnie joins in with more details.
Yeah, so we're seeing a good number coming in from Macrotech Developers this time in Q3 FY25. They've seen the best ever pre-sales quarterly numbers that has come in. Collection also has seen a good growth this time, much better than what we've seen in the past. Now, overall, talking about the numbers in detail, 4,510 crores is what the pre-sale has come in at, which is 32% growth on a year-on-year basis. Other than that, collection saw a growth of around 66% during this quarter YOY, which is around 4,290 crore rupees. Business development is also taking place. They added one new project during this quarter, which had a gross development value of around 2,800 crores. And this would start supporting the growth of the company, especially in terms of pre-sales from FY26 is what they've highlighted. So obviously the company is also working, and they've acquired 33 acres of land for developing and maintaining the digital infrastructure. So that is what is also something that one should be focusing on, as well as the net debt of the company. That's seen a significant reduction this time. So keep an eye out on that. Good numbers actually what came in from Macrotech Developers, but right now the stock is a bit sluggish in trade.
Thank you very much for that. Now 23,700 has also been breached. It's over 1,000-point fall on the Sensex. Things are getting very, very ugly here. The advanced decline ratio now stands at one stock advancing for 7 in the red, more than 7 in the red. There was a minor attempt at a pullback between about 10 and 10:30 that was sold into. The gap between the advances and declining stocks continues to move up. Only 3 stocks so far in the Nifty which are in the green. You've got a Titan where the Q3 update was strong with the jewelry growth of about 26%. So that's up. Apollo Hospitals, which has been showing strength of late. Apollo Hospitals is up 27% in the last 1 year. So that's managing a little bit of a green. Maybe there is a little bit of worry about this new, flu which is doing the round, and the first case being reportedly being reported in India. So maybe there is a little bit of concern in the market regarding that. But, there is... now it's just about 2 stocks in the green right now. But let's turn our attention to Easy Trip Planners, because that's up in the green. Nishant Pitti, remember, resigned as the company's CEO with immediate effect for personal reasons. He will be replaced by his brother, Rikant Pitti. Now, earlier today, we had a chat with him. We discussed his recent stake sale and what the plans are going ahead.
And reflects in strategic focus on driving growth and expanding Eastman's global and international presence. In my capacity as the chairman of the company, while I continue to play an active role in shaping company's future, Rikant will be taking over as CEO to oversee day-to-day operations and ensure seamless execution to a vision. I'm confident that his business acumen and deep expertise in travel industry will pave an exciting and promising future for Eastman. The reason to sell a portion of my stake, that is just 1.4% out of 14%, was a strategic step to diversify my personal investment and unlock a value after doing 20 years for Eastman. Despite the sale, I still own 12.6% shareholding. And as promoter group, all the 3 brothers continue to own almost about 50%. We are not going to sell anything right now. My focus remains firmly on Eastman growth, and I'm fully committed to supporting. Moreover, Eastman stands out as one of the few new age companies where overall promoter equity remains almost about 50%, which you will not find, in other e-commerce companies. We are completely revamping the complete things into the Eastman as well. And as I told you, we are just going ahead with the organic and inorganic growth, both pedals we are scaling it up. So if you see any other companies in new age tech businesses, particularly in the e-commerce space, you will not find any other company who will be having so much of promoter equity till now. And the initial intent was 10% of the block which I hold. That is 14%, 1.5% of the 10%, 1.4% of 14%. And as I told you, we still own almost 50% of the equity. This will be holding up. We can't just give you some timeline, but still, we are not selling anything right now. And that could be, you can say, that in 2025, we are not going to sell anything.
Well, Nishant Pitti told us exclusively earlier that he's not looking to pair any more stake in Easy Trip Planners as far as 2025 is concerned. The stock on the back of that up over 5%. But time now for a short break. We'll get you more on the markets on the other side.
Welcome back. Post the release of the new draft data protection rules, IT Minister Ashwini Vaishnav spoke to CNBC-TV18 on how the rules attempt to strike a balance between the industry and user rights. He begins by answering why draft rules were delayed for 16 months and, what's the plan going ahead?
When this law was presented to the Parliament in November 2023, we had very clearly promised that it will be digital implementation. It will be completely digital by design. So in the last 1 year or so, despite the elections being there, general elections being there, we have worked very meticulously to create a completely digital portal, digital workflow, digital processes, so that when we finally start implementing this law, the entire data protection board will be fully digital by design first. Second, as you are aware, this is a very pragmatic approach towards data protection, and we have made sure that the balance between innovation and regulation, we have a huge innovation economy, right? Huge, large innovation startup ecosystem. And we have to make sure that citizens' rights are protected with full fervor, full confidence. So that's why we have created this structure where the innovation and regulation is properly balanced.
So let's take this next logical question in terms of what does this do as far as obligations of data fiduciaries or companies collecting data is concerned? What does it mean for them? What are the obligations they're now looking at?
The obligations on the data fiduciaries are very well established as per the principles set out in the Honorable Supreme Court's judgment regarding consent, regarding purpose. All those obligations are properly set in the law, and the rules basically implement those. Like the law, the rules are also very simple in language, very clear examples, illustrations are given everywhere. We have made sure that, as I said, in a very pragmatic way, we have made sure that we have not made everything very prescriptive. We have kept, because digital technology doesn't stand, right? It evolves every week. Every week there is a new thing which happens. So the law should be able to catch up with those developments. So that's why we have set the principles in the law and the rules, and the actual practice, the actual prescriptive, which whether to go to left, go to right, or how many steps to take, all that thing is part of the execution, and that's a very good framework which we have set. And we believe, we understand from whatever we have heard from our international counterparts and all, the compliance burden which happened in Europe and which killed the entire innovation ecosystem, which kind of damaged the innovation ecosystem in a very big way, that will not happen. Our innovation ecosystem will continue to grow with a proper legal framework.
Which is the next question that I had in mind. You make a reference to the compliance burden. We're looking at a situation where a company is required to have a data protection officer. There are requirements in terms of security requirements, reasonable security requirements that they're required to deploy, requirements with respect to storage and then processing of data. What does this do in terms of compliance, especially for some of the smaller entities that may, startups, innovation ecosystem that are collecting data?
Most of these things are today standard practice in the industry. For example, all the compliances, all the obligations that we have set, our interaction with the industry clearly indicates that people are fully prepared for implementing this. And we have given enough time, and we have interacted very closely with the industry in a very collaborative manner, so that there shouldn't be any disruption because of this law, right? So we have made sure that people are prepared, they come up to this level, and despite that we'll be giving a very reasonable time frame for people to give the final compliance.
A very interesting conversation there, but having a look at the markets, just have a look at the Nifty or the NSE small cap index. The Nifty down 1.7%, the small cap index seeing significant selling pressure, down almost 2.7%. What's doing very poorly? Well, it's the entire PSU basket. Have a look at the OMCs. So names like HPCL, BPCL, IOCL now trading near the day's lowest point. Have a look at something like an ONGC as well as GAIL. Both these stocks seeing significant selling pressure. JSW Energy, something that we highlighted at the start of the show, that stock is now down almost 5%, and the entire metal pack. Have a look at names like Tata Steel, something from the aluminium space, Nalco, a national aluminium company. Those stocks too seeing significant selling pressure. Even Hindalco seeing significant selling pressure coming in. In fact, now even as we speak, the selling pressure has actually exaggerated, or it has intensified. Even the gold financiers, names like Muthoot Finance, Manappuram Finance, these stocks too seeing quite a bit of selling pressure. Well, on that weak note or muted note, it's a wrap on this edition of Trading Hour. Stay tuned. Halftime Report is up next.
Well, it's been yet another record-breaking night for quick commerce platforms as India's consumers took to their phones to order in their New Year party needs. Now, apart from the usual party essentials, many interesting items like grapes, condoms, ENO, milk packets, and even men's underwear were ordered for in huge quantities across apps. But let's look at Blinkit first. Blinkit saw its highest ever orders and also its most orders per minute and per hour. And in terms of trends, last night saw the most number of chips and most grapes sold in a day. The biggest order Blinkit received was for 64,988 rupees from Kolkata. Now, Instamart too saw its highest ever orders, which was the double of last year. And what did consumers look for the most? Milk, chips, chocolates, grapes and paneer. And the biggest order came from a user in Goa for 70,325 rupees. Now, on Big Basket, orders for things like games, soft drinks, mixers were all up anywhere between 200% to 1,290%. Now, after 2024 turned out to be a year of the quick commerce boom, Zepto CEO Adit Palicha rang in the new year with 3 predictions for 2025. Now, he says that 2025 will be the year where quick commerce will start hitting scale comparable with e-commerce. Now, we've already seen the lines blurring between the two in 2024. Now, his second prediction is that this year, the quick commerce model will really be put to test. Succeeding in this scale will require exceptional execution, he says, which will be a challenge for every single player to be able to deliver. Thirdly, he says that the fundamentals of quick commerce will evolve dramatically and the unit economics to build operating leverage will also change. And finally, as Zepto also gears up for an IPO this year,
Weak Monday on B Street. In line with most Asian markets, the market sees selling across the board. Nifty falls 1%, while midcap index and others fall a lot more. PSU stocks, including public sector banks, lead the fall. The Nifty Bank low by over 1% as well.
ITC now trades sans its hotels business as the demerger gets underway. The stock opens 26 rupees below Friday's close. ITC Hotels is expected to list by mid-February, with shareholders getting 1 share of the hotels business for every 10 shares of ITC.
Bajaj Finance bucks the market weakness as it clocks a steady 28% AUM growth in the third quarter. HDFC Bank slips over 1% on weak loan growth, even as deposits grow almost 16%. Union Bank of India shares slide over 7% as deposit mobilization weakens, with Q3 deposits falling 2% over Q2.
Pizzas and beauty scores over staples in the third quarter. Jubilant Food sees revenue surge by 53%, powered by an acquisition and strong growth in the Domino's business. Nykaa guides for more than mid-20s growth in the top line. Dabur, though, remains cautious on the general trade segment, says sales will grow in low single digits. Marico guides for mid-teens revenue growth, but remains cautious on margins.
Titan trades higher in a weak market as third quarter revenue rises by 24%, powered by a 26% growth in the jewelry segment. The company says festive and wedding spending coupled with higher gold prices led to a strong growth showing.
It's not the kind of Monday that bulls were anticipating, but it is what it is. You're watching Halftime Report with us here on CNBC-TV18. I'm Hormus Fatakia. With me is Mangalam Malu, and absolutely no place to hide today, Mangalam. Everything that you see on your screen is in the red, be it PSU banks, be it metals, but the Nifty, though, is given up everything that it had gained on Thursday, and it's now nearing very critical levels.
Absolutely. Hormaz, I was looking at the Nifty on 31st December. The low was 23,460 thereabouts. Thereafter, the next couple of days were good for the market. We saw a bit of a bounce back from extremely oversold levels. The question is whether those oversold levels come by once again or not. Because from the highs, the Nifty is down about 420 odd points. But importantly, the put-call ratio has now moved to sub 0.7 levels. We've seen a big surge in the India VIX as well. And the broader markets, that's telling you about the weakness in the market. Nearly 2,200 stocks which are in the red for just about 265 stocks which are in the green itself. So maybe, the return of FIIs post the New Year's hasn't been on the buy side. It has, unfortunately, been on the sell side itself. We'll look at the data and tell you that as well. But in light of that, there is one stock which is trading especially lower, and that is ITC. But that's not because there is selling pressure. That's because the company has gone ex its hotel business. So if you look at ITC, it's down by 33 rupees on a percentage basis versus the previous close, down by about 7% itself. But remember, the stock opened with a 26 rupee cut, and that was after a special session between 9 a.m. and 10 a.m. to discover the price of the hotel business, from which the current company is going X. The street expected a number between 15 to 20 rupees. The adjustment was about 26 rupees. What the actual value is something we'll know once the hotel business relists somewhere around mid-Feb, thereabout. So that is something we'll most definitely keep an eye out on. Just to jog your memory, at 15 to 20 rupees, they would value the hotel business anywhere between 26 to 28 times. But even if you were to look at 26 rupees, which the adjustment was on a price-to-price basis, this values the hotel business at around 37 times, which is in line with what Indian Hotels trades at as well. They have about 13,000, rooms, 55% of which is managed. Remember, they have a stated objective of 18,000 rooms by 2030, with nearly two-thirds coming in from managed portfolio, better for their ROCE, and there is an underlying positive trend for the hospitality industry itself. Between Indian Hotels and Chalet Hotels, there is, that valuation multiple difference, 37 times, 25 times. ITC also expected to be somewhere in that range itself, between 26 to 28, discount to the leader, but a premium to all the others. Let's see where it goes. But for now, just to tell our viewers that the street has shaved off 25 rupees, 26 rupees of the ITC share, taking it ex-hotels. But how much is that on account of the hotel business, and how much of that is general weakness is something we'll know only once the hotel business lists on in mid-Feb.
That's important to note, right? It's not everything that's selling pressure that is coming in on ITC. It's at 7% lower on the screen, but then that's also because 25 to 26 rupees have been shaved off post the demerger of the hotels business. Mangalam, thank you for that. Now shifting focus to the stock that has possibly been the stock of last week, which is Easy Trip Planners. A potential block deal, stake getting sold, the CEO quitting. There has been a lot that has happened with the company all through last week. Now earlier, we also discussed the stake sale by promoters with former CEO Nishant Pitti, who says that the promoters will not be looking to sell further stake going ahead. Let's listen into excerpts from that conversation.
And reflects in strategic focus on driving growth and expanding EasyMarket's global and international presence. In my capacity as the chairman of the company, while I continue to play an active role in shaping company's future, Vikas will be taking over as CEO to oversee day-to-day operations and ensure seamless execution to a vision. I'm confident that his business acumen and deep expertise in travel industry will pave an exciting and promising future for EasyMarket. The reason to sell a portion of my stake, that is just 1.4% out of 14%, was a strategic step to diversify my personal investment and unlock a value after doing 20 years for EasyMarket. Despite the sale, I still own 12.6% shareholding. And as promoter group, all the three brothers continue to own almost about 50%. We are not going to sell anything right now. My focus remains firmly on EasyMarket growth, and I'm fully committed to supporting. Moreover, EasyMarket stands out as one of the few new age companies where overall promoter equity remains almost about 50%. Which you will not find, in other e-commerce companies. And the initial intent was 10% of the block which I hold. That is 14%, 1.5% of the 10%, 1.4% of 14%. And as I told you, we still own almost 50% of the equity. This will be holding up. We can't just give you some timeline, but still, we are not selling anything right now. And that could be, you can say, that in 2025 we are not going to sell anything.
Right, let's talk about some of the financials that reported their updates. But before that, an update coming in from Kotak Mahindra Bank as well. The Chief Operating Officer and Chief Technical Officer, Milind Nagnur, has resigned with immediate effect from Feb 15th. Abhishek joins in with more. The stock at the lowest end of today's trading range.
It's been 8 to 9 months post RBI ban on the digital platform. The CEO and CTO has resigned with effect, from 15th of Feb 2025. Now, Nomura has written on Kotak Bank. They have a buy recommendation, target price of 2,170 per share. They say that this resignation adds to recent top management churn. They continue to monitor changes in top management, especially in the light of the recent churn that has been happening. Any impact of the recent management exit on the medium-term growth outlook will be seen closely. Back to you.
Abhishek, stay on, because the biggest pocket of losers today is the PSU banks, and all 12 PSU bank index constituents are trading with losses, particularly Union Bank and Bank of Baroda. Both of them are the top losers on the index today because both of them reported their third quarter business numbers. Tell us more on that.
Well, to begin with, the Union Bank of India has seen the lowest growth on a year-on-year basis in lower single digits. Perhaps no other bank has seen that number. So deposit growth is at 3.8% YOY and down by 2% sequentially. In this, the domestic deposit is up only 2.5% YOY and a decline of 2.4% sequentially. So amongst all PSU banks, what you are seeing is that the domestic business is not growing at the pace of the industry level, but it is the international business which is actually helping them in terms of business momentum. This is not good given the fact that international businesses do command a lower net interest margin than the domestic business. So advances have grown by 5.9% YOY and about 2.2% sequentially. In this, the domestic advances is up 5.3% YOY and about 2.1% quarter on quarter. The domestic RAM, that is retail, agri as well as MSME portfolio, that's grown by only 6% YOY and is down 1.5% quarter on quarter. Now, Bank of Baroda, after a strong show in Q2 FY25 with respect to their business momentum being really strong quarter on quarter, this quarter they have seen softening of the growth rates in terms of quarter on quarter movement. So deposits are up 11.6% YOY and about 2% sequentially. The domestic deposit is up 9.2% YOY and about 1.3% sequentially. Advances growth at 11.5% YOY and about 2.5% sequentially. In this, the domestic loan growth is about 11.8% YOY and 2.6% sequentially. The domestic retail advances, that's shown a strong growth over here, close to 19.5% YOY and about 4.7% sequentially. Back to you.
All right, take that point, Abhishek. Thank you so much for that. Take a short break, come back and you more on the markets, but specifically focus on the consumer space as well. On the other side, a whole host of updates coming in for the third quarter from the consumer sector as well. Consumer discretionary doing generally better, and that explains the outperformance that we're seeing in names like Nykaa, Jubilant Food and Titan. More on that after this break.
Capital markets environment from private to public will also be different compared to 2024 and 2023. So from a year of its boom to its true test of scale, it will be really interesting to see how quick commerce evolves in 2025.
2024 has now become the 9th consecutive year of positive returns for the Indian equities, and that's the record. In fact, 24 was a year of record in many ways, the highest fundraise in a single year, the ever-growing domestic pool, and so on. But the big question is, what is in store for 2025? Will the rally sustain? Will the mid and small cap continue to outperform? These are the questions in the minds of the investors. So now, crystal gazing is always a challenge, but CNBC-TV18 has reached out to the biggest market experts to bring to you an Outlook 2025, the biggest market poll for the new year. In fact, it was a poll across 61 participants, including fund managers, HNIs, as well as institutional dealers. So let's begin with the first and the most important question. What kind of return should investors expect in 2025? Majority of the respondents expect a single to mid double-digit return in 25. Only 11% of the respondents expect a negative return on the Nifty next year. In that case, will the broader markets continue to outperform in 25? Surprisingly, 50% of the respondents believe that 25 will be a year of large caps. Only a small percentage are still betting on
Welcome back. In an otherwise wobbly market, a whole host of consumer stocks, specifically from the consumer durable, slightly elite sort of space in the market, doing a lot better, which is Nykaa, Jubilant FoodWorks and Titan on the back of their third quarter update. Now, seasonally, the third quarter is strong for consumer discretionary names, and in that, these stand out for the following reasons. Let's start with Nykaa, the biggest gainer. It's up around 4% in today's trading session. The company reported its third quarter update, and remember, it was just last week where we had Anchit Nair join us and speak about the underlying trends in the beauty industry as well, where, a lot on the higher end is doing a lot better. The net revenue for the company likely to be higher than mid-20s. And at the same time, the beauty vertical has seen a growth acceleration versus previous quarters. This was also the quarter where they held their community building Nykaa Land event, along with a lot of the other Pink Friday sales, etc., that they did, do in terms of sales activations. So the growth this time around has been in mid-20s for the beauty vertical. If you take into account all the discounts, etc., that they've given, the gross merchandise value has actually been upwards of low 30s. So that's a positive. The part of the business which is not doing well is largely because of consumer sentiment, which is online fashion, which has seen subdued sentiment, because of which the fashion vertical growth has been limited to just about 20-odd%. The street likes the strength in the beauty business and the community, and as a result of which the stock up around 4%. Moving on to Jubilant FoodWorks. Remember, a lot of pizzas were ordered this time around. The question is how much of that was dine-in and how much of that was delivery. Consolidated revenue for the company grew by about 56%. But for them, what will be more important and a teller of the underlying trends is the standalone revenue, because consolidated includes the acquisition of DP Eurasia as well. Standalone as well, the internals are strong. 19% revenue growth is what the company's reported, 1,611 crores on the top line. But more importantly, the like-for-like growth in the Domino's stores has been around 12.5%, which is the highest that I've seen in the last 8 to 10 quarters at least. They've opened 16 new Domino's stores as well. And remember, if you notice over the last 6 to 8 quarters, the like-for-like growth in delivery has been much higher than dine-in. Dine-in had seen a bit of a deceleration. So whether that has been arrested or not is something we'll watch out for in the third quarter results when they are reported. We'll watch out for going forward the impact of beverage portfolio changes on their gross margins as well, because now they've moved away from Pepsi to Coca-Cola. Has that come at a better deal term? And the third thing is that growth in Popeyes is something that we'll watch out for. So these were things that both Hormaz and I could afford. That's Nykaa as well as some of the pizzas. Not so much for Nykaa, because Hormaz and I don't use some of those products, but those are ordered in our houses. The third one is Titan that we're talking about. Now there, a lot of gold was bought in the Diwali and festive season this time around. If you look at the overall performance of Titan, festive season and wedding season, along with the gold price rise, has meant that the overall revenue growth has been extremely strong for Titan this time around, 24% on a standalone basis. But if you look at the jewelry business, which is the mainstay of the company, there's a 26% growth out there. In that, it has been led by gold, and more specifically gold coins. 48% jump in gold coins is what the company has seen. And there has been a respectable growth of 21% in the studded business as well. But because gold has grown faster than studded, the studded ratio has come down. So that's something we will keep an eye out on. All the other segments of Titan, watches has grown at around 15%. Again, the street was working with a number of around 15 to 18% positive out there. Eye care as well has seen some sales activations out there. It's disappointing that the emerging business has grown just around 5%, because by nature of them being emerging, they have to grow a lot faster. Carrot Lane 2. Grown 25%, but a lot lower than the earlier CAGR of growth out there. So which is what we'll now track. One is the performance of other players, because last few quarters, Kalyan, Senco, all the others have grown faster than Titan on a lower base. Secondly, we'll watch out for margins, largely because of higher salience of gold, which is a lower margin business, and lower studded ratio as well. So has there been, some sort of margin correction that we've seen on Titan? And the third thing is the growth part for their emerging business, which is Taneira, and a resumption of growth in Carrot Lane is something that we'll be watching out for. So discretionary, doing fairly well, Hormaz.
Indeed. And I'll tell you something, I used to be a serial watch wearer before the pandemic, and then I've just stopped wearing watches completely altogether after the lockdown.
Is that because analog, or you digital watches or analog watches?
Absolutely no reason whatsoever. Maybe just time kharab chal raha hai, so why even look at it? But in this latest chapter of discretionary versus staple, you mentioned discretionary has done very well. How have staples fared?
Not so well. I mean, I'm afraid the mass consumption environment is still subdued. There were hopes of it recovering during the festive period, but those were dampened by increase in prices, increase in the underlying prices. We keep hearing Manisha on the show itself talking about, how palm oil prices, vegetable oil prices, and some of the raw materials for FMCG prices have seen an increase. So Dabur, for instance, they had called out the weakness in general trade because of the emergence of quick commerce. Out there, they've said that even as rural demand is resilient, that accounts for 35% of their revenues and a lot more in volumes. General trade is still under pressure, so that continues. And they are expecting consolidated revenue to grow in low single digits. The street was working with a number of mid-single digits itself. So low single digits implies that, there has been a bit of a disappointment. Beverages typically used to do very well in the Diwali quarter because a large part of their beverage portfolio comes in from juices, etc. But now maybe competition and underlying trends of people moving away from sugary drinks has meant that the beverage business has not done too well for them. Healthcare, again, does well in the third quarter, but this time around not doing well because of the delayed winter. So maybe that shift has happened in the fourth quarter. That's something we'll monitor. And home and personal care has done well. The question again is how much of that is on account of increase in prices and how much of that is volume led, because there have been inflationary pressures which have been witnessed in some segments, and as a result of which the growth in operating profit margins is absolutely flat. So low single digit revenue growth with flat margins is not something that the street is impressed by. Marico, now they've reported mid-teens revenue growth on a consolidated basis. That is what the street liked, and as a result of which the stock opened in the green. But immediately that was sold into because these are vagaries of the commodity prices. There has been an increase in copra, there has been an increase in prices of vegetable oils, and as a result of which the company had to pass these on to consumers. There has been an impact on their gross margin as well, as a result of which. So we'll watch out for how this pans out. So revenue growth of mid-teens, but modest operating performance growth, which means that margins will be compressed, and that's something the company is watchful of in the very near term as well. Over the medium to long term, inflationary trends are positive for large companies because lower end competition goes away. So these guys gain market share, but in the near term, there is always that pressure on margins, and which is why the stock has seen a bit of a decline from the highs.
Both of them, right? Both Dabur and Marico not doing very well in today's session compared to the likes of Nykaa and even Jubilant FoodWorks. As a complete roundup of discretionary versus staples in the quarter gone by. Of course, detailed results are awaited, but business updates show that this round has belonged to the discretionary names. Time for a short break. There was actually a slight recovery in the markets, but considering how volatile we are, the is has turned into a was in just a fraction of a second. On the other side, Manish Hathiramani joins in from Deendayal Investments to discuss the road ahead on the charts and some trading strategies as well. Stay tuned.
And small cap stocks, which brings to the next big question, and that is the biggest theme to bet on in 2025. Here there is a surprise. First surprise, financial has emerged as the biggest theme to bet on for the next year, and that is despite the macro challenges that the sector is facing and the fact that they have been an underperformer. The other surprise was the stellar outperformer of 24, which was capital goods. That's been considered as the least preferred bet going into 2025. We spoke about the returns and the big themes. Now, what's going to drive all these returns? And the near consensus answer is earnings, earnings, and earnings. That's going to be a dominant factor for the Indian equities to outperform going into 2025. There was a small portion who also believe that the Trump policies could be interesting to watch out for. Now, we spoke about the micros and the themes. Let's focus on some of the macros as well. Q2 was a bit of a shocker as far as the GDP figure is concerned. And after that, many on the streets have trimmed down their growth forecast for the country for next year. But will the growth surprise on the upside? We asked that question to majority. Most of them believe that the GDP growth will be between 6.25 to 6.5% in 2025. Only a mere 3% expect the growth to fall below 6%. So that's the big GDP growth forecast. So what's going to drive the GDP growth? And that's where the consensus seems to be, and that is the government spending. 77% of the respondents believe that government spending, which was lackluster in the first half of this year, will pick up in 2025. So that's going to be the big driver as far as the GDP growth is concerned. We had a record year as far as rupee is concerned. So we asked the question as to will that be a spoil sport into 25 as well. Most of the experts believe that the rupee is going to be ranged between 85 to 87 a dollar, while a small segment expects the currency to appreciate below 85 as well going into 2025. Also, we saw a new RBI governor taking charge, and that the first policy will be in 2025. So we asked the experts, what to expect in terms of RBI action. It's a divided house there. 50% believe that the first rate cut from RBI will be in the Q4 of this financial year. However, a small portion believes that the stretch line could be as late as the third quarter of FY26. So that's the RBI action. Indeed, if the RBI has to cut rates, then how much is the rate cut that the street is penciling in? Half of the respondents, which is...
Welcome back. You're watching us here on Halftime Report. Perfect time to get you the market update at midday itself. There has been a sharp fall that we've seen, as the ticker team at the bottom tells you. And from, the highs, we saw a big decline. There was a recovery, but recoveries, as we see through the day, have been sold into currently at the lower end of today's trading range with a cut of nearly 300 points on the Nifty itself. So if you look at, all the frontline indices, you have the Nifty Bank, as well as the mid-cap index doing a bigger cut. The Nifty Bank as well as the mid-cap index as against the Nifty itself. And the key draggers on the index, if you just look at some of the important, places which are dragging the index, ITC will have to knock off because that's on account of a corporate action. HDFC Bank, Reliance and Kotak Mahindra Bank are the ones that account for majority of the cut that we're seeing on the Nifty, which has been negated marginally by names like Titan and ICICI Bank itself. This increase in, the declines that we've seen on the Nifty has meant that there has been a surge in volatility as well. And that's reflected in the way that we've seen in, the market breadth as well, where we have over 2,000 stocks which are declining for about 267 stocks which are in the green itself. The Nifty now firmly below the 200-day moving average of 23,900. We were expecting that to be a bit of a support, and the fall increased as we broke below this important level itself. That's largely because the 24,000 put writers were caught on the wrong side. A lot of put writers were active at 24,000, hoping for support coming by, but now that they've caught on the wrong side, you can see, some of the open interest has been weaned off out here with a sharp surge in premium itself. And as a result of this happening, 24,000, which was earlier considered to be a bit of a support, is now a stiff resistance because we've seen a lot of call writers come back, and there's 1 crore shares outstanding in the 24,000 call for a premium of 70 rupees, telling you upwards of 24,000, 24,050, 24,070, we could see a lot of supply. Now at lower levels, 23,500 put writers are getting active once again, telling you that maybe there could be support around these levels. And understandably so, because last week we saw a bounce from these levels itself. 23,460 was the December 31 low, after which we saw that 700-point recovery over the next couple of trading sessions. Looking at stocks, we have Union Bank and Dabur, both of them seeing a lot of short positions being added, but a lot of open interest activity on the long side is what we're seeing in some of these diagnostic players, Dr. Lal Path Labs, as well as Metropolis Health. So we'll keep an eye out on these because these guys usually move in tandem and with a lot of gusto as and when there is news that hits. So just keep an eye out on this pack as well.
Indeed, the bulls will definitely be hoping that those December 31st lows of 23,460 are not revisited again. But what's lined up on the charts for the index, we have Manish Athiramani of Deendayal Investments who is joining in now. Manish, good afternoon. Thank you for joining in. 23,900, that 200-day moving average, we spoke about this the last time as well. What are the charts indicating now? Do you see a retest of these December 31st lows, or is there support that lies ahead of it that can trigger some bounce on the upside for the Nifty? And couple that up with your stock recommendations as well.
Good afternoon, Hormuz. Thank you so much for having me on the show. Well, for starters, we have clearly gone range bound, and that is something which we had discussed last time also. We said the difference is that now the range is only exceeding both from the lower end to the upper end. I have kind of diagnosed this range to be between 23,400 to 24,200. We might find a lot of these intraday movements of 300-400 points with the real move or the substantial move to emerge into a trend will only be when either side gets triggered. I see a similar situation in the Bank Nifty also, where we are now looking at 50,400 on the lower end and 52,000 on the upper end. Coming to my stock picks, I'm working with 2 sells on the heavyweights. The first one is on an HDFC Bank, which is for a target of 1650, stop loss of 1820. 1780 and 1740 were 2 important support levels which we were working with, and both have been broken down on the back of good volumes, which should allow the stock to fall further. The second sell is on Ambuja Cements for a target of 517, stop loss of 543. Here to 545 to 550 a 5 rupee range had a large volume block sell, and that has forced the stock to break these important support levels. After a short consolidation phase, the stock has broken down quickly, and we expect the drop to exacerbate.
All right, Manish, thank you so much for sparing time and joining us today to discuss your views on the index and on specific stocks as well. Time for a short break. Management conversation lined up on the other side. Adish Patil, the Chief Financial Officer of Aarti Drugs, joins in to discuss the road ahead for the remainder of FY25 and a lot more. Stay tuned.
That the rate cut going into 25 would be at least 50 basis points. So 50 to 75 basis points is what a lot of people are betting on. So that's the rate cut expectation going into 25. In fact, 24 was a very volatile year. We had a budget, we had general elections, multiple state elections, and so on and so on. But 25 could be a year of moderate returns, but the expectation is that the positive returns would continue going into 25 as well. That's the big poll from CNBC-TV18.
Well, the consolidation theme continued to play out in 2024, with 40 million tons of capacity folding up into the hands of Adani Cement and Ultratech. And over the years, Adani's foray into the cement space with a massive war chest has acted.
Welcome back. As promised, getting into the management of Aarti Drugs now. That's after the US FDA issued an EIR for its MIDC Tarapur-based API manufacturing facility. Adish Patil, the Chief Financial Officer of the company, is joining in. Adish, good afternoon. Thank you for joining in. You know, how big is this clearance for your Tarapur facility? How much does this contribute to your overall business? And with this clearance, how does it pave the way for what kind of drugs from this facility?
Yeah, hi, good afternoon. So definitely this is a very important success factor for us, because not only for US but also for European market, it will help us to market our products. There was a lot of negativity among European clients because of the import alert from this plant. We already had European approval for this plant, but we were not able to export to European markets because of the import alert. So as of today, this plant was contributing only roughly around 25-35 CR per annum to the top line. But the potential of this plant is around somewhere around 80 crores based on the product mix. We have two big production facilities, two main production blocks, which are multi-purpose in nature. So we can do antibiotic, then sedative, then anti-inflammatory segments products from this particular facility. And we are very hopeful that within within a span of 12 to 18 months, we can start seeing some of the commercial exports from this plant.
All right, we take that point. Largely small contributor, but important from a strategy standpoint, like you've pointed out, Adish, because your first half revenue is close to around 1,100 odd crores. Even if you look at the last year revenue, 2,500 crores, you know, the plant does run at full capacity at around 80 to 100 crores, sub 4% of your overall revenues. But remember, Europe is around mid-teens, so maybe it could help in increasing the contribution coming in from there itself. But let's talk about the business itself. You had earlier said that you're targeting 7% growth in this year when it comes to the revenue, with the revenue doubling by FY27. Do you maintain the near-term guidance? And is there an update on the long-term FY27 guidance?
Yeah, so the FY20, based on the current API prices, we all know that last 3-4 quarters, the prices of APIs has been continuously decreasing. And that was mainly on the account of raw material prices going down, on the account of crude going down. So based on the current pricing scenario, it seems that at a full potential by FY 2027, we should try to aim at a turnover of roughly near about 4,000 crores. No doubt about that. We will still try to do that. As far as the near-term targets are concerned, what we feel is that there was heavy negative rate variance for this year on year. And in the beginning of the year, the exports were not doing that well. But now the exports have picked up in the second half of the year, plus two of the capacities which have come up, which will be coming up this quarter, that is in the March quarter, will also help us a little bit in terms of increasing the overall revenues, but not only revenues, but also help us in backward integration that might help us improve some margins as well.
7% revenue growth target is what you had in this year. Do you maintain that? And first half margins were 11.5%.
It will be flattish this year, this particular year, the entire year.
Okay, revenue will be flattish this year. And margins, how much?
Margins overall, we foresee around 12 to 13% EBITDA margins for the entire year.
So which means, so from 7%, you're saying that revenue will be flat this year, Adesh, if I'm reading that correctly, right?
Yes, because the earlier half of the year was not that good in terms of volumes as well. The second half, the volumes have picked up, but then because of the first half of the year, the overall revenue target may not be reached.
Right. So, and what about the entire API segment itself, considering that is the biggest of your business? How is the pricing scenario faring right now? And do you expect any sort of improvement going into the first 3 months of the second? Have you seen any improvement in the first 3 months of the second half? And do you see any further for the remainder of the year as well?
Yeah, so the improvement was seen only on the account of demand. The export demand has increased in the second half of this particular financial year. However, as far as the pricing is concerned, it is quite flattish. The December quarter pricing would be almost flattish, means will be equivalent to the September quarter pricing, which is a good sign because there would be further decline in the prices much. However, if we go year on year, that is December quarter versus December quarter, we might see some 4 or 5% negative price variance. Yeah.
So, despite you saying that revenue growth this year will be flattish compared to the 7% that you had earlier mentioned, do you still believe that you will achieve that 4,000 crore revenue guidance by FY27?
Yeah, it is fairly possible. And the main reason for that is 2 of our big greenfield projects have come online. And plus, we are doing a lot of brownfield expansion as well. And plus, this US FDA approval is very good for us. In fact, in last 2 years, we have 3 Brazilian approvals, a couple of European approvals, and now this US approval. So on the regulatory front, we are going quite well as far as factories are concerned. Now we need to buck up on the commercial side and focus more on the regulatory sales.
So since you spoke of the greenfield projects that have come online, does that include the one in Sayakha in Gujarat as well?
Yeah, so that will be coming up in this particular quarter. Yes, very much.
And how much will that contribute?
So that particular project mainly would be in intermediate and spec chem, though it may not contribute a lot on the top line, but it will definitely help us improve our gross margins.
And what about the brownfield expansion that you were mentioning, Adesh? If you can shed more light on that, how much are you planning to spend? How will you fund that and so on?
Yeah, so some of the brownfield expansion we have already done in the last year. Means one of the antidiarrheal product, already the expanded capacity has come up. We are going ahead with the expansion of few antifungal and cardioprotectant products as well. That particular expansion will be taken care of in the maintenance capex budget of around 50 crores per annum, which we have for every year.
All right, Adesh,
And
thank you
that
so
will be
much.
mainly through internal accruals.
Right. Please go on. That will be through internal accruals, right?
Yeah, yes.
Yeah. All right, Adish, thank you so much for sparing time and joining us today to discuss the road ahead for the company. Wish you good luck for the rest of the year as well. That was Adish Patil, the CFO of Aarti Drugs. The bigger takeaway, though, is that they've cut their guidance for revenue growth this year to flattish compared to the 7% that they had earlier guided for. But as we slip into a short break, here's some good news for our viewers. India's business news leader is now just a click away, introducing CNBC TV18's all-new app, where you get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. You can download the app right now from the Apple Store or the Google Play Store.
Triggering the race for capacity share, which has increased the competitive intensity. The top 5 players now account for more than 60% of the market. That compares with only around 40% 7 years back. The question is, will consolidation slow down from here on? Remember, the recent deals have been concluded at around $100 per ton mark. That's closer to replacement cost. Well, ICICI Securities says that cement majors like Ambuja as well as Ultratech, they have exhausted most of their cash reserves post the recent acquisitions. They add, except for a few NCLT cases, they believe that low-cost acquisitions are largely behind. And now the potential deals may command a significant premium to the replacement cost. That could make them much more unattractive on borrowed funds at low cement prices. Well, the pain point is, elevated competitive intensity has led cement prices plunging to 4-year lows. Demand as well has been plagued by general and state elections, heavy rainfall in few regions of South India, the construction ban in NCR region, and also labor unavailability in various parts of the country. But part of the street is optimistic that cement sector has hit rock bottom and it's ready to fight back. Well, Jeffrey says that dealers suggest that price declines have bottomed out, and now the industry is attempting price increases every month. They believe that the recent increase in industry consolidation further supports a case of revival in cement prices. Though sustainability of the price hikes will depend on what the leaders prefer, volume or price increases. Well, Goldman says that their channel checks suggest that demand is recovering, though on a low base. With the expected pickup in government capex, rural demand is likely to improve, and urban real estate market, well, that's doing well as well. So they expect that cement demand will grow by around 7% in FY26. On the profitability aspect, well, INCRED says that lower fuel cost, improvement in volumes, that could lift EBITDA per ton by around 160 rupees on a sequential basis. Though they admit on a year-on-year basis, it will still be down by around 200 rupees per ton. Axis Capital says that cement spreads are on recovery path. It's at the highest levels we have seen since January 2024. They add,
Welcome back, and there is a recovery that has come in from the lows of the day, at least for now. The Nifty is back above the 23,750 mark, significantly off the lows of the day, almost 150 points now from the lows. The Sensex too at one point was down almost 1,150 points. That too has seen a bit of a recovery and is down close to 800 points, but still firmly in the red are the benchmark indices. But amidst all of this red that you are seeing on the screen, Morgan Stanley has come out with some bullish commentary on the Indian equities. We've been talking about this 1 lakh mark on the Sensex for quite a while now, and Morgan Stanley's bull case scenario expects that to happen this year itself. The bull case scenario target of 1,05,000 now is what Morgan Stanley is projecting for the Sensex. We'll get to that in just a bit, but the base case scenario for now is where Morgan Stanley is expecting fiscal consolidation, an increase in private investment, a positive gap between real growth and real rates, robust domestic growth, and no recession in the US is what Morgan Stanley expects as a base case. Now, in the base case, price target for the Sensex is 93,000 is what Morgan Stanley is projecting by the end of the year, and some other factors at the base case where they say that there should be a modest reduction in interest rates and positive liquidity environment, and they expect the Sensex earnings to compound at an annualized pace of 17% until FY27. Now, that's the base case scenario. Now, for the bull case, which I just spoke of, that 1,05,000 target on the Sensex, here they expect oil prices to remain persistently below the $70 a barrel mark. That will result in low domestic inflation, and that will result in more rate cuts from the RBI than earlier earlier envisaged. And they also expect foreign flows, this FPI selling that has been putting a lot of pressure on the markets, that could surprise on the upside, and some reforms from the government could surprise on the upside, be it the slew of rate cuts on the GST front or even some progress on the farm laws, is what Morgan Stanley says in its bull case scenario. And here they expect the earnings to compound at an annualized pace of 20% until FY27. But a bear case scenario, which is a 20% probability for Morgan Stanley, here they are saying that oil prices will remain above $110 a barrel, and instead of loosening monetary policy, RBI will tighten monetary policy to protect the domestic macros. Now here they expect the US to slip into a recession, and as a result of which the Sensex earnings will grow only at 15% and the multiples will derate to showcase these poor macros. So as of now, there is a 50% probability of a base case, a 30% for the bull case, and only a 20% probability for the bear case is what Morgan Stanley has said in its note. Now, in light of this, what is it overweight on? It's overweight on 4 sectors: financials, consumer discretionary, industrials, and IT. And on the flip side, they are underweight on telecom, consumer staples, energy, healthcare, and utilities. And based on this, they have also come up with a focus list of stocks. There are 10 names there. Brainbee Solutions is one of them, which is FirstCry, the recent listing. But the index heavyweights are part of this too, be it Maruti, Reliance Industries, ICICI Bank, Infosys, L&T, Ultratech. So a large cap focus list is what Morgan Stanley has. The base case scenario of 93,000 for the Sensex, but the bull case is the one to watch out for, a 1,05,000 price target for the index. Now let's also get you some market opinion that came in from Devina Mehra, the founder and chairperson and managing director of First Global, on the themes you should be watching out for in 2025.
So we had been expecting this. Of course, we bought hedges in the middle, but the market continued to run up. So we were cautious in March. We were cautious in June before the election results, but we did not go into cash. We bought hedges. So this year we've spent some money on hedges, but that's like, we didn't get used in a sense, but that's like buying health insurance and not getting hospitalized. I don't think it was a waste, but this was not something we were not expecting. As far as the situation now is concerned, I think if you have made money in very frothy areas, time to move to a steadier, more conservative portfolio, because I don't still see a big risk in the mainstream larger stocks. Pharma has been an overweight since I think first or second quarter of 2023. And again, pharma had a poor run prior to that for many years, which created the room for this up move. And so we continue to be overweight pharma. Of course, in the next 10 days or so, we will be doing a quarterly rebalance. Yes, we have been almost always underweight banks since we started the PMS almost 5 years now. As someone was saying, you repeat this in every interview of yours, that I am a nervous investor in banks and lenders. And the primary reason is that that's a thing that's an area which always gives negative surprises. In the whole credit system, may or may not be exactly the banks. There is, I think, pressure building up on credit. A lot of indicators like that, like gold loans going up, which means, people are forced to mortgage jewelry.
Devina Mehra there of First Global, and just as I mentioned, the Sensex is now back down 850 points. So extremely choppy on Dalal Street at the first trading day of the week. Pull up the India Wix as well. At one point was up 13%. A sharp surge seen in the volatility index as well, and that will give you an idea of how choppy the trade is. Still 12.5% higher above the levels of 15. Well, time for a short break. On the other side, Manisha Gupta joins in with Sachin Jain, who is the India head at the World Gold Council. Stay tuned. Back on the other side.
Spreads are now 12% higher sequentially, though it's still down by close to around 5% on a year-on-year basis. So 2024 has been a brittle one, both on pricing and demand. The hope is that 2025 cement will be in far better shape, and it could deliver a far steadier performance.
India is in vogue for a number of international brands this season. Surabhi Upadhyay, CNBC-TV18, Mumbai. Hello, I'm Surabhi Surabhi Upadhyay, and I am going to be joined by trailblazers who are transforming the banking and finance sector in India and around the world, only on CNBC-TV18.
Celebrating 25 years of CNBC-TV18.
From sharp insights in the political arena to all the excitement from the world of sports. We are here at the CNBC-TV18 Budget Headquarters as we've done for the last 25 years.
Celebrating 25 years of CNBC-TV18.
The markets are betting big on affordable housing. You look at the kind of stocks that have risen.
We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating 25 years of CNBC-TV18.
Welcome back. 250 points lower on the index, but there is plenty of activity that is taking place in the broader markets, and some of the movers that we just spoke of, PSU banks at the start of the show. Union Bank continues to remain 6.5% lower, but the big mover from last week, Lloyd's Metal, that is seeing some bit of profit booking in today's trading session, 6.5% lower there as well. So, and some of the PSU names, pull up the oil marketing companies, considering the fact that crude oil prices are on a tear right now, above $76 a barrel, 4.5% lower for HPCL, 2.5% lower for BPCL, and another 3% shaved off on Indian Oil as well. So not a good day for the oil marketing companies in today's trading session, considering the rise in crude oil prices. ONGC and Oil India, not necessarily crude, because higher crude oil prices are beneficial for ONGC and Oil India, so they will not have a negative impact on that. But Oil India is seeing some profit booking, considering the fact that it has surged quite a bit over the last 5 trading sessions. It was the best PSU performer of 2024 was Oil India. And but one stock that is bucking the trend though in today's session is ITI, and that continues to be going from strength to strength, 17% higher there on ITI as well. But mind you, the stock has very little float in the market. On to the commodities segment now, and Manisha Gupta joins in with Sachin Jain.
Well, you know, when you look at the gold prices, and that is what I want to talk about, we've seen prices being quite very volatile. And if you look at the previous year, we saw multi-year highs come in for the gold prices. And this year as well has started on a positive note. So if gold prices put in the best year since 2010 and gave you nearly 27% of returns, we've seen this year continue to see those kind of gains up. Today is a bit of a red, and that is because the strength in dollar index and higher yield seems to be weighing on to the markets. But even with today's profit taking, we are standing at around a percentage point of gains in gold for 2025 till now, and silver prices, after gaining that 22% in the previous year, are up by nearly 2.5%. Well, that is what the markets really seem to be believing on what the gold prices could be doing going forward in this year. So while it is a divided 2 halves into the year, the street believes that the first half is when you could see all-time highs coming in yet again for the gold prices. And that is because as the US President Trump takes over office on 20th of January, it is going to be a bit of an uncertainty on how he acts and how the other countries react. And that could impact the gold prices on the higher side. The second half is when you could see the prices settling down, and that is when you could be looking at a huge profit taking as well. So at this point in time, it really is about what US will do, how many interest rate cuts will we see from US and from various other countries as well. And the third point really is going to be about geopolitics, and then it is going to be about currencies as well. The kind of depreciation that we've seen come in for various currencies, including Indian rupee. You have Australian dollar trading at a 2-year lows, Canadian dollar trading around 5-year lows. We did recently see Brazilian real at around all-time lows. Japanese yen has been trading at a 2-decade lows. So that is what will impact the gold prices going forward as well. So that is the expectation that anywhere between $2,900 to $3,000 an ounce on the higher side is where the gold prices could go to on the higher side there. The other thing really to watch out would be the Indian budget. There are 3 or 4 things that the street has been putting forth. One, of course, is about the customs duty. Remember, we did see 9% of a cut in the previous budget. Will that have a review is something that the street will watch out for. Second is about hallmarking coming in for bullion as well. At this point in time, it's only on gold jewelry and silver jewelry, but would bullion as well have hallmarking is something that the street will watch out for. And third thing is going to be about a good India delivery. As of now, there's a lot of import that we do, but will India start to do any exports? And will there be hedging opportunities in IRBX as well? So there's a lot depending on in the next couple of months that street will watch out for. But on your screens, we are holding above 2,600 for gold. 2,790 has been an all-time high. So from those kind of levels, we are still $150 away in sense of gold. And silver, the high that silver has seen for 2024 has been $34 an ounce. From those levels, a bit of a profit taking. Quite a bit of a profit taking, but as I said, we are trading 2.5% on the higher side for 2025 as of now. Much would depend upon for this week on where the US jobs data comes in from. And the second important thing to watch out would be various Fed officials are slated to speak in this week. So what is really the sense of outlook for 2025 would be yet another thing that the markets will see impact from.
You know, a lot of this market moves on what the Fed officials say more than the actual policy itself, isn't it, Manisha? But indeed, a lot depends on whether the gold prices will continue to glitter as they have in 2024. But plenty of business updates that we are reacting to since the morning, and Macrotech is one of them. They came out with a business update earlier today, and they mentioned that their pre-sales for the quarter, it was the best ever quarter that they had in terms of pre-sales. 32% growth on a year-on-year basis, above the 4,500 crore mark. Collections were up a robust 66%, and that stood at around 4,300 crore rupees. And it is because of these improvement in collections is the reason why the company has further managed to bring down its net debt to around 4,320 crores, and that is they've reduced it by another 600 crore rupees. Now, in terms of project additions, they have added another project in Bengaluru worth around 2,800 crores, and now they have 5 locations in Bengaluru, and now they expect these 5 locations to contribute significantly to pre-sales starting in FY26. And because of these new projects that they have added across Mumbai, Bengaluru and Pune, they have already achieved more than 90% of their full year gross development value guidance for Macrotech is what they have said. And they've also acquired some 33 acres of land for their digital infrastructure business. And of course, they have entered into an agreement with their JV partner to further increase their stake in the digital infrastructure platform. So good business update coming in there from Macrotech, debt reduction further, and also record pre-sales for the quarter gone by. But considering how the market is, still 2.5% down on the stock. But with that, it's a wrap on this edition of Halftime Report from me, Manglam, and the team that put this show together. Thank you so much for watching. Business Lunch takes you through the next 30 minutes.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform?
It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhat.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
An analysis of election affidavits carried out by 2 independent non-profits has revealed that Andhra Pradesh Chief Minister Chandrababu Naidu may well be India's richest Chief Minister, and by a whopping margin at that. Recent surveys conducted by 2 independent organizations, that's the Association for Democratic Reforms or ADR and the National Election Watch or NEW, has pegged Naidu's declared assets at around 931 crore rupees. That's just shy of nearly 3 times the second place name on that list, and that's Arunachal Pradesh Chief Minister Pema Khandu, whose assets come to around 332 crore rupees. In fact, both Naidu and Khandu top this list of India's richest chief ministers. In fact, both these organizations surveyed chief ministers belonging to 31 states whose total cumulative assets came to around 1,630 crore rupees. That's an average of 52.59 crore rupees per chief minister. But remember, this average number is largely buoyed by the large assets declared by both Naidu.
Weak Monday on D Street in line with most Asian markets. The market sees selling across the board. Nifty falls 1% while the mid-cap index slips close to 2%. PSU stocks including public sector banks lead the fall. Nifty Bank also down over 1.5%. The Indian rupee falls to a new low amid the weakening of the Chinese yuan, the strengthening in the US dollar, higher US yields and rising crude oil prices also weigh. ITC trades ex the hotels business as the demerger gets underway. The stock opens 26 rupees below Friday's close. ITC Hotels expected to list by mid-Feb, with shareholders getting 1 share of hotels business for every 10 shares of ITC. Bajaj Finance bucks the market weakness as it clocks a steady 28% AUM growth in Q3. HDFC Bank dips over 1% on weak loan growth, even as deposits grow almost 16%. Union Bank of India shares slide 7% as deposit mobilization weakens, with Q3 deposits falling 2% over Q2. Pizzas and beauty score over staples in Q3. Jubilant Food revenue surges 53%, powered by an acquisition and strong growth in Domino's India. Nykaa guides for more than mid-20s growth in top line. Dabur remains cautious on the general trade segment, says sales will grow in low single digit. Marico guides for mid-teens revenue growth but remains cautious on margins. Hello, good afternoon. You've tuned into Business Lunch on CNBC TV18 and I'm Vinny Motiwala. Let's look at the markets. Yes, we've seen that fall coming in from the day's highest point, but from the day's low, it tried to make some bit of a recovery. As of now, the Nifty is at 23,000.
744 levels. So from the day's low, we're seeing a considerable recovery. The day's low was around 23,615. But from that, we've seen a recovery coming in for the markets. Let's look at what the contributors are coming in for the Nifty 50 as well today. While we have Infosys and TCS, which are bucking the trend in terms of the top contributors, ICICI Bank also making the list and Titan. We have losers coming in are ITC, HDFC Bank, Reliance, as well as Kotak Mahindra Bank, which are under pressure in today's trade. Pulling up the Nifty Bank today as well. Nifty Bank is seeing a bit of a more decline, down almost 2% in trade. As of now, also 1.7% decline near the day's lowest point is what the Nifty Bank is trading at. Mid and small cap, broader markets also seeing a bit of an underperformance versus the benchmark indices. So Nifty mid cap is down almost 1.8% in trade. Small cap also down almost 2% in trade is what we're watching out for. So keep an eye out on the broader markets in trade. The only sector which is managing to hold on to some bit of a green today is obviously the Nifty IT, holding on to 0.1% of gain. But yes, that's how the market shape is looking like right now. But a lot of individual stocks are there to trade as well. And before that, we've seen rupee that is in focus. So let's start by focusing on the rupee. Now, the Indian rupee has fallen below 85.8 mark today, a level which dealers say that RBI appeared to defend last week. Now, what's led to this giving up on the rupee, giving up on this level, and what's happening in the market today? Lata is joining with us to give us more details on that. Lata?
Well, there was always the dollar index rising to that 109 mark last week. But what appears to have, tilted in favor of rupee shorts is that the yuan has let go, or rather the PBOC has let go of the 7.3 per dollar mark for the renminbi. For a long time, for a few weeks, the PBOC seemed to be defending that figure. On Friday, it went below that. And the offshore yuan, which is the one traded in Hong Kong, etc., what you call the CNH, went past that 7.33 to 7.36. Now, you must remember that India looks very closely at how the yuan is trading. While we are normally discussing about the dollar rupee, the biggest, if the rupee remains appreciated versus the yuan, the chances of Chinese dumping are very high. Even in 2024, the yuan lost 3% and the rupee lost 3%. So we normally try to keep that also as an angle, or at least the Reserve Bank does. So the fall of the yuan below that 7.3 mark was apparently seen as one reason why the Reserve Bank appeared to let go of the 85.80 mark. It appeared to be defending that figure for a better part of last week. But with Friday's calculations changing today on Monday, 85.80 was let go, and we saw even 85.84 getting traded. It's not that the Reserve Bank perhaps is absent, but it is more going with the flow, is the way dealers put it. The rest of the global cues are quite clearly against EM currencies as well as against the rupee. I need hardly recount that the dollar very close to 109 just moved off a bit, 108.88 thereabouts. The US yields, 10-year bond yields at 4.62, higher than the 4.55 that was for a better part of last week. Again, a very strong yield return in the mother market, in the US market, normally attracts, only improves US exceptionalism because it's a risk-free return that funds get. And then, of course, crude also has inched up a bit. The entire gamut of global factors are not in favor of emerging markets. And then, of course, the big domestic negative that we got, the Jan 3rd FPI sale number. We had 1 day of positive flows on Jan 1st. We saw 1,200 crore of FPI buys, which started getting some murmurs that maybe when the New Year's allocations come, the Indian markets will not be such a sell. Next to the US, we may actually be a buy. But this 4,227 crore of sell number has also released more energies for the rupee shorts and, of course, even the equity bears. And you're seeing a considerable amount of custodial bank buying of dollars today.
Okay, Lata, thank you so much for the update coming in on the rupee front. But let's move on and talk about some of these individual stocks that are in focus today. We'll start up with ITC because that's trading X, the hotels business, as the demerger gets underway. Now, ITC Hotels is expected to list somewhere by mid-Feb. Mangalam is joining you with us to break down the details of this merger. Good afternoon, Mangalam.
Good afternoon. So if you look at the ITC share price and compare that to the previous close, you would see there's a decline of almost 32 odd rupees. But that's not a decline. If you look at the stock price open versus previous close, there was a difference of 26 rupees, and that is exactly what the street is valuing the hotel business as a per share basis of ITC itself. There was an expectations of anywhere between 15 to 20% share adjustment for the hotel business. So this 26 rupees, some would say that is overvaluing the business, but that's not to be. We will watch out for the actual value of the hotel business once it lists in mid-Feb itself. But just to jog your memory, ITC's hotel business has close to around 13,000 rooms. They have a stated objective of 18,000 rooms by 2030. And, the hotel business itself in India is led by Indian Hotels, which trades at a 37 times premium or 37 times multiple of EV to EBITDA. And then you have all the others, which include the likes of Chalet Hotels, Lemon Tree, and, EIH as well. ITC likely to be trading anywhere between 25 to 37 times. So that would be around, 17 to 19 rupees per share of ITC and 175 to 190 rupees the hotel business when it lists in mid-Feb. But as of now, the street valuing it at around 26 rupees per ITC share or a little around 250 rupees of the hotel share when it lists in February.
Okay, Mangalam, thank you so much for that update coming in on ITC, keeping an eye out on the listing now of ITC Hotels. But shifting focus to Jubilant FoodWorks, that's in focus today. Why? Because the Q3 update seems to be quite exciting. Mangalam, pizza party this afternoon, at least for Jubilant FoodWorks, surely?
Absolutely. This afternoon and all of the third quarter, because if you look at, Jubilant FoodWorks numbers on a consolidated basis, yes, it's a 56% jump. Don't get excited by that because that includes the, DP Eurasia acquisition as well. So the number one has to look at is the standalone revenue, and out there's a 19% growth. That's strong because it's led by 12.5% jump in like-for-like growth, or similar stores of Domino's growing 12% over the previous year is a big positive. They've also added 60 new Domino's stores this quarter, so that is a positive as well. What we need to monitor, however, is how the performance of these like-for-like growth has been across dine-in as well as delivery, because delivery has stayed steady and seen an improvement for Jubilant FoodWorks over the last few quarters. That's become the new normal, whereas dine-in was declining over the last few quarters as well. So what we need to look at is, has that decline in dine-in been arrested this time around? How is the growth of their beverage business likely to be once the deal with Coca-Cola has come by after the company has gone ahead and terminated that deal with Pepsi? And the third thing is growth in not just Domino's but also Popeyes. So all these factors look at it like it's a positive third quarter, and there are growth triggers going ahead as well, and that's what's explaining the up move that we've seen in the stock today, though it's off highs. But remember, in the last 6 months it's rallied about 60%.
Absolutely. Let's not forget that. Important to watch out for. But yes, we've covered hotels. We are covering QSR, and now Mangalam back in focus again. I think there's more focus on you today. Dabur, how are the numbers looking like? FMCG exciting as much as we saw Jubilant Food, or subdued?
So there are three ways to look at FMCG. One is luxury, which is the ITC hotels business. The street overpriced that. Second is discretionary, which is doing better after a lull. And the third is staples, which is still not out of the woods. So we discussed luxury and discretionary. Let's talk about staples, not out of woods, and led by Dabur itself. Remember, previous quarter too, Dabur said that there was weakness in general trade and there was inventory correction, etc. as well. That's continued this quarter. Rural consumption, while it's resilient, remember, accounts for just about 35% of overall FMCG sales, a little more for Dabur itself, around 50%. If you look at Dabur's performance this time, they've said that, the consolidated revenue will grow in low single digits. The street was working with mid-single digits, so maybe there is a disappointment out there. And the disappointment stems from two quarters in particular. One is the beverage portfolio. Typically, juices does well around the festive season, but this time around there has been a muted performance. Now, is that because of competition from Campa, or is that because of underlying macro trend of people moving away from packet juices? Is something that we will watch out for in the numbers. The second part is that the third quarter, also known for some of their winter products, Healthcare in particular, Chawanprash, demand for that has been delayed because of delayed winter. So does that flow through in the fourth quarter, or is something that we'll watch out for as well? But there is inflationary pressure, and as a result of which the margins are absolutely flat. So if you were expecting margin improvement, that's not come by. If you were expecting revenue growth, that's not come by, and as a result of which the stock lower by about 3%.
Okay, surely keeping an eye on Dabur as well. Thank you so much for all of that, Mangalam, this afternoon. Let's move on and shift focus to Kotak Mahindra Bank. Now, Kotak Mahindra Bank's Chief Operating Officer and Chief Technical Officer have resigned with effect from 15th of February. Abhishek is joining in with us to give us more details on this one. Good afternoon, Abhishek. The stock is down 3% in trade today.
It's been 8 to 9 months post RBI ban on the digital platform. The CEO and CTO has resigned with effect, from 15th of Feb 2025. Now, Nomura has written on Kotak Bank. They have a buy recommendation target price of 2,170 per share. They say that this resignation adds to recent top management churn. They continue to monitor changes in top management, especially in the light of the recent churn that has been happening. Any impact of the recent management exit on the medium-term growth outlook will be seen closely. Back to you.
Okay, thanks for that, Abhishek. But do stay on with us, because Union Bank, along with Bank of Baroda, reported their Q3 business update as well. So tell us a bit more about that front.
Well, to begin with, the Union Bank of India has seen the lowest growth on a year-on-year basis in lower single digits. Perhaps no other bank has seen that number. So deposit growth is at 3.8% YOY and down by 2% sequentially. In this, the domestic deposit is up only 2.5% YOY and a decline of 2.4% sequentially. So amongst all PSU banks, what you are seeing is that the domestic business is not growing at the pace of the industry level, but it is the international business which is actually helping them in terms of business momentum. This is not good, given the fact that international businesses do command a lower net interest margin than the domestic business. So advances have grown by 5.9% YOY and about 2.2% sequentially. In this, the domestic advances is up 5.3% YOY and about 2.1% quarter on quarter. The domestic RAM, that is retail, agri as well as MSME portfolio, that's grown by only 6% YOY and is down 1.5% quarter on quarter. Now, Bank of Baroda, after a strong show in Q2 FY25 with respect to their business momentum being really strong quarter on quarter, this quarter they have seen softening of the growth rates in terms of quarter on quarter movement. So deposits are up 11.6% YOY and about 2% sequentially. The domestic deposit is up 9.2% YOY and about 1.3% sequentially. Advances growth at 11.5% YOY and about 2.5% sequentially. In this, the domestic loan growth is about 11.8% YOY and 2.6% sequentially. The domestic retail advances, that's shown a strong growth over here, close to 19.5% YOY and about 4.7% sequentially. Back to you.
Thanks so much for that, Abhishek. But on that note, we're going to slip into a very short break. But after the break, more news and updates, so don't go anywhere.
Well, it was in July 2023 where ITC first announced this alternate structure. So after a long drawn process, today is finally the record date for ITC Hotels demerger. ITC in July 2023 announced an alternative structure for the hotel business, wherein the company would own 40% in the business by itself and the remaining 60% would be held by shareholders via an entitlement swap, for which each shareholder will get one ITC hotel share for every 10 shares that they hold. The ITC hotel business, does it list today? No, that lists in mid-February, but today ITC will go X the hotel business. Of its total business, the hotel business has 4% revenue, 2.5% EBIT, but more importantly, 14% of assets, which makes this demerger ROCE accretive for the parent company, which will be listed today. For the resultant company, that is ITC Hotels, currently has 140 hotels, around 13,000 keys, 55% properties are managed with 69% occupancy. The important part is their stated target, 200 plus hotels with 18,000 keys by 2030, with 65% salience coming in from the managed portfolio. ITC Hotel financials reflect the underlying improvement in the hotel industry as well. Post-pandemic, over the last few years, we've seen growth. And in the first half of this year itself, ITC Hotels...
Welcome back to Business Lunch on CNBC-TV18. Let's pull up what the Nifty is doing right now as well. Important to watch out for. We've seen the recovery coming in from the day's lowest point. So as of now, Nifty is at 23,700. Slight bit of that recovery that we're seeing. So keep an eye out on that one. Nifty Bank also. Let's look at that chart where it is headed, because Nifty Bank also seems like it was down almost more than 1.9% as of now. But that is also almost near the day's lowest point. Not much of a recovery coming in for Nifty Bank. So today's fall mainly is led by all these banking names, especially PSU banks as well. But on that note, as we kicked off the calendar year 2025, Morgan Stanley has released its strategy note on India, highlighting the top themes and the targets for the year. Hormas is joining with us to give us all those details. Good afternoon, Hormas.
Good afternoon. And, we've been talking about this Sensex hitting that 1 lakh mark for quite a while now. And Morgan Stanley's bull case scenario expects that to happen by the end of this year itself. Now, even if we are in a weak market, Morgan Stanley, though, has come out with this bullish note where they are saying that India will be the emerging market to beat this year. And in this base case scenario, I'll get to the bull case in just a bit, but the base case scenario says that the fiscal consolidation, increased private investment, a positive gap between real growth and real rates, and no recession in the US, along with benign oil prices, will help India's macro stability going forward, is what Morgan Stanley says in its base case. And the base case price target is 93,000, which is still a significant upside from where the Sensex currently is right now, which is somewhere around the 79,000 mark. Now, for the base case, it further says that a modest reduction in real interest rates is what is it pricing in, along with a positive liquidity environment. And here it expects the Sensex earnings to compound at a 17% annualized rate until FY27. Now, the bull case that I just spoke of, where that 1,05,000 price target is for the Sensex, here they say that the oil prices will persistently remain below $70 a barrel, which will result in low domestic inflation, which will then result in more rate cuts from the RBI than earlier envisaged. That will be a positive. Foreign inflows will surprise on the positive, is what Morgan Stanley anticipates in its bull case. There are also the government reforms that can also surprise on the upside, which by that they mean a slew of rate cuts on the GST front and some progress on the farm laws as well. And they expect here the Sensex earnings to compound at a 20% annualized pace until FY27. Now, for the bear case scenario, they are saying that oil prices will go up to $110 a barrel or even cross that. And instead of loosening monetary policy, the RBI will end up tightening policy to protect the domestic macros, and global growth will slow down meaningfully. The US will slip into a recession, and the Sensex earnings will grow only at 15%, and which is why the multiples will derate to project the poor macros. So for now, Morgan Stanley has a 50% scenario probability of a base case to play out, a 30% for the bull case, and only a 20% probability of a bear case to play out. Based on this, they are overweight on financials, consumer discretionary, industrials, and technology, and they are underweight on telecom, staples, energy, healthcare, and utilities. And based on this, they have come up with a focus list of stocks, which is mostly confined to a lot of the nifty names, be it the likes of Trent, Maruti, Reliance, ICICI Bank, L&T, Infosys, and even Ultratech, with some broader market names like Brainbees Solutions. But for now, the base case is a 93,000 target on the Sensex, but the bull case is the one to watch out for, 1,05,000 on the Sensex.
Absolutely. Hormas, thank you so much for that. But let's move on. And the government is set to launch another round of PLI schemes for the steel sector. This scheme will be launched by Steel Minister today. Parikshit is joining in with us to give us more details on this. Good afternoon, Parikshit.
Union Minister for Heavy Industries and the Steel Ministry, H.D. Kumaraswamy, will be launching the new PLI scheme for the steel industry. It will be called Scheme 1.1. Remember, there was an earlier PLI scheme for the steel industry which had an outlay of 6,322 crore rupees. That PLI scheme, according to the government, has attracted an investment of 18,300 crore rupees against a committed investment of 27,106 crore rupees. The government had been receiving feedback that more can be done to make the scheme broad-based, and a second version of the scheme also needs to be notified. So after taking account industry representations and internal discussions, the government has now decided to launch a second PLI scheme for the steel industry with an outlay of rupees 4,300 crore rupees. So this will be a fresh outlay under the steel PLI scheme. And there will be greater emphasis in this to incentivize manufacturing of specialty steel and electrical steel in the country. Now, specialty steel is a high-grade steel which is used in automobiles, it is used in the defense sector, and the government has been trying to encourage more domestic production of this, but the offtake has been slow. Similarly, in this scheme, the government will also want to push the manufacturing of electrical steel in the country, which is used in electromagnetic devices and also transformers. Let's see what the offtake is like, but now the minister will launch the scheme today, and the applications will also be invited for this new scheme.
Okay, thank you so much for that, Parikshit. Surely keeping an eye out on that one. On that note, let's move on and talk about what sources are telling CNBC-TV18 that actually the Finance Ministry has approved 25,000 crore rupee PLI scheme. This is for electronics component. Ashmit is joining in with us to give us more details on this one. Ashmit?
Well, the government is clearly keen on building on the PLI for mobile story by introducing a PLI for electronic components. Bear in mind, this conversation is not new. It's been going on for the last 12 to 18 months. In fact, the demand that came from the industry was for 40,000 crore rupees. And that, in fact, the point where the conversations had began between the Ministry of Electronics and IT and the Ministry of Finance, considering that figure of about 30 to 40,000 crore rupees. That figure, however, for now, the Finance Ministry nod has come only for 25,000 crore rupees. So that figure has been trimmed to 25,000 crore rupees. But what officials tell us, what sources tell us, is that this is not the end of it, that there is that room for flexibility between the Finance Ministry and the Ministry of Electronics and IT to consider an upgrade, to consider increasing this outlay subject to the demand that is now seen for the first round for electronics components PLI, which will be for 25,000 crore rupees. So that's the figure to bear in mind. Another aspect, this is a nod that has come from the Finance Ministry. The file now travels back to the Ministry of Electronics and IT. They will place it before the Cabinet for approval. This is an aspect of PLI will require a cabinet approval. The key indicator, however, what we're picking up from sources is that after the cabinet approval, this is likely to feature in the upcoming budget for the subsequent fiscal. So clearly, the focus is on electronics components. The focus is on building more value addition here in India. And the focus is clearly on replicating the electronics, the mobile story, for PLI with electronics components as well. Back to you.
Absolutely, Ashmit. Thank you so much for that electronic components PLI scheme on that front. Something exciting to watch out for. Moving on, the Finance Minister Nirmala Sitharaman chaired the 8th pre-budget consultation meeting with stakeholders and representatives from trade union as the union budget for 25-26 draws closer. The meeting that was held in New Delhi was also attended by the Finance Secretary Tuhin Kanta Pandey and Chief Economic Advisor V. Ananta Nageshwaran. On that note, we're going to slip into a very short break. But after the break, we'll talk about the 2 cases of HMPV virus, which has been detected in Karnataka. We'll tell you what the Health Ministry had to say on that front after the short break.
1,500 crores with operating margins of around 28%. Remember, in the hotel business, we have the second half, which is more margin accretive than the first half itself. If you look at the balance sheet and the opportunity as well for ITC hotel business, remember 52% of the business revenue comes in from rooms, 40% from F&B. There's a strong opportunity in the hotel business with zero debt, cash balance of 1,500 crores, and only 20% of their inventory is currently operating at 75% of potential occupancy. So that is telling you that there is room for operating leverage as well. They're also looking at value accretive M&A and alliances. The big question, how do you value this business, right? So for that, you have to look at projections. Given the recent history and the numbers that we have, FY25 could be close to 3,700 crores in revenues, FY26 4,400 crores with EBITDA of close to around 1,500 crores itself. And if you look at all the other listed hotel companies right now and their multiples, Indian Hotels is at 37 times, Chalet Hotels 25 times, the others between 17 and 18. My guess is ITC would settle between 25 and 37, closer to 26 and 28. And that means a market value of the ITC hotels business between 36,000 to 39,000 odd crores. But remember, this is the entire hotels business. 40% will be held by ITC, on which a holding company discount would be there. And the remaining 60% could be between 22 to 24,000 crores. What happens to the ITC hotel listing whenever that lists, the shares could be worth 175 to 190. But today, the important part is the ITC share could adjust by around 17 to 19 odd rupees as the business goes ex-hotel business.
An analysis of election affidavits carried out by two independent non-profits has revealed that Andhra Pradesh Chief Minister Chandrababu Naidu may well be India's
Welcome back to Business Lunch on CNBC TV18, and moving on to some national updates. The Indian Council on Medical Research has confirmed 2 cases of human metapneumovirus or HMPV in Karnataka. The cases were identified through routine surveillance. However, the Union Health Minister has affirmed that there has been no unusual surge in influenza-like illness or other respiratory illnesses. The Union Health Ministry is confirmed that they are keeping a close tab on the situation in China and that India is well equipped to handle any unusual rise in any respiratory illness. Karnataka Health Minister Dinesh Gundurao also reaffirmed there is no cause of panic as of now. Listen in.
I don't think we should be pressing the panic button because HMPV is not a new virus, it is an existing virus. And the statement, I mean the way report has come out that this is the first case of HMPV in India, which is not true because HMPV is an existing virus and certain percentage of people do get affected by this virus. And it is not something new. It's been there for a long time and it causes common symptoms like cold and for maybe flu and cough, and then it's a self-limiting virus, so it goes away after some time. And I don't think we should be calling it the first case. That is a wrong way of reporting it.
And as we wrap up this edition of Business Lunch on CNBC TV18, we leave you with some news from the 82nd Golden Globes Awards. Payal Kapadia, who earlier scripted history by securing a Best Director nomination for All We Imagine as Light, lost to Brady Corbett of The Brutalist. The film also failed to win under the Best Motion Picture Non-English Language category. The Brutalist won the Best Film Award, while Adrian Brod won the Best Actor for the film.
And by a whopping margin at that. Recent surveys conducted by 2 independent organizations, that's the Association for Democratic Reforms or ADR and the National Election Watch or NEW, has pegged Naidu's declared assets at around 931 crore rupees. That's just shy of nearly 3 times the second place name on that list, and that's Arunachal Pradesh Chief Minister Pema Khandu, whose assets come to around 332 crore rupees. In fact, both Naidu and Khandu top this list of India's richest chief ministers. In fact, both these organizations surveyed chief ministers belonging to 31 states whose total cumulative assets came to around 1,630 crore rupees. That's an average of 52.59 crore rupees per chief minister. But remember, this average number is largely buoyed by the large assets declared by both Naidu and Khandu. Incidentally, the South isn't too far off when it comes to the upper echelons of this list. Karnataka's Siddaramaiah has declared assets of 51 crore rupees and is 3rd place on this list. But remember, this number is still short of that average value of 52.59 crore rupees per chief minister. The quote-unquote poorest chief minister on this list is West Bengal's Mamata Banerjee with assets of just about 15 lakh rupees, while the 3rd poorest name on this list is again from the south, that's Kerala's Pinarayi Vijayan with assets of just about 1.18 crore rupees. However, the south continues to find dubious mention as far as this list is concerned. The most number of criminal cases lodged for a chief minister belongs to Telangana's Revanth Reddy with 89 criminal cases against his name. The second place name on that list is also from the south, that's Tamil Nadu's M.K. Stalin with 47 criminal cases against him. This, remember, is as per the studies conducted by both ADR and NEW. When it comes to liabilities, the South again isn't too far off as far as the upper levels of this list is concerned. While the total number of liabilities or the largest liabilities per Chief Minister belongs to Arunachal's Khandu at about 180 crore rupees, both Siddaramaiah and Chandrababu Naidu continue to figure on the top of this list. In fact, Siddaramaiah accounts for 23 crore rupees worth of liabilities, while Chandrababu Naidu's liabilities come in at about 10 crore rupees.
Countdown for the Mahakumbh.
Good afternoon. It's time for Midcap Radar, but it is the benchmark indices that are hogging all the limelight today. I am Hormuz Fatakia. With me is Vivek Iyer. Vivek, good afternoon. It's not that the Midcap Index is doing any better, but yes, it is the Nifty that is down below the 23,700 mark as we speak, and everything on your screen right now is in the red.
Good afternoon, Hormuz. Hormuz, I'm looking for specks of green across the screen, not able to find any. The entire market is seeing quite a bit of a sell-off. A few diagnostic companies, a few healthcare companies are holding out, but overall it's a very, very weak Monday as far as the bulls are concerned. Well, we'll start with the top headlines of the show. We have quite a few important conversations lined up during the course of this particular show itself. So it's a weak Monday for D Street, in line with most Asian markets. The market is selling across the board. Nifty falls 1%, while the mid-cap index slips close to 2%. PSU stocks, including public sector banks, lead the fall. Nifty Bank also down 1.5%.
The rupee falls to a new low amid the weakening of the Chinese yuan. The strength in the US dollar, higher US yields and rising crude oil prices continue to weigh on the currency.
Pizzas and beauty score over staples in Q3. Jubilant food revenue surges 53%, powered by an acquisition and strong growth in Domino's India. Nykaa guides for more than mid-20s growth in top line. Dabur, however, remains cautious on the general trade segment. Sales will grow in low single digits. Marico guides for mid-teens revenue growth, but remains cautious on margins.
Union Bank and Bank of Baroda have both leading the losses on the PSU Bank side after reporting their business updates for the third quarter. Union Bank has reported its lowest growth among all lenders, while Bank of Baroda has seen its business momentum soften.
JSW Energy shares fall after the company informed that the Central Electricity Regulatory Commission has not approved the proposed tariff for a battery energy storage project from Solar Energy Corporation of India.
All right, then, any form of recovery that had come in by 12:30 or 1 o'clock has been very swiftly sold into, be it the Sensex or be it the Nifty. 1,200 points now down on the Sensex. The Nifty too heading towards the lows of the day, back at that 23,600 mark. The Sensex is fighting to hold on to that 78,000 mark. But there are plenty of movers on the sectoral bit. The PSU banks are the ones that are leading the losses in today's trading session after the business updates. It's a plethora of business updates that you're reacting to on the PSU bank side. 4% down on the PSU bank index. Union Bank at the lowest point of the day now, 7.5% lower there. Bank of Baroda 2 at the lowest point of the day, almost 5.75% down on Bank of Baroda. UCO Bank is down 4%. So all 12 constituents on the PSU bank index are trading with losses. Metals are not doing any better. Neither is real estate, neither is energy, neither is the auto index. All of them are seeing losses of anywhere between 2 to 3%, Vivek.
Harmal, you spoke about the PSU banks. The Nifty private banks are not doing any better. In fact, names like HDFC Bank, names like Axis Bank, names like Kotak Mahindra Bank, where there's a bit of a negative news flow, and ICICI Bank, all these, remember, are heavyweights as far as the top indices are concerned, both the Nifty as well as the Nifty Bank. And on the back of that, you're seeing the entire PSU basket. Look at Kotak Mahindra Bank, down over 3.5%. Along with that, remember earlier today, Angel One came out with its quarterly update. And if you look at that, the stock at one point of time today was up 5%. But now the stock has seen quite a bit of a sell-off and now down almost 2.5%. So it's been a steep sell-off, especially for Angel One from the day's highest point. But we are now cutting across to Nitin Gadkari speaking at the Sadak Suraksha Abhiyan 2025. Let's listen in.
कुछ इंजीनियर है, डॉक्टर है, कुछ पढ़ने वाले लड़के हैं,
जो इसमें गए उस परिवार की क्या हालत होगी आप देखिए। और सबसे दुर्भाग्यपूर्ण बात है, जो यहाँ टीचर्स भी है और ये संदेश जिन प्राचार्य और मुख्याध्यापक तक जाएगा, स्कूल एंड इंस्टीट्यूशनल एरिया में, स्कूल के और कॉलेज के बाजू में 10,000 मौतें हुई है।
10,000 deaths only around schools.
यस, तो स्कूल में जाने के लिए, बाहर निकालने के लिए, रोड क्रॉसिंग के लिए उनके प्लानिंग में उनको सोचना पड़ेगा और फिर इन बच्चों की जान बच सकेगी। जो वैलिड ड्राइविंग लाइसेंस जिन्होंने लिया नहीं और स्कूटर और कार चलाने की कोशिश की, उनके कारण 35,000 मौतें हुई है। बच्चे अपने माता पिता को और अपने आसपास के लोगों को प्रभावित करते हैं और आजकल कानून भी बना है कि बच्चे ने एक्सीडेंट किया, अगर वो माइनर है तो माता पिता पर गुनाह रजिस्टर होता है। तो मुझे लगता है कि स्कूल में कोई गलत काम किया तो पनिशमेंट होती है। तो ये बच्चे अगर ये तय करेंगे कि नहीं, हम गलत नहीं करेंगे, हम कानून से चलेंगे, तो मुझे लगता है कि रूल्स फॉलो करने से बच्चों की भी जान बचेगी और अनेक लोगों की जान बचाने का श्रेय इनको मिलेगा। और इसलिए मैं इन बच्चों को विशेष रूप से अनुरोध करूंगा कि जो रोड सेफ्टी के लिए जो रूल्स बने हैं, छोटे छोटे रूल्स हैं कि मोबाइल पर बात नहीं करना, रेड सिग्नल होगा तो रुक जाना, स्कूटर चलाना है तो दोनों ने हेलमेट पहनना, गाड़ी में बैठेंगे तो सामने और पीछे में बेल्ट लगाना। अगर बेल्ट लगाए रहते तो मेरे मित्र थे डॉक्टर श्रीकांत जिचकार, उनका डेथ नहीं होता। बेल्ट लगा के होते तो साइरस मिस्त्री का डेथ नहीं होता। तो मुझे लगता है आपके परिवार में ऐसी कोई घटना न हो, इसलिए आप निर्धार करिए और थोड़ा सा इसका पालन करेंगे तो मुझे लगता है बहुत लोगों की जान बचेगी।
बहुत सही कहा आपने।
Well, some very important comments coming in from Nitin Gadkari over there. But Hormaz has just stepped across to the wall. This is our special segment, Mid-Cap Movers. Hormaz, the entire market is bleeding. Are you finding any green, the broader end of the market?
There are green, but I'll start off with the red first up because it's a 1,350 points shave off on the mid-cap index. The small caps not faring any better. There's the Lloyd's Metals, that was the mover of last week. That is seeing some recovery from the lows of the day, but still down 6% as of now, among the top losers within the broader markets, but the others are down to the lowest point of the day, be it GEM Financial, be it Gujarat Fluoro, or be it HEG, all of them trading with losses of anywhere between 6 to 7% as we speak. The PSU banks, we just highlighted that all of them are among the top. All 12 constituents on the PSU bank index are the top, are trading with losses today. Losses there 4% to 7.5%, all of them at the lowest point of the day as well. You know, a segment that we wanted to speak of in today's trading session are some of the other stocks that are impacted because of the business updates. And Nykaa is one. This discretionary versus staples round. It was this round belonged to the discretionary companies, be it Nykaa, be it Titan. But Dabur and Marico not having a good day at the office, trading in the red after some cautious commentary coming in the business updates. You spoke of green. Now comes the green on the screen with volume buzzers. But APL Apollo is one that is trading with losses of around 1%, but on very strong volumes. But look at the others. Aegis Logistics up 10% on very strong volumes in a market like this. And Devyani International, after the update that has come in from Jubilant Foods, is up 7.75%. And Dr. Lal too, along with Metropolis, trading with healthy gains in today's session on strong volumes. And lastly, some other stocks that are bucking the trend. There is no comparison. ITI is up another 13.5% today. Again, we need to repeat this again and again, that there is no float for the stock, free float in the market. Easy Trip, after the management clarification, was up 17% at one point, still holding on to gains of around 6%. And in line with Devyani International, Sapphire Foods is also trading with gains, as is PTC Industries. So there is some speck of green, but the screen predominantly is in the red.
Thank you so much, Hormaz, for that. You know, we'll discuss more about the diagnostic companies update a little later on the show. But let's now slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned.
Has begun. It is just a few days away. Devotees see this as a once-in-a-lifetime chance to bathe in the holy waters of what is called the Triveni Sangam, where the rivers Ganga, Yamuna and the Saraswati meet. The holy event starts from the 13th of January and will last till the 26th of February. About 450 million people from India and abroad are expected to flock to Prayagraj, which is the spiritual heart of India. This isn't just any regular event. The Mahakumbh only happens once every 144 years. It is the culmination of 12 Purna Kumbhs that happen every 12 years. The Ardha Kumbh happens every 6 years. The Purna Kumbh is organized in 4 holy places: Prayagraj, Haridwar, Ujjain and Nashik. As demand for travel is expected to go up, airlines are going all out to launch flights to Prayagraj from different destinations in the
Well, we have a very interesting conversation and an important conversation lined up. Gajendra Singh, member of PNGRB, joins us now. Thank you so much, sir, first of all, for joining us. First up, we want to start off this particular discussion or conversation with you, asking you about what are the key focus areas for PNGRB as far as 2025 is concerned. There's been a lot of news flow and we'll get to that, but could you elaborate or focus on what exactly are the key focus areas for PNGRB in 2025?
Particularly for PNGRB, we are focusing on the infrastructure, whether it is a oil and gas infrastructure, that how it can be strengthened. So first we are focusing towards to create a LPG grid. Currently, if you see all across country, there are 210 bottling plant, but currently the bottling plant connected is 54, which is 25%. So we are putting a new pipeline like Kandla to Gorakhpur. New pipeline is coming, which is connecting another 30. So that will take to the 84 bottling plant. But to cover all other bottling plants, so that road transport should be minimized and road accidents should be minimized. So we are saying the bulk carrier, primary transportation, particularly from refineries to the bottling plant, that should be through pipeline. So we have come out with a 9 LPG pipeline, almost 3,500 kilometers, which is going to create a grid among the LPG pipeline, like we are having a national gas grid. So any point of time, if any eventuality is there, so grid will be there. So this supply will get continuous uninterrupted supply and safe supply will be there. That is our first focus area. Secondly, we are focusing towards the ATF pipeline because we are seeing the international air traffic is now increasing. So earlier the pipeline, the airport, particularly domestic airport or the international airport, are connected through one pipeline or maybe through tankers are being supplied. But now we are putting 2 pipelines to each international airport. So we have worked out and we are coming out with 5 new pipelines, and we are focus is that we connect more and more airports so that we can have at any point of time safe supply. And those pipelines, what we are creating, that will be based on the open access basis. So there will be a competition among the suppliers, and there will be the safe and continuous supply will be there. Right. Third point is we are building we are going ahead with a process have started how to do the open access, particularly in the CGD. So there also we are seeing that there are the number of CGDs who are now have completed their exclusivity period. So now we are seeing how it can be open up so that the consumers will get the other alternate supplier to them. So there should not be any monopoly. Because once we authorized some particular GA, initially for the period of 7-8 years, we provide them, okay, you will only use the infrastructure. But at later stage, we have to open it. And now we are opening up so that the industrial and commercial customer, they will have the choices of supplier to their end. Same way, we are putting a product pipeline also. We are seeing that wherever it is possible, for every time laying a pipeline, new pipeline, one pipeline is there, another parallelly, another pipeline is there. We are entering into that also, the product pipeline, how we can create a network of those product pipeline so that criss-cross movement of the product should not be there. Because if the refinery is north, the product is going in south, and south the refinery, it is going in different direction, east, west, similar way. So we are creating that way. So, but the consensus is being built and the process will start. And the last point is the regas terminal, LNG regas terminal. There also we are seeing how we can register them so that whenever any LNG terminals comes, LNG regas terminal comes, so they should have the provision of timely evacuation of the gas. So by putting an infrastructure up to those regas terminals, we need to have that those entities are registered with the PNGRB so that we can take a infrastructure, whatever the need for evacuation of the gas pipe that can be constructed. So there are the number of other areas also there where we are working. So there are the number of things how we can strengthen oil and gas sector.
Mr. Singh, good afternoon. Thank you for joining in. But you spoke of the LNG regas terminals. That was the question I wanted to ask you. You know, you recently put out a note about saying that the company like Petronet LNG made a lot of profits on these LNG regasification tariffs. What is the reasoning that you want to bring these LNG terminals under the purview of the PNGRB? If you could explain the rationale behind such a statement.
Yeah, you're right. If you see that particularly the paper what you are referring, it was a case study and it was a research paper. We keep on doing in the PNGRB. There's a different group, they keep on putting this thing. So perhaps it was taken as a PNGRB order. It is not like an approved document by the PNGRB board. It is a study. So that we can, and even in that study, it is written that the objective is to start the discussions how it can be developed. Because number of LNG regas terminals are coming, and there is the requirement of the pipeline infrastructure to evacuate the volume from those places. So how it can be developed so that we can have the orderly development all across this regas terminal. As far as PLL, you have referred to that, we all are witnessing the good financial and physical performance of PLL in last many years. And the reason behind them, their fundamentals are very strong. Number one, they are the strategic location. Their terminal is at very strategic location. Secondly, they have the first mover advantage. Thirdly, they have the upstream and downstream. They have the they have the agreement in place. It's not that they are working on like polling mode. So they have the firm contract with them. They have the strong promoters in their board. And their board is very strong. So the way they are working and the way they are expanding, that's good. But only there are the few areas where they need to rethink. Like what we are seeing that their boil off, the boil off they charge is 0.66. Whereas the international practice, if you see, it is not to that. It's a very huge volume. Secondly, if you see the escalation every year, 5 years, which we see that there are something, they can look into that and they can rethink it. It is their, what we call that, their decision. But what we are seeing, registration of these entities are needed so that the required development pipeline infrastructure can be placed. And particularly in PLL case, if you see, currently, if you see their regas charges, it is around 76 cents. But worldwide, globally, if you see, the utilization of the regas terminal is normally 50 to 55%. And the charges are also within 45 to 50 rupees, 45 to 50 cents. So this paper is only giving the points that, okay, there are somewhere globally something is there, here this is there, how we can ultimately, this is one of the component which is adding to the consumer cost. So how we can think of that, how it can be minimized. Perhaps they may be dealing because the current agreement, what they are in place, it is right up to 2028.
Right. Mr. Singh, I just have to interrupt you. You also have another important question. You've explained to us, what is it exactly that the PNGRB thinks as far as Petronet LNG and the regas tariff are concerned. But we also want to ask you on a more pressing need, especially as far as the entire city gas distribution space is concerned. There has been a bit of a policy U-turn as far as APM gas allocation is concerned. It's been cut significantly. In the last week, there has been some diversion as far as some gas from GAIL is concerned. Number one, could you give us what exactly are you thinking of city gas distributions are concerned? Will you look at going ahead and revoking some of the sharp or steep cuts as far as the APM gas is concerned? And number two, you also mentioned about open access policy coming soon for the CGD space. If you could talk on that as well.
Like if you see the CGD sector particularly, everybody knows that the APM gas, what is being produced, it is from the Mumbai High. Earlier occasion also I did mention that. And this, particularly this field, Mumbai High, is producing since 1986-87 onward. And this is now in a decline phase. This APM gas and CGD, if you see the CGD business is now growing all across country. Now we have 307 GA. Earlier it was limited to only to the 34 GAs. Now it has gone to 307 GAs. Now we see that now it is expanding, and the volume, as far as APM volume is there, that is declining. So now everybody knows this thing. It's not that something U-turn is there. Whatever the volume is there, available APM volume, which is coming from the Mumbai High, in the name of APM, it is being given to the CGD entity as a priority sector. I don't think government has made any change into that thing, that it should not go to the CGD. It is going to the volume, but the volume requirement is now increasing. Currently, they are consuming almost 42 mmCMD of gas per day. And this, if you see the APM volume, it is only now amounting to 13 mmCMD. In 13 mmCMD, and rest of the thing is, it is now RLNG. So it is RLNG is already going into that. So I don't see any U-turn from the government side or from any negative thing from the regulator side. We are all for that. Only thing what we are saying in open access also is, we are not saying we are doing immediately, because when we authorize the GA for the infrastructure, to create infrastructure and making that infrastructure for self-use for 8 years. Subsequently, they have to open it, and that too is limited to only 20% of their total capacity, pipeline capacity. So we are saying that industrial and commercial customers who are there in that particular GA, they will have the other options. They should have, the consumers should have the choice. It should not have that, particularly in RLNG, you are selling it at one particular price. Okay, I will take this much of price. But if they have the other option, cheaper option, why the consumer should not have opt that? So it is in the best interest of the industry, not for any U-turn on anything.
Thank you so much, sir. Thank you so much for joining us and giving us clarity and the way ahead as far as PNGRB's policies for the oil and gas sector is concerned. Thank you once again. Now it's time for the Growth Code, an initiative by Crow and CNBC-TV18 designed to provide you with valuable trading strategies. This week, CNBC-TV18's Nigel D'Souza sat with Rohit Srivastava, founder and market strategist, IndiaCharts.com, to understand what pump and dump schemes are and how traders can avoid these.
Let's talk about this, that's come to light in the last few years, which is the pump and dump schemes, not just in India, but globally as well. So could you tell us, how do scamsters, orchestrate artificial price hikes on very, very low liquidity issues?
Yeah, so one of the ways to do that is spread the word, so which is why so many groups get created, investment groups around certain themes, and then people are instigated into buying those stocks and driving them up, right? So a lot of people end up participating in these small stocks thinking that, yeah, this 5 rupee stock could suddenly become 20 in a short period of time. Let us buy a good amount of quantity. And when you get a large number of investors to do that through multiple groups, then the stock price shoots up, and the investors who really bought in early get out and leave everybody else holding. So that is how these schemes operate. In the old days, you also had something like, circular trading, a lot of which has been pulled together by SEBI, but even now in different ways. If you use a lot of, individual accounts at different locations, you can even do circular trading to push up the prices and make it look like the price is moving up very fast and everybody starts participating. So these are things to be very aware of.
Airport Authority says there are 20 new flight connections exclusively for Prayagraj for the Mahakumbh. Indigo has launched flights from Ahmedabad, Kolkata and Bengaluru, while SpiceJet is connecting Delhi, Mumbai, Bengaluru and Ahmedabad. Limited flights means devotees will have to pay more for airfares. For instance, a one-way ticket from Mumbai to Prayagraj on the 12th of January is nearly 30,000 rupees. Then Bengaluru to Prayagraj on the 11th of January will cost over 22,000 rupees. The Prayagraj airport is also stepping up its game. The existing terminal is being revamped and a new terminal is being developed to together handle about 2,700 passengers at peak hours. Staying in hotels will also be an expensive affair, with room rates per night soaring to as high as 40,000 rupees. The state is spending a whopping 5,496 crores for this event, a lot more than what it spent in 2019. The government has allocated 4,000 hectares of land for the Mahakumbh 2025, which is double than over 1,900 hectares of land allocated in the Purna Kumbh of 2013. Over 1,50,000 tents and 25,000 accommodations are being set up for the sea of visitors from India and abroad. And for the first
Welcome back to Midcap Radar. We need to take a look at the markets now. Look at the Nifty, it's down 1.6%. The mid and small cap, the small cap index is now down 3%, as you can see at the top of your screen. The mid cap index now down 2.6%. So it's the broader end of the markets that are seeing deep pain. The advanced decline ratio, as you can imagine, is very much skewed in favor of the decline. So it's an all-round selling pressure that we are seeing. The only pocket that's managing to see some green is the healthcare and diagnostic space. But overall, it's a very weak market, with the PSU stocks bearing the brunt of the selling pressure. With that, it's all the time we have on this edition of Midcap Radar. Closing bell when we return.
entire tent city will be mapped on Google Maps, making it very easy for tourists and devotees to navigate in the Mahakumbh Mela. The Mahakumbh is a big deal for the hospitality and other commercial sectors. The state is expecting a revenue of 25,000 crores, bringing a wave of opportunity to the region.
Well, it's been yet another record-breaking night for quick commerce platforms as India's consumers took to their phones to order in their New Year party needs. Now, apart from the usual party essentials, many interesting items like grapes, condoms, ENO, milk packets, and even men's underwear were ordered for in huge quantities across apps. But let's look at Blinkit first. Blinkit saw its highest ever orders and also its most orders per minute and per hour. And in terms of trends, last night saw the most number of chips and most grapes sold in a day. The biggest order Blinkit received was for 64,988 rupees from Kolkata. Now, Instamart too saw its highest ever orders, which was the double of last year. And what did consumers look for the most? Milk, chips, chocolates, grapes and paneer. And the biggest order came from a user in Goa for 70,325 rupees. Now, on Big Basket, orders for things like games, soft drinks, mixers were all up anywhere between 200% to 1,290%. Now, after 2024 turned out to be a year of the quick commerce boom, Zepto CEO Adit Palicha rang in the new year with 3 predictions for 2025. Now, he says that 2025 will be the year where quick commerce will start hitting scale comparable with e-commerce. Now, we've already seen the lines blurring between the two in 2024. Now, his second prediction is that this year, the quick commerce model will really be put to test. Succeeding in this scale will require exceptional execution, he says, which will be a challenge for every single player to be able to deliver. Thirdly, he says that the fundamentals of quick commerce will evolve dramatically and the unit economics to build operating leverage will also change. And finally, as Zepto also gears up for an IPO this year, Palicha says that the capital markets environment from private to public will also be different compared to 2024 and 2023. So from a year of its boom to its true test of scale, it will be really interesting to see how quick commerce evolves in 2025.
Sharpest strategies, top market trends, unmatched perspectives, the trading day's most comprehensive roundup. Stay ahead with NSE Closing Bell, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good afternoon and welcome to Closing Bell. We're starting a little early because it's been that kind of a market. Relentless selling. It started from the morning. It hasn't stopped now. And it's selling that's encompassing all parts of the market. The only sort of saving grace is that we're not alone. A lot of the Asian markets have fallen. But I think what's happening here right now is pretty severe, to say the least. I'm Surabhi Upadhyay. With me on the show, as always, Rima Tendulkar and Nigel D'Souza. Hi, guys. What an afternoon.
What an afternoon, but Europe is not falling. The CAC and the DAX are actually up close to about 0.5%. The FTSE is flat, but with a negative buy. So it's, at least as of now, we're pretty much falling alone. Asian markets have shut.
Well, that's right. You know, if you look at the trend from morning itself, India has been underperforming its Asian peers, and the futures, the European as well as the US futures, both of them are indicating a positive opening. So there was some kind of talk with regard to that virus. However, the ministers come out and said there's no real reason to worry. So it appears the quarterly updates that have come in, particularly from the banking names, that's what's weighing on the markets. You know, and that's clearly evident from the PSU banking index, which is getting smacked back in today's trading session. The breadth of the market is the most disappointing part of it, because you have 10 stocks that are declining for every one stock that's advancing. The breadth of the market is indicating the kind of selling pressure that we're seeing, and those lines have just been drifting apart from the word go. And hospital and diagnostic stocks are gaining. In case there is some kind of panic on the health front, that's what it's indicating. So that's why you have some of these stocks that are doing well. And, you know, the important part is we've broken the 200 EMA, and now we're trading substantially below that as well, you know, particularly for the Nifty Bank. So that's going to be the important point. The 200 EMA was the important support when the markets were breaking down. Now, in fact, it'll become a bit of a resistance on the way up. The bulls will be hoping for some kind of a pullback towards, the end of trade. But as things stand, it's firmly in favor of the bears as we speak. 90 minutes to go. It appears the FI action as well has returned. So I think we could be bracing for a rather larger sell number as well.
Absolutely. I was just coming to that point. You hit the nail on the head, Nigel, because maybe at the margin, this virus fear became another excuse to sell. At least not that foreigners needed any excuse to sell India. They've been doing that relentlessly for the past many weeks. Even in fact, if you look at the last 5 days, the numbers are on the screen. On Friday itself, the net sell figure from the FPIs was in excess of 4,000 crores, 4,300 almost. So let's see what today's number is going to be like. And it's very clear that whatever domestic support is coming in from domestic institutions, mutual funds, it's not enough to offset the declines. I just want to highlight that PSUs in general were leading the fall. PSU banks and other CPSE stocks as well. But it's now spread far and wide. The bank Nifty is weak. A lot of consumer stocks are reacting quite negatively to the updates that have come through. There's no support. Even IT is not able to offer any kind of support. And to complete the point that Nigel was making, healthcare and diagnostics, it's a sentiment trade that's playing out right now. So you look at stocks like ThyroCare, look at Dr. Lal's, Metropolis, or even look at hospital stocks like Rainbow Medicare or even Apollo Hospitals, among the larger ones. That is where the immediate trade, immediate sentiment is, at least on an intraday basis today, Rima.
The small cap index, by the way, is down more than 3%. The mid cap index is down close to about 2.5%. And of course, the advanced decline ratio, right? 1:10. Even the other sectors like metals, realty, auto, across the board, these are cuts of about 1.5% to 2% coming in for the key indices. Tech is the only index, and that is flat. There is no sectoral index, which is currently in the green right now. But let's find out how you can position your...
We'll do that in just a bit.
Let's talk about the
But the other issue is the currency. And, we've been flagging off the weakness, making multiple sort of lows last week. And today, the level is now gone above 85.80. So we have Lata joining in to put this in context. And then we'll get to, of course, the stock trades in just a second. But Lata, you tell us, it's been a bit of a free fall for the currency. What have you been picking up from your sources in the market?
Well, it wasn't such a free fall last week. We did see the Reserve Bank come in at several points, and the expectation in the market was 85.80 will be held for now, because at several points, as the rupee was approaching 85, 79, 78, you could see the supply of dollars. At least that was the story last week. A few things have happened since Friday. One big thing that turned the domestic sentiment is that number which we've all been talking about, 4,227 crore of selling. There was that one day of positivity when the year began, and there was a feeling that fresh allocations are coming. All those were wiped clean, and how, when you saw that, 4,200 crore selling bang on the first proper working day. for the markets, when probably the trading was a little fuller in terms of volume. But a bigger turn came in the currency markets in the yuan. It was for about 2 weeks, the PBOC appeared to be defending 7.2829 on the yuan. And on Friday, we suddenly saw that 7.3 and then onward, 7.31 come in. So it was to be expected that on Monday, the rupee will have reverses, that 85.80 that was being held will give way. Or the offshore yuan, the one traded in what you call the CNH, that had already gone past 7.33 and started trading at 7.3536 on Friday itself. So those reactions were all expected to come in the Indian markets as well on Monday. That 4227 crore number just turned the tide. And, once you see the force of all these currencies, the Reserve Bank normally lets go. And that's what it appears to have done today. The Chinese yuan also is, the expectation in the market is that it can go even up to 7.4 towards the Trump swearing in. The sentiment is pretty negative over there. And as you can see, all the global factors, the ecosystem itself was against Indian currency as well as EM currencies. Strong dollar index, it was almost 109. US yields at 4.62, the 10-year yield. And then, of course, the crude prices also just unusually going above 75. We have gotten used to 70 to 75 for the better part of last several weeks. So all that combined, but my sense is I bring good tidings for the last 1 hour. The dollar index now has moved towards the 108.7 mark. It's now a distance from 109. So that might create some kind of stability in the currency market. It is never one-to-one currency and equities. But my point is that perhaps the worst of the selling for the moment is over and people will want to see what is the new equilibrium in the currencies. Like I told you, there is a feeling that the yuan has more fall to happen.
Okay, all right. Lata, stay on. In fact, maybe you'd want to take some questions to our next guest as well. We have Mitul Kotecha of Barclays joining us on the phone line for a quick view on what's happening here. Mitul, thanks so much for taking the call. And, we're all watching both Indian equities and the Indian rupee weaken. And maybe to an extent, like Lata also explained, the fortunes of one are tied to the other. What is it that you're hearing on the currency? And I don't know, I'm not trying to, drive up any conspiracy theories, but is this a little bit of maybe an orderly depreciation that right now India seems to be okay with, given what's happening across our border with the Chinese yuan also weakening in the last couple of weeks?
Yes, it's a great question and something that we have been highlighting for some time, that India is going to be very sensitive in terms of RBI to movements in the yuan, given the widening trade deficit with China, the increased focus on manufacturing and competitiveness with China, and the need for some investment potentially from China to help build or push India's manufacturing base to a stronger level. And I think the fact that, as you were talking about earlier, the fact that dollar yuan has broken through 730 may not have gone unnoticed from the RBI. And I think there's another factor here as well. We do have a new central bank governor, and we yet have got to hear about what his policies are on the rupee, but we knew that Governor Das was quite interventionist in his policies, to say the least, and capping volatility. And we may be seeing a sea change in that, although, again, we've had no confirmation of this. But the fact that we've seen a bit more of an orderly decline in the rupee, which, to be fair, is matching some of the moves in other Asian currencies. So it's not that the rupee is depreciating much more rapidly. But at least for now, it's at least a sense of trying to maintain some level of competitiveness. So, as long as the dollar remains strong, as long as other Asian currencies, particularly the yuan, weakens, it does suggest more upside for dollar INR.
Okay. No, it's not so much a sea change in policy that the governor will bring, as much as a sea change in the ecosystem in which he has to operate. New realities and Trump swearing in. But Mitul, the Indian market, the chatter is pretty loud that the yuan may go all the way to 7.45 even before Jan 20th. Do you all have that kind of view?
That's, again, the pace of the move more recently has suggested that there's more weakness in prospect. But our view is that we think that China will wait to see what the shape and magnitude of tariffs that President Trump will enact upon China. And it's unlikely that we're going to see a massive depreciation ahead of some clarification on this stance. And, we just look back at 2018, it took around 4 rounds of tariffs before we saw a significant sharp depreciation of the yuan. I mean, it was weakening, but not to the extent as you would have expected. And I think the point being is that, China may keep its powder dry. We may see the extent of tariffs, and then we may see a deeper weakening of the currency. Our forecast is 750 by year end. So, we still think there's a bit more of a gradual move. That said, and the big caveat here is that if we see Trump enact 60% tariffs on China, we would not rule out potentially a move to around 840 or above in dollar CNY. So a lot depends on the magnitude of tariffs that will be implemented.
Okay, so then your base case is that the yuan remains around the current levels, okay, 7.3 to 7.35 up until Jan 20th, and then take it as it comes. If that's the view, what's the view on the rupee? Is it very, very incremental? Is most of the depreciation over for now? What are the Jan end levels, March end levels?
Yeah, look, I think it's unlikely that the rupee suddenly drops very sharply from here. I think the dollar, already there are signs technically that the dollar has lost a little bit of momentum into this week. I think there is going to be a wait and see ahead of the inauguration. This week is some key numbers in the U.S., and you have the Fed FOMC minutes, and you have the U.S. jobs data, and I think that will also drive direction. So it's hard to see this move accelerating from here. But again, look, we've already passed our key levels of forecast. We were forecasting 87 on dollar INR by end of this year. We've already moved very rapidly towards 86. So moves are quick here in this environment.
So Mithul, are you likely to then, revise that, forecast in any way, or will you also wait for the 20th of January? Now, I don't know if we'll have all the answers by the 20th of January. That's only the beginning of the policy announcements. I mean, the actual tariff policies, the shape and form they take, that'll probably take some more time to become clear. So in the interim,
Trump promised some 10 orders or some
on day one,
number of orders on day
25
one.
executive orders,
25 orders on day one.
Yeah.
So we don't know if he delivers that, but I mean, since you said you were looking at 87 by the end of the year, now we're already close to 86. What's your latest forecast?
No, look, our forecast hasn't changed, but clearly we are monitoring events. And you're absolutely right. Look, we may not see... Look, firstly, Trump has already sounded fairly aggressive, right? It may mean on day one we may see some very aggressive announcements. Doesn't mean we'll see those implemented. And, there's some gamesmanship here. But the reality is that we're probably going to see something fairly aggressive in the initial announcements from Trump. And I think that may also have an impact on the market. Another question is how much is in the price. So we will wait to see actual implementation as well. So you are totally right. We may not see, the extent, or it may take some time for tariffs to be implemented, and then we'll see a bigger impact. So, for now, we're keeping our forecast as is, and we'll monitor events as is most people to see where things are. And obviously, a lot of this is unpredictable at this stage, but we are trying to assess what happens in a couple of weeks' time, at least the initial focus on the inauguration.
Okay. Any numbers on the dollar index itself? Is there a chance that it is, by the rumor, sell the news, that actually after Jan 20th, the dollar peaks off? In any case, your levels?
We haven't got any forecast levels here. I think we've already seen if we really look at the chart here, since the end of September, we've seen dollar index move from around 100 to almost 109, a very, very rapid move. We are still very constructive on the dollar, so we don't see, even if we see a pullback here, it looks like it may be temporary. So our view remains fairly constructive on the dollar. But like I said, I think, we will wait to see what happens in a couple of weeks' time. We'll wait to look at we're all very much data watching. We'll see whether the payrolls shows any sharp moderation. We'll see a lot of Fed comments this week, including the FOMC minutes. So we're going to gauge a lot of this for further direction. But at the moment, there's very little to suggest any sharp turnaround in this sort of constructive dollar view, bullish dollar view that we have.
Just a final number, if you can, on the US 10-year yield. 4.62 is also a peak.
Look, I think in terms of 10-year yield, what we've tended to see is we've already moved fairly sharply higher. Our US rate strategists would seem to be suggesting a lot is in the price in terms of yield. We will also wait to see the extent of fiscal expansion coming through, and it does look like, even with a red sweep, that President Trump may not be able to get through all of what he wishes for in terms of fiscal easing, and that may at least temper some of the sell-off in US rates and US yields. So for now, we've already moved a long way. We would argue a lot is in the price in terms of the US Treasury market.
Okay, Mitul, thank you very much indeed for joining us and giving us that perspective, which I think is important, that a lot is already in the price. I mean, it's 7.5 and for the yuan and 87 for the rupee for the year end. So at least in the near term, it looks like the move, a large part of the moves are over.
And this week, the key data points to watch from the US. On Wednesday, you've got the ADP data. On Thursday, the FOMC minutes for the December meeting, plus the JOLTS data. And then on Friday, the all-important non-farm payroll data and the unemployment. And that will test the strength of the US economy, the dollar index, and where yields head. Thank you, Lata and Mitul, for joining in. We will slip into a very short break with the news. Still down 400 points in the Nifty. Sanjay Parekh from Soham Asset Managers will join in on the other side.
...2024 has now become the 9th consecutive year of positive returns for the Indian equities, and that's the record. In fact, 24 was a year of record in many ways. The highest fundraise in a single year, the ever-growing domestic pool, and so on. But the big question is, what is in store for 2025? Will the rally sustain? Will the mid and small cap continue to outperform? These are the questions in the minds of the investors. So now, crystal gazing is always a challenge, but CNBC-TV18 has reached out to the biggest market experts to bring to you an Outlook 2025, the biggest market poll for the new year. In fact, it was a poll across 61 participants, including fund managers, HNIs, as well as institutional dealers. So let's begin with the first and the most important question. What kind of return should investors expect in 2025? Majority of the respondents expect a single to mid double-digit return in 25. Only 11% of the respondents expect a negative return on the Nifty next year. In that case, will the broader markets continue to outperform in 25? Surprisingly, 50% of the respondents believe that 25 will be a year of large caps. Only a small percentage are still betting on micro cap and small cap stocks, which brings to the next big question, and that is the biggest theme to bet on in 2025. Here there is a surprise. First surprise, financial has emerged as the biggest theme to bet on for the next year, and that is despite the macro challenges that the sector is facing and the fact that they have been an underperformer. The other surprise was the stellar outperformer of 24, which was capital goods. That's been considered as the least preferred bet going into 2025. We spoke about the returns and the big themes. Now, what's going to drive all these returns? And the near consensus answer is earnings, earnings, and earnings. That's going to be a dominant factor.
Welcome back. Well, a mild pullback is what we are seeing from the day's low. A few stocks are seeing some kind of a bounce back. You have Tata Consumer that's holding strong in an otherwise wobbly market. Kotak Mahindra Bank actually has cut its losses a wee bit. SBI Life as well has cut its losses a little bit. So I think some of those stocks are bouncing a wee bit from the day's low. The good news, at least as of now, if you're looking for some good news, is 23,600 has been defended as of now, at least. Let's see whether or not we can see a further up move in the last 60 minutes or so. Sanjay Parekh, though, joins us on the show to help us out, founder and CIO of Soham Asset Managers. Hi, Sanjay. Good afternoon. Good to see you, Ben. Happy New Year. It's not too happy start to the week, though. But what are you making of this fall? I think it's an India-specific problem, right? If it was any kind of fears with regard to the virus or if it was a global issue, then we'll have other markets as well lower. But for the time being, it appears that India is under pressure. So what are you making of this fall? And more importantly, you're sitting on some cash, deploying or waiting by?
Yeah, good afternoon, Nigel. So, I just earlier you all covered on the currency piece and, if Trump were to be aggressive, how would the yuan behave? And that would have ramification again on rupee dollar. So that is certainly playing out. Of course, we don't know about this new virus, I don't think so. But there may be a little bit of jitters, But leaving that aside, we clearly have to watch what happens on 20th, what happens to yuan, dollar index. They do matter to our emerging markets and for us. RBI has been defending rupee, but there is a limit to which it can do. It's been pretty aggressive defending rupee at a level. So, and it does matter if the outlook on rupee is towards depreciation, for new flows or even for them FIIs to sell off. So this could be an interim measure. I think besides this, coming to domestic piece, our results also are not in our favor. If our Q3 numbers were better, it certainly could have been a positive scenario to counter such global issues. But a Q3, as we see top down, and initially we're going to see previews started coming in. But if, right from banking, which used to do well, would have a 10.9% credit growth, and there's a deposit cost pressure, a little inch up on credit cost. So certainly numbers are not going to look great, whatever initial previews that we've seen. And so will be for cement, where there will be a minor increase in EBITDA per ton, but still that full pricing power that we need to justify the valuation is not there. Then comes auto. Auto also, you've seen volumes. Maruti, we saw 1 month being good, but overall auto is still weak. CV is weak. Capital goods, surprisingly, still we're not seeing spend coming from the center. And the state, certainly because of those populist measures, have diverted some amount of funds towards those schemes and not in capex.
Right. So Sanjay, just to go by what you're saying itself, we are in uncertainty with regard to President Trump. There is some kind of nervousness, which shouldn't be a big event with regard to that virus out there. And also the earnings season will be a little bit disappointing. So given these headwinds, what will you do? What is the current level of cash you're sitting on? And will you wait by since there are uncertainties in the future, or are you gradually deploying? If yes, in what sectors?
Yeah, so we are at 7% cash, and clearly cash is coming in because we had some commitments which we had asked to gradually get us those funds, and as we are getting it, our cash levels may marginally go up. So what we're doing is, I'll tell you the Nifty view, our earnings view for 25-26 is like we would be more like 1,200 rupees. It's too early for 26-27, but broadly, if we were to end 1350, then I don't think we should be valued more than 20 times. So for 25-26 at 1,200 at 20 times is 24,000. But as we look at 26-27, certainly there's upside. So what we think is more like 10-11% annualized returns are possible. We very strongly feel that the price correction from another 0.5% or 1% looks difficult. You can never say never, given this global uncertainty. But the time correction will happen. So that is where our strategy is: keep a margin of safety. You'll get your levels. You have enough opportunities now in Nifty as well. And in mid and small cap, have a much higher margin of safety, because there the fall could be much sharper. And that's where we'll gradually deploy, our equity, because we're not so bearish on the larger caps, on the price front.
Sanjay, are you disappointed by the banking updates that we've got so far, either on banking, NBFCs, PSUs? What has disappointed you, if at all?
Yeah, so Nima, one is before the result preview, also the credit growth was showing up in terms of 10.7% growth. That is clearly, rightly, RBI being conservative, that please keep your credit growth in sync with deposit growth. And deposit growth, we know pressures because of several reasons that we know. So that was the first piece. And hence we've seen even the larger banks calibrating the growth. X of HDFC Bank. HDFC Bank, we always knew that it is a phase which will have to pass through, and they've been very vocal about the slowing of advances growth. So that is a transition phase which will continue for a while till they reach a CD ratio maybe around 90, which is it's going to take some more time, maybe 3-4 quarters. So that was known. But even other larger banks, we are able to see that growth has been going to be calibrated. A little bit of deposit cost pressure, not so much on NIMs, but credit cost could marginally go up where the credit cards or microfinance piece is higher. So that's where we are. On the positive side is again, the valuations where I think is all known. We'll see more previews. So as we see that it's all expected, we have to see whether it's in the price, and that's where we believe that some of the companies, like if you see Axis Bank, at the peak you saw at 1370.80, now it's 1060. So all of them, the larger banks, I think, could have some more fall, and then they'll throw up real opportunity. And we are holding all of them. All the larger banks, we are there. So we are positive because of the valuation.
Okay, all right. Sanjay, just hang on. We'll try and get in Abhishek because he's been going through a lot of the updates that came in over the weekend. I think he told us 23 at last count. Those are the number of, Q3 updates that came in over Friday, Saturday, and Sunday. And a lot of the stocks have been reacting today. In fact, to talk about one such name, PSUs in general, PSU banks are leading today's financial decline. But one of them that has been the hardest hit is actually Union Bank of India. It's how much is it down by? Yeah, it's still down about 7 or 8%. So it's been quite a telling story for Union Bank today. Even BOB is down. For Union Bank in particular, deposit mobilization has almost stalled. If you look at it, if you're looking at it quarter on quarter, then the deposit base has actually declined by 2%. So that seems to be a bit of an issue. Then you have larger banking names as well. HDFC Bank, for instance, for them the growth in advances, that's been fairly weak at around 3% or so. And for HDFC Bank, yes, they're mobilizing deposits. Deposit growth is 15-16%. But then what kind of deposits? Term deposits, for which the bank has to pay a lot more interest. So those are some of the, I think, the issues that the market is grappling with today. In fact, we have the man with us now. Abhishek has joined in. So let's ask him. Abhishek, lot many updates have come in. So focus on some of the key highlights that stood out for you.
Well, 21 business updates did come in from the close of market on Friday evening to Saturday night. So PSU banks, they are weak in trade today after the Q3 FY25 business update. It's largely due to the loss of market share in deposits. Take a look. Union Bank of India, the growth of deposit is just 3.8% on a YOY basis and a decline of 2% sequentially. For Union Bank of India, they have been losing market share in business momentum for a long time right now. I don't remember seeing them gain market share even for 2 or 3 quarters in a row. Indian Bank 7.3% growth plus 1.3% sequential growth in deposits. Bank of Baroda, the growth rate has actually slowed down in deposits. So this time it's at 2.1% quarter. Last time it was 4.3% sequentially. Even the loan growth has turned out to be weak on account of the fact that deposit momentum is weak. So loan growth for Union Bank of India is less than 6% YOY and about 2.2% sequentially, while Indian Bank, it's close to 10% and 1.45% sequentially. For Bank of Baroda, again, the fall has been seen with respect to loan growth. It is at 2.5% quarter-on-quarter this time around. Last time in Q2, the loan growth was around 6.6 to 6.7% quarter-on-quarter. Now, some of the lenders that are weak in trade post Q3 FY25 business update, if you see soft or weak quarter update coming in from them, IndusInd Bank, their deposit growth is at just 11% YOY, perhaps one of the weakest in the last 16 quarters, and it's down 0.75% sequentially. Perhaps the first time you are seeing decline in the deposit momentum on a sequential basis in last 19 quarters. Suryodaya Small Finance Bank, over there, the gross NPA ratio has inched up to 5.5% from 2.9% in the previous quarter. Bandhan Bank, they have also lost out on deposits. Deposits have declined by 1% on a sequential basis for them. L&T Finance, their rural business momentum has turned out to be weak. If you take a look at the rural, disbursals over there, it's declined more than 16% YOY and more than 15% sequentially. Back to you.
Okay, all right, Abhishek, thank you very much for that. Those are some of the key updates that came in over the weekend. Sanjay, so, a broader question then, what else? Till there's clarity on what's happening with the market, till this FPI selling stops, the rupee stabilizes, there's too many bigger issues right at hand. The question is, right now, you are getting more favorable prices across the board, pretty much. So what would you buy? Which are the relatively safer areas that you're looking at?
I think, first, Abhishek covered it really well. But our strategy, I think, you rightly said that we'll not get great prices and great news. In fact, we always, in my earlier avatar also, when FIs were sellers, that was the best time you could buy these HDFCs of the world. Then HDFC was listed. And it was a classic trade to contra to their selling. And it works because MSCI, HDFC then was the largest weight. So here again, I think, our structural advantages remain. We cannot forget that all our balance sheets are strong. And by and large, barring some balance of payment issue that we may have, and still I think we are in control, overall we are in all in good shape. So with that, some of the businesses, be it financials, in the larger banks that we like, both in the private and the PSU space, and even in capital goods, if we get the right levels, we would be participating. And now, as I said, you will now get a lot of choice in Nifty. Of course, we're not there in FMCG. Pharma, we have mild overweight. We will look at a stock at a price. And then certainly, broadly domestic, be it logistics, at a price, each of them would look better. But I don't think government will, ad infinity, stop spending. So once you see them spending and you saw the projects being announced, so each of them, the potential to consume cement. So we are very, very confident that you'll see that spend start coming through from Jan till all throughout. And even the budget could be pro-capex, very, very likely. And that's where, because of this global uncertainty, if we are getting the prices right, it's better to do a bottom of stock picking, but slowly and gradually, what I think, over the next 3 to 4 months, because you get time to buy, you don't have to rush up.
Okay, all right. Since you mentioned cement a few times, Sanjay, I just keeping an eye out on Nuvoco. Today, the stock is more or less steady, while all the other cement stocks are actually lower. I think the street is sniffing that maybe there could be some kind of inorganic growth. That is, Nuvoco goes after one of the smaller assets. Let's see whether or not, it's in the offing. But the stock is actually outperforming the rest of the space. So we'll wait by to see how exactly there is some M&A action that involves Nuvoco. Keep an eye out on that. Well, Sanjay, final question. You have been quite bullish on select metals like Vedanta. That's not yet played out. You're still holding on to that position. There could be a lot of value that could get recognized. But for the time being, the markets are in a tizzy.
Yeah, I think globally you've seen LME, all the metal prices coming down. That's to do with Chinese uncertainty led by what Trump could do. So I think it's a transition phase. We at least feel there's a lot of value in Vedanta. As earlier discussed, there's already 43 rupees dividend in the kitty. And during such price falls, the dividend really help. You don't realize, but that 43 rupees, and if your entry price is better, is actually a fantastic outperformance. And that's where we believe, and you've been buying Vedanta, as earlier said, from 318 till even at current price. So we are pretty confident and positive as the demerger happens. There will be a focused, all the focused companies, and there will be a value discovery which will be much better than the current price. The SOTP of each of them will be significantly larger, we believe. And also the global deleveraging is helping them, and they are on that path to further get to $3 billion. So that will again help from today at, I think, little less than 4.5 times EV/EBITDA. It can go to 6.5 times EV/EBITDA.
Got it. All right, Sanjay. Thanks a lot for joining in, giving us that view. So select stocks would be a good opportunity to get in. Appreciate you joining in. We'll keep chatting with you as the course of the year does progress. By the way, keep an eye out on the Nifty. That little bit of a pullback that we saw, that got sold into. Now the market's again making fresh lows of the day. Tata Motors, that did very, very well on Friday. It's unwinding some of those long positioning. Grasim is under pressure. Crude oil prices have spiked up. So you have OMCs under pressure, Brent as well as HPCL. Riva, you want to name a couple of stocks as well, I think.
No, I just wanted to quickly highlight some of these IT stocks. So the Nifty IT index is relatively outperforming, but there are two of them which are managing to hold up in the green. One of them is LTI Mindtree, because Jefferies has upgraded it to a buy, target price at 66.50. They're saying it was one of the worst performing stocks of last year. The stock had fallen 10%. There were EPS downgrades. The stock went through a PED rating. But now, after this correction, the valuation is attractive. It's at 30 times forward multiple, and it has a very high exposure to North America discretionary spends, and therefore it's a recovery play. And the other one is Emphasis, where Jefferies has initiated coverage with a buy, target price 34.60. Again, the key reason is it has about an 80% exposure to America, and BFSI is 60%. And these are the resilient pockets in the global economy. They will recover going into next year, and therefore Emphasis will also benefit. And they're saying because of that, it's one of the IT companies which will give you a double-digit EPS return. Everyone is chasing growth. And according to Jefferies, Emphasis should give about a 14% EPS growth over the next 3 years, and that's driving their bullish outlook. But get into a break on that note. As we do that, here is some good news for all our viewers, because India's business news leader is now just a click away. We're introducing the all-new app. Get instant access to breaking news, in-depth articles, financial world updates, all at your fingertips. Download the CNBC TV18 app now from the Apple Store or Google Play Store.
Is to outperform going into 2025. There was a small portion who also believe that the Trump policies could be interesting to watch out for. Now, we spoke about the micros and the themes. Let's focus on some of the macros as well. Q2 was a bit of a shocker as far as the GDP figure is concerned, and after that, many on the streets have trimmed down their growth forecast for the country for next year. But will the growth surprise on the upside? We asked that question to majority. Most of them believe that the GDP growth will be between 6.25 to 6.5% in 2025. Only a mere 3% expect the growth to fall below 6%. So that's the big GDP growth forecast. So what's going to drive the GDP growth? And that's where the consensus seems to be, and that is the government spending. 77% of the respondents believe that government spending, which was lackluster in the first half of this year, will pick up in 2025. So that's going to be the big driver as far as the GDP growth is concerned. We had a record year as far as rupee is concerned. So we asked the question as to will that be a spoil sport into 25 as well. Most of the experts believe that the rupee is going to be range between 85 to 87 a dollar, while a small segment expects the currency to appreciate below 85 as well going into 2025. Also, we saw a new RBI governor taking charge, and that the first policy will be in 2025. So we asked the experts what to expect in terms of RBI action. It's a divided house there. 50% believe that the first rate cut from RBI will be in the Q4 of this financial year. However, a small portion believes that the stretch line could be as late as the third quarter of FY26. So that's the RBI action. Indeed, if the RBI has to cut rates, then how much is the rate cut that the street is penciling in? Half of the respondents, which is 50%, believe that the rate cut going into 25 would be at least 50 basis points. So 50 to 75 basis points is what a lot of people are betting on. So that's the rate cut expectation going into 25. In fact, 24 was a very volatile year. We had a budget, we had general elections, multiple state elections, and so on and so on. But 25 could be a year of moderate returns, but the expectation is that the positive returns would continue going into 25 as well. That's the big poll from CNBC TV18.
Welcome back. Below 23,600 on the Nifty, 426 points down. One of the levels to watch will be last week's intraday low on the Nifty, which was 23,460. From there, we rebounded to 24,200. It was about a 700-800 point rebound. We once again retraced very significantly. So 23,460 is a level you should watch. In fact, let's get in Mitesh Thakkar now with a few closing strategies. Mitesh, big blow for our markets today. Big fall.
Yes, very big. And I think what's important is that while the Nifty is yet to break the last week's low, I think the bank Nifty has already done that, and that's where the pain is coming from. Today it broke the last week's low. It's also broken the low which it made in November. I think at least on a closing basis, the low was 50,072, so it's trading below that right now, about 300 points. So that could be another breakdown. It's also breaking this 200 average and the weekly averages and weekly trend line and pivot. So I think it is the banking index which is clearly showing signs of further pain, and that of course will have an impact on the Nifty because the banking index or space does occupy significant weightage in the Nifty. So I think look at getting into short positions on the financial names or stocks which are breaking down. For the Nifty, I think the November low on a closing basis around 23,350. So that is the level which I'm watching. We're about 12 points away from that. That could be tested. If that gets taken out, then we'll look at further declines. But for the timing, I think it's the bank Nifty which will be more in pain. On the stock side, I have a sell on Tata Power, which I would recommend selling with a stop at about 387 for targets of 355. And Balkrishna, in fact, the entire tire pack is doing looking extremely weak. They are all negative, and Balkrishna has had a fresh breakdown. So sell here with a stop at 27.50 for targets of 26.30.
Okay, all right, got it. Mitesh, thanks very much for those calls. We'll come back to you in just a bit. Again, quick check, full tilt on the market, 450 down on the Nifty. So there's not much respite, 23,555. By the way, last week's low is close to 23,460. We've already lost, all the key moving averages. We've been trading below the 200-day moving average as well. And now the bulls will hope that at least last week's low does not break. Let's see. It's still about 100 points away from where we are. 3% drop on the mid-cap index. It's a crunching fall, and the bank Nifty is down about 2.5% as well. I think in the next couple of minutes, we'll be speaking to some experts to try and grasp exactly what the situation is with this virus. Before we do that, let's actually hear out what different functionaries of the state government and the union government, what they have been saying as well. Now, here is the latest. The Indian Council of Medical Research has confirmed 2 cases of the human metapneumovirus or HMPV in Karnataka. However, the Union Health Ministry has affirmed that there has been no unusual surge in influenza-like illnesses or any other respiratory illnesses. The ministry has said that it is, of course, keeping a close tab on the situation in China, and it says that India is well equipped to handle any unusual rise in any sort of respiratory illness. Listen in to the Karnataka Health Minister, who says there's no cause for panic.
I don't think we should be pressing the panic button because HMPV is not a new virus. It is an existing virus. And the statement, the way report has come out that this is the first case of HMPV in India, which is not true because HMPV is an existing virus and certain percentage of people do get affected by this virus. And it is not something new. It's been there for a long time and it causes common symptoms like cold and for maybe flu and cough. And then it's a self-limiting virus, so it goes away after some time. And I don't think we should be calling it the first case. That is a wrong way of reporting it.
Okay, so that was the Karnataka Health Minister. Let's get in 2 experts from 2 different companies in the diagnostics and healthcare space. We have Dr. Abhiroop Sarkar, Director Lab at Suraksha Diagnostics. We also have with us Dr. Niranjan Patil from Metropolis Healthcare. Thank you very much, gentlemen, for joining in. So I think we're just trying to understand the nature, the severity of the issues at hand now. There are different reports, not confirmed by ICMR. There's another report indicating that maybe there's a confirmed case in Gujarat. But again, it's not been fully confirmed by ICMR. Dr. Patil, let me come to you first. How should we look at this? Is this virus perhaps another strain, another virus, much like what we saw in COVID? And as far as testing is concerned, has testing started? Is it similar tests like what we had during COVID? What exactly is the situation on ground?
Yeah, so HMPV is a different species of virus. Okay, like coronaviruses are different species. So this is a different species of viruses. They're more like your RSV group of viruses. And we have the testing in place. In fact, we have been testing this by using US FDA approved and CE approved test kits, which basically are kind of syndromic approach where it not only tests for the HMPV but also tests for other flu viruses and RSVs. And we have been testing this successfully, and our test is CAP and enable accredited. And the turnaround time is also quite short for testing. So I would not say there's and we are also ready with if we want to test on a scale. For example, if there is an outbreak, a major outbreak, then we are ready for that. But nothing to worry as such, as it has been emphasized. It is a self-limiting virus, but it is very important to test and be sure about what the virus is out of the different viruses, because of the climate currently, because of the festive season, and because of the international air travel. So instead of having some subjective approach, we should have an objective approach, is my take on this.
Okay, not a big threat is what I'm taking away from that, Dr. Patil. Let's get in Dr. Sarkar as well. Dr. Sarkar, do you concur? Basically, we're worried about, is this something that, is it a routine disease, a flu or viral, or is it something more that we should be worried about?
Oh, it is just a routine common cold virus. So it has been there for decades. In India, there has been thousands and thousands of cases over last few hundreds of years maybe. We started detecting it for last like 3 to 4 years or so, and we almost every lab is like, we also test for this test as a syndromic approach, as Dr. Patil has also said. And it is not a new virus, so it has been tested regularly and tested positive also regularly. But we have to be cautious in that also, because we do not know if there is any new mutation or anything genetic changes there in HMPV. But currently, whatever what are the news now currently, there is no genetic mutation or anything has been reported by China or any bodies. So currently what we are seeing is just a common cold virus, and it is also easy to detect.
Gentlemen, that's very reassuring to hear that this could be another virus. I mean, any sort of common flu or cold sort of a virus. But then why the need to test? I think that is where suddenly public attention is drawn when cases are being confirmed, when testing is happening. If this is a routine virus and if it's not a very severe sort of strain, then why the need to test or to start reporting it officially? Dr. Patil?
So see, as I said, the symptoms of the respiratory viruses are overlapping. Whether it's cold, cough, congestion, shortness of breath, whether it is the flu viruses like your influenza A, influenza B, swine flu virus, respiratory syncytial virus, or your parainfluenza viruses, the symptoms are very overlapping. There are very specific treatment for influenza viruses. For example, you have oseltamivir, also called as Tamiflu. So when you have evidence, I think you can better manage the cases. And when you know that for HMPV, you have to be careful in infants, in elderly, and those with immunocompromised conditions, or those who are taking steroids. So then, yes, it obviously helps in the patient management and patient triaging as well.
Okay. Same question to you as well, Dr. Sarkar, because, I mean, if this is a common cold and flu, we typically, when we go to the doctor, we don't test. I mean, we stop testing after COVID because there could be many, many viral strains. In this case, why the need to test, and what would you expect from the ICMR as well? Because that's when public sort of alarm bells also start going off. When you say case 1 detected here, case 2 detected there. So what would you expect from the ICMR in terms of just managing this from a public health standpoint?
So traditionally, it has been tested mainly in like immunocompromised patients and children, where there is a chance of a complication or something. Otherwise, in like adults, we generally don't test for these respiratory infections as a part of respiratory panel. But for immunocompromised patients or children, pediatricians can actually ask for this respiratory virus, where the common cold may get complicated and may cause pneumonia. This is where it has been traditionally tested, this human metapneumovirus, as a part of respiratory panel, not in silo. It has never been tested. It has never been practiced. So, and this is what it's currently being tested for. But now, at the current situation, also most of the labs, we also are well equipped to test this human metapneumovirus if there is any surge for specifically human metapneumovirus. Then we can also do that.
Sure, and just I mean to confirm, like Dr. Patil also said, that there is adequate testing infrastructure available. If anyone is aged or young children, anyone who has some immuno disorder, for them testing facilities available adequately across the country, right, Dr. Sarkar?
Yes, it is available in most of the top-grade labs in India.
Okay. All right, gentlemen, thank you very much. That's a very quick, brief, helpful insight that I think a lot of our viewers would also need in terms of just how prepared we are and where we stand right now. So you just heard two doctors there on the panel saying that, A, this is not a new virus. This has been around for a long time. What needs to be established is whether there is any mutation, any new strain that's come in which has different behavioral patterns than the virus that was discovered 3-4 years back. That's what the doctors have told us. And there's enough testing infrastructure in the country. And it's only traditionally immunosuppressant patients which have some sort of immunity disorder or low immunity. They are the ones who traditionally go for testing. So that's the situation and what we know right now. But with that, let's move back to the market, which is singing a song of its own, and it's a huge sea of red. Nothing has really changed over there. Gurmeet Chatta of Complete Circle Consultants is with us. Gurmeet, well, very, very happy new year, though I must say, starting off with that wish, not on a very happy note. With what the market's doing. I think the happy news is what the doctors just told us. There's nothing to really worry about with respect to this virus. But back to the market. What's your sense? It's just relentless, the selling pressure.
So I said this, I think the problem is more internal. It is not virus. It is not yen carry trade unwinding. The finance minister of Japan made a comment. It is not FI selling. I think the growth has slowed down. And I think the valuations are still rich. If you see the credit growth update of most banks, and credit growth is basically a proxy to your nominal GDP growth with very high correlation. I think that tells you that there is softness, and that's getting reflected in GDP numbers, in GST numbers, which came in December. So I think, and government spending has been very slow. So I think the problem is, to me, is more internal. Yes, there are issues which will come. Sometimes it is war. Sometimes these are health scares which keep coming. I think that's the world we live in. But I think the key trigger for us is earnings. I think we need to get a bit of a growth momentum back, because if your earnings growth is in single digit, despite the correction, 21 times still market is still relatively expensive.
Hi Gurmeet, Happy New Year. Good to see you in. Well, but what would you do then? Are you all sitting at the sidelines waiting for the dust to clear up, or are you gradually deploying? Because as you said, if it's the problems are domestic related, then earnings is not going to be as good as was earlier estimated. We're kicking the can down the road. It'll become the earnings season to look forward to will be FY26, which means the next couple of quarters will be a bit of a washout.
Hi Nigel. I think broadly there are pockets where either you feel the earning will remain resilient, or there will be signs of them picking up due to cyclicality. I think IT is one pocket. I think earnings will be steady. So you have to be mindful of what valuations you pay. So one obviously is the dollar impact. Second, if you see wage hikes are very nominal or getting delayed, and attrition issues have been solved. And long term, I think US also, whatever noises we are getting, is that they want more people to come to the right route. So there will be some positive long term changes even in H1B, in my view. And then obviously the tax cuts which Trump government is talking about, which benefits IT spending. So I think that's one pocket where you got to be more focused on, assuming you don't overpay. The second pocket we are seeing, which we're seeing a bit of a comeback, would be housing. And I think that that's one pocket where I think you see a bit of an uptick coming in. We have a union budget. You will see a lot of announcements, both in terms of SOPs for the sector as well as some more disposable income coming. And then obviously government initiatives. So that's the second part. And third is, I think with now 3 months left, government is going to spend more to catch up with the 11 lakh crore target they had. So you will see large orders, large projects getting announced to make up for it, and that could come in power transmission, it could come in defense. We saw, the defense minister talking of this being a year of reforms and modern defense technologies. So you got to, as I said, focus. This is a tough year. You have to, it's not a year like 22, 23, 24. I think the money making will be tough, but there are opportunities.
Opportunities. You want to talk more about those opportunities in what is a tough environment. Gurmeet, hang on, just give us a second, because we're looking at some of the big newsmakers of the day as well. And obviously, it's all about ITC. Let's look at the stock and see what it's doing. It was trading down 6-7% last I checked. This is obviously as the the demerger of the hotels business is well underway, down about 8% right now, 37 rupees lower. We have Mangalam joining in. So this is the first leg, Mangalam. Now the stock is trading ex the hotel business, and then the hotel business lists next month, right?
Yeah, so if you look at the ITC stock price today, the cut that we've seen does not entirely reflect the market sentiment. A large part of that is by virtue of the 9 to 10 a.m. special session that took place today to discover the price of ITC hotels itself. So if you look at the opening price today and the closing price yesterday, you would realize that the stock opened lower by 26 rupees per share, and that's the value that the street believes it has ascribed to the hotel business itself. More analysts on the street were expecting this range to be between 15 to 20 rupees, but if you consider this difference as the final value for the hotel business as of today, then it is a little higher than what the street was anticipating. The proof of this, however, will be the day the hotel business lists, which is somewhere mid-February, what the expectations are given the timelines that the company is given. Just to jog your memory once again, ITC Hotels has about 130 properties with 13,000 rooms, and the company is looking at close to around 180 hotels with almost 18,000 rooms by 2030, two-thirds of that being managed. And if you look at the valuations at which all the hotel stocks trade, the street believes that ITC's place in terms of a multiple could be somewhere between Chalet Hotels and Indian Hotels, which is the leader, and at a premium to the sector itself at 37 times. But given the difference of yesterday's close and today's open, that 26 rupee mark values the ITC hotel business at close to around 54,000, but that's an implied value. What we really need to look at is the listing of the hotels business that happens mid-February. If valuations of 26 to 28 times are something to go by, then that share could list anywhere between 175 to 190 rupees a piece.
Got it, Mangalam. So that's on ITC, but markets in red. You have got pink on your mind for personal reasons. Nykaa, though, is one of the outperformers today. Tell us more about that update.
Yes, Nigel, absolutely. If you look at some of the products in your house, you would realize a lot of them do come in from Nykaa itself. And that comes in from the growth that we're seeing in beauty and personal care, especially the premium end of things. The company has been calling this out as a mega trend. And out there, the net revenue growth for the company this time around will be higher than mid-20s. In a sector, the consumer sector, which is largely parched for growth, mid-20s is something that the street likes more so if it comes from the beauty vertical. So, the growth out there has accelerated. Remember, there were a couple of activation events that Nykaa did during the quarter as well. Even if you adjust for that, the net sales growth in the third quarter has been mid-20s. And if you add back those discounts and deals, then the gross sales would be over 30% itself. And that is something that the street likes. The part of the business which is growing a little slower than what the street anticipated it to grow is the fashion business. And that's largely because of the weakness that we're seeing in online fashion. That too is growing at around 20%. So that's a positive. And as a result of which, the stock's holding in the green despite the weakness that we're seeing in the market.
All right. It's all about self-love and self-care, isn't it?
GRWM,
That's what perhaps,
get ready with me is what they say.
I suppose. And Navin, that also explains that the story that our colleagues at Money Control did, right? Minimalist, which perhaps Lever is interested in, and nothing minimal about that price. I think 3,000 crores is what the numbers were that were doing the rounds, right? In terms of the size and price of that acquisition.
Yeah, so if you look at the size of the acquisition, 3,000 crores for HUL will not be as much because they have a lot of cash on their books. And more than just, the size of the business, they're paying for growth. The Minimalist, if you look at the revenues, last year grew by about 90%, and the profits more than doubled from about 5 crores to 11 crores. So if Unilever can scale that out in their own distribution muscle, and again, they too have called out the mega trend of premium skincare, premium wellness doing extremely well. So if they go ahead and do that, execution would be key for them, not particularly the price, but again, they're paying for growth and not just, initial value for Unilever and Minimalist.
Absolutely. Self-care. That's what it's all about. Thanks, Mangalam, for that. Let's actually discuss this with Gurmeet. Gurmeet, so it's very clear, right? The country is consuming, but consuming what? And that's evident in the Q3 updates. We were discussing Nykaa with Mangalam just now, but even Jubilant. I mean, Jubilant's done actually better after a long, long time. Titan's numbers were sparkling as well. And what is not doing well? I mean, your usual, Dabur is talking about single-digit growth. Marico's got good growth, but they're worried about their margins because of, raw material inflation. So how would you look at playing the discretionary consumer side of it, given that stock prices have already run up quite a bit in many cases?
Supi, we discussed how the consumption basket itself is changing, right? So one of it is the digital consumption we are doing. So you've got to own some of the marketplaces. We're paying for literally everything: OTT, online groceries, online consumption on beauty and personal care, your health apps. Even the financial products you are buying, the marketplaces like Policy Bazaar. So I think the consumption basket, which is moving digital, is something which we should look at in your portfolio. The second is the high end consumption happening in different pockets. Like airport has become a new hub for consumption, and that is aided by the increased budgets we are doing for travel. That whether it is religious tourism or it is domestic travel or it is international travel. So there are ways to play that, either through airlines or to hotels, or through some of the high end retail like the luxury watchmakers, etc. And third is the awareness which is coming on organic foods and healthcare and becoming, and that is why products which have high sugar content, and that's largely I'm talking about urban. It's not as much rural, and that's where the consumption pattern is changing thick and fast. So the companies who are on that front, tends to do better. So even if you look at today, something like, let's say, a Tata Consumer which has Sampann, which is ready to eat food, hasn't done that badly in a market like this versus some of the other names. Even Britannia, for example, their portfolio, which is non-sugar and you call the health portfolio, the contribution is incrementally increasing. So I think you got to make that transition in your portfolio, and look at companies who are doing that actively.
Okay, all right, Gurmeet, we'll leave it on that note for now. Thank you very much for joining us this afternoon. Look forward to another chat soon. We do have to take a very quick break. On the other side, we will be in conversation with Ajay Argal of Franklin Templeton, get their perspective on the market.
Well, the consolidation theme continued to play out in 2024, with 40 million tons of capacity folding up into the hands of Adani Cement and Ultratech. And over the years, Adani's foray into the cement space with a massive...
Welcome back. So the market's still dealing with an ample amount of pressure, 370, 375 points down on the Nifty. There's been no real meaningful recovery, very small bounces, but then they've been sold into, at least as of now. Let's see. We've still got about half an hour to go to figure out how this day closes. We have our next guest joining in now. Ajay Argal of Franklin Templeton is our alpha manager of the day. Ajay, thank you very much for joining in. First of all, season's greetings to you. Wish you a very, very happy new year. Well, for Indian investors, it's been a bit of a wobbly start to the year. Time correction in some cases, price correction, and relentless FPI selling. So far, Indian mutual fund investors have kept the faith. Do you think they'll continue doing that?
Yeah, so thing is, the Indian domestic mutual fund investors, they've seen very good returns over a long period of time. So they have also kind of matured. They kind of are looking to buy or increase their allocations on every dip. And of course, that confidence has come because the returns have been good. So as long as the returns are there, the flows are likely to continue. Of course, as we have seen in the last few months, the returns have been tepid. So if this returns being tepid continues for a longer period of time, say 1 to 2 years, then it would be interesting to watch what the reactions of the domestic investors would be.
Yeah, but I guess that's the critical question, right? Whether they can continue to stay invested even if there is a period of low returns or maybe no returns. But Ajay, let's get to the house view. I mean, on equities here, Indian equities, what's the call? A lot of people are calling for maybe just single-digit returns this year. What's the general stance? I mean, what's the house call, and what is the sort of construct with which you're going right now? More defensive, or you're looking for bargains in sectors which traditionally did well in early 24, like capex, like EMS, etc.
Right. So the construct is that we are in challenging times. So as we have been witnessing, there is a bit of a slowdown, and it is across sectors. And initially, it started off with few sectors, and now it's kind of spread to many sectors. And then we have seen the GDP growth itself hit the 5% handle. And it is kind of reflected in the earnings as well. If you look at the first half of this year, the earnings growth for the top 500 companies has been almost zero. And therefore, the earnings downgrades have happened. And now we are expecting like kind of single-digit earnings growth for FY25. And that itself might be a bit of a challenge, as you were highlighting, whatever the initial outlook from a few companies in consumers have come and a few banks have come, it doesn't look like there is a major pickup. So there is this kind of reality check which is happening with the kind of growth which we are having and the valuations which we are trading at. So the valuations are definitely not kind of anticipating the kind of growth which is being currently witnessed. Basically, they are on the higher side. And of course, the valuations for some of the pockets in the mid caps are extremely high. So as far as the constructs of the portfolios are concerned, we are taking all this into consideration. And we have always been bottom up, so stock specific, but this is the time where you need to be more stock specific, because the sectoral trends are not there across most of the sectors. It is not as if you can generate alpha through sector selection. So you need to focus more and more on getting the right stocks. And that's what our focus are in terms of market caps we highlighted. So in our diversified strategies, whether it is focus fund or flexi cap fund, we are having larger weightage towards the large cap. So that is one construct of the portfolio we are having. And then, of course, we are looking at stocks where the balance sheets have been strong, where there is still some semblance of growth. And at the same time, they are available at some reasonable valuations, because some of the stocks which we have seen in the last couple of years, when they were doing or growing very fast, they were kind of trading at much higher valuations. But now that valuations are being questioned very rigorously, if at all there is some disappointment on growth. So more focus on the growth versus valuation combination.
All right. Hi, Ajay. Good afternoon and good to see you, Ben. Nigel on this side. Ajay, it's sounding like it's going to be a difficult year. What would it mean, though? A time-wise correction? Or should we brace ourselves for a larger negative year in terms of returns? Because for the last 6-7 months, actually, the Nifty has gone nowhere. In fact, we're a little bit lower. So if you could define difficult year. Yeah.
Good afternoon, Nigel. And you're right. We believe that there is a bit of overvaluation with respect to the growth which we are witnessing. And if you look at the Nifty itself, the overvaluation might be 10 to 15%. But if you look at the mid cap, especially, the overvaluation might be much more. So the overvaluation obviously can get corrected in two ways. It could be actual price correction, or it could be a time correction. Now, you are asking a very billion-dollar question whether which one of these would be the case. I don't think anyone can predict with any certainty whether it will be actual time correction or actual correction, or whether there will be a time correction. But we feel that there has to be a correction. So if you just go in the recent past itself, October 21 to March 23, 18 months of period, there was no returns. So it is quite possible that we have that kind of time frame, or maybe even a bit 1 or 2 quarters more than that, where you don't have too much of returns. But one thing is clear to our mind, that the returns which we have witnessed in the recent past is not likely to happen. So the investors need to tone down their expectations. But at the same time, and this is going back to the initial question, that how do the domestic investors react? The options for the domestic investors, equity remains the best option from the long-term perspective. If you have a 3-year plus view, then the kind of returns which you get, and especially on a post-tax basis, is going to remain the best in equities. Even with a slowdown, we are seeing a 5-6% growth, or that is about 10-11% nominal growth. And typically, over long periods of time, you get returns which are in line with the growth if the valuations are reasonable. And if the valuations are not reasonable, which is the case at the moment, we might have some bit of longer time frames to get the same kind of returns. So what we might be expecting a return in, let's say, 5 years, you might get it in 6 years. So that kind of situation may happen.
Yes.
But equity markets still remain the best opportunity for returns. Yeah.
Got it. Near-term pain, but longer-term gain. Tell us, Ajay, then, if you're in for the longer haul, then what could be that pocket where you could get reasonable valuations, good theme to play as well, and earnings will ultimately look up. What is that top theme that you all will look to play in this period of uncertainty?
Right. So the top theme we are playing, and we are kind of reasonably overweight, is the banking sector. And we have seen the updates from the banking, a few banks. And we have seen that they have kind of shown or kind of indicated between 7 to 10% kind of growth from the credit system perspective. And of course, we need to see how the margins would be. But the good part about the sector is that the growth is reasonable. There is a bit of a slowdown like other sectors as well, but it is still close to the double digits. There is a bit of hit which will happen on the asset quality front, but again, it will not be too much because just few pockets like microfinance and a bit on personal loans, which anyway the regulator has kind of put some curves, and therefore the growth has anyway slowed down, and they're all short cycle. And what we are expecting is that the interest rate cut cycle will be at a slower speed, and it will be shallow. And in that scenario, the margin hit will not be much. So basically, the growth and the business performance will be very stable. And importantly, this is the only sector where the valuations are lower than the last 5-year averages. So this combination is very good, and we feel very confident that it will be one of the sectors which will do well in relative terms. Another sector where we are a bit positive is the healthcare sector. And where admittedly the stocks have already done well, so the starting point in terms of valuation is not as good as the banking sector, but it's still we have a few opportunities, and this is more stock specific opportunities rather than across the sector, where some companies, either they are in the specialist pharma space or complex generics, they have some good growth opportunities. The third sector is the real estate sector. In the real estate, we have seen that the cycle has turned, and the inventory levels are down to maybe 14-15 months across the top 7 cities or so. And that is down from 40 months of inventory. So there is a substantial correction in the inventory levels. And as and when the launches come, which we are expecting starting from this quarter, that the launches will increase, the sales and the collections would increase, and that will further take up the growth prospects of the sector. So we are a bit overweight on this sector as well.
Okay, all right. We will leave it on that note. Thank you very much for joining in, Ajay, and we look forward to more conversations during the course of 2025. Thanks for being with us today. Well, with that, let's move on. It's time now for our special segment, D Street Chatter. What is a chatter today? What a manic Monday on the street. We have, of course, Nimesh joining in as always. Nimesh, as if Friday wasn't enough, now this Monday has completely eclipsed what we saw on Friday. What is it that you've been picking up?
Oh, absolutely, Surbhi. And it has come as a bit of a surprise as well. Nobody was anticipating such a sharp sell-off Indian markets on the very first day of this week. So caught off guard to some extent. But again, the sense I'm getting is there is selling as well. We saw the selling pressure on Friday as well. The FI number was quite large. And looks like even today there is going to be a large, substantially large FISL figure. So that number will be quite important to track. I guess, globally, there are a couple of global triggers which are having an impact on most markets in India as well. One, of course, is the currency move. We extensively discussed that throughout the day. And second is the central bank action. There is a lot of concerns about what, maybe what Japan central bank will do and what impact it can have on the currencies and on global markets. So again, that's something which is weighing on the sentiment in the Indian markets as well, and that's added by the FI selling pressure. I guess technically we're back to very close to that crucial support on the downside, which is 23,300. I've been saying this, that the Nifty seems to be in that 1,000 points range. On the upside, 24,300 is acting as a very strong resistance, and on the downside, 23,300 is a level to watch as a crucial support. So that's something to track. From a sector point of view, financial has been a big underperformer today. Again, the Q3 has not gone down so well as far as the updates are concerned, and that's the reason why the bank Nifty is up almost 2%. But surprisingly, there is selling across the board today. The broader markets have been under pressure as well. The mid-cap index is down 2.5%, the small cap is down 3%, and looks like there is selling across the board. So a bit of unwinding as well from the retail and HN investors in the broader market. But largely it's because of the global cues and the fact that the FI selling has intensified again. That's adding pressure to the Indian stocks and broader markets as well.
Indeed, Nimesh, rather weak trading session. That FI number we look out for. But what about individual stocks? What are you picking up?
So in terms of individual names, Nigel, the first stock is Marico. Well, the update was quite strong. The stock is under pressure today, but I understand there's going to be a small MOC buying as well in Marico in today's market. So that's something to track from a flow perspective. The second stock is Zomato. Under pressure for the second day running. There are aggressive sellers is what I understand. And looks like some larger FI seems to be active sellers as well in Zomato. So that's the reason why that stock is relatively underperformed for the last couple of days. And so is the case today as well. The third stock is Sequence Scientific. Well, the stock has been consolidating. I understand there could be a corporate development very soon. The street is anticipating some inorganic move by the company very soon. So that's a trigger in Sequence Scientific. And the last is Transrail Lightning. A recent listing. Since listing, the stock is up 20-odd%. Huge volumes in the last couple of days. Even in today, in a weaker market, that stock is buzzing in trade, largely on back of strong HNI flow. So some HNI action seems to be quite active in the recent listing, and hence Transrail is buzzing in trade today.
Okay, all right, Nimesh, thanks very much for joining in with all the updates today. We do have to take a quick break right now. We'll come back on the other side and get you more on the markets in just a bit.
Has acted as a catalyst, triggering the race for capacity share, which has increased the competitive intensity. The top 5 players now account for more than 60% of the market. That compares with only around 40% 7 years back. The question is, will consolidation slow down from here on? Remember, the recent deals have been concluded at around $100 per ton mark. That's closer to replacement cost. Well, ICICI Securities says that cement majors like Ambuja as well as Ultratech, they have exhausted most of their cash reserves post the recent acquisitions. They add, except for a few NCLT cases, they believe that low-cost acquisitions are largely behind. And now the potential deals may command a significant premium to the replacement cost. That could make them much more unattractive on borrowed funds at low cement prices. Well, the pain point is, elevated competitive intensity has led cement prices plunging to 4-year lows. Demand as well has been plagued by general and state elections, heavy rainfall in few regions of South India, the construction ban in NCR region, and also labor unavailability in various parts of the country. But part of the street is optimistic that cement sector has hit rock bottom and it's ready to fight back. Well, Jeffrey says that dealers suggest that price declines. Welcome back. Well, we are back at the low point of the day. Mitesh Thakkar is back with us. Mitesh, your view on the index, if you had a short position, what would you do? Where does support come in? And also fill us in with a couple of your picks.
I think carrying the short may not be a bad idea. So we are quite down today, and there's always a chance of some kind of gap of opening, but the structure is weakened considerably. So I think this is a slightly positional view. One, I think the Nifty is very likely to test 23,350, maybe break below that. Similarly, the Bank Nifty bounced back from 49,700 zone, which is where the Bank Nifty had made a low in August of 24. But looking at the indicator position and the moving averages, I think once we start breaking below this 49,700 levels, I think good chance that we are penciling in about 1,000 point plus cut more in the Bank Nifty. So stay short. Having said that, I have two STBT calls. One of them is BHEL. Sorry, one BTS and one STBT. BHEL is an STBT with a stop at about 222 for targets of 214. And SBI cards, I think that's on the buying side. Disclaimer, we have some call option positions, so there's vested interest. But SBI cards is doing well in this week market. It's come off the day's high, but yeah, the structure is good. So BTST here with a stop at about 722 for targets of 740.
SBI cards is the buy call and the sell call is BHL. Is that correct?
That's right. That's right.
Thanks, Mitesh, for that. Well, diagnostic companies, that's the bright spot today. We have a couple of updates, brokerage notes as well coming in. Vinny joins us to help us out to tell us why Dr. Lal and Metropolis both are doing well. Vinny.
Yes, so we have both these stocks today in focus. Let me start with Dr. Lal. We had a brokerage note that came in from Kotak Institutional Equities. They upgraded Dr. Lal to an add from a previous reduced rating that they had. They've gotten a target price of 3,250 rupees per share for Dr. Lal Path Labs. Now, what are they saying is that the execution has started improving. That started on track for the company, and that is a strategy which they want to follow in terms of improved execution, which is working out well. Other than that, they're expecting gradual improvement in terms of the transition that is taking place in leadership. That will be starting to support the growth in terms of strategies that they're putting in place. Pricing action, that's a key to watch out for, right? We've seen those increased competitions coming in from the online channels and online diagnostic companies and pharma like Tata MG, or even when you look at it in terms of Redcliffe, these are the companies on online and offline channels which are creating some bit of a competition for these companies. So now in terms of pricing strategy, pricing action has been taken across most these online and offline players as well. So that means the gap between the pricing has been reducing, which turns out to be a positive for them. For Dr. Lal, they're expecting a volume growth to see steady pickup in the suburban areas as well as in terms of the tier 3 and tier 4 cities, which will be supporting Dr. Lal's growth. So yes, keeping an eye out on Dr. Lal. Now moving on to Metropolis Healthcare. Metropolis Healthcare reported its Q3 operational update. Good growth in terms of update, double-digit revenue growth of 11% on a year-on-year basis. Other than that, volume growth has also started seeing an improvement, plus product mix is something that is supporting the growth. B2C revenues have seen a 15% growth. They've spoken about increasing the prices in Q4 FY25 in some of these B2C cities. So yes, keeping an eye out on Metropolis also, indicating that the pricing gap is reducing between these platforms as well as these online channels. So that is an interesting one to watch out for.
Okay, got it, Vinny. So those are the key triggers for these two diagnostic stocks, both of them in positive territory. Actually, even Thyrocare surged some 12% today. In any case, I suppose some sentiment rub-off because of the worries around the latest virus. Well, with that, we'll take a quick break, come back with more market talk in just a bit.
And now the industry is attempting price increases every month. They believe that the recent increase in industry consolidation further supports a case of revival in cement prices. Though sustainability of the price hikes will depend on what the leaders prefer, volume or price increases. Well, Goldman says that their channel checks suggest that demand is recovering, though on a low base. With the expected pickup in government capex, rural demand is likely to improve, and urban real estate market, well, that's doing well as well. So they expect that cement demand will grow by around 7% in FY26. On the profitability aspect, well, INCRED says that lower fuel cost, improvement in volumes, that could lift EBITDA per ton by around 160 rupees on a sequential basis. Though they admit on a year-on-year basis, it will still be down by around 200 rupees per ton. Axis Capital says that cement spreads are on recovery path. It's at the highest levels we have seen since January 2024. They add that spot spreads are now 12% higher sequentially, though it's still down by close to around 5% on a year-on-year basis. So 2024 has been a brittle one, both on pricing and demand. The hope is that 2025 cement will be in far better shape and it could deliver a far steadier performance.
India is in vogue for a number of international brands this season. Surabhi Upadhyay, CNBC-TV18, Mumbai.
Hello Hello, I'm Surabhi Upadhyay and I am going to be joined by trailblazers who are transforming the banking and finance sector in India and around the world, only on CNBC-TV18.
Celebrating 25 years of CNBC-TV18. From sharp insights in the political arena to all the excitement from the world of sports. We are here at the CNBC-TV18 Budget Headquarters as we've done for the last 25 years. Celebrating 25 years of CNBC-TV18.
The markets are big.
Welcome back. Well, the markets at least will be holding on to the 23,600 odd mark by the time we wound down. The Nifty Bank, that's the one that's getting a sharp knock. Hemang Jani joins us on the show. Hi, Hemang. Good afternoon. Good to see you win. What are you doing? Buying this dip? Buying anything in particular? If you want to name a couple of stocks, or just sitting at the sidelines till the dust settles?
So, been a bit difficult phase for the market, and today an interesting aspect is that unlike Friday where the Nifty fell almost 200 points, but the broader level portfolio level damage was not as much. But today when we have seen a big cut, the broader market, the stock level damage is 3 to 6% at the stock level. I think some of the pockets where the numbers of business updates have been good, QSR space has been a good positive surprise. So the names like Jubilant Footwork, Sapphire, I think these are the names where you'd be comfortable kind of buying through this phase of volatility. Also, Titan, I think the business update was pretty positive, and that is something that we would surely look to buy into. Nigel, I think the more important aspect is that the banking stocks, 50% of the total banking system, the numbers were out and the growth was hardly anything to talk about. So that is one big disappointment, and that is something that I think it makes sense to avoid at this point.
Okay, got it. But Hemang, in all the updates that have come through, one thing is very clear, that discretionary consumption in large parts still seems to be holding up. So therefore, what we saw on Nykaa, what we saw on Titan today, would you use this fall to nibble back into any of these stocks which have already run up? Throw in some of maybe the QSR names or even some of the e-commerce plays.
So I think some of the QSR names, though they have run up in the past few days, but when you look at a slightly broader time frame, about 12 months, I think these stocks are still, quite reasonable at this price point also. Titan has been a laggard for almost 1.5 years, though it has run up by about 5-6%. But if we have a slightly better trend ahead, surely this pocket will provide good opportunity, including some of the auto names which are part of the discretionary consumption theme. Mahindra, Maruti. After a long time, we are seeing a very strong number being reported. So those are the pockets that we surely looking to buy.
Okay, all right. Hemang, stay with us. We'll have to wind down the markets for the day, and then we'll come back to you for more market opinion in Markets Forward. But we're almost at the final minute of trade, so let's run you through what went on in today's trading session. The Nifty, well, a very, very weak trading session is what we saw. It appears participation was full. The FIs, they could have been back in with a bang, and also there are various global concerns with regard to the yen unwind trade that could potentially take place and what the central bank action could be from here on. Keep in mind, we'll have President Trump as well that will take over office on the 20th of January. Big losers today. Trent was down 4.5%. Tata Steel was down 4.5%. NDPC was on the losing end. You had Coal India as well that was down 3.5%. So all of them were the top losers in trade. OMCs, the worry is that Brent crude prices is perking up. So you had BPCL, HPCL, IOC, all of them were under pressure. What did well? Well, select hospital as well as diagnostic companies did well. You had Apollo Hospitals, the top gainer on the Nifty. Metropolis was higher. Dr. Lal's did pretty well in today's trading session. And you also had, Metropolis, Dr. Lal, as well as Thyrochem. All of them were up and about. The breadth of the market was worrying. You had one stock that was advancing, 10 stocks were declining. In terms of the ones that were advancing, Nykaa was, a positive update that we got. So that stock ended higher. RBL as well, ending high with a gain of around 2.5%, though there could be a technical factor playing out there. What was under pressure? You had Union Bank that was down, posted its update. Hindustan Copper was down 6%. Bank of Baroda under pressure, 6% lower. NCC as well as SJVN. So the whole host of losers in today's trading session. The factors that plagued the markets today was really these quarterly updates coming in from banking as well as consumer names. It's pointing to some kind of a slowdown, and that in turn will have its impact on earnings. So that much awaited recovery in earnings, well, it may not be seen in quarter 3 itself. And that's why the street was a little bit nervous in today's session.
Well, a manic Monday indeed. Tough start to the week. 376 points gone from the Nifty at final count, and a 2% decline on the Bank Nifty as well. Let's see, we'll come back and look at the FPI trends tomorrow morning. But as we sign out of closing bell, do stay with us, because we'll be bringing more of the market action, more perspective, and some technical checks as well. Markets forward up next.
Affordable housing. You look at the kind of stocks that have risen. We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating 25 years of CNBC-TV18.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18. Now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits, and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC TV18 and CNBC-TV18.com. CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets.
Well, it's a weak Monday on D Street as key indices end with deep cuts. The Nifty falls below the 26,600 mark while the Sensex tumbles 1,200 points. Financials lead the losses. Broader markets see a deeper correction.
Union Bank and Bank of Baroda slip on the back of third quarter business updates. Union Bank reports lowest growth among all lenders. Bank of Baroda sees its business momentum soften.
Pizzas and beauty score over staples in Q3. Jubilant food revenue surges 53%, powered by the acquisition and strong growth in Domino's India. Nykaa guides for more than mid-20s growth in the top line. Dabur says sales will grow in low single digits, while Marico guides for mid-teens revenue growth, but remains cautious on margins. IDC goes ex-hotels business effective today. Hello and welcome to a fresh edition of Markets Forward, your go-to show. We'll tell you all about today's trading action and also we'll set you up for tomorrow. I'm Nigel and with me is Surbhi. Well, Surbhi, what a way to start the new year. Well, today was effectively the day when you had large amount of participation and it was down, down and down.
You know, Christmas is gone, but Santa's left his color behind. That red refuses to go from the street, and that's pretty much been the case. It was not just Friday, but the selling action kind of exacerbated it today as well. In fact, it was an all fall down kind of a day. We'll talk about this as we go forward. Of course, we'll have you covered with all the key news and developments on the street as well. But first, a very quick wrap of what happened. So as you can see, we saw that little speck of green at around 9:15 in the morning. After that, it was just a one-way decline. There were some attempts at a recovery, but none of them really proved to be meaningful at all. And this was not just a nifty fall. If you're looking at what happened in the mid-cap universe, then the fall was even bigger. The mid-cap index at one point in time was down almost 3%, and the advance decline ratio was extremely negative. Today was a day where you had almost 10 stocks declining for every one that was advancing. So that was the extent of the fall, and it was cutting across sectoral lines. You know, PSU banks, other PSU stocks, commodity stocks, metal stocks, bank stocks, you name it. There were actually very few places where you could hide today. So that's what it was. Now, just in terms of levels, the Nifty's anyway lost its 200 daily moving average, is trading below that level. And we're now looking out for last week's low, which is 23,460, whether that will be held or not. And mind you, the selling that we saw in India, that was more India specific. Asian markets were down, yes, but we fell a lot more. And there was no recovery in India, even though European markets were trading positive by the time we closed. So, well, that was the market. But we have plenty of ground to cover, Nigel, and of course, lots on the show.
Well, that's right. Well, what all's lined up on the show for you? Today, we start off with the top movers and shakers. Vivek is standing by for that. We have shares of IDC that slumped in trade as the company began demerger of its hotel business. While FMCG names, Jubilant, Dabur, they were buzzing in trade on the back of their Q3 updates. Stay tuned. We'll tell you more on that. And last but not the least, we'll delve into the key market events to watch out for tomorrow's trading session. But as promised, first up, top movers and shakers. Vivek Iyer takes it away. Vivek.
Well, thank you so much for that. A very weak trading session, like you mentioned at the start of the show. Advance decline ratio very, very weak. Struggle to find stocks that are doing quite well, but select stocks did do quite well, and select pockets of the market managed to end the day in the green. Select healthcare and diagnostic stocks, those are the ones that did quite well in the session. Names like Apollo Hospitals, one of the top gainers as far as the Nifty was concerned, Metropolis, Dr. Lal, these were the names that managed to actually trade in the green today. The other set of stocks that did quite well was actually some names from the beauty pack. So names like Nykaa today, after a very strong operational business update, that particular stock off the day's high but managed to end the day with significant gains. Devyani International and other stock QSR players, especially Jubilant Foodworks, gave quite a strong operational update, and Devyani International among the top gainers as far as the broader end of the markets was concerned. One stock that continues to move higher, irrespective of the market breadth, is actually ITI. Even today, this particular stock managed to end the game. Significant majority of the session, this particular stock was doing quite well, ended the day at the upper circuit. And lastly, Ease My Trip. We had the management, we had Mr. Pitti himself telling that he does not intend to sell further stake in the company as far as 2025 is concerned. And on the back of that, Ease My Trip today managed to end the day after quite a few sessions in the green. But in the broader end of the markets, or in the list of losers, it's a very long list. First up, heavyweight banks. Most of the banks today, private as well as public financials, saw significant cuts to 2.5%. Remember, they are major weights even as far as the Nifty and the Bank Nifty is concerned. Oil and gas stocks, PSU stocks, the entire oil and gas pack, OMCs as well as explorers, all of them saw significant selling pressure today. Also, look at PSU Bank and PSU pack. Union Bank, Bank of India, weak operational updates coming in there. PFC, Concord, BHEL, all of the PSU names today saw very, very significant selling pressure, 4.5% of the kind of cuts we saw across the universe today. And even metal and mining stocks, this pack too, didn't discuss it too much during the day, but, look at some of the names like Coal India, NMDC, Hindustan Copper, top laggard as far as the Nifty 500 or NSE 500 is concerned, hinging down almost 5%. Even this particular set of stocks seeing significant selling pressure today.
Okay, all right, Vivek, thank you very much for that, that summary of what transpired. Far more red than green. It was that kind of a day. Well, we have our experts joining in now. We have Jay Thakkar of ICICI Securities. Jay, what a crunching blow. Levels are just coming and going in this market. And I mean, you can't blame the bulls, right? When you're getting 4,000 crores of selling on a single day, we don't even know what today's number is going to be like. But anyway, what's the technical setup saying now?
Hi, good afternoon to you, Surbhi. Well, see, Surbhi, overall, kind of, up and down movement, as you rightly said, is because of the increase in the India risk, which we see is up by almost 14-15% in today's trading session, is above the levels of 15. And we had a very clear stance at ICICI Direct that, it's heading towards 17 to 18 at least in this particular month. And this, I think, has some more few points left on the upside to be achieved at least until the levels of 18 or maybe 20 as well in this particular month because of a couple of events going forward. One is the result season. Second is the president elect is going to take charge in US, and then budget, of course. So these are the three reasons mainly because of which and fourth is the kind of measures which the regulators have taken as far as derivatives is concerned. We have seen the weekly expiry getting over, as well as the lot size or maybe the contract value has almost tripled now. So because of which the option data basically has skewed. So they have the difference between the ATM straddle and the OTM strangle has been higher, and that's increasing. And this would clearly indicate that there would be higher volatility going forward as well. So I think that on the upside, 24,000 now onwards, should be is the very key resistance unless we don't see a close about 24,000 levels. On Nifty, the trend is sideways to negative. Very near term, 23,400, 450 is the immediate support range for Nifty, which is for 49,500 for a bank Nifty. If that breaks, then it's testing the previous lows of 23,260 immediately. So overall trend is negative, with an immediate resistance at 24,000.
Okay, all right, Jay, got that. Well, let's focus on ITC. The stock was under pressure today because it began trading ex of its hotel business. Mangalam joins us to explain all of that to us. Mangalam?
Well, on an optical basis, ITC was the top loser on the Nifty today, but that's because the company shaved off its hotel business into a separately listed entity, which will list in mid-Feb as well. This demerger process obviously was first announced in July 2023. The stock opened lower by 26 rupees per share, implying that, the street had ascribed a value of 26 rupees to the hotel business as against analyst estimates of anywhere between 15 to 20, though the proof of that lies in the listing of the hotel business in mid-February itself. Once again, to reiterate, the hotel business for ITC has close to around 13,000 plus rooms. 55% of them are managed and 69% occupancy as of FY24. They have a stated target of, over 20,000 rooms by FY30, with 66% coming in from managed properties itself. The hospitality sector is doing well, and if you look at the valuations at which hotel stocks typically trade, Indian Hotels is at the peak with around 37 times FY26 EV to EBITDA. Chalet Hotels follows with 25. ITC expected to be anywhere between 26 to 28. This is ITC Hotels that I'm talking about. Listing in mid-Feb, the street ascribes a number of anywhere between 175 to 190 rupees per ITC hotel share. But today's discovery has been a little more than what the street was anticipating.
Okay, all right. That explains the fall on ITC, not just the demerger of the hotels business, but overall market sentiment also, perhaps dragging the stock down lower. Mangalam, thanks for that. We'll come back to you in just a bit. Let's look at the other major headline of the day, and that was the weakness in the Indian currency. The rupee has fallen to yet another new low on the back of the strength that we've seen overall in the US dollar. However, today the dollar index was actually on the back foot, but the Indian currency still kept weakening. We have Lata here for some more perspective. Lata.
Well, the dollar index strengthened all of last week, and the expectation was, okay, it's thin market trading. But last week ended with a fresh bout of bad news for the Indian currency, you may say. I mean, it's not bad news, of bearish news, which is that the yuan, which until then was fighting the 7.3 mark, the PBOC was keeping it at 7.28, 7.29 to the dollar. It allowed it to cross 7.3, the renminbi, as of Friday evening by close of trade, and the offshore Chinese yuan, which we call the CNH, went beyond 7.33 to 7.36. So the reaction from the rupee was expected on Monday. Added to it was, of course, that big FPI sell figure which the market got over the weekend of 4,227 crores. There was somehow a hope that when the new allocations come for the new year, it could be positive. Now, therefore, how did the Reserve Bank react? It appeared last week that the Reserve Bank was defending 85.80. Now, this is the market perception, because every time the currency came towards 85, 78, 79, there seemed to be a supply of dollars. But given the ecosystem today, rising crude prices, selling by FPIs, as well as the US dollar going to 109 index, the yuan falling, given the concomitant of circumstances, it appears that the Reserve Bank let go the 85.80 level. The currency went all the way to 85.84 in intraday trade and finished around 85.82, 83. It appears that some of the immediate causes may be over. For instance, the yuan, it may have expended and gone over. A further weakening perhaps is likely only after the Trump swearing in and announcements. But, that chatter is not uniform. There are some in the market who believe even a 7.4 before the Trump swearing in cannot be ruled out. And therefore, we cannot say with certainty that the bad news is over as far as the rupee is concerned. It does look that it will track everything. It will track how the US yields are going. At the moment, it looks like the dollar index has moved back from 109 to 108.5. But there is enough pressure on the rupee in terms of other factors like the yuan and the equity selling.
Okay, all right. Lata, thanks a lot for that. Well, we have our guest with us still. Mayuresh, I wanted your quick word on ITC. The stock was under pressure because of that, it went ex its hotel business. But what's the view at around 440 rupees?
Afternoon, Nigel. No, I think two things. One, as Mangalam mentioned, I think the expectation in terms of the value per share for the hotel business, I think what the street probably has reacted today, again, in tandem with what the overall markets were also going through, but I think an exaggerated reaction, in my opinion, in terms of the expected value, plus vis-a-vis the perceived value for the hotels business. But to a large extent, again, as we head close to the budget, the typical noises that come around in terms of sin tax with cigarettes, with liquor, is expected to, again, probably play its role. And therefore, I think the stock might go through a phase of consolidation. The other thing that I've probably got, Nigel, is the announcement that they've done in terms of foraying into other lines of businesses as well, developing other products. And we've seen this in the past. I think a large part of their cash flows might actually get diverted in terms of the development of these new products over the next few quarters, so which might also constrain cash flows and return ratios to a certain extent. So in my opinion, again, I think the stock might just consolidate for a length of time to probably come. Obviously, looking at numbers, looking at what comes through the syntax and the value per share in the hotel business is something that will also drive the reaction to the stock as we move ahead in the next few months.
Okay, all right. That is ITC definitely hitting the headlines today. Well, let's move on to our special segment, D Street Chatter. Nimesh is joining in with all that he picked up. It was quite a brutal day for the bulls today. Nimesh, what all did you gather?
Well, absolutely tough day, Surabhi. Technically, we reversed all of last week's gains, and they were selling across the board. So Nifty, Bank Nifty, mid cap, small cap, all were under pressure today, and suggesting that maybe there was a aggressive FI selling. So the institutional data could be quite interesting today. But in terms of individual names, the first stock is Marico. Well, the stock was under pressure. The quarter 3 update was quite strong and better than what Street was anticipating. And there was a small MOC buy flow as well in Marico in today's market. So that's the first name. The second stock is Zomato. For the second day running, there has been selling pressure from larger FIs in Zomato. So expect high delivery volumes on the sell side. And looks like some larger FIs are aggressively selling Zomato at these levels. The third name is Sequence Scientific. Well, the stock has been consolidating. I understand the Street is anticipating a corporate development very soon. A likely inorganic move is what the Street is anticipating in that particular stock. And the last is Transtrail Lightning. In a weak market, that stock has been buzzing up 6%. Since listing, the stock has gained nearly 20%. And there was very strong buying from larger HNIs in that particular stock. And hence, in a weak market, that stock relatively outperformed.
Okay, all right, got it, Nimesh. Thanks very much for that. Let's quickly move on and look at a couple of the interesting consumer updates that came in. In general, it seemed that discretionary consumer companies sound more optimistic than some of the staples companies. We have Mangalam back with us to look at what Nykaa had to say today, along with Jubilant FoodWorks as well as Dabur. Mangalam.
So let's start with Nykaa. Beauty products are doing extremely well, and that's exactly what Nykaa's reports also, or the third quarter update also suggested. The overall revenue growth for the company has to be in mid-20s as per the company's own expectations, and that has been led by their beauty vertical, which also has seen growth in mid-20s itself. If you account for the discounts that they've given, etc., the actual growth would be over 30% or low 30s as well. Fashion part of the business, which is seeing some bit of consumer sentiment subdued, performance, that has grown at around 20% as well. And at the same time, we are expecting some sort of improvement come by on the new verticals like e-superstore, etc. as well. For Nykaa, the street liked those numbers and the stock ended higher in an otherwise weak market. Jubilant FoodWorks, phenomenal numbers coming in from a third quarter perspective, and this was led by their like-for-like growth. 12.5% like-for-like growth in India business, notwithstanding the 56% growth that we saw in a consolidated revenue, which also includes the DP Eurasia acquisition. The more important part that we have to now look at is how the performance of dine-in versus delivery has taken place, because over the last few quarters, we've seen delivery outperform dine-in. Has the decline in dine-in begun to be arrested is something we'll be tracking. And finally, Dabur. Staples end of the market not doing particularly well, specifically on the general trade side of things. Dabur has said while rural demand is resilient, general trade hasn't picked up yet, and as a result of which they are expecting low single-digit growth in this quarter. And also because of the inflation that they've seen in a lot of commodities, maybe margins would be absolutely flat as well. So that performance disappointed the street. The stock ended 4% lower.
Right, Jay, you want to give us a technical view on any of these names?
Sure. In fact, Nigel, I would say that Jubilant Food is one such stock which is clearly showing signs of long build-up, a clear positive momentum out there. And I think, Nigel, the kind of options data also we look at, then there has been good food base as well. So I think that Jubilant Food still is sustaining above the levels of 750. The overall trend in the short term will be positive, at least until the levels of 800. As well as Nykaa, I mean, we are seeing good short covering happening there with the positive divergence, and hence I believe that on the upside we can see the levels of around 185 with a stop loss of 165. One can go long here as well. So these are the two clear buy. In fact, Dabur, as Mangalam rightly pointed out, we are not seeing much of improvement as far as the technical or derivatives data as well. There's a lot of short build up on Dabur, positive divergence as well. But there is no price action. So I think 500 is the level to watch out for on Dabur. Till those levels are held, there is the possibility of a bounce. If that breaks, the stock can weaken from here on as well. So Nykaa and Jubilant Foods are better.
Okay, all right, got that. Jay, thanks very much for joining in. We'll thank Mayuresh as well. With that, we do have to slip into a very quick break. Come back with some more news and market updates in just a bit, as well as the events to watch tomorrow.
More. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhat.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
Well, it was in July 2023 where ITC first announced this alternate structure. So after a long drawn process, today is finally the record date for ITC Hotels demerger. ITC in July 2023 announced an alternative structure for the hotel business wherein the company would own 40% in the business by itself and the remaining 60% would be held by shareholders via an entitlement swap for which each shareholder will get one ITC hotel share for every 10 shares that they hold. The ITC hotel business, does it list today? No.
Welcome back. You're with us on Markets Forward. Now, there were a lot of BFSI Q3 updates that came through today and plenty of stocks were actually reacting. Abhishek is here with the highlights. Abhishek.
Well, the key highlight was the PSU banks. They have lost market share on deposits, and by how much? Take a look at the Union Bank of India numbers. The deposit growth is just 3.8% YOY and a decline of 2% quarter on quarter. Indian Bank, the deposit growth is just 7.3% YOY and about 1.3% quarter on quarter. Bank of Baroda, the deposit growth on a sequential basis was about 2% quarter on quarter. Remember that in the previous quarter, it was at 4.3% quarter on quarter. So they have also seen, a slowdown with respect to deposit growth momentum sequentially. The loan growth has also been weak for PSU Bank, Union Bank of India, less than 6% YOY growth. Indian Bank about 9.5%. Bank of Baroda, again, the loan growth seems to slow down at about 2.5% quarter on quarter when compared to previous quarter loan growth of 6.7%. So some of the lenders are weak in trade today post their Q3 FY25 business update. IndusInd Bank was weak given the fact that deposit growth on a YOY basis was the weakest in last 16 quarters, and for the first time in last 19 quarters they have seen their deposit shrink on a sequential basis. Suryodaya Small Finance Bank, their asset quality deteriorated. Gross NPA ratio increased to 5.5% versus 2.9% in the previous quarter. Bandhan Bank also saw its deposits shrink over 1% on a sequential basis, and L&T Finance, their rural business finance disbursements declined more than 16% YOY and about 15.5% sequentially. That was also weak in trade. Back to you.
Okay, all right. Thanks a lot for that, Abhishek, for that neat wrap of all the banking names that came out with their updates. Well, before we wrap up, we need to set you up for tomorrow's trading session. So let's get you all the key market events you need to watch out for. Mangalam is standing by with that neat list. Mangalam.
Well, you start with the macros first, and there would be the first advance estimate of, the last entire year's GDP that will be coming by from the Ministry of Statistics. So MOSPI will, report that. That's something that we'll be watching out for. But apart from that, a lot of stocks in focus on account of fundraising, IPOs opening, or at the same time, listing. So Indofarm Equipment, for instance, will be listing tomorrow. Alongside that, there will be an InvIT that will be raising some funds. So around a 1,600 crore issue for Capital Infra Trust opens tomorrow as well. And that's not all. There are infra companies. There is, something like Quadrant Future Tech, a near 300 crore IPO that opens tomorrow. GR Infra is the other one. BR Goyal Infra, rather, is the other one where the IPO opens tomorrow. And we'll also keep an eye out on a couple of listed names. Shakti Pumps, for instance, the board meets tomorrow to consider fundraising. And finally, we are in the season of quarterly updates. Today, Titan reported their update. Does Kalyan Jewellers go ahead and report their third quarter update or not is something that we'll be keeping an eye out on as well. A recent F&O entrant, so stock on our radar.
Okay, all right, Mangalam. Thanks a lot for that. Well, on that note, we'll wrap up on this edition of Markets Forward. We'll be back, though, with more news and updates on the other side.
February, but today ITC will go X the hotel business. Of its total business, the hotel business has 4% revenue, 2.5% EBIT, but more importantly, 14% of assets, which makes this demerger ROCE accretive for the parent company, which will be listed today. For the resultant company, that is ITC Hotels, currently has 140 hotels, around 13,000 keys, 55% properties are managed with 69% occupancy. The important part is their stated target, 200 plus hotels with 18,000 keys by 2030, with 65% salience coming in from the managed portfolio. ITC Hotel financials reflect the underlying improvement in the hotel industry as well. Post-pandemic, over the last few years, we've seen growth. And in the first half of this year itself, ITC Hotels revenue has been around 1,500 crores with operating margins of around 28%. Remember, in the hotel business, we have the second half, which is more margin accretive than the first half itself. If you look at the balance sheet and the opportunity as well for ITC hotel business, remember 52% of the business revenue comes in from rooms, 40% from F&B. There's a strong opportunity in the hotel business with zero debt, cash balance of 1,500 crores, and only 20% of their inventory is currently operating at 75% of potential occupancy. So that is telling you that there is room for operating leverage as well. They're also looking at value accretive M&A and alliances. The big question, how do you value this business, right? So for that, you have to look at projections. Given the recent history and the numbers that we have, FY25 could be close to 3,700 crores in revenues, FY26 4,400 crores with EBITDA of close to around 1,500 crores itself. And if you look at all the other listed hotel companies right now and their multiples, Indian Hotels is at 37 times, Chalet Hotels 25 times, the others between 17 and 18. My guess is ITC would settle between 25 and 37, closer to 26 and 28. And that means a market value of the ITC Hotels business between 36,000 to 39,000 odd crores. But remember, this is the entire hotels business. 40% will be held by ITC, on which a holding company discount would be there. And the remaining 60% could be between 22 to 24,000 crores. What happens to the ITC hotel listing? Whenever that lists, the shares could be worth 175 to 190. But today, the important part is the ITC share could adjust by around 17 to 19 odd rupees as the business goes ex-hotel business.
An analysis of election affidavits carried out by two independent non-profits has revealed that Andhra Pradesh Chief Minister Chandrababu Naidu may well be India's richest Chief Minister, and by a whopping margin at that. Recent surveys conducted by two independent organizations, that's the Association for Democratic Reforms or ADR and the National Election Watch or NEW, has pegged Naidu's declared assets at around 931 crore rupees. That's just shy of nearly 3 times the second place name on that list, and that's Arunachal Pradesh Chief Minister Pema Khandu, whose assets come to around 332 crore rupees. In fact, both Naidu and Khandu top this list of India's richest chief ministers. In fact, both these organizations surveyed chief ministers belonging to 31 states whose total cumulative assets came to around 1,630 crore rupees. That's an average of 52.59 crore rupees per chief minister. But remember, this average number is largely buoyed by the large assets declared by both Naidu and Khandu. Incidentally, the South isn't too far off when it comes to the upper echelons of this list. Karnataka's Siddaramaiah has declared assets of 51 crore rupees and is third place on this list. But remember, this number is still short of that average value of 52.59 crore rupees per chief minister. The quote-unquote poorest chief minister on this list is West Bengal's Mamata Banerjee with assets of just about 15 lakh rupees, while the third poorest name on this list is again from the south, that's Kerala's Pinarayi Vijayan with assets of just about 1.18 crore rupees. However, the south continues to find dubious mention as far as this list is concerned. The most number of criminal cases lodged for a chief minister belongs to Telangana's Revanth Reddy with 89 criminal cases against his name. The second place name on that list is also from the south, that's Tamil Nadu's M.K. Stalin with 47 criminal cases against him. This, remember, is as per the studies conducted by both ADR and NEW. When it comes to liabilities, the south again isn't too far off as far as the upper levels of this list is concerned. While the total number of liabilities or the largest liabilities per chief minister belongs to Arunachal's Khandu at about 180 crore rupees, both Siddaramaiah and Chandrababu Naidu continue to figure on the top of this list. In fact, Siddaramaiah accounts
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening: a sharp sell-off on the Lal Street as the Sensex and the Nifty end at the low point of the day. Mid-cap see deeper cuts. All sectoral indices close in the red. The rupee sinks to a new low against the dollar. ITC shares trade excluding its hotels business. The stock opens 26 rupees below Friday's closing price. ITC Hotels is expected to list by the middle of February, with shareholders getting 1 share of the hotel business for every 10 shares of ITC. Union Minister Ashwini Vaishnaw defends the proposed law requiring parental consent for those below the age of 18 to access social media and e-commerce platforms. Industry will get 2 years to comply with new rules. Minister adds India does not need data protection laws similar to Europe, which he says is stifling competition. The government will launch the second round of PLI scheme for the steel sector. Sources say the total outlay would be around 4,300 crore rupees. The new tranche would lay greater emphasis on manufacturing of specialty steel and electrical steel. Finance Ministry approves an outlay of 25,000 crore rupees for a PLI scheme to promote domestic electronic component manufacturing. Sources say the scheme will be announced in the budget and could attract investments of over 45,000 crores. The electronic component industry had sought an outlay of 40,000 crores. Finance Minister Nirmala Sitharaman meets trade unions as pre-budget consultations continue. Also meet representatives from infra and energy sectors in the 9th round of meetings ahead of the budget. At least 8 security personnel and a driver were killed after a police vehicle came under attack by suspected Maoists in Chhattisgarh's Bijapur district. Police say an improvised explosive device was used to blow up the vehicle. Police claim to have arrested the key accused in the murder of 32-year-old journalist Mukesh Chandrakar in Chhattisgarh's Bastar district. Chandrakar had reported on the alleged nexus between the administration and criminals through his YouTube channel called Bastar Junction. The Union Health Ministry says there is no link between cases of HMPV virus detected in Bengaluru and the infections reported in China. 2 infants in Bengaluru have no travel history. 1 infant is recovered and has been discharged, and another is recovering as per health officials. BJP targets Arvind Kejriwal after a CAG report shows the cost of building the official residence of the Delhi Chief Minister went up from the initial estimate of under 8 crore rupees to more than 33 crore rupees. AAP terms the allegations a diversionary tactic ahead of the elections. Canadian Prime Minister Justin Trudeau is likely to step down ahead of the scheduled vote of no confidence later this month. His party fell into a minority after a key ally withdrew support last month. Well, let's start with the market action. It turned out to be a manic Monday on the Lal Street. The Sensex lost over 1,200 points, dropping below 80,000, and the Nifty lost nearly 400 points in what was broad-based sell-off that we saw today. So that's the story for the Nifty, down almost 400 points, 1.5% lower. The Sensex losing 1.5%, 1,258 points lower, 1,500 gone on the mid-cap index, and the Nifty Bank also losing about 2%, a cut of 1,000 points there. So across the board, as we were pointing out, selling pressure this afternoon. Surbi standing by now to wrap up the market action. Surbi, a bad start to the week, no other way of putting it. What are the triggers, the factors that the market is dealing with?
Well, it was quite a manic Monday on the street with the Nifty actually having a trending down day. And why just the Nifty, the entire market? There was just no looking back. The selling started right from the word go at 9:15 and it just kept tumbling down. The fall was also completely across the board. It was cutting across sectoral lines. It didn't matter whether you're looking at large caps or mid caps. In fact, mid caps fell even more. There were almost 10 stocks declining for every one that was advancing. That was the extent and the nature of the fall today. No point in really naming too many individual stocks because it's a very wide fall that we've seen. But anyway, for reference, let's talk about the biggest Nifty losers. Trent, Tata Steel, BPCL, NTPC, Coal India, these were some of the weakest names. Actually, the fall was led by PSUs, both PSU banks as well as overall CPSE stocks. They were all really weak, and global commodity stocks were also facing plenty of headwinds. Then come the big boys. Stocks like Reliance didn't offer any comfort. A lot of the BFSI updates that came in over the weekend, that didn't really help matters. So whether it was IndusInd Bank, HDFC Bank, SBI, a lot of these stocks, Kotak Mahindra Bank, all of them under a lot of pressure today. The gainers were actually only 2 or 3 on the Nifty. Apollo Hospitals up and about, some green on Tata Consumer, and Titan managed to do well thanks to a pretty good third quarter update that came in. Actually, speaking of Apollo Hospitals, because of a lot of chatter around this HMPV virus, in general, healthcare and diagnostic stocks saw some green. So the likes of Thyrocare, Metropolis, Dr. Lal, also thanks to some positive brokerage commentary that came through on some of these names, these stocks were up and about. Important updates coming in, an important reaction in stocks. Nykaa's Q3 update solid. The stock was positive. Jubilant Foodworks has done well in the third quarter. But again, the gains kind of whittled down by the time we were closing. Dabur is still very cautious on the third quarter. Angel One was reacting to the update. L&T Finance also on the weaker side after the third quarter update. An important mention here is going out to ITC because the stock is finally trading ex the hotels business. That explains the pressure. But it wasn't just that, because in the morning the stock opened about 4.5% down. Then, of course, overall weak market sentiment perhaps chipped in, and finally ITC was lower by about 7 to 8%. Coming back to the overall picture, the fall in India was far more pronounced than what we saw in many of the Asian markets today. While we were trading, European markets were holding up. US futures were also higher. So let's see. FBI selling is the critical watch point, and we now need to see, because the 200 DMA is gone, we now need to see if last week's low of around 23,460 thereabouts, whether that holds for the Nifty or not.
Surbi, many thanks for joining us. That was the market action for you. And the rupee continues to fall. It's fallen to a new low against the dollar, pressured by the decline of the Chinese yuan. Strength in the US dollar, higher US yields and rising crude oil prices also weighed on the currency. Lata standing by now to take us through the currency market action. 85.82, that's the dollar rupee. Lata, what is the street telling you?
Well, the dollar index strengthened all of last week, and the expectation was, okay, it's thin market trading. But last week ended with a fresh bout of bad news for the Indian currency, you may say. I mean, it's not bad news, bearish news, which is that the yuan, which until then was fighting the 7.3 mark. The PBOC was keeping it at 7.28, 7.29 to the dollar. It allowed it to cross 7.3, the renminbi, as of Friday evening by close of trade, and the offshore Chinese yuan, which we call the CNH, went beyond 7.33 to 7.36. So the reaction from the rupee was expected on Monday. Added to it was, of course, that big FPI sell figure which the market got over the weekend of 4,227 crores. There was somehow a hope that when the new allocations come for the new year, it could be positive. Now, therefore, how did the Reserve Bank react? It appeared last week that the Reserve Bank was defending 85.80. Now, this is the market perception because every time the currency came towards 85, 78, 79, there seemed to be a supply of dollars. But given the ecosystem today, rising crude prices, selling by FPIs, as well as the US dollar going to 109 index, the yuan falling, given the concomitant of circumstances, it appears that the Reserve Bank let go the 85.80 level. The currency went all the way to 85.84 in intraday trade and finished around 85.82, 83. It appears that some of the immediate causes may be over. For instance, the yuan. It may have expended and gone over. A further weakening perhaps is likely only after the Trump swearing in and announcements. But, that chatter is not uniform. There are some in the market who believe even a 7.4 before the Trump swearing in cannot be ruled out. And therefore, we cannot say with certainty that the bad news is over as far as the rupee is concerned. It does look that it will track everything. It will track how the US yields are going. At the moment, it looks like the dollar index has moved back from 109 to 108.5. But there is enough pressure on the rupee in terms of other factors like the yuan and the equity selling.
Lata, many thanks. That is the currency market action. And let's talk about specific stocks now. ITC shares opened at a discount of 26 rupees to Friday's closing price. This after the cigarette to FMCG company spun off its hotels business into a separate entity. ITC Hotels is expected to list by the middle of February. Shareholders will receive 1 share of the hotels business for every 10 shares of ITC. Mangalam is standing by with more on this much anticipated demerger. Mangalam.
Yeah, so if you look at the ITC stock price today, the cut that we've seen does not entirely reflect the market sentiment. A large part of that is by virtue of the 9 to 10 a.m. special session that took place today to discover the price of ITC Hotels itself. So if you look at the opening price today and the closing price yesterday, you would realize that the stock opened lower by 26 rupees per share, and that's the value that the street believes it has ascribed to the hotel business itself. More analysts on the street were expecting this range to be between 15 to 20 rupees. But, if you consider this difference as the final value for the hotel business, as of today, then, it is a little higher than what the street was anticipating. The proof of this, however, will be the day the hotel business lists, which is somewhere mid-February, what the expectations are given the timelines that the company is given. Just to jog your memory once again, ITC Hotels has about 130 properties with 13,000 rooms, and the company is looking at close to around 180 hotels with almost 18,000 rooms by 2030, 2/3 of that being managed. And if you look at the valuations at which all the hotel stocks trade, the street believes that, ITC's place in terms of a multiple could be somewhere between Chalet Hotels and Indian Hotels, which is a leader, and at a premium to the sector itself at 37 times. But given the difference of yesterday's close and today's open, that 26 rupee mark, values the ITC hotel business at close to around 54,000, but that's an implied value. What we really need to look at is the listing of the hotels business that happens mid-February. If valuations of 26 to 28 times are something to go by, then that share could list anywhere between 175 to 190 rupees a piece.
All right, Mangalam, many thanks for joining us. The major PSU bank stocks fell in trade today on the back of their third quarter business update. Shares of Union Bank of India down over 7% after its deposits declined by 2% on a quarterly basis. Indian Bank's deposit growth also declined by 1.3% on a quarterly basis, and Bank of Baroda's deposits grew by a modest 2% from the previous quarter. All the stocks closing deep in the red. Now, top FMCG companies have given their quarterly business update as well. Shares of Dabur traded in losses after the company said that it was cautious on the general trade segment. The FMCG company said its consolidated revenue might have grown in low single digits in December. It also expects flat profit growth on a yearly basis. Now, shares of Marico also slipping as the company expressed concerns over muted gross margins due to higher inflation in copra and vegetable oil prices. The company expects a modest operating profit growth for Q3 as a result of expansion, investment and brand building. Now, Ease My Trip co-founder Nishant Pitti says neither he nor his family will sell any more stake in the company this year. Remember, Pitti sold 1.4% stake in the company to meet, in his words, personal strategic requirements last Thursday. Interestingly, the term sheet for this exercise had mentioned that a 14% stake was on the block. However, Pitti tells CNBC-TV18 that he never planned to sell his entire holding in the company. He also resigned as CEO of Ease My Trip last week, and the post was filled by his brother Rikant Pitti, who serves as CFO. However, Nishant has since moved into the role of chairman, where he says he will focus on driving the company's international expansion plans. Take a look.
The initial intent was 10% of the block which I hold. That is 14%, 1.5% of the 10%, 1.4% of 14%. And as I told you, we still own almost 50% of the equity. This will be holding up. We can't just give you some timeline, but still, we are not selling anything right now. And that could be, you can say, in 2025, we are not going to sell anything.
Well, that's Ease My Trip's Nishant Pitti. The government will launch the second round of PLI scheme for the steel sector. Sources tell us the total outlay would be around 4,300 crores. The revised scheme is aimed at boosting manufacturing of specialty steel and electrical steel. Remember, the first PLI scheme with an outlay of 6,300 crore rupees attracted investments worth 18,300 crores. And sticking with PLI, the Finance Ministry is learned to have approved an incentive scheme for electronic component with an outlay of 25,000 crores. Sources tell us the Ministry of Electronics and IT may consider expanding the scheme's outlay depending on the response it receives. Remember, the industry has sought a higher outlay of 40,000 crore rupees. That's a CNBC-TV18 exclusive. In court corner, the Supreme Court has directed the Karnataka High Court to hear all competition-related cases against Amazon and Flipkart. The Competition Commission of India had sought to move all the cases pending in multiple high courts to the Supreme Court. Now, it contended that parallel proceedings in courts could lead to conflicting orders. However, this move was opposed by both Amazon and Flipkart. The Karnataka High Court will now hear the cases from the 15th of January. Facebook's parent company Meta has moved the NCLAT, challenging a CCI order that imposed a 213 crore rupee penalty in relation to WhatsApp's 2021 privacy policy update. The NCLAT will now hear the case on the 16th of January. The competition regulator has alleged that Meta abused its dominant market position with the implementation of the privacy policy. Meta and WhatsApp were also asked to implement specific remedies within a defined timeline. Union Minister Ashwini Vaishnav has defended the proposed law requiring parental consent for those below the age of 18 to access social media and e-commerce platforms. Speaking to CNBC-TV18, the minister said that India does not need data protection laws similar to Europe, which he believes have stifled competition. Take a look.
If there is a bank account or any payment mechanism that a child is using, already there is a digital footprint available.
Sure.
So we have created a mechanism using virtual tokens and using the existing digital architecture. We should be able to have a seamless shift towards a digital compliance method in which we don't have to nobody should be required to go and say that, okay, this is my date of birth and this is, right? So all that stuff has been very well thought through and the industry has been consulted. Industry is on board on this. They believe that this structure that we have created here, where we use the existing digital architecture and we provide a verifiable parental consent framework using the existing digital architecture will work very well. And that's very important also, because in today's world there is a big possibility of harm coming to children because of the exposure to a variety of platforms. So that's why it's very important that the benefits continue to accrue while the harms can be prevented.
Well, that is Ashwini Vaishnav there on the new rules, the draft rules of the data protection law. Up next, the Union Health Ministry says there is no link between cases of the HMPV virus detected in Bengaluru and the infections being reported in China. We'll be joined by ICMR's former head epidemiologist, Dr. Raman Gangakhedkar, as we try and separate the facts from fiction. Back after a moment.
crore rupees worth of liabilities, while Chandrababu Naidu's liabilities come in at about 10 crore rupees.
Countdown for the Mahakumbh Mela 2025 has begun. It is just a few days away. Devotees see this as a once-in-a-lifetime chance to bathe in the holy waters of what is called the Triveni Sangam, where the rivers Ganga, Yamuna and the Saraswati meet. The holy event starts from the 13th of January and will last till the 26th of February. About 450 million people from India and abroad are expected to flock to Prayagraj, which is the spiritual heart of India. This isn't just any regular event. The Mahakumbh only happens once every 144 years. It is the culmination of 12 Purna Kumbhs that happen every 12 years. The Ardha Kumbh happens every 6 years. The Purna Kumbh is organized in 4 holy places: Prayagraj, Haridwar, Ujjain and Nashik. As demand for travel is expected to go up, airlines are going all out to launch flights to Prayagraj from different destinations in the country. The airport authority says there are 20 new flight connections exclusively for Prayagraj for the Mahakumbh. Indigo has launched flights from Ahmedabad, Kolkata and Bengaluru, while SpiceJet is connecting Delhi, Mumbai, Bengaluru and Ahmedabad. Limited flights means devotees will have to pay more for airfares. For instance, a one-way ticket from Mumbai to Prayagraj on the 12th of January is nearly 30,000 rupees. Then Bengaluru to Prayagraj on the 11th of January will cost over 22,000 rupees. The Prayagraj airport is also stepping up its game. The existing terminal is being revamped and a new terminal is being developed to together handle about 2,700 passengers at peak hours. Staying in hotels will also be an expensive affair, with room rates per night soaring to as high as 40,000 rupees. The state is spending a whopping 5,496 crores for this event, a lot more than what it spent in 2019. The government has allocated 4,000 hectares of land for the Mahakumbh 2025, which is double than over 1,900 hectares of land allocated in the Purna Kumbh of 2013. Over 1,50,000 tents and 25,000 accommodations are being set up for the sea of visitors from India and abroad. And for the first time ever, the entire tent city will be mapped on Google Maps, making it very easy for tourists and devotees to navigate in the Mahakumbh Mela. The Mahakumbh is a big deal for the hospitality and other commercial sectors. The state is expecting a revenue of 25,000 crores, bringing a wave of opportunity to the region.
Now, the Union Health Ministry says there is no link between the cases of the HMPV virus that's been detected in Bengaluru and the infections reported in China. 2 infants who have contracted the virus in Bengaluru have no international travel history. 1 infant is recovered and has been discharged, and another is recovering, as per health officials. Now, HMPV is a common virus and was first isolated in 2001. Archana is standing by now to take us through the details. Archana, take us through the details that we know of the HMPV virus, its symptoms and its prevalence.
Well, as you mentioned, this virus is not new. It was first isolated in Netherlands in 2001. But HMPV has gained attention amid a surge in cases, particularly among children under the age of 14 in northern China. Now, as the government has reiterated, currently there's no need to panic regarding the spread of this virus, and the Karnataka government has also reiterated that it's monitoring the situation closely in coordination with the health ministry. So what is this virus that everyone is talking about? Human metapneumovirus, HMPV. It's a respiratory illness with flu-like symptoms, and it's more common during the winter season, especially among the younger and older age groups with weak immune system. It can spread from an infected individual to others through coughing, sneezing, or personal contact. It's not limited to just China, but it's also prevalent across most Asian countries. The symptoms include cough, fever, nasal congestion, sore throat, and shortness of breath. Now, what are the precautions that people must take? Well, according to the Karnataka Health Department's guidelines, a lot of it is already known as public personal hygiene, but let's reiterate for our viewers. Now, people have been advised to cover their mouth and nose with a handkerchief or a tissue paper while coughing or sneezing. They should wash their hands often with soap or water and clean it with sanitizer. They should avoid crowded places, stay away from public places while having a fever, cough or sneezing. Unlike COVID-19, there is no vaccine or specific antiviral treatment for HMPV. Back to you.
All right, Archana, appreciate you joining us. And to take this discussion forward, we're now joined by Dr. Raman Ganga Khedkar, the former head scientist of the Epidemiology and Communicable Diseases Division at the Indian Council of Medical Research. Dr. Ganga Khedkar was also the face of the ICMR in government briefings during the onset of the COVID-19 pandemic and was a very regular guest here on CNBC-TV18. Dr. Ganga Khedkar, always a pleasure. Many thanks for joining us again here on CNBC-TV18. Let me start by asking you, sir, whether this is a cause for concern, it is a cause for panic, and what would you like our viewers to know about this particular virus?
What is most important is people do not know that this virus was present in India for a fairly long period of time. This virus has a prevalence rate of almost 4% across countries in the world. If you look at a publication that came from National Institute of Virology, it shows you very clearly that among patients who are having acute respiratory infection, now this is a story of 2016 to 18, among them, the prevalence is 3.4%. Among those who get admitted with severe respiratory infection, which we used to call then during COVID times and even now as SARI cases, it goes down to close to about 2.6%. Now, this virus is known to exist. There is no reason to believe, since there are no publications from China, that it has mutated enough to increase the mortality or morbidity that is associated with any virus. So there is no reason for us to fear at this point in time and create this kind of panic, which is unnecessary to my mind.
Yeah. Yes. So importantly, what you're saying is that this is not a new virus. It has been prevalent in large parts of the world, including here in India, for several years now. And at this point in time, there is no evidence to suggest that there is any mutation that's taken place of the cases that are being reported about in China. So no cause for panic or alarm just yet. Of course, it's always good to be vigilant. But Dr. Ganga Khedkar, the next question then is, and this is what everybody is reacting and responding to now, should we get tested? The question is, what should you get tested for, and what tests are we even talking about?
You can do RT-PCR to diagnose it. You can do a test which detects. I would not name because it is not considered as ethical in our profession. Some names tend to exist where you can test any kind of virus. But do I need that test? Absolutely not. Yeah. Because as I said, the risk of mortality or severe disease is so low that there is no reason for us to unnecessarily go for testing everybody, whoever has this kind of milder symptoms per se. What is also important to remember is, as I said, this infection occurs in India. It tends to occur in winter season. Now, even winter season is almost at the end of its own slot, no? Yeah. In terms of weather. Why am I panicking? I really don't understand. There is no reason.
Well, yes, and that is why we're bringing experts here to speak about this to our viewers. And you're essentially saying that at this point in time, please don't go out rushing to find tests and so on and so forth. Only unless your symptoms are severe will a doctor prescribe any particular kind of further investigation for you. So don't go around looking or go out and start doing RT-PCR tests, etc. That's what Dr. Ganga Khedkar is advising at this point in time, which also also brings us then to the question of, the kind of symptoms associated with this. In fact, all the publications that I've been looking at from Cleveland Clinic and so on and so forth, the symptoms are pretty much similar to a common cold. And in very few cases do they result in severe illness. Is that correct?
Absolutely. Absolutely. No, this test, even if it is done among patients who have severe acute respiratory infection and they get admitted, we must remember this could be a concurrent infection. The person must be having some other disease. So there, perhaps you may do it, but this particular infection is unlikely to cause a major problem. And that's something which we have to keep on informing people. And what is most important is everybody has to understand one thing. During even COVID time, which occurred incidentally in December, as it was reported from China, and the fact that the reports are coming from China, just social media is influencing our thinking so much that we are panicking for no reason. I think it is time the government has taken all kinds of right steps. What is also important is we have to devise strategies as to how to handle social media at this juncture, because perhaps social media related messages travel faster than viral.
Yes, that certainly is a challenge that you speak of, Dr. Ganga Khedkar. But what we can do, of course, is to put out information, to put out facts, to put out expert opinion like yours that will help our viewers make better informed decisions. So at this point in time, as Dr. Ganga Khedkar is very clearly articulating, this is not a Chinese virus. This is a virus that is prevalent in large parts of the world and has been prevalent in India. And this is something that we need to be mindful of, but this is certainly not something that requires us to push panic buttons just yet. Always a pleasure. Appreciate you joining us here on CNBC TV18. With that, it is time for us to wrap up this edition of Business 360. The news will continue here on CNBC TV18. We're back in a moment with more.
Yet another record-breaking night for quick commerce platforms as India's consumers took to their phones to order in their New Year party needs. Now, apart from the usual party essentials, many interesting items like grapes, condoms, ENO, milk packets, and even men's underwear were ordered for in huge quantities across apps. But let's look at Blinkit first. Blinkit saw its highest ever orders and also its most orders per minute and per hour. And in terms of trends, last night saw the most number of chips and most grapes sold in a day. The biggest order Blinkit received was for 64,988 rupees from Kolkata. Now, Instamart too saw its highest ever orders, which was the double of last year. And what did consumers look for the most? Milk, chips, chocolates, grapes and paneer. And the biggest order came from a user in Goa for 70,325 rupees. Now, on Big Basket, orders for things like games, soft drinks, mixers were all up anywhere between 200% to 1,290%. Now, after 2024 turned out to be a year of the quick commerce boom, Zepto CEO Adit Palicha rang in the new year with 3 predictions for 2025. Now, he says that 2025 will be the year where quick commerce will start hitting scale comparable with e-commerce. Now, we've already seen the lines blurring between the two in 2024. Now, his second prediction is that this year, the quick commerce model will really be put to test. Succeeding in this scale will require exceptional execution, he says, which will be a challenge for every single player to be able to deliver. Thirdly, he says that the fundamentals of quick commerce will evolve dramatically and the unit economics to build operating leverage will also change. And finally, as Zepto also gears up for an IPO this year, Palicha says that the capital markets environment from private to public will also be different compared to 2024 and 2023. So from a year of its boom to its true test of scale, it will be really interesting to see how quick commerce evolves in 2025.
2024 has now become the 9th consecutive year of positive returns for the Indian equities, and that's the record. In fact, 24 was a year of record in many ways, the highest fundraise in a single year, the ever-growing domestic pool, and so on. But the big question is, what is in store for 2025? Will the rally sustain? Will the mid and small cap continue to outperform? These are the questions in the minds of the investors. So now, crystal gazing is always a challenge, but CNBC-TV18 has reached out to the biggest market experts to bring to you an Outlook 2025, the biggest market poll for the new year. In fact, it was a poll across 61 participants, including fund managers, HNIs, as well as institutional dealers. So let's begin with the first and the most important question. What kind of return should investors expect in 2025? Majority of the respondents expect a single to mid double-digit return in 25. Only 11% of the respondents expect a negative return on the Nifty next year. In that case, will the broader markets continue to outperform in 25? Surprisingly, 50% of the respondents believe that 25 will be a year of large caps. Only a small percentage are still betting on micro cap and small cap stocks, which brings to the next big question, and that is the biggest theme to bet on in 2025. Here there is a surprise. First surprise, financial has emerged as the biggest theme to bet on for the next year, and that is despite the macro challenges.
Welcome, you're watching Commodity Champions and I'm Anisha Gupta, and this is a special one that we bring you from Geo Convention Center. This is IJS Tritiya Signature, where you have thousands of exhibitors spread between Nesco and Geo, and there's a huge footfall as well. Well, it's the beginning of the year and it's very interesting to see on where the jewelry market will head on from here for 2025. I want to start talking about diamonds first, and the last couple of years were slightly on a weaker side, especially when it came to exports. Remember, we saw all-time high prices in diamonds. That was back in Feb 2022, but the last couple of years have seen a bit of a decline. Well, not in all categories, but most categories. And it would be interesting to know from the who's who of diamond industry on how 2025 really seems to be looking like. So joining me on this discussion is Mr. Milan Choksi. He's owner Moksh. I also have with me Mr. Darshit Hirani from Hirani Exports, and Kevan Taswala is partner, Peace Moon Traders. Thank you, gentlemen, so much for joining in. I want to start with you first, and you know, when you look at the markets right now, and I want to start with prices first, there's been a lot of debate on how the raw diamond prices have seen a decline. Has it impacted a lot when it comes to the retail prices as well?
Thanks, Manisha. Thanks for making time to come to the show. No, I don't think pricing is as much a factor for a retailer or a consumer as much as it is for a manufacturer. So in some ways, lower pricing is great for the retailer because that kind of helps with their margins. They can make product a lot more attractive and affordable. So no, I don't think the pricing, while optics can be that pricing falling is a negative impact, but sometimes it's a positive and kind of brings more customers in, right?
How would you say 2024 panned out for you in sense of an opportunity and then a challenge?
So luxury in general, since you started contextualizing this conversation with 2022 being a high, luxury, that is watches, bags, all the high brands, they're all seen a significant dip in consumption over the last year. Should I wait?
Yeah, please go on.
Yeah, so it's whether it's watches, handbags, clothes, all of it has seen a decent dip. So diamonds being a luxury product and jewelry being a luxury item is in the same kind of space. So naturally, that would also see an impact. Spending in general has
taken a bit of a hit
for all luxury products.
And when it comes to exports, the numbers seemed really weak. Would you say India was a bright spot within all of this?
Obviously, the Indian economy over the last few years, and it's widely discussed everywhere. Indian economy is strong. China and the US are going through its own, transition period. China because of its economic situation, and the US, particularly with regards to our industry, is going through a bit of a change in consumption patterns.
Sure.
So India being such a huge market, obviously everyone's focus will now be inward and focus on India. And that's a good thing because everyone will spend lots of money trying to build the category here, spend on marketing, branding, advertising, and that rising tide will lift all boats.
Let me come to you for a number as well, Milan. And what would you say has been a growth for India? We all understand that when it comes to diamond, it's just about 11% of a penetration. With the way the market is moving, are you looking at growth continuing at a pace that we've seen?
Not immediately.
Okay.
I think it will take some time for the dust to settle on, all the changes that we are seeing in the industry. But eventually, over a longer period, I think there'll be clear distinction. Categories will be stronger. Luxury, generics, everyday product. A lot of that, as marketing evolves in India and communication evolves in India, I think. Culturally, India is such a strong market for jewelry. I don't see a problem. I think it'll become probably one of the most important markets, if it isn't already one.
All right. Darshit, to you then, and we all understand, as Milan Bhai has put in a context there, that luxury across has seen a bit of a hit, let's say.
Yes.
For you, how has it been? Because you deal in uber luxury in sense of diamonds as well there.
Correct. So we are in the rarer side of things. We do color diamonds. Color diamonds are extremely rare, with less than 2% of all diamonds being color. So for us, it has been a very different experience. It's two-pronged. I mean, certainly internationally things have slowed down. It has affected our business, yes. But domestically, this particular segment of color diamond has been appreciated big time, and the demand has been going up year over year. And I think the consumption pattern is also in a way where people want something new and different. With social media, people are moving on to new products very quickly, new things very quickly. So that certainly plays a role. So we have enjoyed the good times so far in India. I believe we would keep enjoying for the few years to come, considering how India is doing and how the spending pattern is. So yeah, I mean, that is a good prospect, yes. But then, yeah, overall, I think things are challenging internationally, even when it comes to color diamonds, for that matter. China and America, they are facing challenges with war and other aspects. But I think all in all, I feel India is going to be the
what has
shining
been your
side.
bigger market until now? And are you looking at newer markets now?
So India is a newer market for us in a very large way. Middle East also has been, I think, overall been doing quite decent. I think a lot of the mindset matches with how India is and how Middle East is. So we do see a good traction still compared to all the other markets. We think Middle East and India are doing the best for now. Yeah.
Kevan, are you also planning to see 2025 continue as the same way? Are you looking at international markets opening, or do you think India is going to be a major focus?
I feel India is going to be the main focus. International markets, I don't see China, US to grow more. I'm looking at Middle East market to grow nicely. So that is a good area for exports. But India is going to be the main progressive country for jewelry, yes.
So what are plans for 2025 now? As the new year begins and we have an IIGS happening right here, how do you see the footfall? What are people looking at? What are you presenting now for 2025? And what is the one marketing strategy that you will pick for this year?
People are looking more for designer pieces, one-of-a-kind piece, which is very different. They don't want traditional pieces. So their focus is they want to keep an inventory. The retailers want to keep an inventory which is very different from everyone. So coming up with new designs, new concepts, and one-of-a-kind pieces is going to be our strategy for this year.
So what is going to be the buzzword? Is it going to be technology, newer designs, giving them a customer service, which they, something that we've talked about in the last year as well?
I think customer service is going to be the main part here, because they want, ready prompt services, good quality, different segments, different concepts. So this is what they are looking for. So this would be their focus area.
Milan Bhai, another thing that we've been talking about is while the gold is hallmarked, the jewelry that is, and silver, there's a lot of conversation that silver and bullion would be hallmarked as well. When it comes to certification within diamonds, there has been a conversation and the government has been talking, BIS is looking at it, but is that a possibility at all, or do you think the third-party certifications is the way to stay right now?
Certainly. There has already been a conversation about disclosure at point of sale when it comes to natural versus grown
synthetic
diamonds.
Or lab-growns.
Lab-grown. and natural. There has obviously a representation that has reached. They are kind of going over it, and there should be some kind of clarification on that. And similarly, even the laboratory services that now will become very critical, because the consumer is also more aware with so much being written in media about lab and natural. It's important that the consumer is protected, and I think the consumer themselves will ask for some kind of third-party audit on what they're purchasing. So yeah, consumer protection is critical so that the trust and belief in this industry remains intact. Hallmarking did a fantastic job for our industry. The industry really burst after that came in, and the same thing will happen with gemstones and diamonds as well.
Yeah, oh, absolutely. There's more transparency. There are more IPOs coming into the market as well, more corporates getting into the street. But is lab-grown still the elephant in the room, or do you think that is settled, done, and the market is moved on?
No, it's not yet done. There is going to be, it's a very new product, right? There is a customer for it. There is a use for it. Nobody knows where it's going to go at this point. It will be, it will take some time for businesses and brands to use the product for its best value. Consumers will also find a reason to buy it at the right time. And like I said earlier, that it will be marketing, branding, storytelling, all of this put together, which will put all the products in their places. I think, I've said it before, I think we should be discussing the painting and not the paint as much.
All right.
So,
that point is well taken.
Yeah.
It's a global 76 billion of a diamond jewelry market. And as we get into 2025, it's going to be a lot about the new president in US and how will he act and how will all the countries react. Is that making you nervous?
No, not at all. I believe, when people make money, they want to spend it. They spend it on all kinds of things, vacations, products, be it clothing or jewelry.
More in sense of geopolitics, because the Russian sanctions and the Kimberley process, and there's lots that happened in 2024. Yes. Are you looking at 2025 with a different lens?
I feel things are going to stabilize a bit more with all the elections and everything done, I believe. So I believe it is going to be better than 2024 in that sense, because I don't see too many red flags. There were many red flags in 2024 for that matter. So I believe things are going to get better from here. So 2025 is only better than 2024.
So let me come to you with the final questioning now on how do you see 2025? What is it that you think will work the most here? And what are your investment in? What is new that you're bringing in this year?
This year we'll be focusing more on bridal kind of jewelry. We are going to keep that because what we see is
big purchases.
Yes. So that is an upcoming thing now coming up in India. So they want bridal kind of stuff. So that is what is going to be our focus this year.
Darshit, bigger is better?
For me, no. Even my kind of products, no, bigger is not better. Quality is more important. But I think with all the big weddings that is happening in last year that has happened, it has opened up a lot of people's eyes to what bridal jewelry has been. So, people are exploring different products. I mean, if you see that many of the big weddings have so many different varieties of products being worn, I think people are choosing what they like and they are demanding such level of products. And I think that's what's going to drive quite a bit of the high-end bridal segment. And along with that being an inspiration, it does trickle down as well. So that's what I feel that's going to be the trend set.
Your final comments as well. More participants coming in. The world is changing in so many ways. Quick commerce and online is coming in. Has world changed a lot for you? And what's your sense as you get into New Year?
I mean, we're in the luxury business, which is typically a slow. Luxury in my world is a slow kind of. It's not go with the flow, it's go with the slow. So we don't move. We don't move that fast. But the effort is to actually show the customer something they've never seen before. So while everything else is, in media and online and, you see it on your phone, our effort is to find them something that they've never seen before.
All right. So clearly the worst is behind us. We have very hopeful jewelers sitting here, manufacturers, diamantiers as well, telling us that 2025 is the year to be. And luxury, well, yes, I absolutely get your point that while you're all running away, but running up and running and rushing, but luxury is something that works slow but works most importantly. Thank you, gentlemen, so much for joining in. Well, that's about diamonds, where you are looking at a better 2025 perhaps coming in. But after this break, we'll talk to you about gold, and there's a lot happening there as well.
And the fact that they have been an underperformer. The other surprise was the stellar outperformer of 24, which was capital goods. That's been considered as the least preferred bet going into 2025. We spoke about the returns and the big themes. Now, what's going to drive all these returns? And the near consensus answer is earnings, earnings, and earnings. That's going to be a dominant factor for the Indian equities to outperform going into 2025. There was a small portion who also believe that the Trump policies could be interesting to watch out for. Now, we spoke about the micros and the themes. Let's focus on some of the macros as well. Q2 was a bit of a shocker as far as the GDP figure is concerned. And after that, many on the streets have trimmed down their growth forecast for the country for next year. But will the growth surprise on the upside? We asked that question to majority. Most of them believe that the GDP growth will be between 6.25 to 6.5% in 2025. Only a mere 3% expect the growth to fall below 6%. So that's the big GDP growth forecast. So what's going to drive the GDP growth? And that's where the consensus seems to be, and that is the government spending. 77% of the respondents believe that government spending, which was a lackluster in the first half of this year, will pick up in 2025. So that's going to be the big driver as far as the GDP growth is concerned. We had a record year as far as rupee is concerned. So we asked the question as to will that be a spoil sport into 25 as well? It will be range between 85 to 87 a dollar, while a small segment expects the currency to appreciate below 85 as well going into 2025. Also, we saw a new RBI governor taking charge, and that the first policy will be in 2025. So we asked the experts what to expect in terms of RBI action. It's a divided house there. 50% believe that the first rate cut from RBI will be in the Q4 of this financial year. However, a small portion believes that the stretch line could be as late as the third quarter of FY26. So that's the RBI action. Indeed, if the RBI has to cut rates, then how much is the rate cut that the street is penciling in? Half of the respondents, which is 50%, believe that the rate cut going into 25 would be at least 50 basis points. So 50 to 75 basis points is what a lot of people are betting on. So that's the rate cut expectation going into 25. In fact, 24 was a very volatile year. We had a budget, we had general elections, multiple state elections, and so on and so on. But 25 could be a year of moderate returns, but the expectation is that the positive returns would continue going into 25 as well. That's the big poll from CNBC-TV18.
Well, the consolidation theme continued to play out in 2024, with 40 million tons of capacity folding up into the hands of Adani Cement and Ultratech. And over the years, Adani's foray into the cement space with a massive war chest has acted as a catalyst, triggering the race for capacity share, which has increased the competitive intensity. The top 5 players now account for more than 60%.
Well, we've spoken about diamonds a lot, but let's talk about gold now. And we saw the prices doing its best since 2010 and 2024 with almost 27% of gains in dollar terms. And the way rupee has been depreciating, we perhaps have better returns for the Indian investors here. But who better than ask on what is expected for 2025 than Sachin Jain? He's MD World Gold Council here in India. Sachin, hi. Wishing you a very happy 2025. What would you say on how the year is started for you? I mean, IGS clearly has had footfalls like always, but what is the trend that it's showing to you?
Thanks, Manisha. Thanks for getting me on. Wish you a very happy new year and may this one be as magical as 24. So that's I can say being from the gold. And you're right, spot on. What I see the energy here is a clear reflection of how 2024 has been what we call is the golden year in the gold business. It's been pretty strong. And I think it gets us to a perfect sort of starting point where people are buoyant, they're energetic, the strength and the confidence on gold is strong. And with what's happening in the world, we think it might not be as sort of buoyant as 24, but it's going to be stable to strong is what we are emphasizing.
So what is the sense as we went into the previous year? How much imports do you think we would have totaled for 2024?
Well, Manisha, if you go back when you and I last spoke, our projection still was between 700 to 800 tons of consumption and import. And we believe we'll still be in that facet of the consumption, which is a great sign of the economic progress of our country because we maintain that volume at, as you said, 27% higher the cost. So that's one part. Also, the other change that's happened is that with the change of custom duty, the numbers reflect the real consumption. And I think that's a great step for the nation. That's a great step for what gold really contributes to the economic fulcrum of India. And as this sets out in 2025, we're pretty confident of gold playing out as an investment product. The jewelry is great, and I can tell you when you go around the show, the innovation, the confidence in which people have been creating is great. And we will be doing, as World Gold Council, also a lot of initiatives that will be out in the market soon to bring back the life and the emotional connect of a consumer and our product.
So, there's a lot of conversation about as the budget nears on, while 9% was done, is there a review? Are we staying on that course? Will we see further cuts or is gold not going to be spoken about?
Well, our belief is that the step that the government of India took was, in my belief and our belief as World Gold Council, was a start of a long-term plan. I think they took the first step. And I think, if you look at just the direction of travel has been extremely positive to a transparent economy, to a strong India. And I don't think government will do anything against that.
Okay.
So
there's no review happening?
I believe not, and I believe that the step was not just a step to strengthen the gold market, it was a step to strengthen India. Sure. I don't see that getting reversed for sure.
Also, there's a lot of conversation about bullion getting hallmarked as well. I mean, we've seen ministers talk about that. We've seen BIS talk about they're preparing on that side as well.
Well, I think Manisha, from our perspective as World Gold Council, transparency at any stage is good for the consumer. Consumer mean whether you're a manufacturer, so you're a consumer to a bullion guy, or you're a consumer. And I think as more we get transparent, this is going to become a way of how we operate. And also the self-regulatory organization that is going to be underway called the IGS. I think it's a direction of travel where, look at last year, we had 19 IPOs in the gold business. They're more getting ready for this year. And if you combine that together, transparency is a way of life. Transparency will be beneficial for the industry and for individuals. So I think if the government is alluding towards that, I think the end goal will be good, which is that when you put your finger on it, when you have something there which comes with more confidence, it's great for everybody.
As World Gold Council, is there any representation that you have made to the Finance Minister for budget?
Well, we've been talking on various facets of things that can help us improvise and get better. And I'm amazed to see and the kind of support, the kind of interactions we've had. Particularly, I'll give you one example on digital gold, which is growing as a subject. It's easy as a product, but it's not regulated. And the fact is that we recently, on the sort of guidance of the Ministry of Commerce and Finance, we got a bit of consumer survey where actually more than 52% consumers believed that this is a regulated product. And hence, there'll be a lot of representations in that area, and we think it's a very important step that we as a country need to move towards, because younger consumers spend most of their wake-up time on the phone, and if consumption is happening through the phone, we need to make that world safe. So that's one of the examples, but there are various other ones that we've been talking to and working with the government on. And the most important one that we're working on and we initiated work is, we started a project called Swarn Udan 2047, which is to align the role of gold in the Vision 2047 of the government. So what is the role of gold in 2047? We're trying to bring together the best thinkers of the world to put together, if that's the role of gold, what is it that the industry should be ready in 2040, 2035 and today? So that's the work happening.
How are you looking at 2025 panning out in sense of demand? Because we did see investment buying, the global central bank buying was a big support to the gold price rise. ETF buying has started to pick up as well. What theme, what role do you see playing out for this year?
Well, let's break it down to India and global. So I'll talk about India first. So if you look at India, the investment borrowing coin demand is something that we've seen over 40% increase quarter by quarter. And I foresee that the interest on investment product of gold will continue. And that'll be a combination of physical gold plus ETF. So I think ETF is here. It's still very nascent product. And we believe that the highest growth we'll see this year will be on the ETF side because the numbers from a demat account perspective are growing up, how the banks and the providers are sort of pushing that area, and I think it's a very easy product to grow. That's one. I think in the jewelry space of it, where we saw first 2 quarters a bit of decline, then quarter 3 went up, quarter 4 we'll have the results now, which I'm pretty positive will be decent. I think jewelry, there'll be still a lot of innovation required to be done. Okay. So if we maintain it, prices of gold are very different than what they were from before, and that'll be one area that will sort of either sustain or slightly degrow is what I foresee.
All right, so 19 IPOs in previous year and more coming up in 2025 when it comes to jewelry as a sector. Well, that's the headline that I'll take from this one. Sachin, thank you as always for joining in and helping us take out on what really to watch out for in 2025 when it comes to gold and jewelry. But with that, that's all the time that we have on Commodity Champions. Thank you for watching.
That compares with only around 40% 7 years back. The question is, will consolidation slow down from here on? Remember, the recent deals have been concluded at around $100 per ton mark. That's closer to replacement cost. Well, ICICI Securities says that cement majors like Ambuja as well as UltraTech, they have exhausted most of their cash reserves post the recent acquisitions. They add, except for a few NCLT cases, they believe that low-cost acquisitions are largely behind. And now the potential deals may command a significant premium to the replacement cost. That could make them much more unattractive on borrowed funds at low cement prices. Well, the pain point is elevated competitive intensity has led cement prices plunging to 4-year lows. Demand as well has been plagued by general and state elections, heavy rainfall in few regions of South India, the construction ban in NCR region, and also labor unavailability in various parts of the country. But part of the street is optimistic that cement sector has hit rock bottom and it's ready to fight back. Well, Jeffrey says that dealers suggest that price declines have bottomed out and now the industry is attempting price increases every month. They believe that the recent increase in industry consolidation further supports a case of revival in cement prices. Though sustainability of the price hikes will depend on what the leaders prefer, volume or price increases. Well, Goldman says that their channel checks suggest that demand is recovering, though on a low base. With the expected pickup in government capex, rural demand is likely to improve, and urban real estate market, well, that's doing well as well. So they expect that cement demand will grow by around 7% in FY26. On the profitability aspect, well, INCRED says that lower fuel cost, improvement in volumes, that could lift EBITDA per ton by around 160 rupees on a sequential basis. Though they admit on a year-on-year basis, it will still be down by around 200 rupees per ton. Axis Capital says that cement spreads are on recovery path. It's at the highest levels we have seen since January 2024. They add that spot spreads are now 12% higher sequentially, though it's still down by close to around 5% on a year-on-year basis. So 2024 has been a brittle one, both on pricing and demand. The hope is that 2025 cement will be in far better shape and it could deliver a far steadier performance.
India is in vogue for a number of international brands this season. Surabhi Upadhyay, CNBC-TV18, Mumbai. Hello, I'm Surabhi Upadhyay and I am going to be joined by trailblazers who are transforming the banking and finance sector in India and around the world, only on CNBC-TV18.
Celebrating 25 years of CNBC-TV18.
From sharp insights in the political arena to all the excitement from the world of sports.
Well, hello and welcome. You're watching News Center with me, Ashmit Kumar. Now, it's been a wait of 16 months. In August of 2023 is when the DPDP Act had been passed by the Parliament. 16 months later, here in January of 2025, we finally have the draft DPDP rules. There's a lot to unpack as far as these rules are concerned. Firstly, the government is insistent that this is a consent-based framework. Just a bit of trivia here. If you go through the draft rules, the third most used word, the third most used noun to be specific, is in fact consent. It's been used 56 times, and that is something that the government cites for establishing how it's seeking to build about a consent-based framework. So essentially, the companies will be reaching out to you, to me, as a user, asking for my consent for personal data. That, of course, is with respect to the consent-based framework, but therein lies the rub as well. Parental consent, a new framework being introduced here. In fact, some of the comments that came from highly placed officials within the ministry, they tell us that the Indian government, the Indian establishment is taking a qualitatively different approach, whereas not to ban social media or digital entities entirely for minors, for people who are not at the age of 18, but qualitatively, the different approach being used here is that a mechanism of parental consent is being introduced. The parents will have to authorize access for their children. But the mechanics of this, how will it really work? How will that consent be sought? Is the mechanism and is the coding in the rules very clear? That is something that the industry appears to be struggling with and, in fact, has cited on multiple occasions. Then, of course, there's the question of the obligations that fall on these data fiduciaries. It's Ashwini Vaishnav, I spoke to him over the weekend. He was quite clear that he does not want a repeat of the European example. He wants a more simple playing field that does not stifle innovation. In fact, speaking of the minister, let's go across to him and let's listen to his comments heading into the draft DPDP rules.
If there is a bank account or any payment mechanism that a child is using, already there is a digital footprint available.
Sure.
So we have created a mechanism using virtual tokens and using the existing digital architecture. We should be able to have a seamless shift towards a digital compliance method in which we don't have to kind of, nobody should be required to go and say that, okay, this is my date of birth and this is, right? So all that stuff has been very well thought through and the industry has been consulted. Industry is on board on this. They believe that this structure that we have created here, where we use the existing digital architecture and we provide a verifiable parental consent framework using the existing digital architecture will work very well. And that's very important also because in today's world there's a big possibility of harm coming to children because of the exposure to a variety of platforms. So that's why it's very important that the benefits continue to accrue while the harms can be prevented.
Well, that was the Minister of Electronics and IT, Mr. Ashwini Vaishnav, in an exclusive conversation with CNBC-TV18. But let's move forward with unpacking this entire conversation around the DPDP rules. To take this discussion ahead, I'm now joined by Aparajita Bharti, the founding partner of the Quantum Hub, as well as Mayuran Palanisamy of Deloitte India. Thank you so much for joining us. To both of our panelists, Ms. Bharti, let me come to you first. The word that the government is clearly stressing on is that, look, we have a consent-based framework. There's no denying that. There is a consent-based mechanism that has been introduced. What will it look like in the weeks and months to come? Are we expecting a number of notifications that will give me an accept versus decline option on granting consent for personal use? How does this look in reality?
Hi, Ashmit. Thank you so much for inviting me and a good start to the new year for all of us who have been waiting for the DPDP rules since 1.5 years now. I think, yes, the framework that we have in the DPDP Act is a consent-based mechanism. That is the only basis on which data can be processed for data principles. I think, however, the minister has also said that, there will be an implementation timeline of 2 years because this is a big shift for the industry. Every MSME, every big company, every company of every size now is a data fiduciary, and they need to have systems in place to be able to implement these rules once they are notified. And these rules are also still under discussion. So I think we still have some time till we start seeing the effects of this in our daily life as users. But I think the industry has already started preparing for some of the simple things like consent, notice, etc. However, how they will exactly do will be on the basis of the rules that are finally notified, which are still under discussion, and we have time till 18th February to give feedback to the government. Speaking of rules, as you had mentioned, Ashmit, I think it's important that the industry gets an indication of how the government is thinking about implementing, and I think it's a two-way process. Because some of the things that the government has proposed now will be discussed by product teams internally on how the data flows will be, what will be the cost of compliance, where is it likely going to cause operational issues, and on that basis the feedback will be given to the government. And the government actually has been very open in listening to the industry, in engaging with the industry to understand operational challenges. And I think in all the meetings, it has been very clear that innovation is paramount and it has to be balanced with concerns of privacy. And in that sense,
Indeed,
we have
in fact,
a much balanced approach.
Indeed. In fact, that was a concern that even the minister had put across, that they do not want a repeat of the European example. India does not need stifling of innovation. But let's take this conversation across to Mr. Palanisamy as well, who's joining us. Mr. Palanisamy, the next question I want to ask you is with respect to one of the issues that was flagged here with respect to consent. We were talking about how this will look like going forward. Parental consent is already an issue where the industry is beginning to voice some concerns. There are some obvious loopholes that have been pointed out. For instance, there is no rule where it's been codified how the age that is being determined, that is being given by a child, will be verified. There is no mechanism for that as far as these rules are concerned. Then, of course, is the bigger challenge of implementing this mechanism of parental consent. What is the kind of conversations within the public policy rooms of companies as they look at parental consent and implementing that over the next 2 years?
Ashmit, hi. Very good evening. Prajita, good evening to you as well. And a very good evening to all the viewers of CNBC-TV18. Yeah, I think regarding the verifiable parental consent, right, Ashmit, this is in a fairly early stage. This was a little bit of surprise because we all knew that government will propose some sort of solution around it, but verifiable parental consent came as something fairly new, right? But as I think Minister also alluded in your conversation, right, I would say this is a very, very critical one, considering the safety of children, right? We all know that there is a fair amount of data being accessed and shared by children in online these days, right? So it is very, very important for us to kind of have a mechanism put in place for that. Coming to the side of the organizations, yes, we'll have to think about how do we make it practical, right? So this is where the verifiable tokenization, all those becomes a very critical one. I believe that whatever the existing digital infrastructure government has established, I believe that we would be leveraging on that largely, or the organization may be leveraging on that to kind of do this implementation, right? That's my initial thought, Ashmit.
Interesting. In fact, the comments that are coming out from the ministry is that they're taking a qualitatively different approach from what has been followed, for instance, in Australia, where there's a total ban on social media for minors. So they're taking a different approach. They're experimenting with something new, seeking the industry's feedback. Let's come back to another point that Ms. Bharti, you had raised with respect to the compliance burden. When we look at the compliances, there's a requirement of a data protection officer, the requirement for reasonable security measures that need to be deployed, a grievance redressal system. What does that do for a smaller entity, a smaller company, a startup with only about 15, 20 employees? How does this burden them? Or is this already a common industry practice that should not be an issue over the next 2 years?
Ashmit, I think this is a very good question. And actually, every law creates some kind of compliance burden on businesses. And of course, if you run a smaller business, then the cost is higher as compared to what your overall revenue is. And it's an added burden. So I think with the DPDPA also, there will be definitely some compliance burden that will be added on MSMEs. But I do think, and I want to go back to the parental consent point also. I think what will happen is that this law will lead to a lot of innovation as well on how to handle data and consent and parental consent. And we will see a lot of innovation in tech tools that will help businesses manage all these obligations that are there under the law. We are already seeing in other countries a lot of age estimation, age verification tools have been deployed. There are also accreditation systems which certify whether an age estimation tool is actually good or bad. So we do foresee that there will be a lot of innovation even in India, which will eventually then become just off the shelf, tools that you have to integrate with your website, with your app, etc. There will be some cost of it. Some cost is actually inevitable with every law. However, I do think that some of the things like retaining, records for 1 year under reasonable security measures, maybe they can be relooked at because that leads to higher costs. But some costs are inevitable. And I do think that there will be a lot of innovation on how to make it easier for MSMEs in the coming years.
It's interesting you speak of innovation. Mr. Palanisamy, let me come to you. One word that is being spoken of in context of innovation has been AI. I just want to understand a few loopholes here, if any, as far as these rules are concerned. There's an exemption that is provided for research companies. Is that exemption then available to a large entity, a global tech player such as a Google or a Meta or an Amazon to use the data, personal data, for training of AI models? Is that something that can be done under the current provisions?
So, Ashmit, I will not interpret it that way, right? It clearly says that it's for research, education, and statistics purposes, right? It doesn't mean that the large organizations who are largely leveraging on AI are exempted from this, right? But what is that most of the organizations who are embarking into the AI journey should keep in mind is that while we are talking about data protection regulation now, it's a matter of time we'll talk about AI regulations, right? So, I mean, what are the data which goes into the AI has to be taken care by the organization. That's a responsibility of any organization, right? So I think this is going to be a little bit of, I would say that in future is going to be a little bit of challenge for organizations if you're assuming that AI is being exempted from this particular regulation, right? If you ask me that, I'll not take that approach. I'll be a little more careful in terms of data which is going into AI and obviously look for other regulations which is going to come in.
Sure. We're running out of time. Ms. Bharti, let me come to you for a final comment. And this is on one key issue, which is exemption that has been provided to the government. All government entities that provide a subsidy, a benefit, a license or a permit are exempt from this act, are exempt from these rules, which basically means that a large chunk of public-facing government entities will not have to comply and need not bother with DPDP. Is that a concern for you going forward?
I think, Ashwin, that is a concern because right to privacy is not just a right against the industry. It is also a right against the state itself. And I think the problem is not so much with the rules. The problem was with the act itself where, the exemptions to the government were very wide. And the rules are just operationalizing those exemptions. So I think the problem is with the act itself in that sense that there are not too many safeguards in terms of government acting as a data fiduciary and following all the other rules that apply to other data fiduciaries as well. The second thing is that another power that has been given to the government is to call for information from data fiduciary or intermediary, which is in the rules itself, which also does not have too many safeguards. And there is no way that an entity can say that if you ask me this information, I don't want to produce this information, or please tell me the purpose for it, which I think also needs to be looked at, and some safeguards need to be built in that.
Right, Ms. Bharti. Mr. Palanisamy, thank you so much for joining us, giving us more color. It's only been 48 hours since we had the rules with us. So clearly a lot to unpack there. We'll, of course, continue these conversations going forward. With that, we're heading into a very short break. But coming up on the other side, we take stock of the data protection rules with the Electronics and IT Minister himself, Mr. Ashwini Vaishnaw, who has led the charge for the new rules. On the other side, stay tuned.
We are here at the CNBC-TV18
budget headquarters as we've done for the last 25 years.
Celebrating 25 years of CNBC-TV18.
The markets are betting big on affordable housing. You look at the kind of stocks that have risen.
We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating 25 years of CNBC-TV18.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship. Celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC TV18 and CNBC-TV18.com. CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every
Welcome back to News Center. Now, Electronics and IT Minister Ashwini Vaishnav has said that the industry will have 2 years' time to comply with the Digital Data Protection Act and the rules. Now, speaking to me earlier over the weekend, the minister also said that India does not need data protection laws similar to Europe, which he says are stifling competition and innovation.
When this law was presented to the Parliament in November 2023, we had very clearly promised that it will be digital implementation. Sure. It will be completely digital by design. So in the last 1 year or so, despite the elections being there, general elections being there, we have worked very meticulously to create a completely digital portal, digital workflow, digital processes, so that when we finally start implementing this law, the entire data protection board will be fully digital by design first. Second, as you are aware, this is a very pragmatic approach towards data protection, and we have made sure that the balance between innovation and regulation, we have a huge innovation economy, right? Huge, large innovation startup ecosystem. And we have to make sure that citizens' rights are protected with full fervor, full confidence. So that's why we have created this structure where the innovation and regulation is properly balanced.
Okay. Let me ask a follow-up question then. When you talk about balancing the rights as well as the obligations, you talked about a completely digital framework. I was going through the rules. Interesting bit that I think DPB will be the first board which will operate virtually, with the chairperson and the members connecting virtually as well. So let's take this next logical question in terms of what does this do as far as obligations of data fiduciaries or companies collecting data is concerned? What does it mean for them? What are the obligations they're now looking at?
The obligations on the data fiduciaries are very well established as per the principles set out in the Honorable Supreme Court's judgment regarding consent, regarding purpose. All those obligations are properly set in the law, and the rules basically implement those. Like the law, the rules are also very simple in language. Very clear examples, illustrations are given everywhere. We have made sure that, as I said, in a very pragmatic way, we have made sure that we have not made everything very prescriptive. We have kept, because digital technology doesn't stand, right? It evolves every week. Every week there is a new thing which happens. So the law should be able to catch up with those developments. So that's why we have set the principles in the law and the rules, and the actual practice, the actual prescriptive, which whether to go to left, go to right, or how many steps to take, all that thing is part of the execution, and that's a very good framework which we have set. And we believe, we understand from whatever we have heard from our international counterparts and all, the compliance burden which happened in Europe and which killed the entire innovation ecosystem, which kind of damaged the innovation ecosystem in a very big way, that will not happen. Our innovation ecosystem will continue to grow with a proper legal framework.
Which is the next question that I had in mind. You make a reference to the compliance burden. We're looking at a situation where a company is required to have a data protection officer. There are requirements in terms of security requirements, reasonable security requirements that they're required to deploy, requirements with respect to storage and then processing of data. What does this do in terms of compliance, especially for some of the smaller entities that startups, innovation ecosystem that are collecting data?
Most of these things are today standard practice in the industry. For example, all the compliances, all the obligations that we have set, our interaction with the industry clearly indicates that people are fully prepared for implementing this. And we have given enough time, and we have interacted very closely with the industry in a very collaborative manner, so that there shouldn't be any disruption because of this law, right? So we have made sure that people are prepared, they come up to this level, and despite that we'll be giving a very reasonable time frame for people to give the final compliance.
One additional question, sir, one new aspect that we've seen has been from the perspective of data localization. There is now a provision in the rules which allows for the government to prescribe what kinds of data can travel overseas and which are required to be...
So there is no difference between the Act and the rules.
Sure.
The Act itself in the section 16 very clearly said that wherever required, see, we studied the best practices in the world, and we said wherever data is getting transferred to a trusted geography, where the other side is also taking the same precautions and the same safeguards that we would have taken, right? And then we said that if there is a particular sector, that sector requires data localization. For example, even today, Reserve Bank of India requires that the payment data should be localized fully. So we maintain that structure, which is a very flexible structure, and we have, to prevent any sudden disruption by any particular sectoral regulator, we have created a committee mechanism so that there is a proper consultation before any sector wants to impose a set of restrictions.
So essentially there is that window for the regulatory mechanism of a specific sector to prescribe what forms of data are to be localized. You use the RBI example.
That is there in this rule in the Act, section 16 already in the Act, and I think that's a very pragmatic way of looking at things rather than fully having a kind of one brush paints all kind of thing. It's a very pragmatic way of looking.
Just a couple more questions, sir. At the very outset, you began by telling us how this is a completely digital framework. The Data Protection Board, I think one interesting bit that falls was, of course, like I was pointing out, that this will operate entirely virtually. Chairman members will conduct meetings virtually. Just give us a sense, what does this translate into in terms of functioning of the DPB? How will it work? And where can the orders of the DPB be appealed? Is there an appellate tribunal framework?
That's a very clear framework prescribed of multiple levels, so that the citizens' rights can be implemented without going through a very cumbersome legal process, right? So it will be a totally new way of working. We have had examples of digital implementation, various things in the last 10 years. Honorable Prime Minister has implemented Digital India as a part of every sector, right? So learning from all that has been implemented so far, this new digital by design, right from beginning, everything being digital, right from lodging a complaint to getting a hearing to making sure that the data fiduciaries give their response to the final order, then the appeal mechanism, everything is digital by design. And it's very well thought through. There is also a provision of voluntary undertaking, which means if somebody understands that it has caused a problem, it has violated the provisions of the law, that person, that firm, that company can go to the Data Protection Board and say that, okay, we made this mistake, so then it can be treated in a totally different way. So all those things are very well thought through.
One final question, sir. This one is with respect to government entities collecting data. I'll just ask a twofold question. Number one, as far as exemptions are concerned, exemptions are provided for the government services being provided, government subsidies, benefits, or licenses and permits being provided. Will that not cover a large chunk of the government functioning as a whole? Number one.
See, the government is also equally obligated to protect citizens' privacy.
Sure.
And most of the provisions of this act, they are applicable to every data fiduciary, right? Regarding the, if a particular person has applied for one set of service, right? Isn't it proper that the person shouldn't be required to do the same set of submissions for another set of services, right? That's the ease of living,
sure,
right? So that is the thought process when we say that if a government department wants to basically use the data which has been provided for one service and the citizen says that it's fine, I would like to access the other service also. So that's the thought process behind this.
Wonderful, sir. And what does this transition window look like? You said there will be generous time. There's a 2 year.
About 2 years, but most of the industry is already prepared for it.
Well, from one union minister to another, the government launched the second round of PLI scheme for the steel sector. Parikshit Luthra spoke to Nodal Minister H.D. Kumaraswamy. For more, take a look.
Second lay of 1.1 scheme, some lacuna, all those things our ministry, what they have taken for the consideration, and some guidelines they have already changed in this 1.1 program in PLI scheme. In this actually out of 6,000, around 6,000 crore in 1.0 time actually what PLI incentive we actually decided to distribute, more than 4,000 crores still it is with the ministry in that PLI scheme. That amount is there. By involving by today's what we open the application, they can participate in this and they can utilize this PLI scheme to strengthen the growth of the steel ministry.
So the focus will be on specialty steel and electrical steel, is that correct?
No, that is the specialty steel and electrical steel. The word is there, but up till now, that proper actually what is the background, nobody has explained up till now. But they are working out in this.
Well, with that, it's a wrap on this edition of News Center. For more news and updates, keep watching CNBC-TV18.
YouTube with me, Shireen Bhat.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
Well, it was in July 2023 where ITC first announced this alternate structure. So after a long drawn process, today is finally the record date for ITC Hotels demerger. ITC in July 2023 announced an alternative structure for the hotel business wherein the company would own 40% in the business by itself and the remaining 60% would be held by shareholders via an entitlement swap for which each shareholder will get one ITC hotel share for every 10 shares that they hold. The ITC hotel business, does it list today? No, that lists in mid-February, but today ITC will go X the hotel business. Of its total business, the hotel business has 4% revenue, 2.5% EBIT, but more importantly, 14% of assets, which makes this demerger ROCE accretive for the parent company, which will be listed today. For the resultant company, that is ITC Hotels, currently has 140 hotels, around 13,000 keys, 55% properties are managed with 69% occupancy. The important part is their stated target, 200 plus hotels with 18,000 keys by 2030, with 65% salience coming in from the managed portfolio. ITC Hotel financials reflect the underlying improvement in the hotel industry as well. Post-pandemic, over the last few years, we've seen growth. And in the first half of this year itself, ITC Hotels revenue has been around 1,500 crores with operating margins of around 28%. Remember, in the hotel business, we have the second half, which is more margin accretive than the first half itself. If you look at the balance sheet and the opportunity as well for ITC hotel business, remember 52% of the business revenue comes in from rooms, 40% from F&B. There's a strong opportunity in the hotel business with zero debt, cash balance of 1,500 crores, and only 20% of their inventory is currently operating at 75% of potential occupancy. So that is telling you that there is room for operating leverage as well. They're also looking at value accretive M&A.
We are kicking off 2025 with one of our favorite themes or shows, the Brain Trust shows. And today we have the Brain Trust of the Kotak Group. As I told you, we have with us Shanti Kapram, Deputy Managing Director at Kotak Mahindra Bank, Sanjeev Prasad, Managing Director and Co-Head at Kotak Institutional Equities, and Sri Srinivasan, Managing Director at Kotak Alternate Asset Managers. Gentlemen and Shanti, thank you very much. And from all of us here in the newsroom and working behind cameras, a very happy new year to all of you, your families and everyone at Kotak. Okay, let me start with perhaps my favorite, banking. Shanti, first to you. How do you see the banking sector? Do you think that the war for deposits that we saw continues? Changing of the calendar, tearing that page is not going to make a big difference. We're going to continue to see pressure on liquidity, pressure on raising deposits, pressure on margins. Will that be the theme, at least in the first half?
So, Lata, if I take the last 2 quarters or even 3 quarters so far, you've seen deposit rates have been reasonably stable. You've not seen them sort of spike or have a runaway as far as the deposit rates are concerned. 2 factors to it. I think the system liquidity was fairly reasonable. And 2, it is a fact that there has been some moderation on the credit side as well. So banks have been able to raise deposit, but the cost of deposit that you asked and the rates have been reasonably stable. And I expect as we get into 2025, this will continue. Ultimately, it is a demand-supply ratio. Right now, it seems reasonably balanced. We have to see how economic growth happens, how demand for credit takes off, which we have seen some moderation in, and that will determine the trajectory of deposit rates. As I see it right now, stable.
Stable. So margins could continue to be under pressure, or that pressure is off?
So it's like this. Margins are a function of your lending and your cost of funding. It is not just the cost of deposit. It's also the mix of your lending, right? And I think if you look at an industry level, the mix of unsecured retail has come down. The mix of SME and some amount of corporate has come up. But banks will devise ways to see how they can sort of keep their names reasonably stable. So expect some stability and maybe some marginal reduction at the industry level on NIMs.
Okay. Point taken. I'll come back to you on this unsecured bit, which has become a theme in itself. But before that, Sanjeev, to you, I mean, I read your 2025 note, and you have been worried about urban consumption and the general slowdown. Does the December auto sales kind of ameliorate the picture a bit? After all, we did see the small car come back in the Maruti sales numbers. So perhaps the urban consumption slowdown is not all that bad and things are plateauing, no?
Well, we'll have to wait and see, because it's obviously only 1 month that we have seen this number. Also, keep in mind the fact that if you look at two-wheeler sales, numbers have been very, very bad, actually. This looks like somewhere about low teens kind of a decline in numbers. So if you look at Bajaj Auto, was down 19%, it was down about 17%, which is quite surprising. Having said that, December is not a very big month for auto sales, so obviously there will be a lot of variation depending on what happened in the base month. On Maruti specifically, the hatchback segment volumes are very low in December 2023, somewhere about 2,600 units only. And that was something like a 74% decline from the December 22 month. So I don't know whether I need to really get excited about this big increase. We have seen almost 12% increase in volumes in December 24 versus December 23, or I need to look at the fact that December 24 versus December 22 actually still a decline. So I would rather wait and see how volumes play out over the next few months before taking a more decisive view on this point. Having said that, the commentary from companies, whatever pre-result, releases have come out, seems to suggest that at least things are getting better compared to September quarter. September quarter was a complete washout. If you recollect, whether it was rural, urban, everything looked very, very bad. At least this time around, you saw the press release from DMart. At least looks like some recovery seems to be there. Again, we'll have to wait and see whether this is for real, how long it sustains, and so on and so forth. But at least as of now, things seem to be better than the September quarter.
So what are your earnings growth expectations for FY25 and 26? I mean, either Nifty or your universe.
Yeah. So for Nifty, if you look at it, it's going to be very bad year for 2025. It's only 4.5% growth. But keep that in the context of the fact that you had very high numbers of BPCL in the previous year. You had some accounting change in Coal India, which boosted its numbers in FY 2024. So if you strip that aside, that is remove BPCL and coal from the base, then you are looking at somewhere about 10% growth for the Nifty 50 for 2025. For 2026, as of now, we have about 16% growth, both on a reported basis, including BPCL and coal. And even without those two companies, also it seems like a similar 16% kind of a number. Obviously, we'll have to wait and see whether we see some money downward as we go through the year, because that's been a typical situation, right? And every year we start somewhat on the higher side, and then numbers start coming down. So as of now, we could be in a golden period of earnings, in the sense people have stopped bothering about 2025 numbers. Even if they're downgrades, people don't care. But people have still not started to cut 2026 numbers. Hopefully that would be the case, but let's see. I'm reasonably okay with 26 numbers forecast for now, given the fact that a lot of growth is actually coming from banks, IT, etc., where we are a lot more comfortable with our earnings forecasts.
Big question, how do you value this business, right? So for that, you have to look at projections. Given the recent history and the numbers that we have, FY25 could be close to 3,700 crores in revenues, FY26 4,400 crores with EBITDA of close to around 1,500 crores itself. And if you look at all the other listed hotel companies right now and their multiples, Indian Hotels is at 37 times, Chalet Hotels 25 times, the others between 17 and 18. My guess is ITC would settle between 25 and 37, closer to 26 and 28. And that means a market value of the ITC Hotels business between 36,000 to 39,000 odd crores. But remember, this is the entire hotels business. 40% will be held by ITC, on which a holding company discount would be there. And the remaining 60% could be between 22 to 24,000 crores. What happens to the ITC hotel listing? Whenever that lists, the shares could be worth 175 to 190. But today, the important part is the ITC share could adjust by around 17 to 19 odd rupees as the business goes ex-hotel business.
An analysis of election affidavits carried out by two independent non-profits has revealed that Andhra Pradesh Chief Minister Chandrababu Naidu may well be India's richest Chief Minister, and by a whopping margin at that. Recent surveys conducted by two independent organizations, that's the Association for Democratic Reforms or ADR and the National Election Watch or NEW, has pegged Naidu's declared assets at around 931 crore rupees. That's just shy of nearly 3 times the second place name on that list, and that's Arunachal Pradesh Chief Minister Pema Khandu, whose assets come to around 332 crore rupees. In fact, both Naidu and Khandu top this list of India's richest chief ministers. In fact, both these organizations surveyed chief ministers belonging to 31 states whose total cumulative assets came to around 1,630 crore rupees. That's an average of 52.59 crore rupees per chief minister. But remember, this average number is largely buoyed by the large assets declared by both Naidu and Khandu. Incidentally, the South isn't too far off when it comes to the upper echelons of this list. Karnataka's Siddaramaiah has declared assets of 51 crore rupees and is third place on this list. But remember, this number is still short of that average value of 52.59 crore rupees per chief minister. The quote-unquote poorest chief minister on this list is West Bengal's Mamata Banerjee with assets of just about 15 lakh rupees, while the third poorest name on this list is again from the south, that's Kerala's Pinarayi Vijayan with assets of just about 1.18 crore rupees. However, the south continues to find dubious mention as far as this list is concerned. The most number of criminal cases lodged for a chief minister belongs to Telangana's Revant Reddy with 89 criminal cases against his name. The second place name on that list is also from the south, that's Tamil Nadu's M.K. Stalin with 47 criminal cases against him. This, remember, is as per the studies conducted by both ADR and NEW. When it comes to liabilities, the south again isn't too far off as far as the upper levels of this list is concerned. While the total number of liabilities or the largest liabilities per chief minister belongs to Arunachal's Khandu at about 180 crore rupees, both Siddaramaiah and Chandrababu Naidu continue to figure on the top of this list. In fact, Siddaramaiah accounts for 23 crore rupees worth of liabilities, while Chandrababu Naidu's liabilities come in at about 10.
First question to you, Srini. This IPO, actually, people made a lot of money. There was a money control story which actually did the calculation. I think about 60% are still trading at a premium. So does the Diwali in IPO continue and investors will make money, you think?
Well, I think, if you look at the liquidity in the market, and as Sanjeev was mentioning earlier, people are discounting further and further out and ignoring the numbers for the short term. What we are also seeing is that there are new categories of companies which are coming into the market, and the inclusion of companies like Zomato in the index just tells you that the composition of how the market will look like over the next couple of years is changing. So all of these new service-oriented companies or the new age companies, those which have achieved scale and who are now showing a trajectory of bringing down their burn, obviously having a positive rub-off effect on all other industries as well. So once people make money in the IPO market, the party will last as long as some other disaster doesn't strike. And right now we don't see a disaster around the corner, so maybe it will continue.
Okay, well, Shanti, let me come to the core problem that banks have faced. Up until 2013-15, we used to think of banks as lending to corporates, but that NPA blow up made everyone come to retail. Otherwise, you used to think, HDFC Bank, ICICI Bank gave some retail loans. But now all PSU banks and then fintechs, everyone is only retail. And that explains why perhaps now we are starting to see over-lending, unsecured loan problems, MFI loan problems. How do you see that getting resolved? Do you think corporates are back in the game? And specifically for Kotak itself, do you think the unsecured issue is behind?
So let's look at the industry level. If you look at banks, Lata, they were always diversified. You had, corporate, what I call commercial credit, as well as retail credit. Commercial credit is really, including commercial vehicles, tractors, agriculture, and the like, etc. So when the demand for loan, you also have to look at where the demand for credit has come in the last 5 years, particularly post-COVID. Post-COVID, you saw the demand surge from consumption, urban consumption, exactly what you mentioned, that you're seeing some plateauing effect. This saw a surge, whether it was buying a property, whether it's buying cars, whether it is lifestyle, whether it's credit cards, etc. You saw a huge surge. So wherever there was an opportunity, I think banks and NBFCs and fintech, right? So banks, I would say, have a reasonably diversified portfolio. If you just talk about us, our unsecured retail is now just marginally below 10%, around 10%. So banks have a diversified retail portfolio. Retail, corporate, commercial. I think what you have to see is some of the fintech players focused only on the unsecured retail, and some of the smaller NBFCs moved towards that. So I think much has been said and written on it. You had the RBI warning, but if you actually see the growth in the last 2 quarters, and I was reading the RBI numbers, etc., it has come off in a big way at an industry level, right? From over 30-35% to now almost 10-15%. So I think that's where it is. As far as corporate is concerned, are you seeing very big capex happening? No. But I think you do see certain sector investments, whether it's renewable energy, whether it's data centers, whether it's adding to capacity, which I call brownfield. So some amount of capex is happening. There's a lot happening in the mid-market and the SME sector where they are building for capacity. So I think there is opportunity across all the 3 segments. Retail has led the surge because of the consumption. As consumption, moderates, as we see, I wouldn't call it this thing as plateaus. You will see an equal focus across. And ultimately, it depends upon what rates, because it has to be win.
Absolutely. Wishing all 3 of you a very happy new year. Prashant this side. Sanjeev, if I can come to you, Shanti mentioned data centers, renewables. I mean, I'm just taking off that and sort of building on that. We've discussed and you've illustrated with the specific examples on power as a sector, some of the absurd valuations at which stocks are trading at. But it's a space, you're smiling, and we've had this conversation many times in the past. But in 25, Sanjeev, is it, since earnings growth is going to be tough to come by, will even slower earnings growth get stocks to move? I mean, 10% plus kind of earnings growth, will it be enough? And which areas you think, Sanjeev, where you think one can still find opportunities?
You go by valuations, and that's where the struggle really starts. It's not as if we are debating the growth prospects of the economy. I mean, we are still looking at 6% for next financial year, inflation coming down. So the macroeconomic fundamentals seem to be in reasonably good shape, I would say. The challenges are, the first is the starting point of valuations. Valuations have stayed high, despite the fact that you had a pretty stagnant market, I would say, for the last 6 months. What has happened, unfortunately, we have seen a lot of earning downgrade in some of the consumption-related sectors, which means the valuations have not really come up. Most of the, if you look at the consumer staple names, most of them are north of 45p even now, despite very, very abysmal top line and bottom line growth as of now. So obviously, investors are still hoping that at some point in time you will see some recovery in rural demand, urban consumption, and so on and so forth. But the signs are still challenging, I would say. So consumption for me is ruled out for the time being, very expensive with not so great fundamentals. If you look at the investment part of the market, slightly more exciting stuff happening over there. Actually, the investment cycle is doing quite okay. If I look at government capex, I think 2026 should see a big recovery compared to 2025. For the simple reason, 2025, the government simply did not have enough time to spend the money. I mean, the first 4 months spent in elections, formation of government, and so on and so forth. Capex number is down 12% in the first 8 months. And the government space seems to be in decent shape. So hopefully 2026, we will see a decent recovery in capex. Thankfully, residential real estate demand continues to do pretty well. And that's one part we are still quite positive about. If you look at the outsourcing sector, which is IT and pharmaceuticals, we are okay on both. Obviously, both benefit from weaker currency and so on and so forth. We'll have to wait and see if any of the policies of the incoming administration in the US are positive or negative. Hopefully, neutral to positive. Let's see, how things pan out. Valuations are high over there. If you look at the pharmaceutical sector, stocks gone up a lot in the last 6-9 months. but I can live with that. At least the company are showing pretty decent top line growth as also bottom line growth. Which brings us back to the banks and NBFCs. The valuations are very reasonable. Shanti talked about some of the issues over there, but I don't know whether that's enough to result to the kind of punishment we have seen for the banks in general over the last 2-3 years. A lot of derating has happened, and assuming that you don't see further bad news on the NPL side, at least most of the banks are doing now 13-15% ROE, whether it's a PSU bank or a private bank, most are in that range. So I am hoping for ROE linked return for the banks in general. I'm ruling out any rating for the time being. If we get a rating also on top of that, well and good. But as long as the book is growing at ROE, and that's the return to expect, I would assume, for the banking sector. So that's how I would summarize our positioning on the market for now.
Well, Srini, can you round up how private equity might work? I mean, after all, the US is a big magnet now with dollar and rates in favor of US exceptionalism. Will money come in? And, actually, you all have been filling the gap which banks are lending to corporates. Private credit is lending, but Reserve Bank warned that, the NBFC connect with private credit can mean that some of the loans are just getting bad loans are just getting kicked. The can is getting kicked. So just tell us, will it be a good year of private credit? Will Indian alternate assets find more takers?
Well, I think if you see, there are three parts to it. You started the question with private equity. I think most of the private equity folks are focused on getting exits, and new allocations are hard to come by. First of all, on account of the LPs not getting enough money back, and India is the only exception, really speaking, where people are able to get exits, and sizable exits at that, thanks to the public equity markets that's been doing very well. On the private credit side, I think Shanti and Sanjeev alluded to that earlier in terms of credit growth. A lot of the credit growth is happening on, infrastructure, in renewables, and some of the newer sectors where maybe some of the banks are a little wary of, having large extension. And we are seeing some structured transactions that we can put capital out to. And many of the private credit market players right now, which is now getting a little crowded because while capital was not available globally because of attractive US dollar returns for US investors, a lot of capital is being raised from the domestic market. So what I do see going forward is that while the private credit market will continue to grow at a healthy clip, there could be situations perhaps 2 or 3 quarters down the road where excess capital or some kind of mispricing of risk is likely to happen, perhaps in the September-December quarter of this year. So while private credit is going to be a good place to be putting your capital to work, you just have to be careful in terms of who you put the capital to work with. I think the other thing that we see a very significant positive coming out of where we are is, I think Sanjeev alluded to residential real estate. We also see very significant opportunity from an investor point of view on the office asset class. There isn't enough build of office space going on, and the global capital centers are actually ramping up capacity utilization. And that means that you are going to have reasonably tight office markets. And those who are in Mumbai already know that rents have shot up significantly and not enough supply coming in right now. So I would say all in all, it will be a year in which you should be possibly thinking of allocation to non-equity assets at this point in time, be that credit or hard assets, and there will be pockets of opportunity. Government and asset owners of infrastructure assets will have to recycle their assets, which means sell stabilized assets to build new assets. And the new bids on solar, for example, which are actually more attractive than actually buying an existing solar platform. So there is going to be a fair amount of churn in terms of solar platforms being available for sale. So it's going to be interesting opportunities to earn good annuity risk-adjusted returns, as well as when you have the appetite for higher risk to get into high-yield credit strategies. So overall, while capital raising is still going to be a challenge, so one is going to be relying more on the domestic capital base to raise even alternative capital as opposed to international capital. That's the way I would sort of sum it up.
Okay, that's an excellent wrap of a very vast topic. Thank you very much, Srini, Sanjeev and Shanti. Unfortunately, out of time, not out of questions, but we do hope all of you and everyone at Kotak have a brilliant 2025.
countdown for the Mahakumbh Mela 2025 has begun. It is just a few days away. Devotees see this as a once-in-a-lifetime chance to bathe in the holy waters of what is called the Triveni Sangam, where the rivers Ganga, Yamuna and the Saraswati meet. The holy event starts from the 13th of January and will last till the 26th of February. About 450 million people from India and abroad are expected to flock to Prayagraj, which is the spiritual heart of India. This isn't just any regular event. The Mahakumbh only happens once every 144 years. It is the culmination of 12 Purna Kumbhs that happen every 12 years. The Ardha Kumbh happens every 6 years. The Purna Kumbh is organized in 4 holy places: Prayagraj, Haridwar, Ujjain and Nashik. As demand for travel is expected to go up, airlines are going all out to launch flights to Prayagraj from different destinations in the country. The airport authority says there are 20 new flight connections exclusively for Prayagraj for the Mahakumbh. Indigo has launched flights from Ahmedabad, Kolkata and Bengaluru, while SpiceJet is connecting Delhi, Mumbai, Bengaluru and Ahmedabad. Limited flights means devotees will have to pay more for airfares. For instance, a one-way ticket from Mumbai to Prayagraj on the 12th of January is nearly 30,000 rupees. Then Bengaluru to Prayagraj on the 11th of January will cost over 22,000 rupees. The Prayagraj airport is also stepping up its game. The existing terminal is being revamped and a new terminal is being developed to together handle about 2,700 passengers at peak hours. Staying in hotels will also be an expensive affair, with room rates per night soaring to as high as 40,000 rupees. The state is spending a whopping 5,496 crores for this event, a lot more than what it spent in 2019. The government has allocated 4,000 hectares of land for the Mahakumbh 2025, which is double than over 1,900 hectares of land allocated in the Purna Kumbh of 2013. Over 1,50,000 tents and 20...
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening: a sharp sell-off on the Lal Street as the Sensex and the Nifty end at the low point of the day. Mid-cap see deeper cuts. All sectoral indices close in the red. The rupee sinks to a new low against the dollar. ITC shares trade excluding its hotels business. The stock opens 26 rupees below Friday's closing price. ITC Hotels is expected to list by the middle of February, with shareholders getting 1 share of the hotel business for every 10 shares of ITC. Union Minister Ashwini Vaishnaw defends the proposed law requiring parental consent for those below the age of 18 to access social media and e-commerce platforms. Industry will get 2 years to comply with new rules. Minister adds India does not need data protection laws similar to Europe, which he says is stifling competition. The government will launch the second round of PLI scheme for the steel sector. Sources say the total outlay would be around 4,300 crore rupees. The new tranche would lay greater emphasis on manufacturing of specialty steel and electrical steel. Finance Ministry approves an outlay of 25,000 crore rupees for a PLI scheme to promote domestic electronic component manufacturing. Sources say the scheme will be announced in the budget and could attract investments of over 45,000 crores. The electronic component industry had sought an outlay of 40,000 crores. Finance Minister Nirmala Sitharaman meets trade unions as pre-budget consultations continue. Also meet representatives from infra and energy sectors in the 9th round of meetings ahead of the budget. At least 8 security personnel and a driver were killed after a police vehicle came under attack by suspected Maoists in Chhattisgarh's Bijapur district. Police say an improvised explosive device was used to blow up the vehicle. Police claim to have arrested the key accused in the murder of 32-year-old journalist Mukesh Chandrakar in Chhattisgarh's Bastar district. Chandrakar had reported on the alleged nexus between the administration and criminals through his YouTube channel called Bastar Junction. The Union Health Ministry says there is no link between cases of HMPV virus detected in Bengaluru and the infections reported in China. 2 infants in Bengaluru have no travel history. 1 infant is recovered and has been discharged, and another is recovering as per health officials. BJP targets Arvind Kejriwal after a CAG report shows the cost of building the official residence of the Delhi Chief Minister went up from the initial estimate of under 8 crore rupees to more than 33 crore rupees. AAP terms the allegations a diversionary tactic ahead of the elections. Canadian Prime Minister Justin Trudeau is likely to step down ahead of the scheduled vote of no confidence later this month. His party fell into a minority after a key ally withdrew support last month. Well, let's start with the market action. It turned out to be a manic Monday on the Lal Street. The Sensex lost over 1,200 points, dropping below 80,000, and the Nifty lost nearly 400 points in what was broad-based sell-off that we saw today. So that's the story for the Nifty, down almost 400 points, 1.5% lower. The Sensex losing 1.5%, 1,258 points lower, 1,500 gone on the mid-cap index, and the Nifty Bank also losing about 2%, a cut of 1,000 points there. So across the board, as we were pointing out, selling pressure this afternoon. Surabhi standing by now to wrap up the market action. Surabhi, a bad start to the week, no other way of putting it. What are the triggers, the factors that the market is dealing with?
Well, it was quite a manic Monday on the street, with the Nifty actually having a trending down day. And why just the Nifty? The entire market. There was just no looking back. The selling started right from the word go at 9:15, and it just kept tumbling down. The fall was also completely across the board. It was cutting across sectoral lines. It didn't matter whether you're looking at large caps or mid caps. In fact, mid caps fell even more. There were almost 10 stocks declining for every one that was advancing. That was the extent and the nature of the fall today. No point in really naming too many individual stocks because it's a very wide fall that we've seen. But anyway, for reference, let's talk about the biggest Nifty losers. Trent, Tata Steel, BPCL, NTPC, Coal India, these were some of the weakest names. Actually, the fall was led by PSUs, both PSU banks as well as overall CPSE stocks. They were all really weak, and global commodity stocks were also facing plenty of headwinds. Then come the big boys. Stocks like Reliance didn't offer any comfort. A lot of the BFSI updates that came in over the weekend, that didn't really help matters. So whether it was IndusInd Bank, HDFC Bank, SBI, a lot of these stocks, Kotak Mahindra Bank, all of them under a lot of pressure today. The gainers were actually only 2 or 3 on the Nifty. Apollo Hospitals up and about, some green on Tata Consumer, and Titan managed to do well thanks to a pretty good third quarter update that came in. Actually, speaking of Apollo Hospitals, because of a lot of chatter around this HMPV virus, in general, healthcare and diagnostic stocks saw some green. So the likes of Thyrocare, Metropolis, Dr. Lal, also thanks to some positive brokerage commentary that came through on some of these names, these stocks were up and about. Important updates coming in, an important reaction in stocks. Nykaa's Q3 update solid. The stock was positive. Jubilant FoodWorks has done well in the third quarter. But again, the gains kind of whittled down by the time we were closing. Dabur is still very cautious on the third quarter. Angel One was reacting to the update. L&T Finance also on the weaker side after the third quarter update. An important mention here is going out to ITC because the stock is finally trading ex the hotels business. That explains the pressure. But it wasn't just that, because in the morning the stock opened about 4.5% down. Then, of course, overall weak market sentiment perhaps chipped in, and finally ITC was lower by about 7 to 8%. Coming back to the overall picture, the fall in India was far more pronounced than what we saw in many of the Asian markets today. While we were trading, European markets were holding up. US futures were also higher. So let's see. FBI selling is the critical watch point. And we now need to see, because the 200 DMA is gone, we now need to see if last week's low of around 23,460 thereabouts, whether that holds for the Nifty or not.
Surabhi, many thanks for joining us. That was the market action for you. And the rupee continues to fall. It's fallen to a new low against the dollar, pressured by the decline of the Chinese yuan. Strength in the US dollar, higher US yields and rising crude oil prices also weighed on the currency. Lata standing by now to take us through the currency market action. 85.82, that's the dollar rupee. Lata, what is the street telling you?
Well, the dollar index strengthened all of last week, and the expectation was, okay, it's thin market trading. But last week ended with a fresh bout of bad news for the Indian currency, you may say. I mean, it's not bad news, of bearish news, which is that the yuan, which until then was fighting the 7.3 mark, the PBOC was keeping it at 7.28, 7.29 to the dollar. It allowed it to cross 7.3, the renminbi, as of Friday evening by close of trade, and the offshore Chinese yuan, which we call the CNH, went beyond 7.33 to 7.36. So the reaction from the rupee was expected on Monday. Added to it was, of course, that big FPI sell figure which the market got over the weekend of 4,227 crores. There was somehow a hope that when the new allocations come for the new year, it could be positive. Now, therefore, how did the Reserve Bank react? It appeared last week that the Reserve Bank was defending 85.80. Now, this is the market perception because every time the currency came towards 85, 78, 79, there seemed to be a supply of dollars. But given the ecosystem today, rising crude prices, selling by FPIs, as well as the US dollar going to 109 index, the yuan falling, given the concomitant of circumstances, it appears that the Reserve Bank let go the 85.80 level. The currency went all the way to 85.84 in intraday trade and finished around 85.82, 83. It appears that some of the immediate causes may be over. For instance, the yuan. It may have expended and gone over. A further weakening perhaps is likely only after the Trump swearing in and announcements. But, that chatter is not uniform. There are some in the market who believe even a 7.4 before the Trump swearing in cannot be ruled out. And therefore, we cannot say with certainty that the bad news is over as far as the rupee is concerned. It does look that it will track everything. It will track how the US yields are going. At the moment, it looks like the dollar index has moved back from 109 to 108.5. But there is enough pressure on the rupee in terms of other factors like the yuan and the equity selling.
Lata, many thanks. That is the currency market action. And let's talk about specific stocks now. ITC shares opened at a discount of 26 rupees to Friday's closing price. This after the cigarette to FMCG company spun off its hotels business into a separate entity. ITC Hotels is expected to list by the middle of February. Shareholders will receive 1 share of the hotels business for every 10 shares of ITC. Mangalam is standing by with more on this much anticipated demerger. Mangalam.
Yeah, so if you look at the ITC stock price today, the cut that we've seen does not entirely reflect the market sentiment. A large part of that is by virtue of the 9 to 10 a.m. special session that took place today to discover the price of ITC Hotels itself. So if you look at the opening price today and the closing price yesterday, you would realize that the stock opened lower by 26 rupees per share, and that's the value that the street believes it has ascribed to the hotel business itself. More analysts on the street were expecting this range to be between 15 to 20 rupees. But, if you consider this difference as the final value for the hotel business, as of today, then, it is a little higher than what the street was anticipating. The proof of this, however, will be the day the hotel business lists, which is somewhere mid-February, what the expectations are given the timelines that the company is given. Just to jog your memory once again, ITC Hotels has about 130 properties with 13,000 rooms, and the company is looking at close to around 180 hotels with almost 18,000 rooms by 2030. 2/3 of that being managed. And if you look at the valuations at which all the hotel stocks trade, the street believes that ITC's place in terms of a multiple could be somewhere between Chalet Hotels and Indian Hotels, which is a leader, and at a premium to the sector itself at 37 times. But given the difference of yesterday's close and today's open, that 26 rupee mark values the ITC hotel business at close to around 54,000, but that's an implied value. What we really need to look at is the listing of the hotels business that happens mid-February. If valuations of 26 to 28 times are something to go by, then that share could list anywhere between 175 to 190 rupees a piece.
All right, Mangalam, many thanks for joining us. The major PSU bank stocks fell in trade today on the back of their third quarter business update. Shares of Union Bank of India down over 7% after its deposits declined by 2% on a quarterly basis. Indian Bank's deposit growth also declined by 1.3% on a quarterly basis, and Bank of Baroda's deposits grew by a modest 2% from the previous quarter. All the stocks closing deep in the red. Now, top FMCG companies have given their quarterly business update as well. Shares of Dabur traded in losses after the company said that it was cautious on the general trade segment. The FMCG company said its consolidated revenue might have grown in low single digits in December. It also expects flat profit growth on a yearly basis. Now, shares of Marico also slipping as the company expressed concerns over muted gross margins due to higher inflation in copra and vegetable oil prices. The company expects a modest operating profit growth for Q3 as a result of expansion, investment and brand building. Now, Ease My Trip co-founder Nishant Pitti says neither he nor his family will sell any more stake in the company this year. Remember, Pitti sold 1.4% stake in the company to meet, in his words, personal strategic requirements last Thursday. Interestingly, the term sheet for this exercise had mentioned that a 14% stake was on the block. However, Pitti tells CNBC-TV18 that he never planned to sell his entire holding in the company. He also resigned as CEO of Ease My Trip last week, and the post was filled by his brother Rikant Pitti, who serves as CFO. However, Nishant has since moved into the role of chairman, where he says he will focus on driving the company's international expansion plans. Take a look.
The initial intent was 10% of the block which I hold. That is 14%, 1.5% of the 10%, 1.4% of 14%. And as I told you, we still own almost 50% of the equity. This will be holding up. We can't just give you some timeline, but still, we are not selling anything right now. And that could be, you can say, that in 2025, we are not going to sell anything.
Well, that's Ease My Trip's Nishant Pitti. The government will launch the second round of PLI scheme for the steel sector. Sources tell us the total outlay would be around 4,300 crores. The revised scheme is aimed at boosting manufacturing of specialty steel and electrical steel. Remember, the first PLI scheme with an outlay of 6,300 crore rupees attracted investments worth 18,300 crores. And sticking with PLI, the Finance Ministry is learned to have approved an incentive scheme for electronic component with an outlay of 25,000 crores. Sources tell us the Ministry of Electronics and IT may consider expanding the scheme's outlay depending on the response it receives. Remember, the industry has sought a higher outlay of 40,000 crore rupees. That's a CNBC-TV18 exclusive. In court corner, the Supreme Court has directed the Karnataka High Court to hear all competition-related cases against Amazon and Flipkart. The Competition Commission of India had sought to move all the cases pending in multiple high courts to the Supreme Court. Now, it contended that parallel proceedings in courts could lead to conflicting orders. However, this move was opposed by both Amazon and Flipkart. The Karnataka High Court will now hear the cases from the 15th of January. Facebook's parent company Meta has moved the NCLAT, challenging a CCI order that imposed a 213 crore rupee penalty in relation to WhatsApp's 2021 privacy policy update. The NCLAT will now hear the case on the 16th of January. The competition regulator has alleged that Meta abused its dominant market position with the implementation of the privacy policy. Meta and WhatsApp were also asked to implement specific remedies within a defined timeline. Union Minister Ashwini Vaishnav has defended the proposed law requiring parental consent for those below the age of 18 to access social media and e-commerce platforms. Speaking to CNBC-TV18, the minister said that India does not need data protection laws similar to Europe, which he believes have stifled competition. Take a look.
If there is a bank account or any payment mechanism that a child is using, already there is a digital footprint available.
Sure.
So we have created a mechanism using virtual tokens and using the existing digital architecture. We should be able to have a seamless shift towards a digital compliance method in which we don't have to nobody should be required to go and say that, okay, this is my date of birth and this is, right? So all that stuff has been very well thought through, and the industry has been consulted. Industry is on board on this. They believe that this structure that we have created here, where we use the existing digital architecture and we provide a verifiable parental consent framework using the existing digital architecture will work very well. And that's very important also, because in today's world there is a big possibility of harm coming to children because of the exposure to a variety of platforms. So that's why it's very important that the benefits continue to accrue while the harms can be prevented.
Well, that is Ashwini Vaishnav there on the new rules, the draft rules of the data protection law. Up next, the Union Health Ministry says there is no link between cases of the HMPV virus detected in Bengaluru and the infections being reported in China. We'll be joined by ICMR's former head epidemiologist, Dr. Raman Gangakhedkar, as we try and separate the facts from fiction. Back after a moment.
Are being set up for the sea of visitors from India and abroad. And for the first time ever, the entire tent city will be mapped on Google Maps, making it very easy for tourists and devotees to navigate in the Mahakumbh Mela. The Mahakumbh is a big deal for the hospitality and other commercial sectors. The state is expecting a revenue of 25,000 crores, bringing a wave of opportunity to the region.
Well, it's been yet another record-breaking night for quick commerce platforms as India's consumers took to their phones to order in their New Year party needs. Now, apart from the usual party essentials, many interesting items like grapes, condoms, ENO, milk packets, and even men's underwear were ordered for in huge quantities across apps. But let's look at Blinkit first. Blinkit saw its highest ever orders and also its most orders per minute and per hour. And in terms of trends, last night saw the most number of chips and most grapes sold in a day. The biggest order Blinkit received was for 64,988 rupees from Kolkata. Now, Instamart too saw its highest ever orders, which was the double of last year. And what did consumers look for the most? Milk, chips, chocolates, grapes and paneer. And the biggest order came from a user in Goa for 70,325 rupees. Now, on Big Basket, orders for things like games, soft drinks, mixers were all up anywhere between 200% to 1,290%. Now, after 2024 turned out to be a year of the quick commerce boom, Zepto CEO Adit Palicha rang in the new year with 3 predictions for 2025. Now, he says that 2025 will be the year where quick commerce will start hitting scale comparable with e-commerce. Now, we've already seen the lines blurring between the two in 2024. Now, his second prediction is that this year, the quick commerce model will really be put to test. Succeeding in this scale will require exceptional execution, he says, which will be a challenge for every single player to be able to deliver. Thirdly, he says that the fundamentals of quick commerce will evolve dramatically and the unit economics to build operating leverage will also change. And finally, as Zepto also gears up for an IPO this year, Palicha says that the capital markets environment from private to public will also be different compared to 2024 and 2023. So from a year of its boom to its true test of scale, it will be really interesting to see how quick commerce evolves in 2025.
2024 has now become the 9th consecutive year of positive returns for the Indian equities, and that's the record. In fact, 24 was a year of record in many ways, the highest fundraise in a single year, the ever-growing domestic pool, and so on. But the big question is, what is in store for 2025? Will the rally sustain? Will the mid and small cap continue to outperform? These are the questions in the minds of the investors. So now, crystal gazing is always a challenge, but CNBC-TV18 has reached out to the biggest market experts to bring to you an Outlook 2025, the biggest market poll for the new year. In fact, it was a poll across 61 participants, including fund managers, HNIs, as well as institutional dealers. So let's begin with the first and the most important question. What kind of return should investors expect in 2025? Majority of the respondents expect
Now, the Union Health Ministry says there is no link between the cases of the HMPV virus that's been detected in Bengaluru and the infections reported in China. 2 infants who have contracted the virus in Bengaluru have no international travel history. 1 infant is recovered and has been discharged, and another is recovering as per health officials. Now, HMPV is a common virus and was first isolated in 2001. Archana is standing by now to take us through the details. Archana, take us through the details that we know of the HMPV virus, its symptoms and its prevalence.
Well, as you mentioned, this virus is not new. It was first isolated in Netherlands in 2001. But HMPV has gained attention amid a surge in cases, particularly among children under the age of 14 in northern China. Now, as the government has reiterated, currently there's no need to panic regarding the spread of this virus, and the Karnataka government has also reiterated that it's monitoring the situation closely in coordination with the health ministry. So what is this virus that everyone is talking about? Human metapneumovirus, HMPV. It's a respiratory illness with flu-like symptoms, and it's more common during the winter season, especially among the younger and older age groups with weak immune system. It can spread from an infected individual to others through coughing, sneezing, or personal contact. It's not limited to just China, but it's also prevalent across most Asian countries. The symptoms include cough, fever, nasal congestion, sore throat, and shortness of breath. Now, what are the precautions that people must take? Well, according to the Karnataka Health Department's guidelines, a lot of it is already known as public personal hygiene, but let's reiterate for our viewers. Now, people have been advised to cover their mouth and nose with a handkerchief or a tissue paper while coughing or sneezing. They should wash their hands often with soap or water and clean it with sanitizer. They should avoid crowded places, stay away from public places while having a fever, cough or sneezing. Unlike COVID-19, there is no vaccine or specific antiviral treatment for HMPV. Back to you.
All right, Archana, appreciate you joining us. And to take this discussion forward, we're now joined by Dr. Raman Ganga-Khedkar, the former head scientist of the Epidemiology and Communicable Diseases Division at the Indian Council of Medical Research. Dr. Ganga-Khedkar was also the face of the ICMR in government briefings during the onset of the COVID-19 pandemic and was a very regular guest here on CNBC-TV18. Dr. Ganga-Khedkar, always a pleasure. Many thanks for joining us again here on CNBC-TV18. Let me start by asking you, sir, whether this is a cause for concern, it is a cause for panic, and what would you like our viewers to know about this particular virus?
What is most important is people do not know that this virus was present in India for a fairly long period of time. This virus has a prevalence rate of almost 4% across countries in the world. If you look at a publication that came from National Institute of Virology, it shows you very clearly that among patients who are having acute respiratory infection, now this is a story of 2016 to 18, among them, the prevalence is 3.4%. Among those who get admitted with severe respiratory infection, which we used to call then during COVID times and even now as SARI cases, it goes down to close to about 2.6%. Now, this virus is known to exist. There is no reason to believe, since there are no publications from China, that it has mutated enough to increase the mortality or morbidity that is associated with any virus. So there is no reason for us to fear at this point in time and create this kind of panic, which is unnecessary to my mind.
Yeah. Yes. So importantly, what you're saying is that this is not a new virus. It has been prevalent in large parts of the world, including here in India, for several years now. And at this point in time, there is no evidence to suggest that there is any mutation that's taken place of the cases that are being reported about in China. So no cause for panic or alarm just yet. Of course, it's always good to be vigilant. But Dr. Ganga-Khedkar, the next question then is, and this is what everybody is reacting and responding to now, should we get tested? The question is, what should you get tested for and what tests are we even talking about?
You can do RT-PCR to diagnose it. You can do a test which detects, I would not name because it is not considered as ethical in our profession. Some names tend to exist where you can test any kind of virus. But do I need that test? Absolutely not. Yeah. Because as I said, the risk of mortality or severe disease is so low that there is no reason for us to unnecessarily go for testing everybody, whoever has these kinds of milder symptoms per se. What is also important to remember is, as I said, this infection occurs in India. It tends to occur in winter season. Now, even winter season is almost at the end of its own slot, no? Yeah. In terms of weather. Why am I panicking? I really don't understand. There is no reason.
Well, yes, and that is why we're bringing experts here to speak about this to our viewers. And you're essentially saying that at this point in time, please don't go out rushing to find tests and so on and so forth. Only unless your symptoms are severe will a doctor prescribe any particular kind of further investigation for you. So don't go around looking or go out and start doing RT-PCR tests, etc. That's what Dr. Ganga Khedkar is advising at this point in time. Which also brings us then to the question of the kind of symptoms associated with this. In fact, all the publications that I've been looking at from Cleveland Clinic and so on and so forth, the symptoms are pretty much similar to a common cold, and in very few cases do they result in severe illness. Is that correct?
Absolutely. Absolutely. No, this test, even if it is done among patients who have severe acute respiratory infection and they get admitted, we must remember this could be a concurrent infection. The person must be having some other disease. So there, perhaps you may do it, but this particular infection is unlikely to cause a major problem. And that's something which we have to keep on informing people. And what is most important is everybody has to understand one thing. During even COVID time, which occurred incidentally in December, as it was reported from China, and the fact that the reports are coming from China, just social media is influencing our thinking so much that we are panicking for no reason. I think it is time the government has taken all kinds of right steps. What is also important is we have to devise strategies as to how to handle social media at this juncture, because perhaps social media related messages travel faster than viral.
Yes, that certainly is a challenge that you speak of, Dr. Ganga Khedkar. But what we can do, of course, is to put out information, to put out facts, to put out expert opinion like yours that will help our viewers make better informed decisions. So at this point in time, as Dr. Ganga Khedkar is very clearly articulating, this is not a Chinese virus. This is a virus that is prevalent in large parts of the world and has been prevalent in India. And this is something that we need to be mindful of, but this is certainly not something that requires us to push panic buttons just yet. Always a pleasure. Appreciate you joining us here on CNBC-TV18. With that, it is time for us to wrap up this edition of Business 360. The news will continue here on CNBC-TV18. We're back in a moment with more.
Mid-double-digit return in 25. Only 11% of the respondents expect a negative return on the Nifty next year. In that case, will the broader markets continue to outperform in 25? Surprisingly, 50% of the respondents believe that 25 will be a year of large caps. Only a small percentage are still betting on micro cap and small cap stocks, which brings to the next big question, and that is the biggest theme to bet on in 2025. Here there is a surprise. First surprise, financial has emerged as the biggest theme to bet on for the next year, and that is despite the macro challenges that the sector is facing and the fact that they have been an underperformer. The other surprise was the stellar outperformer of 24, which was capital goods. That's been considered as the least preferred bet going into 2025. We spoke about the returns and the big themes. Now, what's going to drive all these returns? And the near consensus answer is earnings, earnings, and earnings. That's going to be a dominant factor for the Indian equities to outperform going into 2025. There was a small portion who also believe that the Trump policies could be interesting to watch out for. Now, we spoke about the macro, the micros and the themes. Let's focus on some of the macros as well. Q2 was a bit of a shocker as far as the GDP figure is concerned. And after that, many on the streets have trimmed down their growth forecast for the country for next year. But will the growth surprise on the upside? We asked that question to majority. Most of them believe that the GDP growth will be between 6.25 to 6.5% in 2025. Only a mere 3% expect the growth to fall below 6%. So that's a big GDP growth forecast. So what's going to drive the GDP growth? And that's where the consensus seems to be, and that is the government spending. 77% of the respondents believe that government spending, which was a lackluster in the first.
Hello and welcome to Startup Street. I'm Shruti Mishra, and with me are Arundhati Ramanan and Ritu Singh. These are the top headlines from the startup space. Tablespace founder and CEO Amit Banerjee passes away at 44. The news comes at a time when the company was planning to hit the IPO market in 2025.
Union Minister Ashwini Vaishnav defends the proposed law requiring parental consent for those below the age of 18 to access social media and e-commerce platforms. Industry will get 2 years to comply with the new rules. Minister adds India does not need data protection laws similar to Europe, which he says is stifling competition.
The Supreme Court has directed the Karnataka High Court to hear all competition-related cases against Amazon and Flipkart. The Competition Commission of India had sought to move all the cases pending in multiple high courts to the Supreme Court. It contended that parallel proceedings in courts could lead to conflicting orders. However, this move was opposed by Amazon and Flipkart. The Karnataka High Court will hear the cases from January 15th.
Facebook's parent company Meta has moved the NCLAT challenging a CCI order that imposed a 213 crore rupee penalty in relation to WhatsApp's 2021 privacy policy update. The NCLAT will now hear the case on the 16th of January. The competition regulator has alleged that Meta abused its dominant market position with the implementation of the privacy policy. Meta and WhatsApp were also asked to implement specific remedies within a defined timeline.
Ease My Trip co-founder Nishant Pitti says neither he nor his family will sell any more stake in the company this year. Pitti sold a 1.4% stake in the company to meet personal strategic requirements last Thursday. Pitti had also resigned as CEO of Ease My Trip last week, and the post was filled by his brother Rikant Pitti, who served as CFO. Well, those were the headlines we've been tracking for you this evening on What's Brewing. Global venture capital firm Accel today announced that it has raised a $650 million early-stage fund dedicated to supporting bold founders in India and Southeast Asia. 16 years after opening its India office, Accel's latest fund, its eighth in India and Southeast Asia, will partner with early-stage founders to build disruptive, category-defining businesses that create meaningful impact. To elaborate more on this, joining me now is Bharat Shankar Subramanian, partner at Accel. Bharat, welcome to Startup Street. Now, like I mentioned, Accel's latest fund plans to fuel the next generation of category-defining startups. How many startups are you looking to invest in with this fund, and in what sectors? Also, what will be the ticket size of the investments you make?
Thanks, Shruti. Thanks for having me. We are very excited about this fund. This is our 16th year in India. We've been primarily early-stage investors. Our core philosophy has been to partner with companies, bold founders, working on really visionary, disruptive ideas from a very, very early stage. And we'll continue to do that with this fund. This is our eighth fund for India. And our thesis areas essentially span across four broad categories: consumer, AI, fintech, and manufacturing. So these are the four broad themes that we're excited about. And we have multiple different ways of partnering with companies, from our early stage fund, from our Atoms program. And we are super excited about the next decade and beyond for India.
All right. The ticket of investments, can you tell us how much that would be?
So we start very early. So with Atoms, it's anywhere from about $250,000 to $1 million.
Okay.
And from our early stage fund, we can invest up to 8, 10, 12 million per company.
All right. Like you mentioned, Bharat, Accel will continue to partner with founders in AI, consumer brands, fintech, and manufacturing. But I believe you have also identified subcategories of focus within each of these themes. If you could elaborate on that.
Yeah. So for AI, essentially, the way we're looking at the market, India is the #2 talent market globally. We have 15 million plus developers. So there's a lot of talent, to build in the AI space. Within AI, we are specifically looking at enterprise AI. These are platforms that enable enterprise AI use cases using agentic technologies, LLMs, SLMs, services as software. AI startups essentially taking advantage of India's large IT services capabilities to provide better automation. And then vertical AI, this is essentially what vertical SaaS was before, but these are startups essentially taking advantage of India's large AI talent pool to integrate AI into specific vertical specific use cases. So that's on AI and some of the areas that we are looking at within AI. On consumer, there's a very large internet user base in India, over 900 million plus, over 350 million transacting users, and about 40 million plus affluent households. So within the consumer segment, we're essentially looking at three broad categories. Bharat, which is essentially the 100 million households in tier 2 plus India that are becoming more and more addressable thanks to the digital rails that have been built over the last decade.
Okay.
Then India native models. So these are essentially Indian consumers who are expecting higher levels of service, leading to uniquely Indian business opportunities and aspirational brands.
Okay.
So that's within consumer. Yeah.
All right. Bharat, let's now talk about some trends that we're seeing. While India's public markets have grown 3x over the last 10 years, VC-backed companies represent less than 5% of the market capitalization. Now, with over a dozen companies listing last year and more than 2 dozen startup IPOs lined up for 2025, what is your view on this?
Yeah, I mean, it's been a great evolution, right? So a decade back, a lot of the questions that we used to get was, do public markets really look at startups? How will they value them, reward them? That has really changed. So we have a healthy stream of companies that are now prepping to go public. I think, what has flipped in the last 4 or 5 years is, founders now coming in and, telling us that, hey, we are now actively and seriously considering going public. Let's work towards this, right? So better unit economics, more sustainable models, and then access to public markets funds to build something that's more long-term and enduring. I think these are the changes that have happened in the last few years, and we are very, very excited about that.
All right, one final question before I let you go, if you could quickly answer that. Accel's early stage scaling program, Accel Atoms, that you also spoke about earlier, now in its 4th iteration, has supported 36 startups to date that have collectively raised over $200 million. In the past 2 years alone, Accel invested in over 27 AI startups in India or by Indian origin founders. What does 2025 look like for Accel?
Yeah, for Atoms, essentially, we are running 2 cohorts now, AI and Bharat. So these are 2 streams where we're actively looking for companies, founders to work with. And we will continue to sort of look at new thematic areas. And the way we do it is essentially a prepared mind approach where we work on thesis areas that we think will be material and relevant for India over the next decade and essentially come in early. And Atoms gives us a way to do that in a fairly swift manner.
All right. On that note, it's time for me to wrap up our conversation. Bharat, many thanks for joining us today on Startup Street. Wish you the very best for all your growth plans.
Thank you so much.
Moving on, it's only been 8 months since Chennai-based SaaS major Freshworks got a new CEO. And his first interview with CNBC-TV18, Dennis Woodside, also made his first big prediction for the new year. He says SaaS pricing models will change in 2025. Jude Sanith caught up with the new Freshworks boss on the sidelines of the Chennai Marathon to talk to him about pricing, AI adoption, layoffs, and his passion for running. Here's a slice of that conversation.
We've been the sponsor for the Chennai Marathon, including the 10K. I think this is our 3rd time. And it's really exciting for us to get out here, to be able to support Chennai. There's 25,000 people who are running today, which is amazing. We have about 300 of our own employees running, so I really had to be here.
Talk to me a little bit about the decision that you took. How difficult was it as a new CEO who's just come into the company to lay off 660 employees at the get-go? How challenging was that for you?
Yeah, well, I took the CEO role in May of last year, and one of the things that we needed to do is make sure we've got the right people, the right team to take the company forward. Is obviously a tough decision. I'm really excited about where we're going. We've got an amazing position in our EX product line, which serves the IT department. We've got a great position in customer support as well. And our AI products are doing really well. So we've got a really bright future, really excited.
What exactly lies ahead that you're really looking forward to in 2025?
So I believe that we can become one of the defining software companies in our space and a true global player. We have customers all over around the world. Over 70,000 companies use Freshworks to run their company. And that's everywhere in the world. The very first business that ever was a customer of Freshworks actually was from Australia. So we've been global from day one. That opportunity is huge. Every company in the world has to automate their service operations. They have to use AI. They have to automate their IT department. That's what we do. So our market is every company in the world. That's a huge opportunity for us.
But I'm just wondering, Dennis, what's the big challenge for you as a CEO here?
I think a lot of what we're trying to do at Freshworks is to provide a lot more value for our customers and solve bigger and bigger problems for them. So those customers tend to be much larger, and that requires us to grow up as a company to be able to serve more complex needs. So that's the real challenge for us. How do we serve those bigger and bigger companies that are looking to us to solve their problems?
What are those big challenges that you hope to get around?
Well, every company that we work with is talking about AI and is trying to figure out how do they use artificial intelligence to improve their interactions with their customers, to make their employees more productive. So we've done a great job of building AI products that the market is finding useful. We reported this in our last quarter in Q3. We had over 1,700 customers for our Freddy Copilot product, which makes agents more effective. So our job is to make every one of our companies, we have 70,000 customers, not all of them are using AI, not all of them are comfortable with AI. That's what the opportunity is for us, that's what the challenge is for us.
Is there a timeline that you have for yourself in terms of when everybody will end up using AI?
I think in 2 or 3 years, the vast majority of our customers will be using AI.
All right. In fact, Sridhar Vembu of Zoho said there's just way too much SaaS going on, and that AI might lead to further productization on a scale and level that we haven't quite seen before. Do you foresee that being a problem that stares at you in the face at this time and place?
I think it's a real opportunity. So the traditional software as a service model is a seat license model. You pay a per agent price for the software. But with AI coming in, that's going to change. You're going to pay more on interactions. You're going to pay more on resolutions. And we're currently using a model for some of our products that's based on interaction. We're exploring resolution pricing as well. You're seeing some companies do that. So I think the pricing model will evolve and change, but the value to the end customer is going to be substantial, and that will enable us to build a big business.
All right. So while you see pricing models change, what's the one big trend that you look forward to in 2025 for the overall SaaS industry, AI included?
I think the 2024, AI for most companies was very new, and in software, we launched our first Copilot product into GA, general availability, just in February. So it hasn't been that long that we've been selling AI. In 2025, it's going to become much more mainstream. A lot of our customers are going to move into our AI products, and it's just going to be a way of doing business.
What kind of growth projections do you foresee or project as far as the SaaS industry is concerned in 2025?
Well, the industry has to provide value to customers, and that value can be improving the productivity of their workers. That value can be improving the customer satisfaction of their customers. So as long as we're doing that, there's going to be a lot of growth ahead of us. And the business is, as you said, quite large, already growing quite quickly.
All right. And will you hazard a projection in terms of how much the SaaS market will grow this year?
I haven't seen any projections. I know where we're going. I'm excited about our future. I think there's a lot of growth ahead for everybody in the market.
All right. And what's your one big prediction for 2025 overall that you could see change the game really in terms of SaaS?
Well, what we're working on is what we call agentic AI. So AI that can take actions on behalf of the customer. Think about if you need a return of a product that you want to ship back to the company that sold it to you. AI can handle all that. And so we're excited about agentic AI, enabling AI to do things on behalf of companies.
Well, and what's brewing today after the Delhi NCR region, Bengaluru and the UAE, electric ride-hailing company BlueSmart has announced its expansion into Mumbai. The rollout will initially allow select participants to access the service before it becomes available to the general public. Now, founded in 2019, BlueSmart now operates a fleet of more than 8,500 electric vehicles and has a charging network of 5,800 stations. For more on BlueSmart's Mumbai launch and its significance for the company, joining me now is Anirudh Arun, who is the co-founder and CEO of BlueSmart Fleet. Anirudh, thanks very much for your time here on CNBC-TV18. BlueSmart finally entering what is a fairly challenging and competitive market in Mumbai, dense traffic, high demand. Start by telling us your plans for the market, the timing of this launch, and what your overall expectations are.
No, thanks so much, and a happy new year to everyone. We are super excited to launch in the Mumbai market. As you know, it's one of the classic trinity markets of the country. BlueSmart is already present in Delhi NCR, which is Delhi, Gurgaon, Noida, Faridabad, and the surrounding areas, and also in Bangalore, where we service both the city as well as the airport. And we're expanding fast in Bangalore as well. Mumbai was the missing link, and we're very happy to venture into Mumbai on the 1st of Jan 2025 with an invite-only launch.
So what can customers in Mumbai expect then? Because BlueSmart claims zero cancellations, on-time arrival, transparent pricing, although your rush hour pricing was seen as surge pricing by some customers. How are you going to ensure all of these features are maintained in Mumbai's tough market?
We communicate beforehand, even during the rush hour pricing. I think we've always been very forthcoming and explained the logic behind what we do. And it's not the kind of thing that always leaves you jittery that, oh, what is the price of my trip going to be today? And that's the same logic with which we have launched Mumbai. There is absolutely no change.
Well, you have about 8,500 EVs in your fleet. How many more are you looking to add in the city? And will all of these be from the JSW MG Motors partnership itself? And how will you scale this over the near term?
I think the audience in Mumbai, just like in Bangalore and in parts of Delhi NCR, are very discerning. They want a certain level of service. So that's why we have decided to enter with the premium SUV class of MG ZS EV vehicles with premium driver partners. Whenever we enter a market, we go deep in that market. So it's not about launching the largest number of cities, but servicing all the use cases that our customers come to expect of us. So initially we are launching with a limited fleet in a limited geography with only rentals, airports, airport rides, etc., which we believe are going to be the go-to use cases upfront. But soon you will see that we will add, other product categories. We will launch, sedans as well, and we will keep informing you, before we do that. And we're very excited to, continue to grow along with the city's mobility needs.
Okay, Anirudh, let's also talk about the charging infrastructure that you're looking to set up for the Mumbai market. What are the plans on that front?
So the charging infrastructure upfront, BlueSmart has partnered with multiple public charging network companies, and we have opened up, charging through the BlueSmart, driver app, etc. We've exposed our driver partners to the public charging network, which is fairly, well developed in Mumbai. Of course, it's developing as we speak. So we are relying on the early public charging network, while in the background we continue to build our own charging infrastructure in the city as well.
Okay, you'd raised about $24 million equity last year, another $25 million from responsibility. Given that you have this, asset-heavy model where BlueSmart owns all the cars in its fleet, is this expansion into Mumbai going to require additional fundraising? Are you in talks with anyone at the moment?
We are committed to, putting in all the funds required to servicing the needs of customers in Mumbai. So as you will see over the coming, 3-4 quarters, we will continue to grow the fleet. We will continue to develop the charging infrastructure and deliver great experiences, 5-star experiences that people have come to expect of BlueSmart.
Okay, in terms of additional revenues, what are your
All right, on that note, it's time for us to head into a short break. But once we return, supply chain fintech startup QuidCash has raised $4.5 million in its pre-Series A round from a host of angel investors, including Piyush Jain and existing backer MintCap. We speak with Subhash Gupta, the co-founder of QuidCash, on the other side. Stay tuned.
Of this year will pick up in 2025. So that's going to be the big driver as far as the GDP growth is concerned. We had a record year as far as rupee is concerned. So we asked the question as to will that be a spoil sport into 25 as well. Most of the experts believe that the rupee is going to be ranged between 85 to 87 a dollar, while a small segment expects the currency to appreciate below 85 as well going into 2025. Also, we saw a new RBI governor taking charge, and that the first policy will be in 2025. So we asked the experts what to expect in terms of RBI action. It's a divided house there. 50% believe that the first rate cut from RBI will be in the Q4 of this financial year. However, a small portion believes that the stretch line could be as late as the third quarter of FY26. So that's the RBI action. Indeed, if the RBI has to cut rates, then how much is the rate cut that the street is penciling in? half of the respondents, which is 50%, believe that the rate cut going into 25 would be at least 50 basis points. So 50 to 75 basis points is what a lot of people are betting on. So that's the rate cut expectation going into 25. In fact, 24 was a very volatile year. We had a budget, we had general elections, multiple state elections, and so on and so on. But 25 could be a year of moderate returns, but the expectation is that the positive returns would continue going into 25 as well. That's the big poll from CNBC-TV18.
Well, the consolidation theme continued to play out in 2024, with 40 million tons of capacity folding up into the hands of Adani Cement and Ultratech. And over the years, Adani's foray into the cement space with a massive war chest has acted as a catalyst, triggering the race for capacity share, which has increased the competitive intensity. The top 5 players now account for more than 60% of the market. That compares with only around 40% 7 years back. The question is, will consolidation slow down from here on? Remember, the recent deals have been concluded at around $100 per ton mark.
Welcome back. You're still with us on Startup Street. Supply chain fintech startup QuidCash has raised $4.5 million in its pre-Series A round from a host of angel investors, including Piyush Jain and existing backer MintCap. Earlier in 2024, Quid had raised 5 crore rupees in its pre-seed funding round, led by MintCap Enterprises and Stone Park Capital. Joining us now to discuss this further, Subhash Gupta, the co-founder of QuidCash. Subhash, thank you so much for taking time out and being here with us on Startup Street. You know, you're a supply chain fintech startup, right? Can you take us through the gap that you're trying to solve for? What's on offer?
Sure. Thank you, CNBC team, for having me here, and wishing you and all the viewers a very, very happy New Year. Right.
Thank you so much. Happy New Year to you as well.
Thank you. See, we are actually working on tier 2 supply chain financing. So supply chain financing itself is a very, very old industry, but we are focusing largely on tier 2 supply chain financing, which is the end MSME. MSME is our borrower or a customer. So we provide the credit limits to MSME, who happens to be our borrowers, and who we work with is the large anchors. And these large anchors are B2B marketplaces, B2B e-commerce platform, the modern age large distributors. These are our anchors who have thousands and thousands of MSMEs or retailers to whom they supply the goods and services, and they further sell it to the end retailers. So we are into B2B supply chain, and we cater to tier 2 supply chain financing.
Right, to tier 2 supply chain financing. You've raised this $4.5 million from a host of angel investors, right? So if you could sort of take us through how you plan to use these funds. I know, you're going to use it towards technology and building your platform. So how do you plan to use the funds that you've raised?
Sure. Large portion of our funds is going to be used in technology. So we want to make our entire platform much more scalable and flexible. So today, for an example, right from speaking to an MSME to onboard, to assign a credit limit and to disperse an MSME, it takes around 8 hours. We want to bring down that number to less than 5 minutes. The entire B2B credit cycle has to be less than 5 minutes using a lot of technologies and infrastructure, associated infrastructure. We are also going to venture into B2B payments ecosystem. And apart from that, portion of the money is also going to strengthen our NBFC operations, which requires some ground operations and the supports, which requires.
Right. So 3 key areas there that you're using the funds for, and some new ventures that you're looking at as well. But, if you could sort of tell us, you've told us the kind of customers that you serve, but what's the typical size of the loans that you give? What about NPAs? And, how does this work? What about checks in place?
Sure. Our lending check size is anywhere from 50,000 rupees to 1 CR per borrower. At this point, we are at an early stage. We have not seen many NPAs. I mean, our current NPA rate is around 1%. But this year, since we are going a little bit aggressive, we have kept a target of NPA of around 2%.
All right. And so you serve around 8,000 users and partners with over 20 major companies in the FMCG, automotive, pharmaceuticals, and agricultural industries, right? Take us through the kind of partnerships you have, and how do you plan to grow this further?
Sure. So right now, most of the partnerships we have is these with large anchors, and each anchor is having around 50,000 to 2 lakh or 3 lakh MSMEs into their platform. And we want to continue to nurture these partnerships. At this stage, we are operating largely in South India, but we want to also venture into North India and west side of the India. So we are into conversation with more than 100 partners at this point. But we want to be responsible in terms of lending, and we want to serve our current customer base first. So we will grow from here. Right now, we are serving to around 8,000 MSMEs. With the plan we have in next 2 years, we want to make this number to 5 lakh MSMEs.
Right. So you have a primary, presence in the south of India, looking to move to the north. But if you could take us through the revenues you've made so far, and what are the targets that you've set for 2025?
Sure. So by the virtue of business, right, we are a revenue generating, but we are at early revenue generating company. Right now, I think I will talk about 2025 and 26. Our primary target is to increase the dispersal rate. So today we are doing around 70 lakhs to 80 lakhs per day of loan dispersals. We want to take this number to around 20 CR per day because the credit gap in the industry which we cater to is more than 40,000 CR. And even if we serve to a sizable portion of it, it's a huge industry which we have to cater. So that's the key target. And our net interest margins are anywhere from 7% to 11%, depends on anchor to anchor. So that's how we want to grow our business.
All right, Subhash, thank you so much for joining us on the show. We're completely out of time, but we wish you all the best on this journey going forward.
Thank you so much. Thank you so much.
All right, moving on. It's been a tragic few weeks for the startup community. The startup world has lost an entrepreneur today. Tablespace founder and CEO Amit Banerjee passed away at 44. The news comes at a time when the company was planning to hit the IPO market in 2025. Banerjee founded workspace provider company Tablespace in 2017. Before venturing into the startup, he was associated with Accenture for over 13 years. His sudden death just comes weeks after Rohan Mirchandani, co-founder of yogurt brand Epigamia, died of heart attack.
On that note, it is a wrap on this edition of Startup Street. From Shruti and me, goodbye and many thanks for watching, but stay tuned for more news and updates on the other side.
Replacement cost. Well, ICICI Securities says that cement majors like Ambuja as well as Ultratech, they have exhausted most of their cash reserves post the recent acquisitions. They add, except for a few NCLT cases, they believe that low-cost acquisitions are largely behind. And now the potential deals may command a significant premium to the replacement cost. That could make them much more unattractive on borrowed funds at low cement prices. Well, the pain point is,
2024, we know, ended with positive returns, about 8 to 9% on the headline indices, but about 23-24% for the mid and small caps. But the big question is, what's in store for us for 2025? Nimesh has done the most comprehensive market poll, and he joins in to give us the answers. Nimesh.
2024 has now become the 9th consecutive year of positive returns for the Indian equities, and that's the record. In fact, 24 was a year of record in many ways, the highest fundraise in a single year, the ever-growing domestic pool, and so on. But the big question is, what is in store for 2025? Will the rally sustain? Will the mid and small cap continue to outperform? These are the questions in the minds of the investors. So now, crystal gazing is always a challenge, but CNBC-TV18 has reached out to the biggest market experts to bring to you an Outlook 2025, the biggest market poll for the new year. In fact, it was a poll across 61 participants, including fund managers, HNIs, as well as institutional dealers. So let's begin with the first and the most important question. What kind of return should investors expect in 2025? Majority of the respondents expect a single to mid double-digit return in 25. Only 11% of the respondents expect a negative return on the Nifty next year. In that case, will the broader markets continue to outperform in 25? Surprisingly, 50% of the respondents believe that 25 will be a year of large caps. Only a small percentage are still betting on micro cap and small cap stocks, which brings to the next big question, and that is the biggest theme to bet on in 2025. Here there is a surprise. First surprise, financial has emerged as the biggest theme to bet on for the next year, and that is despite the macro challenges that the sector is facing and the fact that they have been an underperformer. The other surprise was the stellar outperformer of 24, which was capital goods. That's been considered as the least preferred bet going into 2025. We spoke about the returns and the big themes. Now, what's going to drive all these returns? And the near consensus answer is earnings, earnings, and earnings. That's going to be a dominant factor for the Indian equities to outperform going into 2025. There was a small portion who also believe that the Trump policies could be interesting to watch out for. Now, we spoke about the macro, the micros and the themes. Let's focus on some of the macros as well. Q2 was a bit of a shocker as far as the GDP figure is concerned. And after that, many on the streets have trimmed down their growth forecast for the country for next year. But will the growth surprise on the upside? We asked that question to majority. Most of them believe that the GDP growth will be between 6.25 to 6.5% in 2025. Only a mere 3% expect the growth to fall below 6%. So that's the big GDP growth forecast. So what's going to drive the GDP growth? And that's where the consensus seems to be, and that is the government spending. 77% of the respondents believe that government spending, which was lackluster in the first half of this year, will pick up in 2025. So that's going to be the big driver as far as the GDP growth is concerned. The other important factor was the rupee. We had a record year as far as rupee is concerned. So we asked the question as to will that be a spoil sport into 25 as well. Most of the experts believe that the rupee is going to be ranged between 85 to 87 a dollar, while a small segment expects the currency to appreciate below 85 as well going into 2025. Also, we saw a new RBI governor taking charge, and that the first policy will be in 2025. So we asked the experts what to expect in terms of RBI action. It's a divided house there. 50% believe that the first rate cut from RBI will be in the Q4 of this financial year. However, a small portion believes that the stretch line could be as late as the third quarter of FY26. So that's the RBI action. Indeed, if the RBI has to cut rates, then how much is the rate cut that the street is penciling in? Half of the respondents, which is 50%, believe that the rate cut going into 25 would be at least 50 basis points. So 50 to 75 basis points is what a lot of people are betting on. So that's the rate cut expectation going into 25. In fact, 24 was a very volatile year. We had a budget, we had general elections, multiple state elections, and so on and so on. But 25 could be a year of moderate returns, but the expectation is that the positive returns would continue going into 25 as well. That's the big poll from CNBC-TV18.
We are going to speak to two veteran fund managers about what the year ahead holds for us. Let me welcome our guests for the day. Joining us are two market veterans, Sameer Arora, founder and fund manager at Helios Capital, and Sunil Singhania, founder of Abacus Asset Manager. For starters, what is the philosophy a stock picker should assume? Bhagta hua ghoda ki piche, the one that's already performing for us, the EMSs, the e-commerce, the mid-caps, or do you go to the one that did not perform, the HDFC banks, ICICI banks, Reliances of the world?
So, I think the last 4-5 years have been pretty good for all investors, and obviously the returns have been outsized, and obviously stocks which were like the obvious ones have not performed as well, but obviously the broader markets have done much better. 24 also is similar. If you actually see, Nifty has been more or less like 10-11% in terms of returns for the calendar year, though the broader markets have returned anywhere between 20 to 30%. I think going forward, it's going to be a little bit of a challenge. We're already seeing that, and as you rightly said, there is a lot of momentum in the so-called narrative themes, and maybe rightly so because they have growth. However, as value conscious and more fundamental long-term driven investors, we are sticking to stocks where valuations at least have certain growth which you are able to build in. And valuations at any price obviously has not been our strategy. So it's going to be a challenging year ahead, though we remain optimistic. And I think as long as we as well as investors are happy with decent mid-teen kind of returns, I think we will follow our same strategy of focusing on fundamentals.
But it's going to be a challenging year, and making those 10-15% kind of returns, according to you, Sunil, is not going to be easy. So how would you construct your portfolio? What would be the advice? What would be the mistakes to avoid this time? And also, do you think earnings will make a comeback?
So on the second question, first, I'm very sure that earnings will come back. Obviously, December will be slightly better than September. But we do expect, the March quarter onwards earning to trend back to the double-digit growth. If that doesn't happen, then India does not qualify to be a growth market and will not obviously attract the kind of P multiples which it has been. But we are quite hopeful with the government spending coming back, monsoon's good, and the festive season as well as the wedding season in full swing. I think from now to June, which is pre-monsoon, activity should really pick up, and so would be the earnings. On your first question, actually, what typically happens is that obviously everyone likes momentum and everyone likes to be in stocks which are moving. And what has happened over the last, obviously, 6-12 months is that the segments which were mentioned, like EMS, to some extent, even the narrative sectors like defense, railways, after a big jump, they have sort of slowed down a little bit, but there is still interest. And there is this segment, I call it, the market cap from 101 to 250. I think that is the most overpriced segment of the market, and largely because mutual funds which are mid caps have to compulsorily invest in that segment. And there are good stocks there, but if you see the valuation, nothing is below 60-70 PE there. So I think there is a sort of a issue of money coming in, and therefore funds having to buy the stock. And obviously when momentum is there and the price keeps on moving, the others are forced to invest in that. So I think it's going to be a tough time sort of resisting stocks which are moving up. At the same time, valuations at some point of time will start bearing on the stock price movements.
So since stocks where the market capitalization, if you rate it from highest to lowest, between 100 to 250 you're saying is highest, where we've seen maximum exuberance and valuations, etc. So would you bet with large caps and even small caps then?
So I think the good thing about India is that we have so many listed companies, and though our view is that IPOs are significantly overpriced, there are some decent companies which are also going to be listed over a period of time, which are already listed and going to be listed over a period of time. And as a portfolio manager, all you need is, maybe 5, 6, 7 good picks in a year, the new ones, and you are home. And I think with this large number of companies which are listed and the markets as well as the economic environment being so dynamic, from time to time one ends up, finding a few bets which you can look out for. So I think at this point of time, what we are trying to do is in our funds, which are like we have an all-cap fund, which is more a mix of large and mid. We have increased our weightage slightly to the large cap. On the other hand, we have a pure mid and small cap fund. There we are 100% mid and small cap. But I think what we're trying to do is shift towards companies where earnings are a little bit more visible and more sustainable in the near term also. So our experience over the last 6 months has been that when the markets have also been a little bit challenging, companies which have demonstrated resilience as far as earnings have ended up doing much better than otherwise. And I think a little bit of more focus on near-term earnings is also what we are more concentrating on.
Sunil, interesting you mentioned that IPOs made money, but you're saying that many were overvalued. Money Control did a study and 60% of the IPOs are actually even now making money for the investors. Of course, some of them are outstanding, like that Jyoti CNC. I think it was 300% or something above issue price. you don't think the IPO market is frothy, is it? You're saying that people are getting away with unreasonable valuation?
So I think right now the interest level is like crazy. And when interest levels are such crazy, you obviously will have in the near term, pricing also reflecting that. But, we are not here from a 3-6 months perspective, I think we have still not seen a major drawdown as far as the broader markets are concerned. The markets have been flattish last 6 months on the Nifty, but broader markets have been, I would say, pretty decent. I think once the valuations start to reflect the reality, that is when some of these companies, at least as stocks, would face a challenge. And the other thing is, Lata, what happens is when a company comes in for IPO, obviously there is a very limited history of performance in various cycles. And one is relying completely on the guidance given from a next 2-3 years perspective from the investment bankers and management. And no one gives negative guidance. Everyone's guidance is superb. So a company which has made 100 crores over the last 20 years cumulatively is expected to make a profit of 400 crores in the next 2 years. And you are willing to give the benefit of doubt till it comes. So I think let the result season start for these companies in the next 1 or 2 years. We'll know, how many of them end up doing better. But as I said, there are definitely good companies which are hitting the market. And there are companies which are maybe good, but overpriced. And then there's a third lot which are not good and overpriced. So, one has to be careful about the 3 buckets.
Yeah, absolutely. Sunil, tell us what could be the red flags that you would watch out for? I mean, not a worst case, but likely red flags.
So the good thing is that India still stands out. I am very sure that we will head back to the 6.5% growth rate. Obviously, Trump coming in will lead to a little bit of rhetorics. Obviously, he's known to speak a lot. But, every politician speaks a lot and not everything what they speak ultimately gets implemented. So once he takes power, who comes to power, we'll see what happens. But we are already seeing some, movement on the currency side. Indian rupee has been resilient but still depreciated by 2.5-3% over the last couple of months. I think that movement has to be watched very carefully because depreciating money will push back maybe the likely FI inflows which we are expecting in 25. The other red flag is purely earnings. I think as long as corporate India keeps on reporting earnings which are 12 to 15% year-on-year growth, I think the macro are pretty decent. We are heading to the next 4 years, 5 years of this new government. Hopefully the budget will be pro-growth, which always happens in the first 2-3 years of a new term. We have decent foreign exchange reserves. I think there is a lot of government spending which is lined up. Companies are quite optimistic. And we are also coming out of maybe a 12-15 months of a lull as far as consumer spending is concerned, and that should also come back. So I think we are heading to a nice 2-3 year setup. I think the only thing we need is the corporate profit to come back, and that also hopefully from March will come back. From a global front, as I said, rhetorics and talks would maybe cause near-term ups and downs, but I don't see a major issue even there.
But doesn't it worry you that urban consumption has been falling? I mean, not just the warning from Godrej. Did you just see the Bajaj Auto sales also down, about 1.5% year-on-year? Will that not be an issue?
So, there are segments, obviously real estate. Everyone was selling apartments in Bombay at 1 lakh and 1,50,000 rupees a square feet. Now there are only that many, Indians who would be able to afford those kind of apartments. And suddenly, you have buildings coming in left, right and center. Everyone is going in for redevelopment. And there is going to be a lull at some point of time. Though we are quite optimistic about the real estate sales, but I don't think prices can go further from here. As far as auto is concerned, I think auto in India, two-wheelers and four-wheelers on the passenger side, has never seen volume growth consistently of more than 5-6% year-on-year. So I think it's not a surprise. And the other thing which you have not to forget is that the number of players are increasing. So maybe the volume overall is growing at 5-6%, but the listed guys are not able to retain their market share, which is happening in a lot of places. I was speaking to a major tile company, and this is the segment is growing, but there are new players coming in from Morbi who are now selling in their own brands. So it is getting, a little bit more competitive. And I think that is going to be the case. I think one thing which we should not forget, Lata, is that capital has been available in plenty, and hopefully that will be available in plenty. Now, capital raising is good for the companies, but we also have to not forget that it breeds competition. Because if a company is able to raise 1,000, 2,000 crores of capital, the ability of that company to compete with existing players increases quite meaningfully. And we are heading into a phase where maybe the ROEs, which were 17-18% for Indian corporates on a consistent basis, might fall to maybe more around 15-16%.
Thank you so much for joining us, Sunil. Well, with that, let's take our first break. We will take this discussion forward in a minute after this break with Sameer Arora, founder and fund manager at Helios Capital.
Intensity has led cement prices plunging to 4-year lows. Demand as well has been plagued by general and state elections, heavy rainfall in few regions of South India, the construction ban in NCR region, and also labour unavailability in various parts of the country. But part of the street is optimistic that cement sector has hit rock bottom and it's ready to fight back. Well, Jeffrey says that dealers suggest that price declines have bottomed out, and now the industry is attempting price increases every month. They believe that the recent increase in industry consolidation further supports a case of revival in cement prices. Though sustainability of the price hikes will depend on what the leaders prefer, volume or price increases. Well, Goldman says that their channel checks suggest that demand is recovering, though on a low base. With the expected pickup in government capex, rural demand is likely to improve, and urban real estate market, well, that's doing well as well. So they expect that cement demand will grow by around 7% in FY26. On the profitability aspect, well, INCRED says that lower fuel cost, improvement in volumes, that could lift EBITDA per ton by around 160 rupees on a sequential basis. Though they admit on a year-on-year basis, it will still be down by around 200 rupees per ton. Axis Capital says that cement spreads are on recovery path. It's at the highest levels we have seen since January 2024. They add that spot spreads are now 12% higher sequentially, though it's still down by close to around 5% on a year-on-year basis. So 2024 has been a brittle one, both on pricing and demand. The hope is that 2025 cement will be in far better shape and it could deliver a far steadier performance.
India is in vogue for a number of international brands this season. Surabhi Upadhyay, CNBC-TV18, Mumbai.
Hello, I'm Surabhi Upadhyay and I am going to be joined by trailblazers who are transforming the banking and finance sector in India and around the world, only on CNBC-TV18.
Celebrating 25 years of CNBC-TV18.
From sharp insights in the political arena to all the excitement from the world of sports. We are here at the CNBC-TV18 budget headquarters as we've done for the last 25 years.
Celebrating 25 years of CNBC-TV18.
Welcome back to our special coverage Outlook 2025. We just spoke with Sunil Singhania. Now let's take the conversation forward on how markets may pan out in 2025 with Sameer Arora, founder and fund manager at Helios Capital. Sameer, first up, a brilliant 2025 to you from all of us here.
Thank you very much. And Happy New Year to you and Rima and all the people watching and everybody at CNBC and otherwise, all the Indians, of course.
Hey, nice to see you in the pink of health, Samir Arora.
I have to be colorful on day one because day one sets the tone.
You bet. Actually, if you looked at Nimesh's poll, clearly the market is going with what didn't perform this year should perform in 2025. Even the Dow, as Rima and I were discussing, Dow did only 12%, Nasdaq did 28% in 2024. And likewise here, the Nifty didn't do well, but mid-caps have done 26 to 30%. Do you think that trend continues, that we are not going to see the big boys, do so much?
So for me, the model, and actually for everybody, it should be like that, and maybe it is, that you take it from different pockets. You buy some stocks because they are growing well, but they have also performing well in the market, and some which are doing well but are cheap or value. And it is that combo of, buying some financials and some of these high growth stocks that you're talking about, these food delivery or otherwise, or whatever be the new growth. Also, if you look at the FIIs, it looks as if FIIs are selling, but they are effectively selling their current holdings and buying into IPOs and QIPs, which means they are also, in some sense, changing their portfolio from some of the older names that they may be having in consumer and auto and others, and buying into these new IPOs, which are, at least many of them or some of them, are offering high growth. So there is no point in ever talking about absolutely one or the other. Of course, you can have groups of sectors doing well and expectations of groups of sectors doing badly, but there is no overdoing anyone, I would say, because you really never know what fancy the market takes.
No, I agree. But, you're a veteran of, how many cycles in the market? Probably 30 years. So at this juncture, bhagta hua ghode ke piche hi bhago, EMS, e-commerce types, mid-caps. Yeah, put a larger share in the one that did not perform, HDFC Bank. I mean, you can't complain about the quality of some of these stocks, but not their best year.
So that's why we have, I think, a good description of these. One, which is what we call high confidence in reasonable return, which is these HDFC Bank or ICICI Bank or these big IT companies. You're not expecting to make 20-25% return, but you hope to make in high double digits, maybe 15, 17, 14, depending on the market. And you have more money than otherwise. And then you have these smaller, newer, faster growing, where you keep a limit on each stock and you diversify across the different themes and have, maybe in our case, maybe around 15, 18%, but that also in 5-6 stocks. And it is that combo which lets us sleep every day without overly one. If you say you have to make only one investment and that one investment is the marginal new investment, then also there's an easy answer. It depends on what you don't have. If you are too much in small and mid cap, then it is better for you to buy a large cap, stabler stock. And if you are only into the old stodgy companies, even though they are promising to be okay, you need a bit of variety and a bit of higher growth, higher risk. I think it's, in the end, portfolio construction adds at least a few percentage points. Because I'm a fund manager more than an analyst, and I always say that construction has helped us. Otherwise, investors will come to me and say, all my analysts are responsible for my performance. I say yes, but there was also this construction bit which added. So I would suggest to everybody, you cannot.
So talking about your construction, Samir, you're saying only 15 to 18% of your portfolio would be in some of these smaller, faster growing companies, while 85 to 90% or whatever, 80, 90% would be in these, large cap HDFC type bank. Okay.
No, the larger, well-known, these compounder names that were given, which spoiled their compounding immediately when that name was given, those are 50, 60%. Okay. These 18, 20% are these super high growth guys, which are these, 25, 30% and growing also, but making losses, maybe all these Paytm, Swiggy, Zomato types. And you still have a third group. No, these are the groups where you are discovering new companies and they might be a little valued a little cheaply, or their growth is a little high, but you're not expecting them to make 25 and 30% for 4-5 years. This could be Indigene types or these smaller hotels or something, which are not also super well known, not super well ready in terms of quality and history, but they are promising. And we are trying to discover some of them. So there are sort of.
Do you want to tell us some of these stocks that you're discovering?
No, we
like
don't
Indegene is
not
one.
tell you
Yeah.
anymore because now we are also separately in the mutual fund business. So you can see 100% of the portfolio every year, including the changes that the Indian guys make. And broadly, although I manage an offshore fund, because the research is common, many of these names will be there. But so you can see all of them yourself. There's nothing for me to highlight here separately.
Okay, you know, clearly since you manage global money as well, Samir, is there any chance of a global accident? I mean, not like the layman variety, but minor accidents like, you know, SVB or something, which takes away 10-20%, because we have a president who can do extreme things coming on Jan 20th.
Yeah, so right now the bet is that he will not. So first, let me talk about the US a little bit, global a little bit. You know, people talk that the US market has gone up a lot. Actually, maybe 15 stocks have gone up a lot. And if you even this year, the S&P's returns 50% are from 7 stocks. So therefore, if you see the Russell 2000, which is like the mid-cap index, or you see the S&P equal weight index, where all these guys are getting extra weight, the returns over the last 5 years are 9-10% per annum, which may be considered good in dollar terms, but they are not wild. And those 15 stocks, which includes these 7 that everybody talks about, even more, you know, you could go Spotify, Netflix, all these which have done very well. Those stocks separately look very, very good. We have nearly all of them except Apple, and they look very good separately. So the thing is, there may be an accident driven maybe by some policy thing, but I would think there is one risk, which big picture is considered positive, but in the small picture may be negative, which is that if really the US, because of Elon Musk and Vivek Ramaswamy and all, really are able to convince the US system to cut costs on government waste and all that. Now, that is a big part of the growth of the economy in the last few years, because the government spending, government deficit, all has led to this growth. And so if you cut that, big picture, it is supposed to be positive that government deficits are being brought under control and you are making the overall deficit sustainable. But it can lead. Now, but my hope is that these things don't happen immediately. You know, these things are not as straightforward as Trump signed some tariff things.
Thank you so much, Samir, for being with us on the first trading day and giving us the benefit of your advice. Wish you a very happy new year yet again. And with that, we wrap up this special coverage on Outlook 2025 for 2 market masters. Thank you.
Markets are betting big on affordable housing. You look at the kind of stocks that have risen.
We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating 25 years of CNBC-TV18.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18. Now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most.
Well, hello and welcome. You're watching News Center with me, Ashmit Kumar. Now, it's been a wait of 16 months. In August of 2023 is when the DPDP Act had been passed by the Parliament. 16 months later, here in January of 2025, we finally have the draft DPDP rules. There's a lot to unpack as far as these rules are concerned. Firstly, the government is insistent that this is a consent-based framework. Just a bit of trivia here. If you go through the draft rules, the third most used word, the third most used noun to be specific, is in fact consent. It's been used 56 times, and that is something that the government cites for establishing how it's seeking to build about a consent-based framework. So essentially, the companies will be reaching out to you, to me, as a user, asking for my consent for personal data. That, of course, is with respect to the consent-based framework, but therein lies the rub as well. Parental consent, a new framework being introduced here. In fact, some of the comments that came from highly placed officials within the ministry, they tell us that the Indian government, the Indian establishment is taking a qualitatively different approach, whereas not to ban social media or digital entities entirely for minors, for people who are not to the age of 18, but qualitatively, the different approach being used here is that a mechanism of parental consent is being introduced. The parents will have to authorize access for their children. But the mechanics of this, how will it really work? How will that consent be sought? Is the mechanism and is the coding in the rules very clear? That is something that the industry appears to be struggling with and, in fact, has cited on multiple occasions. Then, of course, there's the question of the obligations that fall on these data fiduciaries. It's Ashwini Vaishnav, I spoke to him over the weekend. He was quite clear that he does not want a repeat of the European example. He wants a more simple playing field that does not stifle innovation. In fact, speaking of the minister, let's go across to him and let's listen to his comments heading into the draft DPDP rules.
If there is a bank account or any payment mechanism that a child is using, already there is a digital footprint available.
Sure.
So we have created a mechanism using virtual tokens and using the existing digital architecture. We should be able to have a seamless shift towards a digital compliance method in which we don't have to kind of, nobody should be required to go and say that, okay, this is my date of birth and this is, right? So all that stuff has been very well thought through and the industry has been consulted. Industry is on board on this. They believe that this structure that we have created here, where we use the existing digital architecture and we provide a verifiable parental consent framework using the existing digital architecture will work very well. And that's very important also because in today's world there is a big possibility of harm coming to children because of the exposure to a variety of platforms. So that's why it's very important that the benefits continue to accrue while the harms can be prevented.
Well, that was the Minister of Electronics and IT, Mr. Ashwini Vaishnav, in an exclusive conversation with CNBC-TV18. But let's move forward with unpacking this entire conversation around the DPDP rules. To take this discussion ahead, I'm now joined by Aparajita Bharti, the founding partner of the Quantum Hub, as well as Mayuran Palanisamy of Deloitte India. Thank you so much for joining us, to both of our panelists. Ms. Bharti, let me come to you first. The word that the government is clearly stressing on is that, look, we have a consent-based framework. There's no denying that. There is a consent-based mechanism that has been introduced. What will it look like in the weeks and months to come? Are we expecting a number of notifications that will give me an accept versus decline option on granting consent for personal use? How does this look in reality?
Hi, Ashmit. Thank you so much for inviting me and a good start to the new year for all of us who have been waiting for the DPDP rules since 1.5 years now. I think, yes, the framework that we have in the DPDP Act is a consent-based mechanism. That is the only basis on which data can be processed for data principles. I think, however, the minister has also said that, there will be an implementation timeline of 2 years because this is a big shift for the industry. Every MSME, every big company every company of every size now is a data fiduciary, and they need to have systems in place to be able to implement these rules once they are notified. And these rules are also still under discussion. So I think we still have some time till we start seeing the effects of this.